of 8%. Yesterday, the breakdown was energy at the top in terms of your sectors and travel and leisure at the bottom. But again, it was a negative session for European equities. FTSE 100 futures pointed low by 0.4%. We'll see how much support comes through with oil above $100 a barrel, around 103. DAX futures and focus currently pointed low by 175 points. And the earnings story, of course, central as well. And maybe a bit of strength that will come through for the likes of Switzerland and France on the back of L'Oreal and Nestle. But also you've got ASML as well. Anna, in focus, some names for you as well.
Yeah, let's bring up some individual companies and some sectors that we are particularly interested in this morning. L'Oreal in focus after a pretty strong update from them. The ADRs were strong. Nestle in focus again, a strong update there, talking about snacks and coffee. Chip stocks, nothing to do with snacks, but chip stocks also in focus because some European corporates and SK Hynix out with some numbers. Guy.
Okay, let's show you some numbers. Let's give you an idea of what is going on. How's that all going to even out in the European session? FTSE 100, we've got oil stocks potentially on the move today. Keep an eye on what is happening there. But there's plenty of other stocks they're going to be moving as well. LSEG is certainly one that stands out for the FTSE 100. I'm interested to see how it trades this morning. So the FTSE 100 barely budging. Not much movement. That is, I suspect, a narrative we may see replicated elsewhere. But as Anna's been pointing out, a little bit of divergence when it comes to single stocks. That may show up at an index level. The FTSE 100 now beginning to tip a little lower. We're down by 0.5%. The Stock 600 down by 0.5%. The IBEX is down by 0.8%. The AEX, we'll look at ASML there, but also some of the other chip stocks down by 0.4%. We're expecting the CAC 40 maybe to benefit from a little bit of L'Oreal this morning on the upside, 6-7% potentially on the upside for that one. And the DAX clearly has something to digest. It is not open yet. Tom, what are we seeing when it comes to the sector story?
This is a similar picture to the sector breakdown that we saw yesterday. Broadly at the top of the list, energy gaining 0.5% with Brent at and above $103 a barrel right now. On the downside is travel and leisure once again down 1.2%. That's the biggest loser across your sectors. Banks also lower by 0.9%. Every single sector apart from three in negative territory so far in Europe. Very modest gains coming through for telecoms and personal care. That's where L'Oreal sits, of course. That sector's just turned negative. So just two sectors now in positive territory. Energy up 0.4%, Anna.
Yes, it is interesting that we've talked a lot about the chip story and how the chip story has been really quite positive for the European names, the likes of ST Micro, BE Semi. But then we were also watching ASML to see if we get negative reaction to the TSMC story, that they're not going to spend so much money on the ASML kit, or they're not going to spend on the latest ASML kit. And ASML is down, but only by 2%, which is sort of... I mean, it's a big name, though, so that's going to weigh on the AEX. But that's where we are. I think expectations perhaps set by ADRs, whether that could be lower than that. Interesting that LSEG is up by 1.6%, which in a market that is going downwards is not a bad performance. And Dassault Systèmes, just having a look at that one, that's up by 3.4%. Yeah. So is there something in this rethinking those stocks that were really beaten up by the SaaSpocalypse?
There's something odd going on with Kongsberg. If you're seeing it on your screen, Kongsberg is divesting its maritime business. So just be aware of that when you potentially see some odd things showing up on your boards. But I think it is interesting that you are seeing chip stocks kind of holding in there. Expectations are so high. So to continue to believe in that trade rather than going, now's the time to take profit, I think is quite a strong kind of indicator for future activity.
The thing I said about those beaten up by the SaaSpocalypse not helping SAP, though, which is interesting ahead of tomorrow, because SAP down by 3.3%. We've got a lot of ex-divs, though, so we'll just keep that in mind, as I mentioned that. We'll come back with a rundown of those. Let's get some more perspective on what's happening in these markets. Sharon Bell joins us, Senior European Equity Strategist at Goldman Sachs. Sharon, nice to speak to you this morning. Good to have you with us. So we're busy digesting a lot of European corporate earnings. What stands out for me from your analysis? and you can update us on this, because I think this was a few days ago, but the European, there was earnings growth, there has been earnings growth reported in the first quarter for Europe. It is substantially weaker than in the US. That was up by 4%, you were saying, for the first quarter. That was, as I say, a few days ago. I wonder how your thinking is evolving about European stocks as we watch this earnings season unfold.
So you're right. The first quarter in the US is likely to see double-digit earnings growth. It's very driven by certain companies, but nonetheless, double-digit earnings growth quite easily. Whereas in Europe, you're probably going to see a few percent earnings growth, also quite skewed. Banks and energy are probably going to give you a lot of that growth, whereas other companies, it's flat or even slightly down.
Right, okay, so that's the earnings story. And then the earnings story is just one of the things, one of the narratives that's running through the market at the moment. The other is around how much we can look through what's going on in Iran and higher energy prices, because look over here, we've got AI and tech stocks doing really well, in particular chip stocks overnight. How much can that story offset our concerns about what's going on in Iran, and for how long? Perhaps that's more the question.
Well, it's interesting. The US market's back at all-time highs, isn't it? And I think that's because the AI story absolutely does offset those concerns, because the companies exposed are so big within the stock market. In Europe, it's a smaller offset. It's still a little bit there. It's a smaller offset. The other offset, I guess, Europe has to the problems in Iran is that there are a lot of energy companies in the index. There are a lot of utility companies in the index that tend to benefit as power prices and energy prices go up. But yes, I'm a little bit surprised myself at how much equity markets, and especially Europe, have actually bounced from their lows. May have come off in the last few sessions, but they've bounced a lot from their lows, given that we still remain in this limbo and the Straits of Hormuz are not open.
When does that reality ever come in and impact investors, do you think? Like how long? We're all conditioned now for V-shaped bounces and to look through geopolitical events, and that instinct is so strong. Is it strong enough to just completely kind of whistle past the graveyard and ignore what is happening in terms of what is going on in the Gulf, which is a horrendous situation?
Yeah, and it's continuing, and the longer it continues, the more economic damage it will do, the more it will push up inflation, the more it increases the chances that with a higher inflation shock, you see central banks react more hawkishly, etc. And if you look at what happened in early 2022, and I don't think it's an exact parallel to the invasion of Ukraine and the rise in gas prices we had then, but if you look what happened, you did see lots of falls, lots of bounces, and then lots of further falls. So absolutely, we can look through it now, but then we do need to see the Straits of Hormuz start to open in the next few weeks. If you don't, then I think markets take that.
Do you have a date in mind? Do any of you guys have a date in mind? What do you talk about inside the company about kind of how much longer this can last for? When does it start to show up? What does it look like?
What we hear is that things like jet fuel and other fuels would be finding very, very difficult in Europe to continue to run the same number of flights by the end of May. If you don't have more supplies, that's no big surprise. You'll have to have demand destruction. You've already got some demand destruction in Asia, especially. And what's different again about that early 2022 period is that hit Europe first, whereas this is probably hitting Asia first, because the Straits of Hormuz supply Asia more quickly than they do Europe. It takes a long time for ships to come around. Europe has also got other sources of gas and energy, North Africa, the US, etc., more differentiation. But nonetheless, it will hit Europe the longer this goes on.
Is there a delayed effect in terms of the pass-on of energy costs that helps support that AI build-out? You said AI is immune. Maybe US AI is more immune, given their energy independence. But is there a potential delay in terms of the energy hit to the AI story at some point further down the line?
I mean, that's fair, because AI, of course, is also dependent on energy. We know it's very energy hungry as a technology. I mean, of course, I think it will encourage more efficiency over time, and AI is getting more productive with less energy, for sure. But I don't think it will stop the rollout, put it that way, of data centers and things like that. I think it's extremely unlikely to stop the rollout. But I do think it's a factor as well in causing more energy demand in an environment where we're very restricted in supply.
Back to the earnings story, and a stock that Anna's been fascinated with today, and rightly so, because it's up about 9%, which is L'Oreal. And it's another reminder that there are companies out there that kind of match fit after the challenges of COVID, and that they can pass on prices. Their expectations, they may have to raise prices, and they've mapped out the cost of barrel per oil in terms of what that means for revenues. Other companies have talked about the ability to pass on costs and prices. Is the consumer, are customers able to do that? Are we underestimating how well prepared these companies are, or overestimating their ability to pass on cost?
It's a good question. It's the number one question, really, for the next quarter or two. Honestly, I do think companies will try and pass on a lot of the costs. Some companies will be successful because they have excellent brands, they have good products, etc. Other companies will find, and I guess there's another reason you can be successful. A lot of the chemical companies in Europe, as I said, they're competing against Asia chemical companies that are seeing their costs rise more. So actually, European chemical companies probably can pass it through. They often have contracts as well, which means that they can pass it through. So it would depend. You either have great contracts, or you're strategically advantaged, or you've got a great brand, you'll be able to pass it on. Consumers do have high savings levels, generally, in aggregate, not everybody, but the average consumer has a reasonable amount of savings, but the labour market is weaker than we were a few years ago. Coming out of the pandemic, the labour market was strong, and at that point, companies really could push through these higher prices. Now, a little bit more questionable.
Yes, because that was the story of the early part of this decade, the ability of the companies to pass on those higher costs and the inflation that they were seeing. So if we're looking at the macro momentum that we see from the European corporates at the moment, then, Sharon, we've got 60% of non-energy sectors, this is in European earnings, where we're seeing margin estimates coming down. This, according to your latest research, which just shows that if you strip out the energy story from Europe, things do look a lot weaker than they do if you keep the energy story in, which is sort of obvious. Sure. But that's a pretty fundamental story.
Yeah. I don't think earnings are collapsing. I just think, yes, if you take out utilities, if you take out the oil companies, then and there will be some companies with good brands, as we've just discussed, that can pass on higher prices, but many will start to see margins come off a little bit. And it's not just not being able to pass through the prices, it's probably also not seeing the demand that they saw previously when prices generally for all goods, including energy in our basket of things we buy, is going up.
It's great to see you, Sharon.
Thank you.
Thank you for stopping by to see us. We always appreciate it. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Let's take a look at some of the core in Europe and figure out what is happening there. Nestle on the right-hand side of your screen having a sensational day to the upside. Snacks and coffee, apparently. We are consuming more of those, and that is where the positive points come through. Luxury is under a little bit of pressure, despite actually what we're seeing with L'Oreal, which is performing very strongly. But the centre of gravity continues to be around the world, and you've seen it out of Asia, the United States, and to a certain extent in Europe this morning, what we are seeing in the chip space. So let's get there first. Chloe Melly has more.
Good morning, Guy. Indeed, we are in the green across that chip sector in Europe this morning. This follows STMicro's very positive results and bright outlook from this morning. And this is really driving the shares up almost 10% this morning, and also driving up the rest of that chip sector. The expectations are so high, but it seems that there is still a little bit further to run for that sector. Moving on to Heineken, which is in the red this morning. It is down a little over 2% after saying that volumes had fallen more than expected. It's really dealing with the impact of lower alcohol consumption, and out of all of its peers is the one that is worst affected, and so we are seeing that reflected in those shares this morning. Sainsbury's is also not doing so well this morning. It is also down more than 5%. It said that profit could drop this year because of consumer uncertainty and the higher costs associated with the conflict in the Middle East, so a little bit of a negative outlook there. Dassault Systèmes, the software company, however, is doing quite well. This is interesting given that this is one of the companies that was caught in the software sell-off from earlier this year, and therefore the expectations going into the earnings were a little bit pessimistic, but all the metrics came in either in line or above expectations, and so this is seen as quite reassuring. And finally, LSE Group, London Stock Exchange Group, which is one actually of the other companies that was affected by this software sell-off, is also doing well today, up almost 1%. But what is really driving that this morning is primarily its market segment, which has really benefited from this market volatility and this trading activity. And therefore, it said that it will be targeting the up end of its revenue growth guidance. And we're seeing that reflected in those shares this morning.
Chloe Melly, thank you very much indeed on some of the stocks on the move this morning. Some big individual moves across European names and earnings front and centre, of course. Coming up, we're going to talk more earnings, but with a focus on defence. Swedish aerospace and defence company Saab reporting better than expected first quarter operating profit. We will be talking to the CEO, Mikael Johansson. That is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Welcome back. This is the opening trade. We've got some breaking news coming out from France in the shape of PMIs. And I'll start with the composite number because this is big picture. We are seeing a drop down. This was already in contraction territory. So this is telling us something about a decline in growth momentum for the French economy. It's gone down from 48.8 to 47.6. And it's crucially weaker than had been anticipated. So that's part of the story. But underneath that composite number is a really interesting divergence where services is getting materially weaker. That's at 46 as the handle there. And manufacturing has actually jumped and is much more positive at 52.8. So expansion in manufacturing, contraction in services is the latest at the coalface indicator we're getting from the French economy. I say the coalface, I should probably say nuclear because, of course, this is a much more nuclear-exposed economy. So maybe here is not where we see the real pain of what's happening in the Strait of Hormuz. But we'll keep watching these numbers.
Pretty certain they drive cars. But maybe there are a few more electric ones coming through, and maybe the impact comes through, particularly in industry. It was interesting to hear we talk about L'Oreal and what they're doing in terms of quantifying their impact, what they are going to see. So there is probably an effect in there. But why services have dropped back pretty sharply?
Yeah, but that manufacturing strength is quite pronounced. Almost 53, so comfortably in expansionary territory. The forecasts have been for below
which is the bigger part of the economy. Services.
Yeah. Services, yeah.
By some considerable margin. So if you're seeing that kind of weakness in services, what does that reflect in terms of consumer behavior? What are consumers doing right now that they weren't doing before? Is this a sign maybe that they're actually backing off some of the things they would have done traditionally?
And these numbers are quite far off estimates, aren't they? Which is also interesting, the fact that economists didn't anticipate this this particular divergence or this scale of movement. So we'll certainly keep that in mind. We are still talking about earnings, though, and specifically from the defence sector.
We are. So let's talk about what's happening with Saab this morning. The share price is on the move a little bit this morning. That's what it's doing, down by around 1%, but not a relative to kind of recent moves, relatively big move. In terms of what we are seeing, the Q1 operating line looks ahead of estimates. The sales line looks pretty kind of in line, but slightly softer than maybe estimates were looking for. The company's talking about the market conditions still being favourable. So what does favourable mean? Let's try and find out. We're joined by the Saab CEO now, Michael Johansson. Michael, thank you very much indeed for joining us. you talk about market conditions being favourable. Can you quantify favourable for me? Is it more favourable than it was before? Less favourable than it was before? What does favourable mean this morning?
Thanks for having me. Well, I mean that we have intensive discussions with many customers across Europe and elsewhere as well, both when it comes to sort of medium-sized potential contracts and big ones. So, I mean, the intensity is still as I've seen it earlier, but, you know, in the defense business, it's not sort of easy to say that you will get sort of exactly the big ones in which quarter, so you can't look at a single quarter. But I'm really pleased with the order intake also in the first quarter of which is on par with last year first quarter. So we have lots to do in the market and the demand is there. So that's what I'm trying to sort of quantify, but maybe not so clearly that as you expect. That's how it is.
As you say, fairly lumpy in terms of the order flow and exactly which quarter things show up in, difficult to predict. Are you seeing more interest out of Europe? Are you seeing more interest out of the Gulf? Where is the new business? Where are the new conversations happening right now?
Well, I think in Europe we still have lots to do in terms of both filling magazine depth. So we have magazine depth on conventional things, but also initiating autonomous capabilities in many countries, and especially in the region, the sort of the Nordic, the Baltics, Poland, Germany, UK. In that region, I think the awareness of the threat to the East is sort of substantial. The support to Ukraine is substantial. That hasn't changed either. So we see lots happening there. But also from the Middle East conflict, of course, there has been a huge demand now on sensor capability to detect sort of incoming missiles and drones across the region. So sort of urgent requests, which we have tried to fulfill and delivering in the short term. So yes, there has been demand there as well. But it's across the field. We still have discussions with Canada on a potential dual fleet when it comes to the Gripen and also the Global Eye in Canada. We have discussions, of course, from the meeting between President Zelensky and our Prime Minister last year on taking it forward with the Gripen in Ukraine. So there are many things ongoing.
Mikael, good morning. What is your current annual production capacity for combat weapons, and are you looking to increase that capacity?
Absolutely, and we have invested heavily on that side, and we still have factories coming into play both in the US and India, but we have taken into operations now 2 lines in Sweden this quarter. And that, of course, is supporting the growth of the company, and sort of the 23.6 organic growth is substantial. So, and that is helping now, and we have a big order backlog, so we need to get these things into action, and that is going really well. So, of course, we have probably 4 or 5-folded the production of support weapons since the tragic war in Ukraine started.
What are the biggest constraints to building out capacity at this point?
Well, I would say I have great respect for the supply chain issues because of the geopolitics and the conflicts and what have you. Not short term, because we have plenty in stock, but we have to work diligently with regionalization and also the depth of the supply chain. I mean, the component side of things, the raw materials. All the time, we have to get more sovereignty in the Western world across the field of that. That is very important to us. And of course, we're looking at redundancy in the supply chain. So supply chain is probably the area where we spend most time now securing our growth going forward. Not urgently, but sort of a bit more long term.
Can I ask, you mentioned Canada as you went around the world, Mikael, on opportunities. There's currently a review of the F-35 program underway there. You have been in the past pitching the Gripen, of course. Do you have any sense of timing, any sense of progress, any sense of what kind of opportunity might be thrown up by quite open tensions between Canada and the US?
Hard for me to judge exactly when Prime Minister Carney will take a decision on that side after the evaluation. I see an interest. We give lots of information. We have plenty of discussions, both on the Gripen side of things, but also on the Global Eye. So we have two avenues working in Canada, and I will continue to work that diligently until they've taken a decision, because this is all about, okay, Canada, do they want sovereign capability in the aeronautics field, which we are prepared to give them in terms of tech transfer and knowledge transfer and setting up capacity together with their industry in country and having a Gripen hub in country. So that's what we're talking about, but it's up to Canada to take this decision, and I can't exactly say when, but lots of interest, yes.
Yes, interesting how that conversation about in-country might become more prominent. Mikhail, can I take a step back and think about where we are on the journey around defence and the build-out of defence? You talked about a big order backlog. Some portfolio managers talk to us about, yes, buying defence stocks, and others, in particular around Europe, cast doubt over whether European governments will really spend the amounts of money that are being talked about. Is that conversation getting into Saab at all, and the big order backlog? Do you have real proof from European governments about their spending intentions?
I see no signs of governments in Europe sort of saying that we will take a step back and maybe not invest as much as we have said. It's different in different countries in terms of the schedule, the timetable. But I mean, in our region, Sweden, Baltic states, sort of the Germans, the Poles, that is lots of investments ongoing, and we still sort of maybe halfway plus on the journey towards 3.5%, which everyone committed to in the NATO summit last year. So there's lots happening still, and I don't really see a sign of countries now stopping their investments. No.
Mikhail, can I just ask you a question about the Nimbrix anti-missile system, anti-drone system that you have? It's coming soon. You talked earlier about conversations you're having, near-term conversations you're having with Gulf countries. Are you talking to any of the Gulf countries about deploying that within the theatre? Can you give us a sense of timeline? Does that change? And is the sort of cost per kill advantage that potentially you have over other systems now about to really come to the fore?
Well, our ambition, of course, is to create an effect which is really cost efficient and connects to our already up and running counter-UAS systems. I cannot say exactly when that will be delivered the first time, and of course the interest is big in all countries, including the Middle East. But to say exactly when we will have it up and running in play, even though it's not far away, I think that's a bit premature to give you that information. But we do have counter-UAS systems up and running with different types of effectors as we speak, and we just recently got a reasonably big contract from Sweden, 2.6 billion Swedish, on counter-UAS systems. So, and that we've done in only 7 months to establish that sort of system into the market. So when Nimbrix comes into play, that will add another sort of effector to the system, because that system is agnostic when it comes to the effectors. But to say exactly when, in which country, it's a bit premature.
Okay, Saab CEO Mikhail Johansson, thank you very much indeed for your time on the back of those earnings. Coming up, oil hovering around $100 a barrel on Brent as the US and Iran battle, of course, for control of the Strait of Hormuz. We'll bring you the latest next. This is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the lights air. Then make the 4 fingers curl, make sushi shape, then touch this. 2, then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3, then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
So we are 30 minutes into your Thursday session. European stocks are still down about 0.1% across the benchmark. So still set as things stand. Early doors, of course, for 4 straight days of losses. But this is a much better picture than when we first came in this morning when European futures were pointing like by more than 1%. So earnings story has come through to revive some of the spirits to some extent. That is the context. The DAX in Germany is down 0.2%. But you can see green on the screen over in France. The CAC 40 up 37 points. L'Oreal is playing its part there, up 0.5%. Again, that's a strong earnings story. The FTSE 100 under pressure, down 0.4%. We have macro data coming through as well. We saw divergence in terms of what was happening in France with manufacturing strength versus services weaknesses. We have German PMI now, German April composite PMI, wrapping the two together, falling to 48.3. The forecast had been for 51.2. So in contractionary territory, and signs then broadly of weakness in Germany. We'll break down the manufacturing versus services. Manufacturing is expected to be in expansionary territory, but again, on the composite level, a pretty sizable miss, Guy.
Absolutely. Germany very exposed to the energy story. How does the ECB read that? We'll talk about that a little later on in the programme in a few minutes' time. 2 to 1 in terms of the ratio we see in the markets this morning. 2 down, 1 up. You've got very light volume in the market. Once again, this is a feature. It continues to manifest itself. This is a strange rally, you could argue, in many ways, in terms of the market internals. But that's the nature of the story at the moment we see in Europe. There is a very strong earnings narrative that runs through the market as well that we can't ignore. L'Oreal and Nestle, 2 companies obviously historically connected, both doing well today. L'Oreal up by 8% this morning on the back of its numbers. Nestle, coffee stacks, doing well. It is rallying as well, up by 5.5%. Nokia is also doing very well, up 8%. The AI trade is represented here, giving it a real opportunity, a lifeline, you could argue, maybe I'm being a bit strong with that terminology, but a real opportunity for Nokia to turn itself around and generate a really positive picture with that story that is developing. ASML, though, under a little bit of pressure. This kind of TSMC story looks like it's weighing a little bit. EssilorLuxottica is also off this morning. The luxury space is under a little bit of pressure. Santander is also down. I think it's suspending its buyback. I think, though, this is a mechanical kind of process as a result of an acquisition it is making over in the United States, but the stock is still giving back a little bit of ground on the back of that this morning, Anna.
Let's get up to date then, Guy, on some of the other stories that we're following this morning. SoftBank Group is said to be seeking a $10 billion margin loan backed by its shares in OpenAI as it looks to intensify its AI push. Sources say the 2-year loan would carry an option for SoftBank to extend the borrowing for an additional year. Founder Masayoshi Son has been piling on debt as he positions himself as a linchpin in the global AI boom with large-scale investments into the ChatGPT maker. France's forecasting office has flagged suspected tampering with weather sensors at Charles de Gaulle International Airport and referred the case to police after detecting unusual readings. The numbers are important for the safe operation of the airport, but also are used to settle contracts for daily high temperatures on Polymarket. Prediction market traders and independent meteorologists questioned the results of the contracts, which attracted roughly $1.4 million in combined bets. That's according to data from Polymarket. And the US will host a second round of talks between Lebanon and Israel today in Washington as the two countries push on with direct negotiations amid regional tensions. The ceasefire announced last week runs to Sunday and has largely held despite mutual accusations of attacks. Tom.
Let's get back to the macro data picture, because what you're seeing is a distinct story between France and Germany in terms of relative manufacturing strength, but services weak on both fronts, both countries. So across the services picture over in France, you saw a contraction to 46.5, deeply in contractionary territory, and you're in contractionary territory as well in Germany. Services PMI for the month, the most recent month of April, 46.9. Again, manufacturing for both Germany and France still in expansionary territory, but you put them together in terms of the composites, and it's a pretty challenged picture, and certainly the energy story and constraints out of the Middle East will be a factor. Let's get more analysis right now, because of course we are getting that second read of business surveys. So there's the detail, and bring in Zoe Schneeweiss, Bloomberg's Europe economics editor. Zoe, what for you as you pass this data are the main takeaways?
The main takeaway is that this is hitting Europe a lot more strongly than anyone had feared. We saw this last week already when we got the new IMF numbers. The new IMF forecasts with the downgrades to Europe were quite considerable. Now, with France, we were expecting those numbers today to be below that 50 level that in PMIs is so important. Below 50 is contraction, above 50 is growth. Germany here had been expected to have readings above 50, and now both the services number and the composite number are clearly below 50, or clearly in contraction, and that is very bad news for the German government, which, as we know, just downgraded, just halved its economic forecast for this year to just 0.5% yesterday.
So if you're Christine Lagarde and you're looking at these numbers, what do you make of them? You have an inflation mandate, but this looks like weak growth.
Yes, it does look like weak growth. At the same time, these aren't hard data. These are soft data. These are based on surveys. And we had Philip Lane speaking both last week at the IMF and just yesterday in Frankfurt saying the people answering these surveys, the purchasing managers in this case, have the same information that we have. There's so much uncertainty about what's happening in the Middle East, about the Strait of Hormuz, how long that will be closed, what will be happening there. So they all have as many questions as we do. So while they can give you a smart impression, it really, with things changing day to day, we need to wait for more hard data. And that means next week's rate decision, we've had indication now from most all policymakers, will be a hold, because policymakers just don't know yet how hard this situation will be.
Yes, absolutely. With the Strait of Hormuz still practically closed, with these two interlocking or overlapping blockades, then Zoe in place. What's interesting also from the data is, yes, the manufacturing side has shown a little bit of weakness, or at least coming down, but it isn't really where the action is. It's the services side in both Germany and in France, where we're seeing quite a lot of weakness, certainly in Germany at 46.9, well below the estimate as well, and well below the previous reading. I mean, what do you think is explaining the way that this is getting into the services sector?
We know for France that the reason that the services number was so weak is because people are not willing to spend. That makes sense. If we don't know how the economy is developing, we as consumers don't want to go out and spend our money because things might get tighter. We'd rather keep our savings. So pulling back from services is a real problem. It is quite interesting, though. As you've noted, manufacturing has been the weak point for years in Europe. And now this reversal, with actually services being the point of weakness, is quite problematic.
Yeah, certainly something that the central bankers will be interesting to hear from about. Zoe, thank you very much. Bloomberg economics editor for Europe, Zoe Schneeweiss. Let's talk about the driver of some of this data, and a lot of this is coming from oil prices, of course. Oil prices extending gains as the US and Iran remain locked in that standoff over the Strait of Hormuz after failing to meet for a fresh round of peace talks. Let's get more with Stephen Stachynski, who leads our Asia energy coverage. So what are traders watching for then, Stephen, for the next catalyst then for oil prices? I mean, it seems day after day we have to keep saying the Strait is still not open. I mean, what is it that traders are going to be watching for?
I think they really want to see whether Iran is able to get ships through. There was an interesting Vortexa report out earlier this week saying that dozens of ships have essentially gone through the Strait that were Iran linked, despite the U.S. blockade. But then the U.S. came out yesterday and said that's they pushed back against that report, saying that they've been able to turn around ships. They've boarded 2 oil tankers that were Iranian-linked. So I think the market is really just trying to monitor whether or not the U.S. will carry through with this strict blockade and whether this will continue, and whether that means that there will be escalation from the Iranian side. Because as more ships are boarded, what does Iran do? Do they fire on cargo vessels, which has been the case over the last few days? And does this stay just in the Strait of Hormuz, or does this escalate to a wider regional conflict, right? Before the ceasefire, there was a lot of attacks on different facilities, upstream and midstream oil infrastructure across the Middle East. Saudi Arabia, Qatar's giant LNG export facility, all were hit with drones, missiles, and that is the true fear in the market. If it escalates to that level, then maybe we'll see Brent rising to where we were in the highs last month, which was the $120 level compared to where we are right now, which is just around $100.
Stephen, where are we in this standoff? You point to the fact the Iranians have fired on a couple of vessels. They've taken a couple in. It seems. What is the latest in terms of any traffic through the Strait and how the US and Iran are responding?
So we have seen a couple of ships kind of go through that were Iranian linked. I mean, the challenge is all we can see is the AIS. Those are the signals essentially from the ships saying where they are. In real time, you can see it on MapGo on the Bloomberg terminal. But the problem is we don't know exactly how many vessels are going through because a lot of them turn dark. They go dark before they go through the Strait to avoid detection. Now, the U.S. says that they're still able to find those ships and turn them around or board them. But essentially, we're at a standstill, and it's very fascinating because I was tracking liquefied natural gas tankers over the last few days, and LNG ships, that's 20% of global LNG supply goes through the Strait of Hormuz. Not a single ship has gone through since late February when the war began, and there were some ships over the weekend kind of getting close to the Strait, looking like they might even go. They were signaling Pakistan as their next destination in the next few days, and then they turned around, and now they're back in Qatari waters, which really, in my view, indicates that perhaps a lot of these vessels that aren't Iran-linked have just given up. They don't want to risk it. They don't know how to get through. They're not able to get the clearance from Iran, or they're just worried that they might get attacked if they were to go through Omani waters as well. So we really are at a total standstill. And every day that the Strait remains shut, that removes millions of barrels of oil per day from the market. It reduces the amount of LNG. 1 week that this Strait remains closed, there's enough LNG supply lost that can power all the homes in Sydney. It's a tremendous amount of energy. So I think traders are also just kind of keeping track of that as they try to navigate the supply-demand situation going forward.
Stephen, thank you very much indeed. Stephen Stachynski joining us, leading our Asia energy coverage. Lots to talk about there. Let's turn our attention back to some of the corporate news we've been receiving over the last 24 hours. Tesla plans to spend more than $25 billion this year as the company tries to pivot from EVs, electric vehicles, towards AI and robotics. The automaker also saw European new registrations jumping 84%. This as it continues its comeback after what can only be described as a bruising 2025. Stefan Nicola, our Autos editor, joins us now. What do we know about this massive investment? It's not going into cars, it sounds like. It's going elsewhere.
Yeah, it is going into a lot of things. AI is one thing, chip factories is another, automation, automated driving software. Tesla also wants to expand its robotaxi service to several more cities this year, so spending will go into that project as well. However, Tesla has been quite thrifty in the first quarter, so it will need to ramp up spending massively to get to the 25 billion, to the tune of more than $20 billion in the remaining 3 quarters. Yeah, so quite an extensive spending push. And Tesla wants to show that it's more than a car maker, that it's this conglomerate of AI, of next generation digital technology that it's showing to investors.
It almost, seems to decreasingly want to be just a car maker, doesn't it? Let me ask you more about Tesla then, and what its plans are around chips in Texas. Tesla is to spend $3 billion, we understand, on research into a chips factory. Is that right, in Texas? What more do we know?
Yeah, that's correct. And this is a sort of a smaller scale chip research facility. A bigger scale, latest generation chip plant can cost, $20 billion, $30 billion. So this is a smaller scale facility that will probably look into testing cutting edge chip technology for use in the various Tesla products. It's a combination with from Tesla, SpaceX, and also Intel. So this is where Tesla is probably testing out new technology for different products. And this obviously comes as chips are getting scarce around the world. So this is a sort of a hedge against bottlenecks in supply.
Stefan, thank you very much indeed, breaking down the Tesla numbers for us. Stefan Nicola, our autos editor. Meanwhile, EU leaders are meeting in Cyprus amid mounting economic pressures from the Iran conflict. We are live in Nicosia. We'll be on the ground for you, bringing you an update. That is next. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 60-65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027.
For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
Welcome back to the opening trade. 48 minutes into a session that's actually almost entirely flat now at the overall Stock 600 level, but that hides a lot of divergence. The CAC 40 doing well on the back of some of the earnings. L'Oreal in particular, ST Micro is also doing well. The chip sector doing okay. The AEX is weaker on ASML. The DAX is also, in fact, the DAX was weaker, but it's actually pretty flat now. So we see quite a lot of divergence across these markets. Let's talk about where the geopolitics story, though, goes over the next 24 hours. And I'm actually not talking about Iran. I'm talking about Ukraine, because Ukraine is set to finally start receiving a 90 billion euro loan from the European Union after Hungary lifted its veto. The approval comes as EU leaders are meeting in Cyprus amid mounting economic pressures from the Iran conflict. Bloomberg's chief Europe correspondent, Oliver Crook, is across all of this news flow from Ukraine to Iran and how it impacts on these European leaders as they gather. He's in Nicosia in Cyprus. Ollie, good morning. So this loan, let's start there. The loan for Ukraine, it's been a long time coming. Just how significant is it going to be?
Yeah, it's absolutely extremely significant. I mean, it's a matter of survival for the Ukrainians. That's what we've heard repeatedly from Zelensky when we spoke to him, at the end of last year, and we've heard from various officials from Ukraine that 90 billion euro loan is essential not just to finance the sort of budget of the government, to finance the war effort, and that money will be used basically immediately on a number of different things, but predominantly drones and trying to sort of expand and maintain the kill zone on the battlefield within Ukraine. Absolutely essential for them in order to fend off and to stop these sort of Russian advances. So for them, this is a sort of joyous moment here now that we have Viktor Orban finally sticking effectively to his word in that agreement that we had back in December for that 90 billion euro loan. That should be progressing. We will have Zelensky here in Cyprus meeting with leaders a little bit later this evening to discuss that. But there's also another conversation around the sort of disappearance of Viktor Orban at some point in the next month when we have the new government in Hungary. Does that give the opportunity and scope for the Europeans to advance a lot of other initiatives that they've had difficulty moving forward? For example, additional sanctions on Russia. There's also a very long conversation that is now accelerating about integrating and exceeding the Ukrainians within the European Union. We spoke to the Deputy Prime Minister of Ukraine, who was in Brussels yesterday, to have those discussions with the Europeans. They say they're about 40% of the way there. They would like to see themselves joining the EU next year. That is, of course, a much bigger conversation, a complicated one and a difficult one for many, even allies of the Ukrainians, but that is something that now seems much more possible than it was a month ago.
Ollie, let's link what is happening in Ukraine and what is happening in Iran. When the Ukrainian conflict first erupted, there was an energy crisis, and European governments responded by protecting consumers. This time round, their capacity to do so is significantly lower. What happens next? How does Europe deal with this energy crisis? Can it protect its consumers?
Guy, what I think is really interesting here is you have this sort of middle ground here that the European leaders are trying to walk to sort of signal that they're very, very worried about this energy crisis, that if it goes on for another matter of weeks, months, I mean, people talk about years, that it could have a very sort of devastating impact, and yet not wanting to inspire panic. So that leaves the sort of Europeans in this little bit of an awkward position where on the one hand you get the sense that this is obviously very serious, but on the other hand there's a lot of wishful thinking that maybe it will be resolved, and yet you haven't seen this sort of big bazookas come out yet. We've had a number of measures on the individual nation-state level, about 120 measures from some of the reports that have been out, over 20 countries. That's cost the Europeans about 9 billion euros. These are sort of short-term measures. What is the long-term plan? That is going to be one of the big conversations for EU leaders here today and tomorrow. There's some sort of limited things that the European Union can do. They can help coordinate things like gas storage, jet fuel, making sure it gets to all the different nations. Of course, there's always that debate about whether, the Germans can afford more when the prices go up than, say, the Estonians. So these sorts of things need to be sort of talked about at the European level. There's also a discussion about loosening state aid rules at the European level. It's another thing they can do. But of course, the EU will also use this opportunity to say this is the great case for why we need to move towards electrification, away from fossil fuels, particularly when obviously the supply from Russia is no good. Now from the Gulf is threatened, and there's some serious questions, Guy, about the supply from the United States. If you have shortages, America First policy, what does that mean for the exports coming out of the United States? And Europe is much more dependent on the U.S. for fossil fuels than it's ever been.
Okay. Apologies, Tom. Go ahead.
Ollie, thank you very much indeed. Thank you, Anna.
It clearly says Tom on the prompt. I don't know why I started speaking.
Thank you to Ollie for that comprehensive update. Ollie, thank you very much indeed. Oliver Crook reporting from Nicosia, and Ollie will be on the ground for us throughout the day with updates on that meeting and those issues, of course, as they unfold. Let's look ahead to what else we are thinking about for this Thursday. 9 a.m. UK time, then we're going to get Euro area services and manufacturing PMIs. We've broken the ones for Germany and France for you, with services under pressure in both of those countries. Today, EU leaders, of course, as we've been discussing, meeting in Cyprus, as you know. Ollie's going to be keeping us across that, of course. And on the jobs front, in terms of the labour market in the US, later, US jobless claims will come through, services and manufacturing PMIs out of the US as well. So that rounds out a bit of the picture in terms of the health of the US economy. And aftermarket, on the earnings front, SAP, really important in light of the SaaS apocalypse. We'll be getting those numbers for you. American Airlines reporting, and Intel as well in the chip front, getting a bit of reprieve in terms of the tie-up with, or at least support from Musk and Tesla. And tonight, the US is hosting a second round of Israel-Lebanon talks. So that's part of the geopolitical conversation.
Now I read. Right, Skylar Montgomery-Koenig joins us. Bloomberg Markets Live team, of course. Skylar, good morning to you. So are we all about earnings now? In Europe, it's tempting to think so, because we've got European stocks entirely flat and very divided across the different markets, and very much driven by the earnings stories. The CAC really outperforming as a result of earnings.
Yeah, absolutely. And I think particularly since we got the ceasefire, you've had Brent range trade, and that's let other narratives come to the fore. And so right now we're testing that a little bit. Brent's risen above the highs that we had since the ceasefire, so that's a little bit more worrying. But if we kind of stay in a range, then earnings matter more, and you get these stories come out where the tech trade, for example, is powering U.S. equities and South Korean equities higher. I think, too, there's a divergence that you're seeing that makes sense in that the U.S. is outperforming on tech versus Europe, but also it's outperforming on the fact that it's an energy exporter versus Europe being an energy importer. So I think it's good maybe that we're seeing some of this other kind of narrative or story push the market around if you have Brent stay at current levels or in a range.
Bond market doom, equity market boom. Who's right?
I think it's just a different reaction function, right? So equity markets can be cheered. Yeah, absolutely. Equity markets can be cheered by the fact that you have Brent range trading, right? And the key point here is that volatility has come down significantly.
So the level doesn't matter?
It matters eventually, but it doesn't matter right now. Okay. It matters eventually in terms of it feeds into your earnings, it feeds into your economic activity data, but you see very clearly that inflation surges before growth falters. So that's also what you're seeing in bond prices, right? Yep. You expect more of a hike followed by cut pricing in bonds if you we're more worried about the growth backdrop there as well. And I think the key for equities is that volatility has come down a lot. So if you look at G10FX, equity rates volatility, that's either at or below 10-year averages. So we knew when volatility was on the way up, that was a negative in itself for equities. So the fact that it's compressed and down is a positive in itself. And it means that you don't necessarily need good news on the Strait of Hormuz for equities to rally because it's other stories that are also
relever.
Yeah.
Skylar. Thank you very much. Skylar Montgomery-Coney from the Markets Live team. Don't forget, our monthly show Next Africa airs tonight. Jennifer Sabasaja will be looking at the food crisis faced by vulnerable nations as the Iran war delays shipment of emergency deliveries. You can catch the full episode on your terminal, the Bloomberg website, and on Bloomberg TV. And we talk a lot about the commodities that are stuck in the Persian Gulf. It is oil, it is jet fuel, it is LNG, but it's also fertilizer, and that takes us to the food conversation, one we'll continue to monitor, of course. That is it for the opening trade this Thursday morning. The Pulse is up next. This is Bloomberg.
Tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
The U.S. and Iran are locked in a battle for the control of Strait of Hormuz after failing to meet for a fresh round of peace talks. Meanwhile, the Pentagon says the U.S. Navy Secretary is standing down, effective immediately. Tesla is ramping up billions of dollars in additional spending to transform the electric vehicles pioneer into an AI and robotics company. Plus, TSMC, the world's biggest chip maker, says ASML's latest machines are too expensive, dealing a blow to Europe's most valuable company. So, as you've guessed it, we have a lot going on. We're in the middle of earnings season. At the same time, we're, of course, trying to keep an eye on what's happening in the Middle East. Now, we did have a record-breaking rally in U.S. stocks that suddenly, well, not suddenly, but it did come to a halt, again, as these peace talks in the Middle East remained in limbo. Brent actually further above $100 a barrel, and then European equities dropping some 0.2%. Overall, it seems that U.S. stocks have shaken off the turmoil that the Iran war unleashed unleashed on global markets, shuttering around 20% of global oil flows. But then they are going back to a lot of testing, I guess, that optimism around artificial intelligence and confidence in the American economy. Tesla also plans to spend more than $25 billion this year to pivot from electric vehicles towards AI and robotics. Tesla pre-market down 1.8%. And then we have Norges, actually the sovereign wealth fund of Norway, losing some 1.9% in the first quarter. We'll be speaking exclusively to Nicolai Tangen, the chief executive of the Norges Bank Investment Management, next Tuesday at the Norway Wealth Fund Investment Summit. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Our top story today, the U.S. and Iran remain locked in a standoff over the Strait of Hormuz, with both sides effectively choking off traffic during an extended ceasefire and attacks from both sides on commercial vessels in the Strait continuing. Now, for more, we're joined by Bloomberg's Jumana Bersecci in Dubai. Jumana, good morning. Talk us through the latest developments and actually where you think negotiations stand.
Yeah, well, yesterday, once again, the White House reiterating that this is an indefinite ceasefire and they're waiting for Tehran to come back with their own proposal for a peace plan. But of course, we've not got any signals from Tehran that they plan to do so. Overnight, the Iranian President Masoud Pezeshkian once again linked further rounds of negotiations to the U.S. lifting the naval blockade. And so essentially what has happened here is the focus has now shifted to what is happening around the Strait of Hormuz. Yesterday, a very active day of incidents. And I should tell you that UK Navy reported that 2 ships came under fire. Iran reportedly then seized 2 ships. Wall Street Journal is saying that they seized 3 this morning. CENTCOM also said that they made 31 vessels turn around. And these are Iranian-linked vessels or Iranian-sanctioned vessels. And so what is going on here is essentially a standoff around the strait. You've got 2 blockades in place. And the thinking is that one of the sides will at some point have to yield. From Iran's perspective, the longer this goes on for, the more it's going to put upward pressure on oil prices. The thinking there is that it will eventually come to bite the U.S. and the U.S. president. And at the same time, U.S. President Trump keeps asserting that the longer the U.S. naval blockade goes on for, the more it's going to harm the Iranian economy, which will force the Iranian hand and bring them back to the negotiating table. Who is going to fold first, I think, is a big question for the markets. But at this point, no real signs that these negotiations or another round of diplomatic talks are going to take place. And plus, there's still a real possibility, once again, Francine, that hostilities flare up if the state of the strait continues to worsen.
Jumana, thank you so much for the update. Jumana Bersecci there in Dubai. Now, Bloomberg also understands that the U.S. Navy Secretary, John Phelan, has been fired after clashing with top leaders at the Pentagon. Let's bring in Laura Davison, Bloomberg's Washington Deputy Bureau Chief. Laura, so the U.S. Army Chief stepped down earlier this month. Now the U.S. Navy Secretary is gone. What's happening at the Pentagon?
Yeah, so we're starting to see a bunch of top Trump officials getting the ouster. Just earlier this month, it was a dispute about promoting specific generals. That was the top uniformed officer at the Army. And just yesterday, the top civilian leader at the Navy, also after clashing with Stephen Feinberg, who's the Deputy Defense Secretary, and Pete Hegseth, the Defense Secretary, over shipbuilding priorities, also was asked to resign. So this is, sort of a real shakeup at the Pentagon at a really precarious moment where you have the U.S. military engaged in one of its most ambitious, operations in some years, and particularly this week with the Navy being, really in the spotlight with the Strait of Hormuz sort of being the center of all of the conflict in the Middle East, in the war in Iran. This is timing that is, while not directly connected according to our reporting, is really quite auspicious that there is, so much so much turnover there, particularly when it's seen by, top military people that, especially in a conflict, you want to keep top people in their role. This is also at a moment where Trump more broadly across the administration is firing people. We've seen him fire about 3 cabinet officials, the Attorney General, as well as the Secretary of Homeland Security, and just last week, the Secretary of Labor also, have been shown the door. So this is a real moment as Trump is facing flagging poll numbers, a war in Iran that is not going his way. He's looking to shake up his top team.
Laura, thanks so much. Laura Davison there, Bloomberg's Washington Deputy Bureau Chief. Now, geopolitical uncertainty, of course, once again hitting sentiment. Joining us now is Hugh Gimber, Global Market Strategist at JP Morgan Asset Management. Hugh is also staying for the next 20 minutes as we kind of decipher together a lot of the earnings news as well. Hugh, it's just difficult to know what happens next, right? There was also reports that actually demining of the Strait of Hormuz takes 6 months. So I don't know if what happens to inflation, demand, and the economy.
Yeah, directionally, we know what's happening here, which is inflation's heading higher. We've already started to see evidence of that. But I think more tellingly, it's the growth slowdown that's to come. We've had PMI data out this morning where manufacturing is holding up perfectly well because people are front-loading for now, but it's services where we're seeing the squeeze. And this, I think, importantly, is where the central bank tone has changed over the past month. The message in March was inflation, inflation, inflation. We need to be ready to act. And I think rightly now there's greater acknowledgement that the longer this goes on, the bigger the hit to the consumer, the bigger the hit to growth, and therefore you question really the value in delivering rate hikes now.
I mean, you could get into the nightmare scenario of stagflation.
So directionally, growth is coming off and inflation is pushing up. I still think stagflation in terms of a recession is a long way away because we entered this shock with the economy in such good shape. Corporate balance sheets looking strong, consumer balance sheets also healthy. So there's an element of resilience to this shock. But this is where the US, the longer it goes, the more the pain is going to be felt, and likewise on the Iranian side, which is why I still think markets are looking at this issue and saying, we don't know when it's going to be solved, but we know it will be solved because ultimately one side is going to have to back down.
But if you look at central banks, and I know a lot of them are thinking also about 2022, where they were just late to the game because of what happened in Ukraine and that energy shock. I mean, does it make more sense to actually, hike now and then quickly cut, or wait?
So for me, it's all about patience here. Optionality, if you're a central banker, is the critical word. Lagarde herself has been talking more recently about how ultimately the ECB does not know where this is headed. And she's leading out a list of questions and basically saying the data will tell us which way these fall in the next few weeks. And therefore, my question for the meetings next week would be, why act now when you simply don't know where things are going to be in 2 or 3 or 4 weeks' time? So you can understand why they're wary of really fighting the last crisis, which unfortunately is what many central banks have a habit of doing. But here I think some patience is required because of that acknowledgement that this is, yes, an inflation shock, but also a growth shock.
But Hugh, how do you model the markets? So is it how much pain will come if Brent stays at 102, 103 for the next 6 months, as opposed to maybe 140 and then back down again?
Yeah, so this all comes down to US consumption. Ultimately, that's what's driving the economy, and that is critically linked to the labor market. As long as the labor market holds up, as long as incomes are remaining steady, consumption tends to remain at pretty good levels. Naturally, you see the rotation underneath the surface. Take airlines, for example, an area where consumers will be pulling back because typically they'll refuse to moderate their petrol spending or their gas spending. So I think this is more rotational at this point. The longer it goes, the more you're likely to see the labor market slowing. That's when you start to think more about a significant pullback in overall consumption. But for the time being, this is more a rotation in where consumers are spending their dollars and pounds.
Okay, Hugh, keep that thought because I'll get back to you. I want to know about where you see dollar next, but also some of these earnings. Hugh Gimber, Global Market Strategist at JP Morgan Asset Management, stays with us. Tesla now plans to spend more than $25 billion this year to pivot from electric vehicles towards AI and robotics. Now, the automaker also saw European new registrations jump 84% as it continues its comeback after a bruising 2025. Stefan Nicola, our autos editor, joins us. So, Stefan, how is the massive investment going to be deployed?
Yeah, Francine, well, Tesla is spending a lot of money on AI, on computing power, on robotics. Its humanoid robot project is still on the way. It's also expanding its robotaxi efforts in the United States. So a big push on digital technologies there and expanding with data centers for AI. The main message here from Elon Musk to investors is, hey, we're not an EV maker anymore. We're morphing into this big conglomerate of AI, robotics, and autonomous driving. And yeah, that's helped the shares last year. And this is driving optimism down the road for Tesla.
Yeah, I mean, what's amazing is just the numbers involved, right? We also found out that it's $3 billion that Tesla will spend on a research chip factory in Texas. What do we actually know about what they're looking to do?
Yeah, the facility in Texas is a smaller scale research facility that it's running with Intel technology and also in a bigger sort of chip corporation with SpaceX. This facility will probably test new technology for Tesla. It's a smaller scale, as I said, big chip factories can run into $20 billion cost, $30 billion cost. So this is a smaller hedge play, I would say, and another message by Elon that, it's really seeing chips as a core competency for Tesla rather than something it wants to outsource, especially as access to chips is getting scarce these days.
Stefan, thank you so much. Stefan Nicola there, our autos editor. Now let's get back to Hugh. Hugh, when you look at, I mean, this is a story really of investment. I mean, the numbers around AI, again, are just mind-boggling. So where do you stand on AI, and do you see investment only coming actually from the space?
So Tesla's reaction last night I thought was really interesting because it delivered a strong set of results and then came the CapEx announcement and the market reaction changed. That was a pattern we saw right the way through the Q4 earnings season. It was not enough to beat on earnings. You had to be beating on earnings and demonstrating CapEx discipline. Because when we tie this to what's going on elsewhere in the world, the question I think that investors are all trying to grapple with is how much of these increased CapEx commitments are coming due to new capacity? How much of them are just coming because things are getting more expensive? The energy costs, the semiconductor costs, the memory and the gas that goes into producing those semiconductors, it's all getting more expensive. And therefore, in every earnings announcement, you're now having to say, well, okay, this is a bigger number. That used to be good, but now you're trying to pass through and say, well, is that simply cost inflation, which makes that ROI even harder, or is this genuine new capacity that's being delivered?
Yeah, but the concern is that you're in this massive race, right? Everyone is in this race to also build better so that CapEx has to come. So is there a skew towards the markets? I mean, I don't know what the markets need or what's priced in, actually, for a lot of these earnings.
I mean, this is where, depending on where you sit within the ecosystem, is critical. You look at someone like an NVIDIA, they're set to deliver almost 40% of this quarter's earnings growth themselves. Tech in itself is doing about 80% of the heavy lifting for the market. So whether you're a semiconductor name fueling this drive and this new spending, whether you're a Korean name providing that memory, you're really, really doing very well out of all of these new CapEx commitments. On the other side of it, the hyperscalers and the spenders now are starting to be punished by the market because there's just that lack of clarity about the ultimate ROI.
But if you also look at AI, I mean, you know, there's not, the markets are not looking at it through an economic perspective. I mean, it must be deflationary, is it not?
Well, it takes us on to what we're hearing out of Washington over the past few days. I think there are still significant question marks about how much of this we can read into the real economy impact. Right. Just look at what's happening in businesses everywhere. AI is clearly a time saver today. Yeah. But from an economic standpoint, for that to be productive, where are you using that time? You know, are people just having slightly better days? Are they having slightly longer lunches? Or are they driving that extra time back into the economy and producing more output? Because ultimately, that is the test that has to be passed to deliver higher productivity. And I still think we're too early.
And just very quickly, I mean, this is what Kevin Warsh is all about, right? I don't think he's ever really promised to cut interest rates. He promised to, you know, somehow cut interest rates because of the AI kind of overhang.
But he's also saying he wants to work on realized inflation. inflation. That was one of his other big messages this week. We don't like the way that the current Fed is forecasting too far ahead. We want to be working on what the data is telling us now. So there's a conflict, I think, that the market's going to have to work through here. Ultimately, the message for me from the hearings that we've had so far is about additional Treasury volatility, because this Fed is going to be less predictable than prior Feds. You could have a chair that's dissenting against the vote. I think the role of the chair under a Walsh Fed changes quite significantly, and therefore you have to demand higher risk premia because you have less visibility on where rates are going.
So interesting. Hugh, thank you so much. Hugh Gimber stays with us. We'll talk about earnings. We'll discuss a potential setback for Europe's most valuable company. That's coming up next, and this is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
TSMC is delaying using ASML's newest, most advanced chip-making machines until at least 2029 to save money. Well, joining us now is Neil Campling, Bloomberg's senior strategist. Also with us still, Hugh Gimber from JP Morgan Asset Management. Neil, so good to speak to you. Thank you for sticking around, Hugh. But what does this mean for ASML? I mean, when you say, actually, you're too expensive when I cut back, is it great news? No.
On the surface, no. A year ago, TSM said they were evaluating these machines. Now, the current technology costs around $200 million per piece of kit. Pretty expensive. But the next generation of the high NA is over $400 million. So a significant step up in cost. TSMC are working on internal solutions. Whether they'll be able to replicate the kind of technology ASML can remains to be seen, given how advanced really these machines are. And it's really the only game in town. It's basically a complete monopoly on this kind of advanced technology. So we'll have to wait and see. But it's certainly, I think it's a tactic perhaps for TSM to bring ASML to the bargaining table in terms of pricing of these machines.
But Neil, if you're TSMC, so I mean, I think this is a bold move. And what do you do in the meantime?
So this technology that they have is for the next generation of the chip tools. But given the advances we have within, the AI chips, so you need to have the most advanced machines. So whether TSMC can try and develop something in-house, given that they are the actual chip designer and producer, they're not the equipment producer. So I am skeptical that TSMC will get to the promised land on their own, to be honest.
Yeah, I mean, again, your take on this is, costs are going up. Are we going to see some of these quirky market moves at times?
I think it's a good reminder here that trying to understand who the market leaders will be in 5 years' time is almost impossible in the tech space. we've seen that throughout the decades, the change in leadership. And I'm not saying that we've learned enough to be able to rule out ASML entirely, but I think it shows you that when the supply chains are this concentrated, a small number of decisions can change a company's position very quickly. And so could you say today you have sight in 5 years' time of who the winners are? Have you been able to say for the last couple of years, who is the best LLM out there? It's changed every 3-6 months. And so this, I think, is just another reminder of how quickly this space is moving, and therefore you'll need to be active within the tech space to be keeping up with these trends.
But Neil, is the space also moving away from European players? Because there are question marks over Mistral AI and whether they can actually cope with the big ones in the US. If ASML now is also having question marks, it kind of leaves Europe in a very vulnerable place.
There are very few leaders in technology in Europe in the first place, and clearly ASML has also been hit by some of the export restrictions that came out of the US to use the advanced machines in China. So ASML is not insulated in that respect. And clearly the other factor in terms of getting these machines and the tools out to the likes of Taiwan and Korea aren't easy when you have things like what's going on in the Middle East at the moment. So it is, there are a number of challenges that ASML faces for sure.
I like your point that actually you're right. The fortune of some of these companies can change fairly swiftly. So how do you make a bet as an investor?
Well, I mean, with or without ASML, I think Europe is too late in terms of playing the tech provision in terms of the technology itself. It's now about the adoption for Europe. That's where Europe can win on AI.
But for example, for Mythos, and we heard this, I was in DC and you could hear it in the corridors. It's like if you don't have access, because Mythos Anthropic is giving access to some of Wall Street to play around with it, to see whether they can help in cybersecurity. If you're a European company and you don't have access to that, it's also the banks that could be, not left behind, but in a worse position.
I think that's fair, but I mean, I think it's very hard to imagine a world where you still only have 5, 6, 10 companies with access to this kind of technology in a few quarters down the line. What's interesting to me is we still have this market pricing the winners and losers of AI in terms of those at the forefront and those that are meant to be the customers. That's Europe's role. It's providing the revenue for the companies to generate the return on investment, whether that's coming from the banks, manufacturing, healthcare. It would be a mistake here, in my mind, for Europe to be trying to be a big LLM provider or a big data center provider, because they're just too far behind. But that doesn't mean that Europe has to lose in this AI story if the market's appreciation for the role in your place in the ecosystem starts to change from those hardware manufacturers towards the adopters who ultimately have to provide the revenue to generate that return on investment.
Well said. Intel, so they're also giving an update to investors, and actually some of the valuations, I mean, you were telling me, what are you expecting from Intel? But also valuations are crazy.
The market's expecting a lot, given the stock is up over 200% in the last year. It's had the investments from the US government clearly recently, but I was staggered to find out this morning through our TechWatch column that actually it is the most expensive stock on a forward price earnings multiple in the SOX index. It's at 90 times forward earnings. It's more expensive than any of the other constituents. There's a lot of expectations for a company that, dare I say it, is way behind the technology curve to the point about the fast mover adoptions of new winners and losers. Intel has not been a winner in terms of technology development for over a decade. And I don't see any evidence yet that that's going to change anytime soon.
I mean, that's just an extraordinary fact. Thank you both for joining us. Our Bloomberg senior strategist, Neil Campling, and thanks also to Hugh Gimber, global market strategist at JP Morgan Asset Management. Now, Boeing has reported lower than expected cash outflow as it delivered the most aircraft in the first quarter since 2019. Let's bring in Bloomberg's managing editor for aviation, Benedict Kamel, who's in Berlin. Benny, so what do the results tell us about the company's rebound from the multitude of challenges it's had?
Well, if you think about Boeing in the last couple of years, this has really been a company in crisis. And what we heard from them yesterday really cemented this image that this is a company that has come back and that is doing much better than it was only 6 months ago and certainly a year or two ago. So this is a real recovery story for the company. And you saw it in the numbers. They are not quite generating cash again now, but they are very close to doing so. They said that by the second half of the year, they want to be cash positive again. And they put out a long-term target once again, which had existed a long time ago and then sort of went away. And that is, we want to generate $10 billion in cash again And we heard from the CFO yesterday saying that they can even go beyond that. So all in all, a really strong set of results, no sort of skeletons in the closet. I'll go as far as saying it was almost boring, which is a good thing, you know, so it was a very straight set of numbers. And, you know, if I think about the last couple of quarters of Boeing earnings, it was always a sort of hair on fire kind of moment, and that was not the case yesterday.
Yeah, I like that. I mean, Boeing is probably like, yes, we're boring for once. Meanwhile, American airline earnings, after the bell, what can we expect?
So American is the last of the big 4 U.S. carriers to report. We've heard from Delta, from Southwest, from United, and the outlook there across the board is very cautious. We had some airlines retracting their outlooks. We had some airlines declining to reaffirm it, and all of that is down to the fuel situation. As we know, fuel costs have soared over the last couple of weeks. They've doubled in some cases, and that is really hitting airlines hard across the board. We heard from Scott Kirby yesterday, the CEO of United, saying that we have to pass this on to the consumer ultimately. That means higher ticket prices. So we will hear from American on that today, sort of how they are coping with this. The other big sort of, should we call it, elephant in the room is the consolidation story. We have reported that United and American, or that United at least approached the idea of combining with American. American have said they're not interested, but obviously they'll be asked about this today.
Benny, thanks so much. Bennett Camel there with the very latest on aviation. Coming up, attention turns to how the U.S. and Iran can break the deadlock over the Strait of Hormuz as a fragile peace deal grinds to a halt. We'll be talking to Fawaz George from London School of Economics. That's next, and this is Bloomberg.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. and Iran are locked in a battle for the control of the Strait of Hormuz after failing to meet for a fresh round of peace talks. Meanwhile, the Pentagon says the U.S. Navy Secretary is standing down effective immediately. Tesla is ramping up billions of dollars in additional spending to transform the electric vehicle pioneer into an AI and robotics company. Plus, TSMC, the world's biggest chip maker, says ASML's latest machines are too expensive, dealing a blow to Europe's most valuable company. Now, we are getting some data out of the UK, extremely important given the fine balancing act that the Bank of England has to do. Look, the UK April composite PMI has risen to 52 compared to the forecast of 49.8, and that's just the very latest of data. Remember, it's next week that the Bank of England decides on the same day as the ECB. Now, France's forecasting office has flagged suspected tampering with weather sensors at the country's largest airport. The office referred the case to police after detecting unusual readings alongside heavy betting on a popular prediction market. It's a wild story. For more, I'm joined by Bloomberg's weather and climate reporter, Joe Wertz. So, Joe, talk us through what happened.
Yeah, so there were a couple days in April where there were these anomalous spikes in temperature readings at the Charles de Gaulle Airport, the weather station there. And, some independent meteorologists on a very lively weather discussion forum flagged this to the forecasting office there. And they took a look and examined both the weather station at the airport and the data and found signs of possible tampering with the weather station there. They referred the matter over to the police. The police have referred it for investigation for potential charges. The reason this is such a big deal is the weather sensor at the Paris airport is used to settle these contracts on Polymarket, where one of these prediction markets where people are betting on different things. And so there's been a lot of interest and suspicion from traders on there that this data was potentially manipulated.
I mean, I do find it a crazy story. I didn't know you could do predictions like that. What kind of activity have prediction markets seen regarding weather betting recently?
Yeah, we've seen a real boom in weather betting on these prediction markets, places like Polymarket and Kalshi. Yeah, you could bet on anything on these markets. People are betting on, during the big New York City blizzard we had earlier this year, people were betting on total snow amounts that would fall in Central Park. People bet on high temperatures. People bet on low temperatures. They bet on the amount of rainfall that might fall in a particular area. So these weather bets are on these thriving prediction markets alongside all sorts of bets about politics, about government, about sports. And we're seeing, more and more of these pop up for weather phenomenon. And this has, really been a magnet for all sorts of traders, from meteorologists, from weather nerds, from sort of amateur people who kind of watch the weather, all the way to like AI companies and weather tech firms using these prediction markets to test their models and test their predictive tools. So we've really seen a boom there. Yeah.
And I know people are also, wagering on who the next James Bond will be. So and we have a great explainer, Joe, which I really read with great interest, saying, look, how the prediction markets turned the world into a casino. So I urge everyone to go on Bloomberg to read that. Joe, thank you so much for all of your reporting. Joe Wertz, Bloomberg's weather and climate reporter. Now, EU leaders are meeting in Cyprus amid mounting economic pressures from the Iran conflict, with the oil and gas price spike already costing the bloc 22 billion euros. Ukraine has also returned to the forefront of the agenda after Hungary lifted its veto on Brussels' 90 billion euro loan to Kyiv. Well, Bloomberg's chief Europe correspondent Oliver Kirk is on location in Nicosia. Ollie, how is the EU looking to tackle the energy price shock from the Iran conflict? And good morning.
Good morning, Francine. Yeah, for European leaders, they're really stuck in this sort of messaging campaign here, where on the one hand, they want to sort of demonstrate how worried they are about this energy crisis, really sort of impress the urgency while also not sort of inspiring panic. And that's all happening as we're starting to see this hit really very directly on inflation figures for the month of March. We're now seeing it hit GDP forecasts out of Germany, for example, halving not just their growth for this year, but also cutting off about 400 basis points of growth for next year, which is obviously very, very significant. But we're not yet at the moment here, it feels like, with European leaders for the break the glass moment, reaching for really emergency measures to go really hard on this. It does feel a little bit like a little bit of wishful thinking that this is going to resolve itself. But what European leaders will be discussing today and tomorrow here in Cyprus will be some of the measures they can take at the European level. Those are fairly limited right now. They're not talking about the kinds of things they were talking about after the invasion of Ukraine. They were talking about gas price caps at that point. We're not there yet. But there is a conversation about coordinating gas storages between member states of the European Union, also making sure that jet fuel gets distributed sort of equitably across the European Union, because often in these situations you have nations like Germany that can really afford to pay for these fuels while some of the others cannot. They will also potentially loosen state aid rules to make things a little bit easier, but the broader sort of project here from the Europeans' perspective and the EU's perspective is that this is an argument for electrification, for moving away from all fossil fuel supplies. We know the ones from Russia are out, the ones from the Gulf are now threatened, and you have to wonder about the ones from the United States. When you have a sort of fuel shortage issue across the world, what does America First energy policy mean? And the Europeans are more dependent than they've ever been on the United States. Could those supplies come into jeopardy if things get very serious?
Ollie, how significant also is this loan for Ukraine?
It's absolutely, it's completely essential for the Ukrainians. We've heard from Zelensky. For them, this is a matter of survival. Now, finally, we have Viktor Orban honoring his word from the agreement back in December, lifting his veto, meaning that 90 billion euros can start flowing to Ukraine. When it starts flowing is absolutely essential. They have been saying that they need it really by April. Not sure that it will hit that deadline, but it appears that that is now moving forward. But there's a broader conversation here that will begin at the European leader level here, Francine, which is the post-Orban sort of European political structure. Now that Orban is out, that there will be a new government within Hungary by really the middle of May is what we're expecting. What else can be achieved here? Can we move forward, for example, on Russian sanctions? Are there other European initiatives that can move forward? And one of those initiatives, Francine, that is being discussed at the highest level and is really accelerating is the timeline, getting the timeline down for Ukraine potentially joining the European Union. That is something we spoke about with the Ukrainian Deputy Prime Minister this week. He was in talks, in negotiations this week in Brussels. He says that they're 40% of the way there in terms of the reforms. They'd like to see it happen next year. So that is going to be one of the big questions and conversations here among European leaders. And Zelensky will arrive a little bit later this evening to have those discussions.
Ollie, thanks so much. Oliver Cork there, Bloomberg's chief Europe correspondent. Now let's get some further analysis on the Middle East. I'm joined by Fawaz Gerges, the professor of international relations at the London School of Economics. Professor, thank you for joining us. I mean, things are very unclear at the moment. It's up and down whether there's any kind of negotiation possible, and it's very difficult to see where they end up. How do you see this playing out in the next couple of weeks?
What we have now is a stalemate. We have an impasse between the United States and Iran. And we should not be surprised. I think what we're talking about really are high-stake diplomacy. And high-stake diplomacy is a continuation of war by other means. So even though the guns have fallen silent, but both sides are positioning themselves to basically gain a strategic advantage. Just to give our viewers a glimpse or a context of what we're talking about, the 2015 nuclear deal between Iran and the Obama administration took 20 months of hard work, countless hours of give and take, of meetings. You cannot resolve the U.S.-Iranian conflict in 20 hours or in 40 hours. I think it's going to take a long time, but here's the big picture. For our viewers, Iran has been able to turn a weak hand into a strong one. And President Trump finds himself in a strategic bind. He's desperate to exit the war. The war has been catastrophic for the world economy. The war has failed to achieve its political ends. And President Trump keeps blinking.
But Professor, I mean, is this about, negotiating a lasting agreement or at least some kind of compromise? I mean, is a, very put together, maybe even dirty compromise better than no compromise at the moment?
What President Trump wants, he wants basically a grand bargain. President Trump does not really like small, limited agreements. And that's what J.D. Vance, the vice president, said. Iran has no trust in President Trump because, as we know, President Trump carried out 2 major attacks on Iran while Iran was talking to the United States. So they want ironclad commitments that the United States and Israel will not attack Iran again. And Iran wants to bargain, to negotiate. I think, the big picture for our viewers, President Trump feels that he has won, and he wants to impose his terms on Iran. He basically wants Iran to accept American demands, American, conditions. While Iran says, look, you failed to really basically change the regime or even to force us to surrender. They want to bargain. They want to compromise. At the end of the day, my take on it, both sides have a vested interest in bridging their divide. And I think it's a matter of time. And that's really what high-stake diplomacy is all about.
But Professor, so we don't have a good understanding actually of how strong the regime is in Iran, of how much they've been hit because of access. Do you have any understanding exactly on what this Iranian regime wants to achieve and what they can achieve given their strength or not?
If you ask me what's the biggest bargaining card that Iran has now and will have in the future, it has a stranglehold over the Strait of Hormuz. It's much bigger. It's much more important than Iran's defunct nuclear program. And as we've seen what's happening in the world economy, 40% surge in oil and gas prices. I mean, this is the greatest energy disruption crisis in world history. So at the end of the day, what Iran wants, it wants basically America to lift the sanctions on Iran. It wants its asset to be unfrozen. It wants basically to have the right for domestic enrichment at home. And more importantly, it wants international guarantees that the United States will not attack Iran again, either from China or even a Security Council resolution. So at the end of the day, it seems to me that President Trump really, the reason why he's in a strategic bind, because he wants a better agreement than the one signed by President Barack Obama. He is obsessed with President Barack Obama. And at the end of the day, he won't be able to get a better agreement than the 2015 agreement.
Right, because at the moment, in 2015, there was no talk about the Strait of Hormuz. Now, effectively, Iran is controlling a large part of it.
It's not just a part. I mean, shipping has basically ended in the Strait of Hormuz. Literally, yesterday, one ship. And Iran yesterday seized 2 major cargo ships. And in fact, and that's why, I mean, in terms of insurance for shipping is almost, 100% in terms of extra payment. Not to mention, I mean, you're talking about 10 million barrels of oil missing from the market. And it's been going on for 7 weeks. Imagine if the crisis continues for, let's say, a few months. This will be devastating to the world economy, not to mention the American economy. Inflation in the US, 3.3%. Even here in the UK, in Europe, is very hurting as a result of energy prices, fertilizers, food. 40 million people in the developing world have plunged into poverty. I mean, this is a global crisis. And that's why Iran has been able to really turn a weak hand militarily into a stronger hand economically and also in terms of shipping, blocking the Strait of Hormuz and increasing pain to the world economy, including the American economy.
Fawaz Gerges, thank you so much for joining us, International Relations Professor at the London School of Economics. Now, oil flowing again through the Druzhba pipeline, this according to the Hungarian refiner MOL, with the first deliveries expected in Hungary and Slovakia today. Now, the repairs to the pipeline, which was damaged by a Russian attack in January, and months of deadlock over a $90 billion loan from the EU to Kyiv. Now, for more, we're joined by Greg Sullivan, Bloomberg's Russia Economy and Government Editor. Greg, so good to speak to you again. So just how important is this loan for Ukraine to keep defending itself against Russia?
It's incredibly important. Ukraine has been defending against the Russian invasion for 4 years. Its economy has been really taking a hit from that. U.S. aid has practically evaporated since Donald Trump came to office. This is essential. They had only a few more weeks of funding left before this, so now that it's coming, it's basically a 2-year lifeline to Ukraine. Stepping back more broadly, though, it also shows that the EU is now better positioned to support Ukraine and be a more solid position of aid to Ukraine. And we see that with also not just the loan, but a sanctions package that appears ready to move against Russia.
Yeah, and how is Russia at the moment? I mean, first of all, there are loads of implications for Russia with, this new developments, but also the war in the Middle East has a massive impact on actually Russian exports.
Absolutely. And up until this point, Russia has really seen their ability to capitalize on that, somewhat curbed by Ukrainian drone strikes on exporting facilities. They are poised to relieve some pressure on their budget deficit. Obviously, spending is very inflated because of the war. The Russian economy is sagging and it's poised to slow, possibly even tip into recession. So they are struggling economically. But, as you said, the surge in oil prices could ease some of that pressure nonetheless. And again, it's somewhat ironic that these are Russian oil flows in Druzhba heading into the EU as they try to divorce themselves from Russian energy.
Greg, I mean, overall, there's a lot less focus, of course, on this conflict because the Middle East has been left, right, and center, and rightly so. But does it really matter for the battlefield on the ground in Ukraine?
Yes, absolutely. Right now the battlefield is pretty much at a stalemate. Each side can claim some gains, but the line isn't really moving. Drone warfare, Ukraine's advantage there has kept Russian advances somewhat at bay. But, a lapse in funding would have been a huge vulnerability for Ukraine, and that could tip the playing field. Likewise, a surge in oil revenue could really help Russia. So both sides are trying to jockey for an advantage while the battlefield remains at a stalemate. So it is really significant, this loan package.
Greg, as always, thanks so much for joining us. Greg Sullivan there, Bloomberg Russia Economy and Government Editor. Now, coming up, we discuss what it takes to outperform the market during times of increased volatility. We speak to hedge fund Foxtail Pine next, and this is Bloomberg.
Tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Well, hedge funds had a strong recovery in early April, recouping some of the huge losses made in March when the outbreak of war in Iran upended investment strategies. Now, in this world of increased volatility, but also geopolitical uncertainty, what does it take these days to outperform the market? Well, joining us now is Sterling Larkin, Chief Executive, hedge fund Foxtail Pines. Sterling, thank you so much for joining us. I mean, you also have an interesting story because you had the shop in Asia, basically, and you've recently moved to the U.S. So I want to explore that a little bit. But first, how can some of the smaller managers, is it difficult to keep up in a world dominated by these multi-strategy giants like Millennium and Citadel?
Good morning. No, that's a really poignant question. What's really exciting is I think in the next 4 years, there'll be more money made in markets than the last 20 combined.
Okay.
And the context of that is there's obviously a lot of bad news in the media at the moment and the headlines and the sentiment. But at the end of the day, the fundamentals are basically putting us in a Goldilocks scenario for the next 2 to 3 years.
I mean, the fundamentals at the moment look a bit, not ropey, but there's so much volatility, which also creates opportunities. How did you perform through that volatility in March?
We basically come from a monetarist point of view and off the back of reflation, basically. So all the money that was printed through the era, as of right now, 26.3% of the global economy, not just markets, but the actual economy is bedrocked off the balance sheet of central banks. And that really is a fundamental driver why we're seeing, for example, in the last week, markets bounce higher, even though there's no technical reason why they did. There's just a girth of liquidity still in the system for good and bad reasons, but it is still there, and it's a fundamental reality of the world we live in.
And so where do you see the biggest opportunities right now?
Yep, equities. It's still equities. I mean, that was the whole point of the policy. And again, we're going to see a lot of volatility in fixed income, etc. AI, all these things are causing headwinds, but at the end of the day, that pushes it up the capital stack and into those risk assets.
It feels like March actually, really tested the multi-strat model for producing steady returns because so many people lost money given the market conditions.
I mean, it was a particularly unusual year, particularly in the US. It was the only year, even including the Great Depression, where the market went sideways for the most weeks since November of last year. And then obviously in the last 10 days, we've seen a rip higher. But again, that just talks about the underlying liquidity that's still in the real economy and obviously flowing through the markets.
I mean, what did you learn during that period? I mean, it feels like, it was yesterday, but it's moved on since.
I mean, politics rarely actually has a real impact on markets. I think politics this year is having an impact. You had a fantastic guest on a few days ago, Baroness, and she was talking about from a Keynesian point of view. And she's right from some degree, but you may want to look at it from maybe more from Friedman's point of view, a monetarist point of view, that liquidity is still under bit rocking the whole economy and has a massive impact. But we have seen this year with what's happening in politics here in Europe and obviously North America, that it did push the market sideways for an unusually long period of time.
Sterling, last time I interviewed you was in Singapore for a New Economy Forum, and since you moved from, basically servicing Asian clients to the U.S., has that changed the dynamic of the fund?
I mean, I've always really been passionate and focused on North America, and I guess living there, what's fantastic about being in New York in particular is you really see what's coming around the corner 2 or 3 months from now, and the sentiment is still very, very bullish. Politically, obviously, in the headlines we talked about before may have, some temporary whatever to them. But at the end of the day, there's still a lot of money in the system and there's a lot of money to be deployed for the rest of this year.
How are you using AI in your investments, and how will that be accelerated or changed in the coming years?
I mean, AI in itself is reflationary, and simply because we know there's some big IPOs coming out there, there's going to either be private savings or credit and debt. And that credit and debt has to come from the private market. We're talking potentially trillions of dollars. And that in itself is reflationary. So it's a good sign that it's not just central banks adding liquidity to the system. The private markets are going to be a massive driver of liquidity, which is exactly what money printing and MMT was designed to do 3 or 4 years ago.
But does it change? I don't know whether it makes it harder actually to stand out.
Sure, but I think on the net, AI is going to be very exciting. I mean, LLMs themselves, they're still quite dumb in many regards. People talk about AI as one big bucket, but there's a lot to AI. But we're talking about technology in 2003 or the electrification of the grid in 1915. We're still very early in these stages. And I think this is a multiplier that will have massive beneficial impact socially, but also markets and investors as well.
Sterling, how much do you look at the longer term implication, what's happening in the Middle East for some of these financial hubs?
Yep.
Like, Dubai and others were really a pool of capital. Does that get questioned? Does it change over time?
Yep. I think where the market is misreading it is oil at the moment is actually is not necessarily inflationary, right, because oil is price inelastic. Where it obviously does have an impact is on the US dollar, and the US, for better or worse, in its actions, for military actions, is still a massive supplier, and where Europe and Asia still have to turn for LNG and gas and oil for the next 2 to 3 years. Whether that's a good or bad thing, that's for individuals to decide. But I still think there is a bullish case for why the US dollar ends up the beneficiary in this.
I'm sure you've seen, we've had some, really funny stories about gazumping and talent and how it's difficult to retain talent and hold on to it. When you look at candidates to hire, what kind of profile are you looking for?
People are passionate about markets. You really have to love this. Markets are going to continue to change. We are in an unusual period in the fact that technology is becoming a part of our day job, as well as understanding the fundamentals of economics. And at the end of the day, nothing's really changed in the fact that you really have to love what you do and have to love the underlying economy and the dynamics around that.
Is there a particular focus on less experienced traders or traders from the big shops that have been cut? I don't know if there are opportunities actually to swoop up talent at the moment, given it's a heated market.
It is a heated market. We're trying to embrace technology as much as possible. As I said, we're in 2003 of the tech era, so it's still embracing technology, but still using those, finding people who know the fundamentals of the 101.
How do you keep your talent? That's the other big question.
Hopefully passion as well. But we have a very unique strategy. We have a unique approach, and we've been very picky on our clients and our investors, and we love working with them and sort of build a rapport through that.
And over the next 12 months, what do you see as your biggest challenge? If there's one priority, I know it's never fair to ask for one only, but
yeah, the midterms are a great opportunity for the US, but obviously things are going to change. We're seeing a lot of geopolitics at the moment. There's probably a few more weeks of that, including what will probably happen in Cuba. But the Republicans have to get serious about the midterms. They know that, and let's see how that plays out and what impact that has on markets as well.
Okay, Sterling, thanks so much for joining us. Sterling Larkin, there, Chief Executive of Foxtail Pine. Now, up next, of course, we'll have a roundup of the markets. We'll keep an eye on everything that's happening in the Middle East. But up next, it's Bloomberg Brief, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin. only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. At an impasse, stocks fall, oil rallies as tensions mount at the Strait of Hormuz. A $25 billion spending plan. Tesla aims to invest aggressively on AI and robotics this year. And chips shine, software struggles in a mixed bag for tech earnings. So let's take a look at these markets. Then we have S&P futures and NASDAQ futures pointed lower today after a rally yesterday, albeit on anemic volumes. Volumes have been pretty low. Conviction is a little bit fragile, I think, to say the least, in this market. We did have tech outperforming so far this month by 8.5%, the broader S&P 500. But let's take a look at oil, because that's once again where the story is today. We're well above $100 a barrel on Brent. Impasse, intransigence, call it what you will, nothing is happening. The U.S. says it's waiting for a proposal from Iran as a response to its latest proposal, and Iran is saying, well, we're not expecting anything to happen imminently, and has given no actual formal proposal. So Brent above 103, WTI also elevated, yields up again. Let's get to some individual stock movers now. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Tesla is in the red today after boosting its capital expenditures for the year. This is part of Elon Musk's plan to transform the company into an AI and robotics company, but it seems that the cost of doing so is looking a little steep to investors, and so we are down almost 3% this morning. Moving on to Texas Instruments, and the chip maker has issued quite an upbeat outlook, and this seems to be really benefiting from a broad recovery across its industrial customers, but also its growing exposure to AI and to data centers. And so we are seeing the stock up more than 10% this morning, and this echoes a similar outlook and share price reaction from its European peer ST Micro as well. And finally, ServiceNow, the software provider, is in the red today. Its sales disappointed. It seems to be really impacted by sales delayed because of the war in Iran, and this really compounds existing challenges for the company that's already dealing with all of those concerns around AI disruption. And so we are down more than 13% for ServiceNow this morning.
Chloe, thank you so much. We'll be back a little later on. We'll have more on these moves in just a few moments. Later this hour, too, State Street's Marvin Lowe will be joining us on the fragile optimism in this market. Plus, more on Tesla results with Stephanie Brindley of S&P Global Mobility. But first, the U.S. and Iran remain in a standoff over the Strait of Hormuz, with both sides trying to gain leverage during an extended ceasefire. The White House now awaits for Iran to come to the table.
The president has not set a deadline himself. Ultimately, he will dictate the timetable. And again, he is satisfied with the naval blockade, and he understands that Iran is in a very weak position, and the cards are in President Trump's hands right now.
Joining us now is Jumana Bersechi in Dubai. Jumana, does Iran even have any plans to give a response to the U.S.'s proposal? Tehran has said it has no plans to take part in any more peace negotiations imminently.
No indication in the last 24 hours that they plan on submitting their own version of a peace proposal. To respond to your question there, Vonnie, even though Caroline Levitt once again suggesting that the ceasefire was indefinite and the U.S. side are waiting for a formal Iranian response. That has not come through. But what we do have are comments from the Iranian president, Masoud Pezeshkian. Overnight, he put up a post saying that Tehran does want dialogue and agreement, but a breach of commitments, the blockade and threats are the main obstacles to genuine negotiations. Once again, repeating that so long as the U.S. naval blockade remains in place, it's going to be very difficult to proceed to those second round of negotiations. And so effectively now what has happened is the focus has shifted to the Strait and what is happening around the Strait of Hormuz. there is a standoff going on there. There are essentially two blockades in place. You've got the U.S. naval blockade around Iranian ports. You've still got Iran as well trying to exercise an influence and also cause disruption around the Strait of Hormuz. And just to give you an idea, in the last 24 hours, 3 vessels were fired upon by the IRGC. 2 vessels were seized, quite dramatic footage emerging overnight. And then CENTCOM in the U.S. This morning posting that they had actually forced 31 Iranian-linked vessels to turn around. And so both sides are claiming that they are looking to exercise control over the movement of vessels that are passing through. But for many commercial ships, it's simply just too risky, and they're choosing to stay away, which has meant that traffic is essentially at a standstill. And so what we have now is a battle of the wills, both sides waiting to see whether the other side is going to cave on the implementation of the blockade. The Iranians' calculus here is the longer it goes on for, the more you're going to see an uplift in the price of oil that eventually will feed back to the U.S. consumer, and President Trump will come under pressure to perhaps lift the blockade to move forward with the negotiations. The U.S. thinking is that the longer this goes on for, the more there's going to be economic pain inflicted on Iran. President Trump is claiming that it's costing them $500 million a day, and they will not be able to sustain or absorb those costs for the indefinite future. So here we are. It is a stalemate, but no signs really of material progress on the diplomatic front.
And we can definitely see it in the price of oil. Jumana, thank you so much. Jumana Bersachi there in Dubai. Let's turn to earnings. Shares of Tesla lower in pre-market trading after the company announced a capex boost to $25 billion, as well as a $3 billion investment to build a research chip factory in Texas.
I think you've seen most, if not all, certainly the major technology companies substantially increasing their capital investments. And we're going to be doing the same. I think it's going to pay off in a very big way.
Bloomberg's Stefan Nicola joins us now. So $25 billion plus, Stefan, how will it be deployed?
Yeah, it's a big sum, and Tesla wants to spend billions on AI, on data centers, so more computing power, but also to expand its robotaxi service to more cities in the US. And also it wants to spend more money on its humanoid robot project that's still underway. So a lot of spending on future technologies, and Elon Musk is sending a clear message. We're not just about making EVs anymore. We're becoming this big conglomerate of AI, autonomous driving, and robotics.
They definitely need regulatory approval, though, Stefan. So we'll see, how much money it takes to get that. It's not clear that money will actually get you regulatory approval. What about this $3 billion research chip factory in Texas? What kind of chips and what for?
Yeah, this is a smaller scale research facility that will probably do testing, development, but also maybe early stage production of these next generation chips that are so high in demand right now. The spending $3 billion is, obviously significant spending, but it is much smaller than the full-scale chip factories that some of the bigger manufacturers are building. Those can cost $20 billion, $30 billion. But it is a play by Elon Musk and Tesla to really show that chips are seen as a core competency for Tesla and not just something they want to outsource. Chip access is getting tighter these days, and a lot of big technology companies are securing chip supply. So this is a play by Tesla to secure its own.
There have been a lot of departures from Tesla in recent months. How much will Elon Musk be able to bring whatever vision he has for 2026 to bear? I mean, given that some of the executives, at least on the auto side, have been leaving in droves.
Yeah, well, the car business has been up and down. 2025 has been bruising for Tesla in Europe. We're seeing some recovery in Europe in the first 3 months, although, of course, it's early days. We'll have to see whether that holds, especially as competition around the world gets tougher with Chinese automakers pushing into Europe. So yeah, the coming months will of course see a lot of more investment. That's what Elon has announced. But yeah, on the EV front and on the business side, the jury's still out whether sort of, EV sales can be sustained in the long term.
Stefan, thank you so much. That is Bloomberg's Stefan Nicola joining. Sticking with earnings, shares of IBM also down after the company posted software sales that weren't enough exactly for investors to shake off concerns over AI disruption. Joining us now is Bloomberg's Neil Campling. Neil, software revenue was up 11%. What does that say about consumer software and business software for IBM products, even in this glory day of AI?
Yeah, the glory days of AI. Unfortunately, if you're software focused, AI is seen as a threat and as software as a risk. Now, IBM, as did ServiceNow last night, both reported numbers on the software side which were only in line with street expectations. Now, the reason why people are expecting more is because both companies closed an acquisition during the quarter. So the inline guidance was expected to be increased above street expectations because they both had acquisitions that closed and should have increased the growth rates thereafter. So the concerns on AI's impact on software vertical is going to continue, I think, Bonnie.
Different story for Texas Instruments. That stock is soaring pre-market. Data center demand buoying sales there. I guess it's all sort of in keeping with the same story, right? Demand for AI products.
Absolutely. That's why the SOX index has enjoyed a 39% surge in the last 16 sessions, a record run and to record levels, because the semiconductors are clearly at the forefront of the tools enabling the AI adoption. So that's certainly a very positive indicator in terms of the enjoyment of the chip demand that we're seeing, and it's coming across the globe. ST Micro this morning in Europe, Hynix 500% plus profit growth in Korea. So there's many indicators that there is no end to demand for the semiconductor chips fueling the AI adoption.
Neil, I have to ask about TSMC saying that ASML's latest machines are too expensive. I thought all the money in the world was available for this kind of thing. What's too expensive?
Yeah, it's interesting. TSMC appear to be trying to develop a technology in-house as opposed to using the high NA machines from ASML, which have a price tag of more than $400 million each. That's more than double the existing EUV technology of ASML. So they're attempting to do this. I think it's a way of trying to bring ASML to the bargaining table, because effectively it's a monopoly at leading edge equipment. And it's trying to, I think, get better terms as the biggest acquirer of this kind of equipment.
So, Neil, we had a huge amount of tech earnings yesterday, right? Tech and related earnings yesterday, and there are more to come. What kind of broad thoughts are you taking away from just yesterday's batch of earnings?
Yeah, I think the themes that have been playing out in recent weeks in terms of AI growth is coming through on semiconductors, the impact on the negative side on the software side of things, and there are clearly high expectations into what we're going to hear from the hyperscalers when we get their earnings next week. Though one company that there's a lot of interest in, because it's moved up a lot since the US government investment, obviously, is Intel, which come out tonight. Now, quite surprisingly, within the semiconductor index, the SOX index, it's Intel actually that's the most expensive stock in terms of the future PE multiple valuation. So there's high expectations, and it's more than 100 times PE, very expensive relative to a company that's expected to grow its top line at just 3%. It's been very interesting to see market reaction when expectations are baked in to estimates going into those numbers.
Yeah, absolutely. Well, we'll watch for the stock reaction later, and our thanks to Neil Campling. Now to other top stories trending on the terminal this morning. France's weather forecasting office flagged suspicious tampering with sensors at Charles de Gaulle Airport that coincided with a surge in polymarket bets. Automated temperature readings at the airport unexpectedly spiked to their highest in the evenings of April 6th and April 15th. The readings at Charles de Gaulle are used to settle poly-market contracts for daily high temperatures. The consequences of tampering with sensors at an airport could be severe as the data are used for takeoffs and landings. L'Oreal shares soaring after posting strong sales in the first quarter. Sales were boosted by increased popularity of its Kerastase shampoos and La Roche-Posay skin creams. The company also said it was facing logistics and materials costs linked to higher oil prices. And Nestlé shares grew in the first quarter despite carrying out the largest product recall in company history. Organic sales climbed 3.5%, led by strong numbers in coffee and in snacks. Nestlé confirmed its financial guidance for the year despite the cost of the formula crisis. Coming up, we'll bring you part of our interview with Citadel President Jim Esposito on AI costs. That's next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Earnings season is here.
Earnings season begins. Let's get right to it.
Bloomberg is first to break the numbers.
Netflix here crossing the terminal.
Let's go to a retailer, Urban Outfitters.
I'm looking at shares of Paramount, Skydance.
Morgan Stanley, another monster quarter.
A lot still to come.
With the smartest insights.
What are some of the sponsors and some of the CEOs talking about here?
I think the biggest risk continues to be that inflation gets imported around the world again.
Continuing coverage on Bloomberg.
Bloomberg Brief. I'm Bonnie Quinn in New York. Citadel is paying up on AI as the firm continues to grow its use in trading practices. Bloomberg's Eric Schatzker spoke with President Jim Esposito at the Bloomberg Global Markets and Banking Summit.
Look, I think sometimes what you pick up from us when you talk about AI, it's not new. We were a company founded, roughly 25 years ago, basically with the principles that technology is a force for good. We levered technology from day one. We were using large language models and machine learning before most people knew what those things were. And so I think when you talk to us, it's kind of like obvious that those things can have a big, big impact on market making. To your question, yes, we continue to make strides and advances incorporating agentic AI into our business. Look, at a high level, what I would say is in any business, but especially ours, speed matters. Speed to market probably matters more than ever before. What I'm finding is we're getting faster and faster at all the things we need to do. Think about the flow that comes through our platform. We run some very large, very complicated risk management models. In prior years, we would re-underwrite, we would tweak our large risk models a couple times a year, maybe 3 at best, 4 times a year. It was a labor-intensive process. It required enormous computing power to re-underwrite and tweak these models. Every time we did that, we'd give a better price to a client. That would fall to our bottom line, so it was worth doing. Now, with the advances in computing power and AI, order of magnitude, we can re-underwrite those models about 12 times a year. So yes, AI continues to have a big impact, and potentially now it's accelerating.
So the improvements in the client experience, yes, in theory, should flow through to the bottom line. But the cost of compute is, as we hear from so many players, whether they're in your business or whether they're in other businesses, is becoming, is not only rising, but is becoming such a growing requirement. Does it balance out? Is the investment in compute still worth it for what you get to the bottom line?
It's a good question, and you're absolutely right. There is a bit of an arms race right now from financial players around computing power, TPUs specifically. Our spend has been increasing. At the moment, we're getting a healthy return on that spend.
Citadel President Jim Esposito speaking with Bloomberg's Eric Schatzker. Coming up, look at what's making headlines in your front page news. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you're good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Vonnie Quinn in New York, and it's time now for your front page news. First up, the New York Times leading with the firing of Navy Secretary John Phelan. He's leaving the Pentagon effective immediately. The Times says that comes after months of infighting with senior Pentagon leaders and disagreements over how to revive the Navy's struggling shipbuilding program. The Navy Secretary has no role overseeing deployed troops. Next up, The Washington Post reporting on the Pentagon informing Congress it could take 6 months to fully clear the Strait of Hormuz of Iranian mines. The Post says a classified briefing to the House Armed Services Committee also revealed any such mine clearing operation is unlikely to be carried out until after the war ends. And finally, the Wall Street Journal reporting U.S. officials are ramping up their inquiries into how much risk has built up in the $3 trillion private credit industry. This, as investor angst has motivated some backers to head to the exit. The Journal reports the SEC has opened several enforcement investigations of large private credit managers. And those are your front page headlines. These are your markets going into the Thursday session. Futures lower. This, of course, after a really great month in the end so far. Tech particularly outperforming the broad index by 8.5%. 8.5%. Now we have low volumes, but nevertheless, plenty of churn going on in this market. The dollar index back up about 1/10%. Yields just slightly higher today. We are elevated, though, from previous to Kevin Warsh's testimony. Let's take a look at oil, because it's effectively the war trade on again, only just maybe a little bit softer of a trade. We're seeing Brent crude above $100 a barrel, but not like spiking. It's just higher by about less than 2%. Same for WTI. Gold down about 0.8%, still at $4,700. Bitcoin is lower today as well. Coming up, equities remain the path of least resistance. That's according to Marvin Lowe of State Street. He's going to tell us why next. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. At an impasse, stocks dropping, oil rallying as tensions mount at the Strait of Hormuz. A $25 billion spending plan. Tesla aims to invest aggressively on AI and robotics this year. And chips shine, software struggles, and a mixed bag of tech earnings. Let's take a look at those markets then. It's all being dictated by oil. Once again today, we're just below 104 on Brent, just below $95 a barrel now on WTI, and no end in sight as the standoff continues. More attacks, in fact, if anything, in the Strait of Hormuz. Yields a little bit more elevated, 381 on the 2-year, and then future is lower as you might anticipate. We did have a better day yesterday, but S&P futures and NASDAQ futures looking to declines at the open today. The dollar index a little stronger, and if you look at the VIX, we're just below 20 once again. Let's get to some individual movers now with Chloe Melly in London. Chloe.
Good morning, Bonnie. Tesla is down almost 3% this morning after saying it would boost its capital expenditure for this year. This is part of efforts to transform itself into an AI and robotics company, but it seems that the price tag on that is looking a little too steep for investors, so we are seeing a little bit of weakness there. Moving on to the chip maker Texas Instruments, which has beat estimates and provided quite an upbeat outlook this morning. It's benefiting from a broad and really solid recovery across its industrial end markets, and also a growing exposure to data centers and AI. And this really echoes what we've heard from STMicro in Europe as well this morning, which also had a very positive outlook and was also rewarded by a big boost in the shares. And we're up more than 10% for Texas Instruments. And finally, the software company ServiceNow had sales that disappointed. It said that it's really feeling the hit from the Iran war in terms of sales delay. And of course, this compounds those existing challenges for the software sector around all those concerns around AI disruption. And therefore, we are down for ServiceNow more than 13% this morning.
All right, a huge move there for ServiceNow. Chloe, thank you so much, Chloe Melly there. Tensions over the Strait of Hormuz rising as the U.S. military says it has intercepted 2 Iranian oil supertankers. This as the White House says it's waiting for a response from Tehran before restarting peace negotiations.
The president has not set a deadline himself. Ultimately, he will dictate the timetable. And again, he is satisfied with the naval blockade, and he understands that Iran is in a very weak position, and the cards are in President Trump's hands right now.
Let's bring in Mika Solner of Bloomberg Government in Washington. I mean, the U.S. can't restart anything if Iran isn't on board, and it seems like Iran has absolutely no plan to even respond to the U.S.'s latest proposal. Mika, what happens next?
Yeah, as far as we know, Vani, that this is a peace timeline or a ceasefire timeline with no end to date. And this is a very different approach that the Trump administration is taking from its recent actions in latest weeks, where the president was clearly playing a little bit more hardball with Iran, threatening to destroy an entire civilization. Those were his words on Truth Social. Of course, that didn't happen. So it seems that the White House is still trying to navigate the next steps here as things really remain in a stalemate here between the two, and it continues to wreak havoc economically on Americans as well and worldwide.
A little bit of havoc at the Pentagon too. The Navy Secretary was ousted apparently after infighting. Tell us more.
Yeah, Trump fired the Navy Secretary yesterday very abruptly over his unwillingness to or the differences he had in terms of the ships, the fleet, the golden fleet, so-called golden fleet that the administration has really tried to push. Shipbuilding has been one of the top priorities for the administration, so it's no surprise Mr. Phelan, was ousted by the president. But this also comes at a time, of course, where we're in the middle of this Iran war, and there's been other shakeups at the Pentagon as well.
Mika, bring us up to speed on DHS funding and the latest plan.
Yes, the Senate is about to start their marathon votorama when it comes to trying to work DHS and ICE funding through the reconciliation process. Now, the president met with Senators Lindsey Graham and John Barrasso just weeks ago and has been really adamant on getting everything done on a June 1st deadline. Now, that's a very ambitious timeline to get everything through. But what essentially Republicans can do is pass this kind of funding through the reconciliation process without Democratic help. And they want to do so for the remainder of Trump's term, so it no longer becomes a sticking point for the party.
Mika, thank you so much. Mika Solner there of Bloomberg Government. Stock futures lower after the S&P 500 set another record. Marvin Lowe of State Street weighing in, writing, quote, while finding a durable end to the war remains a challenge, the view that we have seen the worst is a tradable theme. We think that risk remains supported despite the aggressive rally over the past few weeks. Equities remain the path of least resistance. He's Global Macro Senior Strategist, and he joins us now. Marvin, thank you so much for coming in. What is your time horizon in a market like this? I mean, do you have to suddenly think more shorter term given oil price moves?
Well, I mean, I think that you have to be prepared for volatility, and headlines still drive a lot of the intraday price action. But if, in fact, you can get comfortable that we're not going to get worse, if you will, if we don't get escalation from the perspective of violence restarting and or the energy infrastructure being damaged, I think that investors can get back into some of the themes that were supportive of the markets before the conflict began.
It does seem that before the conflict began, though, there were a lot of worries in this market. Has the conflict suddenly taken those worries away? Because at least, you know what you're getting if you get some kind of an AI bubble, but you don't know what you're getting with a war.
For sure. I do think that there were questions as to whether or not concerns about AI were getting ahead of themselves. Certainly calling for the decimation of broad industries, given where we are in the evolution of AI, was certainly looking very deep in the future. And then credit was a big issue. And if anything, we've seen that the fact that the war didn't negatively impact the availability of credit should push at least some of those concerns a little bit to the sideline.
Why is volume then so anemic? Because it has been lower and for some time now.
Yeah, I mean, there's still a great deal of uncertainty, right? The bounce back has been it really has been impressive. And I think that takes a lot of the upside out of it and will have this positive bias, but we're always going to need affirmation as to why we should be pushing further, given that we've really bounced as aggressively as we have off the lows.
So, Marvin, can the S&P continue to make records throughout this year then, even as we don't even know, at what point we're going to get a changing of the guard at the Fed?
Yeah, I think it can, just because a lot of the growth has been built on this CapEx type of discussion, very much around tech, very much around the AI data center, and that driver is still intact. And if anything, we're starting to hear the tech companies reaffirm their view that it makes sense to spend this kind of money.
Would you diversify a little bit out of tech, though? And if so, where would you be looking to?
Yeah, you know what? It's probably a decent idea. I don't necessarily know if there are other broad sectors that are clear cut to me. But really thinking through maybe the tips discussion, thinking through potential hedges, which is very hard at this point, given how a lot of these asset classes performed when the market was going down. But looking at commodities, looking at income, looking at tips as inflation protection, I think that's the type of diversification that I'm spending time on.
What about emerging markets? You're a global macro strategist, so obviously, you take a lot of time examining other markets. Sure. Which ones look attractive now? Because dynamics have changed very much for these.
Yeah. You know what? It's funny because throughout the pandemic, it really had been the emerging market, either central bankers or economies that were willing to take the hard medicine early on in the process. And I think that there's been credibility that's been built on that. Kind of having said that, if volatility and dollar funding gets strained, EM certainly will always be in the crosshairs. Make sure that you're looking at markets where you're getting compensated with high real interest incomes, if you will.
So what would they be now, given that we just saw the Bank of Japan decide that they were going to put off, an interest rate increase. Yeah. We don't even know what other central banks are going to have to do.
Yeah, I think a lot of the Latin American countries do kind of float to the top, not necessarily because you love the economic dynamics, but you are being compensated for the risk a bit more than maybe some of the lower yielders that emerge within Asia.
What did you make of Kevin Warsh's testimony and what he said about the Federal Reserve and how he might change things if he can?
Yeah, he certainly has a history that gives him a view on how he would like the Fed to ultimately evolve to. I think that data is still a very, very important part of his discussion. He might want to push back against the traditional data that the Fed has been using, but inflation sounded like it was a very important part of his discussion. And if the data allows for us to take a softer touch on inflation, perfect. But if it doesn't, I think that he's still going to be one of 12 members, and that data is going to drive, really what the monetary decisions are.
What kind of data will he be looking to, though? I mean, what's better than core PCE for telling us about the...
There is a lot of alternative data that's out there. State Street is one of the companies that provides that alternative data. He mentioned it as part of his discussion. Using alt data is not a new thing. Certainly in a world where data gathering has come as far as it has, you should be tapping into all of those different sources. I think having additional facets of the prison to look at is not necessarily a bad thing.
Marvin, you say that you're seeing a little bit of hesitancy in duration now, particularly among foreign investors, and you're also seeing a little bit of a shift or a little bit less liquidity potentially into the US dollar.
Yeah.
Why, on the one hand, do you have such a sanguine view about U.S. equity markets and so on, and we're seeing this kind of dynamic play out ever so slightly in the background?
Yeah,
it's a little ominous, no?
You know what? It is a great question, and it's one that shows the nuances of the markets ultimately. U.S. companies have been leaders in regard to performing the way you expect it to perform, and certainly the quality growth in the U.S. is undeniable. The dollar and treasuries are the most U.S. of assets, and I think that we never really got past some of the concerns around what the U.S.'s role, if you will, from a government perspective that started to emerge last year. We certainly had trading around it, but I think that is still making its way into the thought processes, especially of foreign investors. Do they need to own as many dollars? Do they want to own long treasury duration given uncertainty with the budget, given uncertainty with inflation? And we're seeing that while they're still comfortable investing in the U.S., they might not necessarily need to take that kind of risk.
Gosh, Marvin, you'll have to come back and give us an update very soon.
You.
That's a little ominous, as I said. Marvin Lowe of State Street, thanks for joining us in studio. Now to other top stories trending on the terminal this morning. Novo Nordisk says top-line results for its Pioneer Teens trial are positive, showing promise for its oral semaglutide for use by children. The study included 132 children and adolescents aged 10 to 17. The drug could become the first oral GLP-1 for youths with type 2 diabetes. SoftBank is seeking a $10 billion loan secured by shares in OpenAI. SoftBank has been piling on debt as it pursues founder Masayoshi Son's mission to become a key player in the global AI boom. American Airlines and Alaska Air are said to be pursuing a potential revenue-sharing agreement as both carriers face higher costs and industry competition. Sources say the airlines discussed adding Alaska into American's joint arrangements with British Airways and Japan Airlines. American Airlines declined to comment. Alaska said it doesn't comment on speculation. Coming up, Tesla lower in the pre-market after a major boost in its capex plans. More on that with Stephanie Brindley of S&P Global Monthly Mobility. That's next. This is Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop. I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I think you've seen most, if not all, certainly the major technology companies substantially increasing their capital investments, and we're going to be doing the same. I think it's going to pay off in a very big way.
Elon Musk boosting Tesla's capex with a plan to spend as much as $25 billion in AI and robotics. Joining us now is Stephanie Brindley, Associate Director of Auto Intelligence at S&P Global Mobility. So how much of this $25 billion, Stephanie, will go towards things like the cybercab and charging stations?
It does seem that the spending is shifting more toward AI. It's shifting more toward the robot and all of that. I think that the focus on traditional automotive has shifted quite a bit for them.
He did say cybercab production would begin slowly but ramp up exponentially by the end of the year. Is that a distinct possibility?
It certainly it is, but it's interesting, and that I think that's just they haven't disclosed entirely, whether you get steering wheel and pedals on all of that. They don't necessarily have the exemption for that. So it's interesting to see kind of how that's going to come together over time. And while they've talked about ramping up the production of that, they haven't really talked about how they're going to make that available to consumers. So we've got some more questions about cybercab, I think.
Yeah, I mean, the regulation question is huge, right? Are they making inroads at all in various states on this issue of actually being able to, when they eventually get these cabs up and running, and when they don't crash at 4 times the pace of regular humans, when regulators will actually allow them to be used?
I think that they're making some inroads in terms of being allowed on the road. One of the form factors and most in the U.S. certainly, and in other countries, is that they still have to have a steering wheel and pedal and accelerator and brake pedals. That there doesn't seem to be a lot of movement and being able to produce and sell them without those factors. That seems to be a part of the issue as well. Being able to be on the road is less of a big problem. In terms of, as long as you have that backup, you're able to do that. Being able to be approved by the Netherlands and paving the way to European approvals, I think is certainly important for them. But the Netherlands also said it's not fully self-driving, right? The Netherlands said you still have to oversee that, and you still have to be involved and be ready to take over at a moment's notice. So there is a bit of a caveat to that as well.
Yeah, and so when Musk says unsupervised full self-driving, FSD, will reach customer vehicles by Q4 of this year, is that at all a possibility?
He's been saying that for a really long time. Sure, it's possible. And how quickly that actually happens. I mean, even in the call this afternoon, they talked about how you're looking at hardware 3 needing to be updated and not quite able to do that. So earlier discussions of how as soon as version 14 came out, you were going to have millions of vehicles on the road just ready to drive themselves, does seem to be not entirely the case. So they're saying anything after hardware 3 still needs cameras updated. It still needs compute updated. So there's still a long way to go between saying, what you've already got on the road is ready to be robotaxi and it's ready to do FSD. When they're still working on it. Frankly, at the end of the day, they're still working on it.
Yeah, I mean, you mentioned the Netherlands and sort of the positive outlook for Europe. We also had better vehicle registrations. That would have been a nice boon, up 11% in general last month. But for Tesla, registrations were up 84% in Europe last month. But China is still a problem, and we're not even talking about FSD here. We're just talking about some of the autonomous parts of Tesla. Is Tesla going to continue to try and push on China?
China's a difficult market right now. There's price issues in China. When you look at Europe and the US and seeing increased sales versus last year, you also had a first quarter where they were making some production changes. And those have now those have been resolved in terms of they were updating Model Y at that point. So you've got a little bit of tailwind from that issue as well. The China market is tough right now, and I think it's going to continue. One of the things that we didn't see out of the conversation was a lot of discussion about how basic capacity was going to increase. Not a lot of we're going to build a lot more cars this year than we did last year. That seems to have settled down. There was a reference to the Roadster. Apparently being the most exciting thing to be introduced, and maybe next month, maybe the month after. So you still have some automotive thing, but I think one of the most interesting things here is that fundamental shift. It's about AI, it's about robots, it's about non-automotive, and I think that theme still continues through with what we've talked about for this quarter as well.
Even more so on this call. Stephanie, thank you so much for joining us this morning. Stephanie Brindley of S&P Global Mobility. Coming up, we'll get you set up for your trading day. A host of earnings again on deck. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, earnings. We get Lockheed Martin, American Airlines, and Keurig Dr. Pepper all before the bell. And then data, we get jobless claims, that's out at 8:30 a.m., followed by the S&P PMIs, preliminary April reads there, that's at 9:45 Eastern. And then Intel, one of the big ones after the market close. Don't miss our interview with CEO Lip Bhutan, that's at 2:45 p.m. Eastern. Some earnings movers for you a few hours before the market opened. Texas Instrument extending double-digit gains. Data center demand absolutely buoying sales there. Really knockout quarter for Texas Instruments. IBM, though, down more than 7%. Software sales failed to shake concerns over AI disruption, though revenue was up pretty nicely and met expectations. Just didn't particularly beat according to what this market wants to see these days. ServiceNow down almost 14%. Sales slowed by the Middle East war, and that's weighing peers down as well. Here's your macro picture for the day. Hit a record yesterday for the S&P 500. We might be pulling back slightly today. That as oil tops $100 a barrel. The dollar index a little stronger, and the 10-year yield across the board, we're seeing a gain of about 2 basis points. That's it for Bloomberg Brief.
Day 2 at the Mutua Madrid Open. Great Britain's Katie Bolter enjoyed an excellent opening round win over American Taylor Townsend. 5 aces and 14 winners on her way to a straight sets victory after just over an hour and a half on court. Up next for her, 5th seed, Jessica Pegula. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download the
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your
supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
Markets remain relatively buoyant and hopeful.
That bounce back that you have is warranted.
We're clearly pricing out a lot of the tail risk.
The stock market has been the most accurate indicator of where the economy is going.
If you're looking 6 months out, I still think we're higher than where we are here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday at all-time highs. A record-breaking chip surge powering the U.S. stock market rally as capital expenditures at Tesla is set to exceed $25 billion. The tech boom, insulating equities from a prolonged crisis in the Middle East. Crude back in triple digits.
And really that's framed perfectly because on one hand you have this huge face-off in markets of oil prices on the one hand, and then on the other, the AI hopes and dreams that are coming through in a lot of the earnings. You can see, for example, chip stocks. 16 straight day of gains, which is the longest run ever in history. That index is on pace for its biggest monthly gain going back to 2000. At the same time that, yes, you're seeing record highs with incredibly narrow breadth because of all of what we're seeing under the hood tied to oil prices. How much is this rally being kept down, frankly, even though people say we can just hit more records again and again and again?
Look at what companies are doing. Let's pick 3. Let's go with Tesla. Tripling CapEx for the year ahead. That's them. Texas Instruments raising their outlook. Strong guide from them, strong forecast. GE Vernova, they make the big nat gas turbines for the big data centers. Their order book at the electrification unit was bigger last quarter than all of last year, which speaks to the tech boom we're seeing right now in this country.
Those 3 companies perfectly exemplify what's going on right now because you saw Texas Instruments and GE Vernova both shoot to the moon, right? You saw a complete welcoming of those results because they showed how much they're winning from the tech investments. Tesla, another story. They came out, they beat expectations, but it turns out they're not a car company. They're using their car revenues to fuel all of the autonomous driving as well as the robotics that they have in place. And the CapEx is actually causing some skepticism around the share. So is this sort of a template for what's to come for the big tech players that report next week?
This is the tension, it's the tug of war between 2 different time horizons. The future, a positive one for US tech, got all of that. The present, pretty dire over in the Middle East. The confidence seems to be around the idea that the president is committed to de-escalation, that this won't be a prolonged supply issue, it will be a transient shock. And then you see this from the Washington Post. This story right here. It could take 6 months to fully clear the Strait of Hormuz of mines deployed by the Iranian military.
What does reopening the strait entail? What does it mean? How close are we? And what is open enough to comfort the market that there will be enough supply to actually keep this economy going? There is a complete disconnect between the people who we speak to in the physical world and the people who we speak to in the theoretical world who have a lot more hope. What you can see, though, in the prediction markets is people are ratcheting back their expectations for when there's an all clear in the Middle East. It's getting harder to see when that could actually happen. And again, the time horizon of when this creates economic damage continues to be in focus, and people keep kicking the can down the road in terms of what they say really will be pernicious.
Welcome back. I should have started with that.
Thank you.
You caught up with Scott Kirby of United Airlines yesterday. Big question for all of us. Is summer cancelled or not? What's happening with flights and how much are they going to cost?
What he said is the transatlantic flights will be prioritized. And before you start to not be able to go to the south of Italy, they will cancel all of the regional flights in Europe in order to prioritize that corridor and all of the international flights. That said, there is going to be constraint, and that is what you can see. He's looking for it at it as an opportunity to potentially pick up assets. But what that indicates is there's severe pain, and we're hearing about government bailouts again for the airlines at a time of real distress.
Uncomfortable choices, uncomfortable trade-offs, and the data in Europe, uncomfortably bad throughout this morning so far. Equity futures stateside on the S&P 500 negative by 0.5%, pulling back slightly from all-time highs. Coming up this hour, we'll catch up with Keith Lerner of Truist, with stocks pulling back from those records. Victoria Coates of the Heritage Foundation with the US and Iran deadlocked, and Paul Sankey of Sankey Research with crude back in triple digits. We begin this hour with our top story. The US calling on Iran to restart peace talks. Bloomberg's Jumana Basechi leading our coverage out of the region and joins us now for more. Jumana, are we any closer to those talks?
It doesn't appear to be the case, John. And, yesterday, once again, the White House reiterating that they're waiting to hear from Tehran on their version of a new peace proposal. It hasn't come through. And what we have got instead is a post, once again, from the Iranian president overnight, Masoud Pezeshkian, saying they do want to return back to dialogue, but a breach of commitments, the blockade and threats are the main obstacles to genuine negotiations. And here, once again, referring to the fact that as long as the U.S. naval blockade remains in place, they will not be returning back to the negotiation table. That is the stance that they have consistently been portraying over the last couple of days. And it seems very unlikely at this point that we're going to get another round of diplomatic discussions despite the mediator's best efforts. So the attention in the last 24 hours has really shifted to what has been happening around the Strait of Hormuz, because there is an impasse there, but that's not to say that it's safe or uneventful. In fact, there have been several incidents in the last 24 hours, pretty dangerous. The UK Navy reporting that 2 ships were fired on. IRGC then seized a couple of vessels as well. The US, their part, caused made 2 Iranian they were laden with oil vessels turn around, and CENTCOM releasing an update this morning suggesting that they have caused 31 vessels to change routes over the course of this blockade that has been going on for more than a week now. And so what you have here is obviously a battle of the Strait, but essentially a battle of wills, because the question here is timing. Iran's calculation is that the longer this goes on for, the more you're going to see uplift on the price of oil. Eventually, that's going to feed back to the U.S. consumer. It's going to test President Trump's patience and bring him to the table for another round of negotiations, or at least to wind up this war quickly. The U.S.'s calculus is that the longer this goes on for, the more you're going to start eliciting a lot of pain on the Iranian economy. President Trump is saying that it's costing them $500 million a day. We haven't been able to verify those numbers, but the point is, it is a battle of wills alongside the battle of the Straits. And we've got to see whether either or both sides will be willing to lift the blockade in order to move to a next round of negotiations. The alternative, though, is still a resumption of hostilities. So that's still a possibility.
A high-stakes, potentially lethal blinking contest taking place right now. Jumana, thank you. Jumana Basechi out of Dubai this morning. Crude, Brent, for a 4th consecutive day, 103.80 so far this morning. That's the situation in the Middle East. This is the view on Wall Street this morning. Keith Lerner of Truist writing, the weight of the evidence continues to suggest that the bull market deserves the benefit of the doubt, and we would view weakness as an opportunity. Keith joins us now for more. Keith, welcome to the program. I've got 2 whys. Why do you believe the bull market deserves the benefit of the doubt? Why do you think that a weakness is an opportunity?
Yeah, well, great to be with you all. Well, the first thing is I think the bull market has earned it. This bull market has been battle-tested through a series of shocks, from high inflation to fast-paced interest rates. And each time, these companies have adapted, and we're seeing profit margins continue to expand, and we're seeing forward earning estimates at new highs, not only in the S&P, but also by the, by mid caps, small caps, and even emerging markets as well. So, listen, I don't want to be Pollyannish either, Jonathan. I think there is some uncertainty. We just had a nice rally off the low, so it would be perfectly normal to see some backing and filling after this. But the last point is, we also know, I think there's so much focus on Iran and the situation there, which is important. But let's not lose sight of the dominant theme of this bull market, which you all talked about, is AI and tech. And that story is likely not changing. In some ways, it looks like it's actually accelerating.
Keith, 16 days Lisa mentioned it, 16 days of gains for the Philadelphia Semiconductor Index, a powerful rally. One of the best months we've seen, by the way, in about 25 years for that particular index. Keith, when you look at those moves, and when I look at where we bottomed, do you think we still underappreciate the relationship between this rally and, say, Mythos and Anthropic, and perhaps we're looking too much towards de-escalation and what's been developing in the Middle East?
Yeah, I do. And, you know, when we were selling off in March, we were highlighting the technology that, the valuations got to a 20 PE, which was lower than the terrorist shock of last year. And the premium relative to the market shrunk to the lowest level in over a decade. And one thing we just looked at, Jonathan, I thought was really interesting. We looked at the peak to trough change in the valuation, or the compression of the valuation for the tech sector, over the last several months. It was 37%. We went from a 32 PE to 20. When we look back this decade, that's the most severe compression we've seen out of any of the pullbacks, more than COVID, more than the terrorist shock. And you can argue that there was actually more uncertainty in some of these other areas as well. So I think we've reset pretty well. The earnings momentum by far is the strongest in the market. The forward earning estimates are being revised higher over the last 3 months by almost 20%. That's about double the S&P. So I think all in all, kind of this tech story moved to the back burner. Now it's moving towards the forefront again. And again, after this big move, are we going to pull back a little bit? Maybe. But last point on tech is it just moved above the October high. So since the October high, we're up 0.2%. So ultimately, I think this bull market and tech has further to go.
Where in tech, though, Keith? And this is a big question mark underpinning this rally, given the fact that right now, the picks and shovels of tech seem to be rallying. We're seeing the semiconductors, we're seeing the memory chips, we're seeing the energy side of things, GE Vernova, with respect to some of the way that they're electrifying some of the data centers. Going forward, do you think that next week is going to be a gut check in terms of how the market responds to additional CapEx plans?
It likely will be, but I also think, as long as these earning estimates continue to get revised higher, I think the market will be okay if CapEx continues to be at a rapid pace. I don't think anyone's really expecting much of a pullback in CapEx, because really what's got the market's attention more recently is there's a lack of availability for GPUs, and as these models are becoming more powerful, the demand for that will only grow. So, listen, I don't think we're going to see a big change in the CapEx story. I think in some ways what we're seeing more recently in the power of these models is going to validate the expansion of that CapEx. I think more interesting we'll see what are we going to hear about the employment side, because we're actually starting to see a tick up in some of those announcements as far as displacement.
How do you treat that as an investor? I mean, I know that from a psychological perspective, that has a pretty big hit, and we're seeing that take place even in places like China. Some of the anecdotal information suggests that there's a real cramp down on employment as a result of AI. Is that a good thing as an investor because it reduces costs?
Yeah, longer term it is somewhat circular, because we do need people spending to move the economy forward. But I think there's different time frames on this, and I think in the short term, if you see profit margins continue to move up and you're seeing the sales per employee or cash flow per employee move up, I think ultimately the market will reward that. Now, again, there's probably a greater story to be told from an economic perspective, and we all know that. But I think in the near term, the market's going to focus on profits.
Hey, Keith, that's the focus right now, that's for sure. Thank you, sir. Keith Lerner there of Truist. Netflix just moments ago authorizing a buyback of additional $25 billion in shares. In the pre-market, that stock erasing losses now positive by around 1.7%. But look at the consumer. I'm pleased you brought up the labor market and the real economy. Hilton up by 10% this month. Chipotle up by 10% in April. Carver up by 20% this month. Some interesting things going on in the restaurant and hotel business as well. You've seen some rallies there, even with this move in energy.
Part of the reason why is just the resilience that you see in the consumer. You were talking to Holly O'Neill yesterday from Bank of America, highlighting just how robust things have been. Scott Kirby of United yesterday saying he's been surprised that there hasn't been demand destruction even as they raise prices. So clearly there is a consumer with money to spend. Where they're spending it, the winners and the losers, definitely coming clear. Mediterranean, evidently triumphing over, say, some other high-priced coffee.
Mike Dada published something recently that I think is going to resonate with you, because you've alluded to this a few times in the last 2 months. What if instead we have an underlying boom condition that has been partially suppressed by geopolitical turmoil and the energy shock?
That, I think, is what a lot of people are saying is actually happening. That you're seeing these upgrades to earnings that would be even bigger upgrades, that would have been a huge blowout type of quarter had it not been for what we're seeing over in the Middle East. And the resilience that you're seeing in the underlying economy and, frankly, the equity markets exemplifies that more than anything else. And I think that that is what people are coalescing around. And frankly, that is what record highs on the U.S. equity market speaks to.
Speaks to the data we've seen as well so far. ADP jobs data was pretty decent. Retail sales pretty strong. Jobless claims a few hours away. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. I'm pleased to say joining us now is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump saying the ceasefire will stay in effect indefinitely until Iran comes to the table with a new peace proposal. Iran saying it has no immediate plans to take part in negotiations. Iran's president posting on social media that the U.S. blockade and threats are the main obstacles to diplomacy. The U.S. military intercepted 2 Iranian oil supertankers that were attempting to evade its blockade. U.S. Central Command saying the 2 tankers are now anchored at an Iranian port in the Gulf of Oman. CENTCOM posting that the U.S. has directed 29 vessels to turn around or return to port since the blockade began. Tencent and Alibaba are in discussions to join a funding round for China's DeepSeek. Sources telling us here at Bloomberg, Tencent has proposed the acquisition of as much as a 20% stake in the startup, though DeepSeek isn't keen on ceding such a large portion of control. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later in the programme. Up next, playing the waiting game.
The president has not set a firm deadline to receive an Iranian proposal. The United States maintains control over this situation, leverage over the Iranian regime. The cards are in President Trump's hands right now.
Up next, we'll catch up with Victoria Coates of the Heritage Foundation, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Snapped the 2-day losing streak on the S&P 500 in yesterday's session this morning, taking some of that back. We're down by 0.5% on the S&P, down by close to 0.6 on the Nasdaq 100. And as Savannah's this morning, playing the waiting game.
The president has not set a firm deadline to receive an Iranian proposal. Ultimately, the timeline will be dictated by the commander-in-chief and the president of the United States. The United States maintains control over this situation, leverage over the Iranian regime. Not only have they been significantly weakened and obliterated militarily, but they are losing economically and financially. The cards are in President Trump's hands right now.
So here's the latest this morning. Peace talks between the US and Iran at a standstill. Iran saying it won't resume negotiations unless the US ends its naval blockade. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, at this point, the standoff in the Strait of Hormuz is only worsening, threatening the potential timeline and prospects for a deal. New this morning, the U.S. military saying that it has intercepted 2 Iranian oil supertankers it says was trying to evade the U.S. naval blockade. And at this point so far this week, we've only seen Iran try to move to tighten its grip over the waterway and boost its negotiating leverage, as data shows us that the country is now moving its supertankers into the Arabian Sea. And yesterday, the IRGC came out and said that it seized these 2 vessels in retaliation for the U.S.'s efforts. Now, White House Press Secretary Caroline Leavitt went on there to say that the U.S. doesn't view these actions as violation of the ceasefire, in particular the fact that the 2 vessels that Iran seized were not American nor Israeli flagged, but it's just going to underscore the point of how dangerous the conditions in the Strait still remain, as a military assessment presented to Congress and reported on by the Washington Post is now estimating that it could take up to 6 months to clear 20 or more mines that Iran laid and deployed in the Strait of Hormuz. John, as you've been discussing on the program, this White House says that the timeline to reach a deal at this point is indefinite, that the U.S. wants to give Iranian leadership time to come together and present the U.S. a plan. But we are starting to learn a little bit more about how the president is thinking about the pressure of energy prices. Axios reporting earlier this week the president could extend the waiver he has issued on the Jones Act in a bid to help out the consumer.
Tyler Kendall with the latest. Tyler, thank you. There is a ceasefire. It's difficult to make the case that things are peaceful, particularly given the coverage we've heard from Tyler and Jumana already this morning, that the Iranians have been firing on vessels and seizing ships.
Yeah, I was reading about the damage done to an Indian ship that thought that it had clearance to go through and then didn't, and then ended up in Iranian waters. When you start talking about mines that are embedded in the Strait of Hormuz that might take 6 months to really detonate, highlights just how high the bar really is to reopen the strait in a way that we were used to, say, a couple months ago.
Let's build on this conversation. Victoria Coates, the former Deputy National Security Advisor to President Trump, writing the following: Iran has sustained such systematic damage that they really can't recover. Time is entirely on the president's side. Victoria joins us now for more. Victoria, welcome to the program. We called this at the top of the program a high-stakes blinking contest. Is Iran willing to risk regime collapse? And is the U.S. willing to continue to put maximum pressure, assert maximum pressure on the Iranians and take the economic consequences that the global economy might have to take?
Well, good morning, Jonathan. I have to be careful what I write on my X feed because I never know what you're going to read back to me. But I stand by that. I stand by that comment. I think that, as we dive deeper into what's happening in the Iranian economy, and also the other piece of this is the fact that since they haven't been able to get product out of the Gulf since the blockade began, they're starting to fill up their storage on Karg Island, and they're going to wind up at a point in a matter of days. They might have a week or 2 weeks, but I think it's a shorter period where they're going to have to start thinking about capping wells, and that's not a good thing. That could really do permanent damage to their oil reserves, and they have the second largest oil reserves on the planet. It's one of their great strengths. That's going to be a decision point for them. So I do think that the pressure that is building on the Iranians, they have to restart their economy. They need to turn their internet back on, their stock market back on, but most of all, they need to start being able to get product to market. So if these days go by, they're going to have to make that existential decision you describe and make a choice between economic collapse and potentially preserving the regime.
Victoria, do you have confidence that this is a logical kind of regime in Iran that the United States is dealing with in the matter of financial collapse being enough of a threat to really bring them to the table? And I ask this because so many people have come on this show and said their goal is simply survival.
Well, I would never call them rational, Alicia. I think that they are right now very cornered. You've had the decimation of the 40 top leaders in the first day of this action against them. And so they're still trying to recover from that. Nobody knows where the supreme leader is. He's been supreme leader, Mujtaba Khamenei, for more than a month, and he hasn't even published a video greeting the Iranian people. Famously, he was a cardboard cutout at the announcement of his appointment. So, this is not in any way a stable, normal, functioning government. They also can't communicate. They're worried that the Israelis are in their cell phones, probably for pretty good reason, and so they're passing notes back and forth, and that's part of the delay in the negotiations. The president wants to make sure he has somebody with the authority to make those decisions at the table, and it's not clear that person has emerged yet.
One difficulty and one reason why a number of strategists have been really pessimistic is they don't see a path to an end that leaves the Strait of Hormuz open, free trade and commerce going through that, and the current regime in place. How do you see this playing out in a way that brings the Strait of Hormuz back to sort of the free flow of commerce that we were familiar with a couple of months ago?
Well, I don't think we're going to return to sort of business as usual in Iran. I don't think there's a universe in which the regime can reconstitute itself as it was. I would go back really to early December of last year and the kind of control it was able to exert over its people. And this will be a very fluid period. And I know that's disruptive and concerning for a lot of folks. But at the same time, the other thing that's happening to them is they've stopped being able to pay the salaries of their security apparatus. The IRGC, the Islamic Revolutionary Guard Corps, that's the key to their being able to control the country physically, is stopped paying its people, and their police are stopped being paid as well. So that's going to create some more disruption within Iran as the people of Iran realize that what's kept them down, the people who carried out that horrible massacre in January, maybe aren't as loyal as they were at that time, because quite simply they're not being paid. So I agree, this is going to be very fluid. We're going to have something different on the other side, and hopefully with the strength of the United States, if that weakened entity is not able to assemble the same kind of power the old government of Iran was, we'll be able to establish that control you're talking about over the strait and ensure the free passage of shipping.
Victoria, just a final question, just briefly, if you can. You've worked with the president on high-profile foreign policy issues. There is a comfort in this market right now that the president is committed to de-escalation. In your mind, what would it take to return to hostilities?
I would take a provocative action by the Iranians. President Trump has wanted that as the last resort from the beginning. He has offered diplomacy repeatedly to resolve this issue, but if the Iranians make a horrible decision, and they don't have a great track record in that, they generally do make horrible decisions, then I think you'll see the reapplication of American might.
Victoria, thank you. Always appreciate your time. No doubt we'll catch up again soon. Victoria Coates there of the Heritage Foundation. That's the situation that most people in this market ultimately think we will avoid and certainly want to avoid.
And that's the reason why every extension of some sort of ceasefire discussion has been rewarded in markets, even if there isn't a clear sign of when that can actually begin once again.
Equity futures pulling back from all-time highs here. We're down by 0.5%. Tesla in focus. We'll catch up with Ben Callow of Baird, with Tesla set to triple full-year spending. Plus, your Hira's got your morning movers. ServiceNow falling on slumping sales. That stock is down by 13% from New York City. You're watching Bloomberg TV.
problem we've got as an industry is when the government overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
All-time highs coming into Thursday, just pulling back from those levels this morning from 0.5% to 0.6% lower across the board here. Down by 0.5 on the S&P, on the Nasdaq. Down by 0.52 on the Russell. Down by 0.59 on the Nasdaq. An amazing run we've seen on the Nasdaq 100 and for tech stocks as well. For the Philadelphia Semi Index, Lisa mentioned that 16-day record-winning run. We're on track for the biggest monthly gain for semis in America since the year 2000. We're up in April, and April ain't over. We're up in April so far by more than 30%.
You need memory and you need chips in order to execute the AI hopes and dreams that have been powering the American economy and have been powering the American stock market. So now the question is, do you keep buying, or have things gotten to such a top and have gotten so extreme that you want to back off? And right now people seem to be saying, let's keep buying because ultimately this is what's going to power the future.
How insulated is that market from this? Brent, WTI, inching higher again. 4 consecutive days of gains for Brent crude, back to 103, high by 1.4%. Yes, we've extended the ceasefire, but yes, we have also extended the closure of the Strait of Hormuz.
The ironic aspect of this is that as oil prices go higher, the more that AI stocks become sort of a moat of safety, and people are going to those. It's Europe that really is going to feel the brunt of it, and that's what every economic projection says. The longer this goes on, there will be disproportionate cannibalization from the European economy, and you are seeing that in the equity move. So it's not totally irrational that the market seems to be shaking it off when you say that the market is a group of U.S. and frankly even Asian tech stocks.
It's PMI day today, and the PMIs in Europe, not good. Not good at all. Let's finish on the bond market. 2s, 10s, 30s. 2s so far this week, up around 10 basis points. Data's been decent. ADP, retail sales, jobless claims coming up later. Crude starting to bleed higher again. That's taken a 2-year to about 381.47. Yields up again this morning by 1 to 2 basis points. The good news, though, we are nowhere near where we were only 2 months ago, 6 weeks ago, when we were testing 4% at the front end of the yield curve. And I think this market's got comfortable with the idea that the bar for rate hikes is still incredibly high.
Yeah, and Kevin Warsh spoke to that to some degree in the hearings, not necessarily giving any view on rate cuts in particular, but talking about a new Fed regime that could allow you to cut rates in the face of AI productivity booms that he expects to see coming down the pike. A real question here about the long end, and I think that increasingly we need to keep focusing on that. If you reassess inflation and use a different metric to understand what inflation is as a forward-leading indicator and cut rates in the heels of that, does that lead to an unmooring of the long end of the yield curve?
10s this morning, 431, 30s at about 492. As we count you down to the open about 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Tesla shares initially jumped after earnings yesterday, but we wake up to a negative Tesla, down nearly 3.4% after announcing that it is boosting spending to more than $25 billion this year, surpassing analyst estimates and roughly triple last year's level as it ramps up spending on AI and robotics. Moving on to Lululemon, those shares also in the red, down nearly 4% after it named a new CEO, tapping longtime Nike executive Heidi O'Neill to lead this turnaround. But as you can see, the market not fully convinced because she's walking into a tough setup Competition is heating up. It's in a proxy fight, and the shares are down some 40% in the past year. And we end on ServiceNow, those shares plunging more than 13% in the pre-market after the company says large deals are being delayed over the conflict in the Middle East. And in a market already nervous around software in the AI era, that is enough to send shares sharply lower, adding to a 30% drawdown just this year. John?
Yahaira, thank you. Thank you very much. More from Yahaira in the next hour. On our radar this morning, the standoff in the Strait of Hormuz intensifying. The White House saying it's awaiting a response from Iran. Tehran saying it won't restart negotiations until Washington ends its blockade on Iranian ports. Elsewhere, IBM trading lower in the pre-market. The company posting stronger than expected first quarter results and maintaining its full year guidance. The report failing to shake investor fears about AI disruption. That name is down by almost 7%. And finally, the NEC director, Kevin Hassett, saying Fed Chair Jay Powell can stay on as head of the central bank until his successor is named.
I think that's the appropriate legal understanding, and we're all hoping that Kevin is confirmed as soon as possible, and that Jay moves on to a happy and productive life.
So after May 15th, Powell is standing in. Trump will be okay with that because he knows Warsh is hopefully.
I've not discussed that with the president.
I'm not sure if Kevin Hassett meant that to be a joke or not, but hoping Jay moves on to a happy and productive life got my attention too. I'll park that. The other piece of this that I think is interesting, Bramo, is that's now Kevin Hassett, the NEC director, suggesting that Chair Powell can stay on if Kevin Warsh hasn't been confirmed yet. And we've had the Treasury Secretary, Scott Bessent, also open the door to keeping interest rates on hold as well, for the time being, given the Iranian war, without any additional pressure, at least, coming from him.
Yeah, to me, you put these two things together and you have the economists in the room kind of pushing back a little bit to a president who's saying, I'm going to put the Fed chair right next to my office and I want him to cut rates really aggressively because they know what would happen to the long end of the yield curve. I think more importantly than whether the Fed chair will stay or not, if Kevin Warsh isn't confirmed, is a question of how Kevin Warsh is going to operate once he comes in, how he is going to overhaul the Federal Reserve, how he is going to overhaul the understanding of inflation, given the fact that he wants to look at gauges of underlying inflation instead of the one-time shocks that seem to keep percolating into our market. I mean, these are some of the things that people are trying to wrap their heads around. In the face of all of this, markets completely dead.
Inflation is a choice.
Yeah.
And as we joked yesterday, yes, it is a choice. You just pick your favorite index right now, and Kevin Warsh is maybe going in that direction.
Well, exactly. He's saying it's a choice, and I choose this index, which shows that inflation is pretty much close to 2%.
I'm not sure that's what he meant initially when he said inflation was a choice.
Well, that's the reason why we all took that as hawkish. Then the rest of the market said, well, actually, he's just choosing the index, and the index is a lot lower. So I like that choice. Keep cutting.
The NEC director says you can stay on. The president says you're going to be fired if you don't move on. It's an interesting dynamic right now.
It kind of goes to the whole Chris Wright thing, which is gas prices are going to remain above $3 probably for the remainder of the year. And President Trump says, I don't agree with that. So it's a difficult sort of needle to thread, considering the fact that we have people who are mired in these markets. And we have a president who is messaging a very different type of thing.
That's the latest on the Federal Reserve. Elsewhere, Tesla, those shares trading lower in the pre-market. The EV maker raising its full-year capex to $25 billion as it ramps up its push into AI and robotics. The announcement overshadowing strong first-quarter results. The stock down by a little more than 3%. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning. What were the big takeaways for you yesterday afternoon?
I mean, for Tesla, $25 billion is a monster number. A monster number. You know, capex previously peaked at about $11 billion in 2024. But the warning, right, is that because of their commitment to enter this kind of multi-year investment cycle to fund the humanoid robot, to fund the robo-taxi, the balance of 2026 is going to see them be in negative free cash flow. And so the market's immediate reaction this morning is they don't like that. You know, it's been so interesting. Elon Musk framed this capex commitment, which is up from the prior guide just last quarter of $20 billion for the fiscal year, as just being in line with the environment, right? He said, well, everyone else was doing it, so you should expect us to do this. Of course, Tesla isn't doing capex at the level that the hyperscalers are. But the way you introed the segment, John, is absolutely right, because what's so funny is all of the people saying, don't even bother talking about the car company bit, are kind of eating their hat. There was a lot of evidence initially when the print hit that demand is returning. And actually, the CFO, who often gives a lot more granularity than Musk does, said high gas prices are driving demand short-term returning to EVs, which is really interesting. A lot of news was packed into the call. You know, Elon dropped a lot of sort of quick-fire commentary on the plan to build chip manufacturing. That drove the shares of Intel. But really, this is now Tesla in spending mode to deliver on the things that it's tried to keep investors looking to the horizon on for some time.
Ed, thank you, buddy. Appreciate the update. Ed Ludlow there. Look out for Ed later on this morning, 11 a.m. Eastern Time on Bloomberg Technology. That stock is slightly lower. I thought Lisa asked a fantastic question a little bit earlier on in the program. Is this a gut check for the Metas, the Microsofts, the Alphabets to report next week?
You can make an argument that Tesla needs to spend big because their auto manufacturing side of the business is not going to reap the kind of multiples that it currently is trading at. And yet when they say they're going to spend all of this money to invest in those hopes and dreams, people say, we're not buying it, we're going to sell. So if you get the Microsoft, the Apples, the Amazons, et cetera, Apple maybe is another story, saying that they're going to engage in much bigger CapEx programs than people expected next week, do we see some of the sheen come off the AI trade once again?
Wednesday is a big day for tech earnings next week, the same day, by the way, that we get the Federal Reserve decision. Let's get the view from the analyst community. Ben Callow of Baird trimming his price target to 522, keeping an outperform rating, writing in the long term. We view Tesla as a core holding in the very short term. We think the stock is likely linked to the SpaceX IPO and potential merger rumors. Ben joins us now for more. Ben, we'll get to the earnings later. I've got to pick up on that line. It's so important. What is the relationship between the performance of this stock and what's about to happen with SpaceX?
Well, good morning. Thanks for having me on. I think a couple-fold. First, the reason we think that ultimately the two companies make sense together, there's obviously synergies between operations. There's synergies between costs. There's a control issue with Musk that would help his control of Tesla if they did merge. But on the call, I found something very interesting. He said that when it was talking about the Terafab, about how difficult it was to get approval and the lengthy process of having to go to each individual boards. I think that's him priming the market for the companies to come together. And then just going back to the previous conversation you guys were having about CapEx versus the other Mag 7 companies and how they really dwarf Tesla's CapEx, even though they raised it from 20 to 25 billion. It's double what they did, more than double what they did last year. It dwarfs in comparison, and I think the two companies combined together can help get that scale needed to run in this CapEx AI race that Elon is certainly part of right now.
Ben, does it seem to you like Elon Musk is sick of running a car company?
I think that the car company is a foundation, but an important part of it, the car company, the energy business, which is very strong right now because we do need electrons, we need storage, we need generation. But for Tesla, the car business and the energy business, they are going to provide that cash flow, even though they're going to burn cash this year and into the really the foreseeable future. It does provide cash for that CapEx and that next generation. The car business also is the foundation for the robo-taxi business. It's helped them gather nearly 10 billion miles of data out there so that they can scale. And, it's interesting to see them scaling with a safety rider out into other Texas cities. And I think that they'll continue to scale faster than originally predicted this year. Although it's taken a long time, I think that we're at a turning point there.
Ben, do you think that ultimately getting into Tesla now is a cheap option to get into the SpaceX IPO later? Is that kind of how you're seeing this play out as we expect that to come to fruition later this year?
I think that for patient investors, it is a way to invest in ultimately what we think is going to be a combined company. Even on a standalone basis, I think in the short term, you have a flow of funds, maybe people raising capital from selling Tesla to buy SpaceX. That's out there as well. And then we're kind of in a wait and hold period to see if they actually do come together or what the plan is until Elon says no or go forward. It's kind of in this kind of lull here. But I think that if you're a patient investor, now's the time to buy.
Ben, if you want to get aggressive, let's pick out one final name. It's another name that you cover. Ben, GE Vernova, a gain of 100% last year and up more than 70% this year, up big time already this month, given the gain to the last 24 hours. The bar's high. They keep skipping it. How promising is business over at that company?
It's very promising. I think it's a great bellwether and a great stock that is right smack dab in the middle of all of the electrification, the energy generation. We're short on electrons, and I agree with the CEO of GE Vernova that we're in this super cycle, and we at least have a decade. Elon's talking about sending data centers into space because of energy constraints, and GEV's out there, providing gas turbines and then generation equipment, to hook up to the grid. And so they're right down the middle of it, and they have a long runway. They're getting price in their turbines. And I think that we'll continue to see that, our grid is going to be stressed, and we need to invest heavily into it. We're underinvested in it, and now we're adding not only, new manufacturing, but, big data centers that are equal to the size of energy draws of major cities out there. And so a great way to invest in that long-term trend that we haven't seen before.
What a rally. What a rally. Ben, thank you. Ben Keller there of Baird. We caught up with Scott back in January. He sounded confident then. I think there was good reason to sound confident based on these results.
When you take a look at first quarter electrification revenue, it is up 61% year over year from GE Vernova. When you take a look at power revenue, up 12%. A real question here about just how they can keep up with demand, and that really has been the story for all of the energy providers and the manufacturers of the equipment needed for it.
Quite phenomenal, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Back with us, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The Trump administration nearing a $500 million bailout of Spirit Airlines. Sources telling us here at Bloomberg the deal would give the government the option to take ownership of up to 90% of the carrier once it emerges from bankruptcy. United Airlines CEO Scott Kirby discussing the plan with Lisa.
This was a fundamentally flawed business model that I've been on going back into the last administration saying it's going to fail because the business model doesn't work. And so I think the spike in fuel prices just moves it forward by a couple of months.
Kirby sidestepped questions about a potential merger with American, but acknowledged that the current climate might offer opportunities for deals. Lululemon has named former Nike executive Heidi O'Neill as its new chief executive starting in September. O'Neill takes over as the athletic apparel retailer is facing slowing growth and investor unrest following recent product mishaps, including the sale of see-through leggings. Italy could make an appearance in the upcoming World Cup. The Financial Times reporting a top envoy to President Donald Trump asking FIFA to replace Iran with Italy, arguing Italy's 4 World Cup titles justify awarding it the slot. That is your Bloomberg brief. John.
Vonnie, thank you. Obviously, I disagree. You've got to earn it on the field, the pitch.
I know.
No?
I know. Yeah, no. I think
not convinced?
No, not at all.
No?
I think that you still would go.
Obviously.
So, it would be a better marketing pitch.
Come on. I'm not going to pretend I'd be disappointed.
I know.
But I do think you've got to earn it.
Yeah. You have to earn it in order to pay for the tickets, frankly, to get there. So that's the truth.
You've got to earn it. Up next, crude under pressure.
This next Brent expiration, if we don't start seeing that convergence, then we may be in a position where no matter what type of news flow happens, the situation keeps getting worse and futures may not respond.
Oil back at triple digits. Brent crude on a 4-day winning streak. Paul Sankey of Sankey Research joins us next.
The frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like
very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures slightly negative, down by 0.5%. Our next guest is so keen, he already wants to answer questions we haven't asked yet. We'll get to them in just a moment. Calm down, Paul. On the NASDAQ, we're down by 0.5. At the surveillance this morning, let's talk about energy. Crude supply under pressure.
This next Brent expiration, if we don't start seeing that convergence, then we may be in a position where no matter what type of news flow happens, physically on the ground, on the water, the situation keeps getting worse and futures may not respond. The differential between them was never contemplated to be this wide. So in some sense, it's broken, right? And it may need to be reconfigured after this.
So here's the latest this morning. Crude climbing for a fourth consecutive day, back over $100 a barrel with the US and Iran seemingly deadlocked. Joining us around the table, Paul Sankey of Sankey Research. Paul, good to see you.
Hi.
Have you met Lisa before?
Yeah.
All right, okay. Moving on.
Inside joke.
Inside joke. Let's go on.
We'll move on. Paul, before this war started, the day before, Exxon closed at around 150. Exxon closed yesterday around 150. Why hasn't this war and this supply hammering that we've seen in the last 2 months energized a rally in energy names?
Well, the energy names were running hard into this. You know, they were the best performing sector of the year to date, and that had, you know, very much reversed. So you had tech going down, oil going up, and I think that was important because in many ways the market was adding terminal value into the oil. So what they were doing is they were buying on the basis that the oil age isn't ending. And, you know, you had fundamentally more long-term value in Exxon. Exxon themselves had come out with their long-term energy plan in October, around the time BP capitulated, the IEA capitulated on the end of the oil age. So Exxon came out and said, actually, we think global oil demand is going to be flat through 2050. So the market began to think, you know, actually and of course the AI energy requirement, natural gas requirement, the market began to buy in a very big way to the idea that the oils were fundamentally worth more because they have a much longer outlook for their products. And so that was bullish. But of course, when you get into this situation, and this is what we're looking at directly today, and I'll mention in passing that there's also been some profit warnings for Q1 that we saw, which is to do with inventory values changing massively because of the crisis. So you're going to have some very big headline losses reported by the oils in terms of their working capital in the earnings season that's coming up right now. But then what we saw here is that people are typically unwilling to buy into the oils at a peak price. And what we've seen at times is the oil price will come down and the oils go up. And that's big investors wanting to get into oil but not wanting to buy when jet fuel's $200 a barrel. But you can see the underlying bid is there. Now, of course, it gets more complicated because then we had this huge tech rally. You know, so people were shoving money back into NVIDIA or whatever they were. So we didn't get part of that bid either. And I'll leave it to you geniuses to work out why tech was so strong. But I think that the AI theme has remained on course, and particularly the AI CapEx. And so there is an argument that the AI theme is, I mean, all the language from the companies is it is going to be vast, it is going to be huge, and people wanted to buy back in. But I think over the coming months, this is going to unfortunately deteriorate badly, this situation. It already is, but it's nothing to say that it's going to not be anything other than deteriorating over the next 2 months. We're locked into that. And so I think the market has, it's been a great rally, an all-time rally by some measures. But I think this is it's gonna come back to us. And I think, John, another one of your expert areas is the T. What we're looking at is the T-bill and how government finances can really handle this total disaster, and it's going to be difficult.
Before we get there, though, it's easy for people to say oil prices are going to remain structurally higher for the foreseeable future as a result of this, regardless of whether it gets resolved or not. Why is that not enough to give a boost to some of these oil majors, and why aren't we seeing them invest in CapEx?
Yeah, I think that's a good point, and I think it becomes a demand destruction case. So what happened, we have an almost opposite of COVID effect here, but what you saw with COVID is in 2019, world oil demand hit a record high. You structurally lowered it, and you had just fought your way back over 6 years, 5 years, to be at record highs again. Literally in February 26, you were at all-time record highs for global oil demand. And I think what you'll see out of this crisis is actually a structural reduction in oil demand, as well as a structural increase in the oil price. So I think that's one of the reasons why at this energy forum we were talking about this week, Kees Van Hoff, the really outstanding CEO of Diamondback, was talking about the fact that the future strip's at $72 for next year. And there's nothing he can do with that. He can't sell into it. He can't drill more on it. It's really another interesting aspect of this crisis, which is the future strip is disincentivizing investment in more oil supply in the way that we need it. And so the companies aren't changing their CapEx plans. The AI guys are, Tesla is, but you won't see any, in my view, you won't see any public oil company make a major change to their CapEx plan on this Q1 earnings.
Paul, we've got about a minute left. You seem to think this is going to get very bad. And I just want you to spell out why, because there is a degree of comfort that people have got that we're on a de-escalatory path.
Well, the comfort comes from the fact that the tankers only stopped arriving last week. It's a 40-day process. And so almost immediately what we've seen is the inventory numbers have now started to get scary, and it's just starting. But you're not at the stage of just outright crisis pricing. You're not at the stage where American very low share of their income goes to gasoline, 3, 4, it's 8, 9 in Germany. It's not that big a price. It's a sticker shock, but it's not really that huge an effect for the average American. Obviously, it's regressive and bad for poor people. So I think that the situation here gets worse simply because it's guaranteed. Normally when we're forecasting oil, we can be very, very wrong for extraneous reasons. In this case, we can be sure that the next 2 months is going to be an ongoing absolute disaster, even if you open the straits tomorrow, because it's just locked in by virtue of tankers. And the tankers are all in the wrong places. It probably means it's 3 months. So it's a very bad situation, and we're looking at where the supply chains are breaking. We've focused on Australia, on jet fuel. People are talking about solvents in Japan for chip making today. You'll see where the cracks really start to appear. And then finally, there's another issue, which is emergency inventories. The first slug is easy to release. The second slug, you're going to release it, but you're going to be scared. And then there's a question of, can you really release the third slug? So the emergency inventories are probably lower in real, actual terms than they appear on your screen, and they appear very low.
This is quite sobering stuff. Paul Sankey, appreciate your time. Thank you, sir. Paul Sankey there of Sankey Research. Up next, Nate Turf of Manulife, General Robert Walsh of Academy Securities, Don Stroyven of Goldman Sachs, Christina Campmany of Invesco.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard you know, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, you know, these things can go on for a long time, but ultimately, you know, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the trend, the technology trend and the investment is real.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We're definitely seeing strength of the U.S. consumer accelerate.
That growth is coming across the board in the consumer segment.
Consumers are wary, but again, as long as they're working, I think they can make it through.
We do think you'll see inflation begin to recede.
It's very clear there's a lot of resilience in the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Snapping a two-day losing streak on the S&P in yesterday's session. All-time highs coming into Thursday, pulling back this morning by 0.4% on the S&P, on the NASDAQ by 0.3. In the commodity market, 4 days of gains for crude on Brent, back in triple digits, 103, and up by 1% this morning. And that screen is doing some real damage to the airline industry. We've seen the likes of United cut their outlook. We've seen Lufthansa slash flights, 20,000 of them going into the summer, and numbers from American Airlines just dropping.
Yeah, they said that they essentially met operating revenue for the first quarter. It met the average analyst estimate. When you look through here, you see that available seat miles are a bit above where it had been expected. They do have an adjusted loss per share of 40 cents versus a loss per share of 59 cents year over year. So a better than expected, lower than expected loss. That said, talking about the year ahead, talking about how expensive gas fuel is going to cost, jet fuel is going to cost, talking about how they essentially are going to hold a lot of their guidance flat. This is what we're going to be looking through as some of these earnings come through.
We're going to have some price pressures stateside. They're going to have shortages in Europe. That's different. And the way these airlines respond domestically in America and how they respond internationally in places like Europe could well be different too.
Well, in Europe, they're going to have to cut a lot of the regional flights, and we've already seen that from Lufthansa. For the United States carriers, a question of how do they prioritize international flights, given the fact that it's going to be really expensive to refuel on the other side to come back. How high are the prices, and how much do you see demand destruction as a result? You see American, you see United, you see Delta all prioritizing their premium offerings, and this really is key because this is where they make their money. And how much can they jack up those prices? $15,000 flights over to London and still get the business customer coming through, given the fact that ultimately it may cost that in order to get to the other side of the pond.
It's quite a headline, isn't it? American Air, more than $4 billion expense related to fuel costs. It's quite a number.
I mean, this is what you're seeing from a whole host of different airlines as people look through and see how much their expenses are going to go up. A question of how much can you keep passing that along to customers? Again, that is why they're leading into premium, and that is where the bulk of all of the profits are coming from.
And that kind of speaks to the numbers we just got from American Express. Amex first quarter EPS 428, the estimate 403. the financials, the likes of American Express. Some of these names just speak to an economy that's doing better than okay.
Well, that's the reason why everyone is reporting better than expected earnings. That's the reason why, even though American Airlines is reporting a loss and a $4 billion expense tied to jet fuel costs, you're seeing still the shares up in pre-market trading. American Express talking about premium card spending staying strong. So here's what we're going to have to ask economists. How much is this just the upper quartile being able to spend, the wealthier individuals and the K-shaped economy really expressing itself, and how much does this really express underlying strength that has been masked by what's going on, overshadowed by what's going on in the Middle East?
Equity futures are raising losses this morning, negative by 0.4%. Coming up this hour, we'll catch up with Nate Turth of Manulife Investment Management after stocks hit fresh all-time highs. General Robert Walsh of Academy Securities on the high-stakes pause in the US-Iran talks. And Dan Stroyven of Goldman Sachs as crude climbs back above $100 a barrel. We begin this hour with stocks pulling back following a record-setting session. Nate Turth of Manulife Investment Management writing, the next few weeks will tell us whether strength broadens or whether this remains a narrow, high-quality earnings cycle. Nate joins us now for more. Nate, welcome back. Last time we caught up, you played down the risk of a repeat of 2022. Can you give us an update on your thinking now we've played through this story through the last 6 to 8 weeks?
It's great to be back. I agree that we are still in a world where I don't think 2022 repeats itself. We have a much more resilient economy. We have companies that have been through supply chain shocks before, so they're more prepared. And we have just general resilience that we're seeing across corporate America. And given how the U.S. indexes are skewed towards technology and financials, it's a world of have and have-nots within corporate world, just like it is a world of have and have-nots in the economy. And so we still have a very resilient underlying corporate America, which is driving risk assets, especially U.S. equities, higher.
The earnings from semis and the whole AI ecosystem have been phenomenal, incredibly encouraging. Overnight, we heard from Texas Instruments, strong forecast from them. We talked about GE Vernova yesterday, again this morning, making some big moves in their order book. In fact, the quarter in some measures was better than the whole of last year. Nate, the haves, they're the haves. Who are the have-nots in this equity market?
Well, there's a lot of have-nots, but if you think about the haves first, haves make up basically 80% of earnings growth this year. It's about 60% from technology companies, and another 20% is coming from financials. So the rest of the index, all the other sectors, are well under when it comes to potential earnings growth. And that includes everything from consumer names to the more cyclical names. The one area I would say that's still a little bit of a bright spot is part of the industrial sector and aspects of the healthcare sector. But everything else is not growing nearly as well as what we're seeing in tech and financials.
Does that mean it's an opportunity, or is that a warning sign, Nate?
I think it's a mixed bag. There are certainly some opportunities in certain sectors. We like a number of the industrials because of some of the secular tailwinds behind that, whether it's AI build out, whether it's robotics, whether it's capital spending for the energy cycle, when it comes to just more efficiency gains, infrastructure for power, et cetera. There's a lot to like about industrials because there's secular themes that are playing into it, including AI. And then healthcare is the only sector in our view that can compete with technology from a secular growth perspective. It's unfortunate, though, there's just a lot of regulatory overhang and a lot of negative sentiment that has impacted healthcare in a more negative way. And valuations are showing that because it's historically cheap versus its average.
There's a real tension right now in markets, Nate, and I'm watching some of these earnings come through, whether it's American or whether it's American Express. This idea that the U.S. consumer can keep spending and they're willing to absorb higher prices to keep doing the things that they have enjoyed doing, which points to this inflationary backdrop that we might be looking at. People have been saying that this is going to be a one-time shock or it's not going to be long-term structurally inflationary. At the same time that the strength in the U.S. economy is raising real questions about that. How do you see that playing out through your portfolio?
I think it's an important dynamic. The reality is we have an environment where the wealth effect, particularly those on the higher end of the income spectrum, are doing very, very well. And as long as equities continue to do well, and that wealth is not impacted materially, you have a broad underlying driver, particularly for the upper echelon, to continue to spend and spend a lot. And unfortunately, on the flip side, you have a big part of the economy that's not benefiting from that, and they are struggling. And despite the fact that inflation probably is a bit transitory, as this is a one-time kind of shock, that doesn't mean it's going to go back down. So these prices are here to stay. It's just that the fact that the prices going forward may not go up as much as they have been going up. And so the reality is we still have versus have not economy when it comes to the health of the consumer. But do not underestimate the wealth impact as it pertains to the broader dynamics that drive consumer indices when it comes to the strength that it's shown.
And Nate, back in 22, we had a very, very different central bank posture. At the Federal Reserve, there is a high bar to hike interest rates. What were your reflections on the hearing we had with Kevin Warsh, and how close are we to the next move from that institution?
I think it's hard to read too much into just the hearing, because the reality is this is a person trying to get a job. They're going to tell them, he's going to tell them as much as they want to hear that's supportive of what he thinks is the right answer for what the outcome is for the Fed. The reality is they are going to still be a very data-dependent Fed, and this new member is just one voting member, not the only voting member. Right? And so we got to think about the weight of the evidence. We think the Fed is very inclined to cut rates if job data weakens, if growth weakens. But at the same time, they're perfectly content sitting on the sideline and holding pat as long as there's this lingering concern about inflation in the background and the job data still looks okay and growth still looks pretty good. And so we're in a wait and see mode for the Fed. But ultimately, we do think the Fed will still get in at least one, if not two cuts by the end of this year.
Is inflation a choice? And I don't mean with respect to monetary policy. I mean with respect to which index you look at to determine exactly what the inflation rate should be?
It is, clearly, because you have top-line inflation, and that's being impacted heavily right now by energy dynamics. And then you have broader inflation trends. And if you look at broader inflation trends, there's a lot of downward pressure, particularly when it comes to housing side of things, and when it comes to some of the areas of consumers that just aren't doing as well, and the spending on those types of dynamics, particularly household goods and furniture and things like that. So there's a lot of downward pressure on inflation, just as there's upward pressure in other areas like the energy sector. So it is a balancing act, and the construct of those indices do matter when it comes to what that data looks like. But ultimately, we think what wins out is we do have inflationary trends, ex energy, that are still quite favorable to the downside.
It's nice to get a constructive view. We appreciate your time. Thank you, sir. Nate Tuff there at Manulife Investment Management with a constructive view, given the dire forecast that we had from Paul Sankey of Sankey Research about 15 minutes ago.
Yeah, especially because he said that there would be structural demand destruction as a result of higher energy costs, meaning that people wouldn't do certain things as a result. Well, maybe they wouldn't do certain things in Europe, but in the U.S., evidently, they're doing things just fine. I just wonder how this filters into inflation, because if people in the U.S. are accepting higher prices and able to keep spending, especially if they're at the upper echelons of the earning spectrum, how does that filter out into pricing that affects disproportionately people at the bottom end of the K? I mean, this is the conundrum that the Fed might not have the tools to address, but will be faced with when they're making very political decisions.
That's the pushback to the 22 repeat. The labour market isn't as tight. The consumer price tolerance isn't as high. And for that reason, you're not going to get this broad-based inflation story. My question would be, without this war, how strong would this economy be right now? The Amex numbers we just saw moments ago, top in forecasts. We've seen this repeatedly across the financials and the banks. You've voiced this as well. I think very well played to you over the last 2 months to keep asking this question. From Mike Dada over at Roth, what if instead we've been having an underlying boom condition that has been partially suppressed by geopolitical turmoil and an energy shock?
That is essentially what all of these earnings are telling us, that we were seeing a boom condition that has been suppressed. Question now, how much can that boom condition continue and persist in the back end of this if this continues for a longer period of time? And that speaks to what Paul Sankey is talking about.
Equities recovering just a little bit. We're down by 0.4% on the S&P with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Pentagon telling Congress it could take 6 months to completely clear the Strait of Hormuz by mines placed by Iran. The Washington Post reporting that a senior Defense Department official laid out the timeline during a classified briefing. SoftBank is seeking a $10 billion margin loan backed by its shares in OpenAI. Sources telling us here at Bloomberg the 2-year loan will carry an option for SoftBank to extend the borrowing by an additional year. The company is taking on more debt for its push into AI. White House National Economic Council Director Kevin Hassett showing support for Fed Chair Jay Powell. Hassett saying Powell should remain at the helm of the central bank on a temporary basis if a successor is not confirmed when Powell's term expires next month. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Always good to catch up with Vonnie Quinn. More from Vonnie later this hour. Up next on the programme, locked in a leverage standoff.
The president has not set a firm deadline to receive an Iranian proposal. The president chose to extend the ceasefire because it's Iran who needs to get their acts together.
Up next, we'll catch up with General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Stocks slightly softer, down by 0.4% on the S&P 500. Small pullback from all-time highs on the Nasdaq 100, down by 0.4%. We've talked a lot about this run in semis, but what a run it is. 16 days of gains, a record long daily winning streak for the Philadelphia Semiconductor Index. And within that, some of the names putting up the numbers. Texas Instrument being one of them.
Yeah, Texas Instruments came out and boosted their earnings tremendously and their outlook as a result of AI-tied tools. You saw a similar kind of move from GE Vernova, also completely rewarded. Now the question is, can you see that kind of boom from some of the hyperscalers? Because this is the picks and shovels side of the story. This is sort of the energy, the memory, chips, et cetera, that has been absolutely surging. Can you see the actual users of it monetize it, or are they just fueling this gain because they're willing to pay whatever it takes to face off this existential risk?
And is it strong enough to insulate this market from this? Crude up by 1% this morning. Brent around 103, four-day winning streak, and that's coming with a big, big bill for the airlines. American Airlines seeing over $4 billion boost in expenses due to fuel prices.
Yeah, and cutting their full year forecast for profits as a result of this. This is what we're hearing from all the major airlines. What they're leaning into, the premium offerings. They're talking about retrofitting old planes. They're talking about adding some of those business class in extra legroom types of seats, because that is where the profits are being made. Guess why? Because it is the upper income consumer that is fueling this consumer boom that we're seeing in the United States, whether it's American Express, whether it's American Airlines, or whether it's United.
Funded by Amex, I was going to say, topping estimates. At the same time, American Airlines were posting those numbers. Brent crude this morning at 103. Under surveillance this morning, locked in a leverage standoff.
The president has not set a firm deadline to receive an Iranian proposal. The president chose to extend the ceasefire because it's Iran who needs to get their acts together. The United States and President Trump have been very clear in our demands and our red lines and what we need to see in the best interest of the American people and our country and our allies from the very beginning.
So here's the latest this morning. Crude extending gains as the power struggle in the Strait of Hormuz builds, and the US-Iran peace talks remain at a standstill. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, the standoffs and the potential talks and over the Strait of Hormuz appear to only be worsening because at this point, the two are linked. Iranian negotiators have repeatedly said they won't resume talks until the U.S. lifts its naval blockade. The thing is, President Trump has maintained that it's not going anywhere. And new this morning, the U.S. military confirming it had intercepted 2 Iranian oil supertankers it says was trying to evade the blockade. Now, it is just the latest in what has been a series of efforts this week by Iran to try to test the U.S.'s limits, including the IRGC confirming yesterday that it had seized 2 vessels. Now, the White House press secretary actually went on there to say that the U.S. didn't view this as a violation of the ceasefire since the vessels weren't American nor Israeli flagged, but it does just underscore how dangerous conditions remain for nearly all shippers, as the Washington Post reports on this military assessment that was shared with Congress that estimates that Iran had laid 20 or more mines in the Strait of Hormuz and that it could take nearly 6 months to clear them. Now, we should say that a spokesperson for the Pentagon did tell the Post that that information was inaccurate, but it's adding to fears, of course, about how long it will take to get a safe strait. But, John, at least we can point to one effort at de-escalation, which is the White House coming out yesterday saying that the timeline for the ceasefire extension does remain indefinite in a bid to give Iran some more time to come to the negotiating table with a new proposal. We can confirm that Pakistan is still trying to mediate these efforts. Just yesterday, the country's prime minister did say that it met with Iran's ambassador.
No sign of a breakthrough just yet. Tyler, thank you. Tyler Kendall with the latest down in Washington, D.C. To extend the conversation, General Robert Walsh of Academy Securities writing, this isn't a breakdown. It's a high-stakes pause with escalation risk if neither side blinks. General Walsh joins us now for more. General Walsh, welcome to the program. My first question for you, sir, is whether you believe the U.S. has the leverage to force the concessions from the Iranians.
Hi, good morning, Jonathan. Great to be with you again today. I think right now, certainly, there's no question about what's gone on in the first phase of the campaign that's gone on with all the attacks and how far down Iran's military has been taken. There's no question at all the U.S. has the leverage. Obviously, there was a period in there where it seemed like Iran had taken some of that leverage back when they closed the Straits of Hormuz. But I think the counterstep, the chess move that the U.S. made to blockade the Straits and put both economic and military pressure on the Iranian government, this to me was really clear to show that they've got the leverage. And that's why I think right now the Trump administration is willing to sit back, give the Iranians more time because of the leverage that they have right now.
General, the Iranians have lived under very powerful sanctions for a long, long time. In the West, we have first world problems. We worry about a flight being cancelled for our summer vacation. Maybe we have to cut back on certain things. They've been living a very different lifestyle for an extended period of time. And I just wonder whether we're underestimating the pressure point for the Iranians. How do you reflect on that idea?
No, I think that's an excellent point, Jonathan. They can take a lot more. So right now, by putting an economic blockade, and we look at that, how long will that stranglehold take to really have an effect on a very radical Islamic government like that we're dealing with there? You could go back to World War II. You could go back to the Japanese. You could go back with how we dealt with Nazi Germany. It took a lot. You took a lot in the Civil War with Operation Anaconda to do a stranglehold. They can take a while. So that's why I think this is a move to show leverage, to get the Iranians to the negotiating table. And I think there's going to have to be some small concessions on the U.S. to get to some type of off-ramp to get to those negotiations. Because if it's just straight the blockade and the pressure, we don't know exactly how the Iranian government will act. But they certainly could sit down and hold back for a long, long time.
General, in the meantime, on the U.S. side, there have been a number of high-level departures from the U.S. military ranks, the latest being the Secretary of the Navy, previously the Army Chief of Staff. How do you view these departures in light of the larger scheme of things? Does it seem more like signal or like noise?
I think when it comes to the troops out in the field, the sailors, the Marines, the airmen that are out there conducting these operations, this is really noise to them. They've got a very focused operational commander in Admiral Brad Cooper They're focused on the mission, and having been in these type of missions before, you're just heads down, focused on what your mission is. That's all noise back in Washington. They focus on what their commanders are doing in theater, and they get at the mission. So that's a lot of things that go on in Washington that will not really affect the mission at all.
At the same time, a number of people have come on the show and said from a military execution standpoint, it's been excellent. And as far as accomplishing the goals set out, there's a real question strategically of how to accomplish the end result that people are talking about, which is a Strait of Hormuz that can allow free travel of shipments without paying a toll to Iran. What is the way to get there, given the fact that it seems unlikely that this regime in Iran would give up one of the only levers that it has of leverage?
Yeah, I think the key thing here is it's going to take both diplomatic, economic, and military pressure on Iran. It's all of those things. It's the hammer in the background that the military can bring, and all Iran has to do is see the vast amount of military force that the U.S. has continued to bring to make it even larger when, Operation Epic Fury started. We've got more forces there. So that hammer is there, and you see how far the Iranian military has been reduced so far. But now it's going to get to negotiations, because comparing back to your last point, is this regime is willing to sit down and take pain for a long time. So I think it's going to take both the economic pressure on there. It's going to take the diplomatic side. It's going to need to get to the negotiating table with the Iranians. And right now, the problem with getting to negotiating tables is because of the split between the politicians and the IRGC, it's hard to get to a unified position. So the Trump administration, I think, did the right thing by giving the Iranians some time to pause, an indefinite ceasefire, to really kind of get their act together, to get a unified position, to come forward with a term sheet on what they're looking at to get the negotiations started. Those negotiations, once they get started, now they can have the discussions about starting to open the Straits of Hormuz and releasing that pressure that's on the world markets today.
General, how comfortable are U.S. partners in the region with an open-ended ceasefire?
I think at this point, Jonathan, that they want to see the war end. The ceasefire has occurred, but they want to see this end in a good way. So I think their positions align very much with President Trump's. They don't want to walk away from this and we go on for this for years and years and years. They want to end this. So they're hoping that between the military and economic pressure that is on them, we can come up with a good solution. So I think they're very much aligned. In fact, I would say, and they're aligned so much that they want to see this through in the same way the Trump administration sees it, that we end this and we see Iran as a viable neighbor in the Middle East, and bring them into that. As difficult as that may be seen with this radical government, that's the end state we'd like to get to, where we don't see this constant cycle of violence that's gone on in the Middle East, all caused by Iran over many decades.
That would certainly be a major win for the region and for the world for that matter. General, always learn something when I catch up with you. Thank you, sir. General Robert Walsh there of Academy Securities on the pressure point for the Iranians. And just the idea that this could go on longer than you think.
You asked the key question, though, which is, will the regional partners be okay with that? The goal might be right, but how do you get there? And that ultimately is really the detail that's the sticking point.
Coming up on the program, we'll catch up with Don Stroyven of Goldman Sachs with crude back in triple digits, plus Jahira's back with your morning movers. American Airlines rising on strong first quarter demand, but held back by a major expense associated with fuel costs. That conversation up next.
tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Equity futures pulling back from all-time highs. We're negative 0.5% on the S&P 500. Similar move on the Nasdaq, down 0.4 on the Russell. The small caps down by 0.6. The guide coming from corporate America, pretty decent. Strong forecast from Texas Instruments. Strong numbers from American Express. First quarter EPS 4.28. The estimate just north of $4 a share. We'll get to some of those names in just a moment. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We've gotten a wave of earnings this morning, and we start with American Airlines flipping to negative, down 0.4%, even after stronger than expected results with losses narrowing and demand holding up. But the bigger story and what's weighing on this name is what comes next when it comes to fuel. The airline warning that higher oil prices could tack on more than $4 billion in costs this year. Moving on to a name in the positive, American Express out now just slightly, but still in the green. The credit card company beating expectations as its premium cardholders keep spending, transactions jumping 10%, showing some resilience at the top end of the consumer. No surprise because of what we hear on this program all the time about the K-shaped economy. And we end on Tesla. Shares are falling 3% in the pre-market after announcing it is boosting spending to $25 billion this year, surpassing analyst estimates of about $20 billion and about triple last year's level. John.
Yahara, thank you. More from Yahara later in the program. On our radar this morning, crude rising as peace talks in the Middle East remain on pause. Iran saying it will not resume negotiations until the U.S. naval blockade is lifted. President Donald Trump demanding Tehran hand over its stockpile of enriched uranium. Elsewhere, Lululemon naming former Nike executive Heidi O'Neill as its new CEO starting in September. O'Neill facing the immediate challenge of easing investor concerns and regaining market share in the very competitive athleisure category. And finally, American Airlines and Alaska Air are discussing a major revenue-sharing partnership. Sources telling us here at Bloomberg the deal would include adding Alaska into American's global network in an effort to better challenge rivals.
This comes after we get the American Airlines results for the first quarter, cutting full-year earnings forecast as a result of higher fuel prices. How much do we see an acceleration of mergers and acquisitions in the airline industry as a result of higher fuel prices? It also comes as American Airlines tries to rebut United in a very personal type of squabble between these two airlines, with United looking or reportedly vying to buy American Airlines saying we're absolutely fine, ruling out some sort of acquisition or merger with Alaskan Air, but still coming up with different ways to fortify their earnings stream.
I'm always tracking people's body language in an interview when I'm watching them and when I'm conducting them at the same time. And when I was watching you interview Scott Kirby and you asked him about this, there's this very interesting moment where he just looks off camera, smiling, almost looking at his team as you ask him that uncomfortable question about going after American Airlines.
He didn't answer the question. He can't answer the question. I'm sure his legal would have a coronary. The question, though, ultimately is, what would be the goal for United should they want to buy an airline? They talked about international presence because that's where the money is. They want an international type of footprint, and they consider their rivals the international airlines that have a disproportionate number of flights of U.S. customers to Europe and back. So they want to get that share back. This is the pitch, I'm sure, that they're making to the antitrust regulators, saying, ultimately, we need a strong U.S. airline, and our competitors are international, not necessarily the big three. American is saying, look, we're fine. Look, we even have a revenue sharing deal with Alaska Airline. Either way, the pressure of high oil prices very much prompting an acceleration of some of the M&A that we otherwise might have seen down the line.
So what did you sense that he really wanted? Some gates, some access to, say, JFK, to do that through some kind of merger, some kind of acquisition? What do you think he wants?
You know, he didn't say. He said that ultimately he's more interested in international. He kept repeating that. So it seems like it's perhaps a little bit more than a couple of gates. There also is a feeling that the international scheme has really changed, especially in light of how high oil prices have gotten, and frankly, the fact that a greater proportion of the dollars are coming from the premium customer. So if you want to make revenues in a consistent way, you are going to have to really get a bigger part of that share going internationally. And how do you do that? Well, it isn't small. That, I think, is the key point.
It was a great exchange, a very cool exchange. Check it out on Bloomberg.com and the Bloomberg Terminal. Lisa catching up with Scott Kirby of United. Let's talk about energy. Brent crude higher for a fourth consecutive day as the US and Iran angle for control of the Strait of Hormuz. Dan Stroyven of Goldman Sachs writing global visible oil inventories are likely to reach record low levels, even in an optimistic scenario where flows start to recover by the end of April. Dan joins us now for more. Dan, good morning.
Good morning. Thanks for having me.
You can see how things are set up. You've got visibility of the tankers that have arrived and the ones that aren't coming anymore. Can you describe what the next 2 months is going to look like?
Yes, so global visible oil inventories, I would say fortunately for the world, were at pretty high levels before the war started. But the pace of global inventory drawdowns is just so sharp, around 11 million barrels per day or so, that because of the bottlenecks and the logistic supply chain time it will take for the system to reset, that even if we start recovering flows by the end of April, we're on track to reach the lowest level for global visible oil inventories, even if flows start to recover by the end of the month. And we just have never seen how oil prices react at such low levels. So we have to recognize that implies some upside risks to our forecasts, which are based on historical data.
Does that aggressive drawdown in inventories explain why something like, say, dated Brent is some $40 off the highs?
Yes, so the dated Brent is still $10–15 higher than the June futures contract. The main reason is there's a big premium on getting oil sooner rather than later. The June Brent futures contract gives you the right to get oil in June. Dated Brent gives you the right to get a cargo in the next 10 to 30 days. And because some market participants assume a high probability that by June things will have normalized, you have this big immediacy premium on barrels now rather than later.
You know, we were talking to Paul Sankey earlier and making the point that whatever happens, whenever this gets resolved, it seems like there's going to be a structurally higher level of oil prices going forward and commodity prices going forward. Why wouldn't the oil majors in the U.S. be investing significantly more to produce more? And he said because the longer this goes on, the more there is structural demand destruction for oil. Do you agree with that?
Yes. If the supply disruption is very sustained, I would downgrade or constructive long-term oil demand estimates. The best illustration, I think, is what happened in the 80s. After very high oil prices in the 70s, you saw a very sharp drop in oil demand per dollar of global GDP produced. Now, if the disruption is relatively short-lived, and I think that's still the market's central expectation, I would expect somewhat more limited effects, especially in the short term, because, for instance, households don't buy a car every year. In the short term, you don't have that many switching opportunities. Lower GDP tends to be the bigger adjustment mechanism from very high refined product prices.
What replaces it? I mean, is it just sort of lowered GDP on a prolonged period of time? Or are we going to see other sources of energy that start to pick up? I mean, is that sort of an investing theme that you're looking for right now?
Yes, we do think so. We think this is actually a period that is pretty supportive for the global energy capex outlook, both because within traditional oil and gas, we'll need to invest into diversification, because we've learned that the risks from reduced supply from the Middle East is high. And it's also an incentive to diversify into other energy sources. And we are already seeing switching into renewables, into coal, because you can produce coal at home in Asian countries. And I think we're also seeing a pickup in EV sales. So I think the shock really supports the need to invest in all of those above, in all the energy sources.
Have you been surprised, and this is probably not the question you expected, but surprised that crude's not higher? Yes. Have you been surprised by how low crude actually is? And I mentioned dated Brent. Dated Brent is at 111. At the start of April, that was approaching 150. That's come down. Maybe inventories explain that. You and I talked about that briefly. But the idea that Brent now is at 102. Yeah. At 102, when back in 08 it was trading close to 150. Yep. And what's the 150 equivalent in today's money? Yeah. Something north of 200?
Yeah. So I think there are three factors. One, product prices are still very high. They've also moderated, but ultimately what matters for demand, for real income, inflation growth is product prices. Two, since the hostilities ended, I think the market, especially the equity market, has sharply downgraded its probability of a very lengthy disruption and of scarring to oil production potential. So that has taken out the tail of the price distribution. And then third, I think many market participants in the physical world, including, for instance, oil consumers, also think now that it's plausible, likely that the war will be over in a few months, and so they're actually destocking. If you expect that it's likely that you can buy at a lower price 6 weeks from now, after panic buying, massive restocking in March, you hold back and you hope that prices come down. Of course, that's not sustainable if the flows don't recover.
So there's not any funky business going on in the futures market, as far as you're concerned?
We don't think so. I think the cleanest evidence is sort of the price of a so-called exchanges futures for physical, EFP, which essentially allows you to convert a physical futures contract into a physical cargo, and that price never exceeded $2 per barrel. So the physical markets and the futures markets, are not as disaligned as some people believe.
How much is this because the Chinese strategic reserve of oil dwarfs everything else added together? I was just looking at a tweet highlighted by Javier Blas, looking at how the strategic petroleum reserve in China is equal to that in the United States, Japan, Europe, and Saudi Arabia all added together. I mean, how much is that buffering a lot of what we're seeing right now in oil prices?
Yes, it's a very big buffer. It's a key reason why we think China has time. We think that inventory levels in China would not reach critical levels until the summer. For now, based on the data we can track, we have not seen large declines yet, large releases in China SPR reserves. But because the market knows China could do this arguably dampens some of the upside to prices.
You keep saying that if it's a temporary shock. Initially, a temporary shock was a couple of weeks. Yep. Then it was a couple of months. Then it was, well, as long as it's resolved before June. Now it might take 6 months to get rid of the mines that are currently in the Strait of Hormuz, according to intelligence from the United States, as reported by the Washington Post. I mean, how do you put this together and get a sense of what temporary means, what prolonged means?
Yeah, the longer this lasts, and if this lasts more than a quarter, the main adjustment mechanism becomes lower demand and lower economic activity. For a 2 to 3 month period, you can draw down inventories at a very rapid pace, in part because the starting point for inventories was quite high, but this is not sustainable. And so, if this continues, demand losses are unfortunately the main adjustment mechanism.
I've said this a few times, really enjoyed your research throughout this war, so thank you for that. To you and the team. Thank you, sir. Yes. Dan Struyven there of Goldman Sachs on the energy market. Let's give an update on stories elsewhere with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. High-profile shake-up at the Pentagon. Navy Secretary John Phelan fired after clashes with top leaders. According to a Pentagon spokesman, Undersecretary Hung Hao will replace Phelan, who is stepping down, effective immediately. In markets, a check on shares of American Airlines, down about 0.7% in the pre-market. American beating expectations for first quarter earnings, seeing robust demand in the first quarter. The company expecting the midpoint of its full year guidance to be approximately flat versus last year, despite more than a $4 billion cost extra tied to higher jet fuel prices. American Express in early trading, up about 0.2% now. Amex topping estimates thanks to strong spending from its premium credit card. Build business jumped by 10% from a year earlier. The company maintaining its full-year guidance, expecting revenue to rise 9 to 10%. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Thank you very much. Up next on the program, maintaining dollar dominance.
Many of our Gulf allies have requested swap lines, and swap lines are to maintain order in the dollar funding markets and to prevent the sale of the U.S. assets in a disorderly way.
Up next, we'll catch up with Christina Campbell of Invesco from New York City. This is Bloomberg Surveillance.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Stocks recovering here. We're down by just 1/3 of 1% on the S&P. Likewise on the Nasdaq. Small pullback from all-time highs. So far, so good on the earnings front from American Express, from the likes of Texas Instruments. Next Wednesday, just to frame next Wednesday for you, you're going to have a Federal Reserve decision in the afternoon. And after the close, Meta, Microsoft, Alphabet, and maybe Amazon too. I haven't seen that confirmed just yet, but a big number of major tech firms reporting that afternoon.
Key point's going to be watch. What is their capital expenditure plan for the upcoming year, for 2027? Do they give any guidance for that? And do we get the same response that we got from Tesla? Tesla increased its capex to $25 billion from $20 billion, and the stock fell after beating expectations on the earnings from their car sales. So a question here for the big hyperscalers. Are they seeing a warning sign from what we just saw from Tesla?
Not expecting them to triple their capex, are we, next week?
You know, you never know. They've done it before. They can do it again.
It's the latest on Tesla, the latest on the equity market. Here's the latest on crude. Higher for a fourth consecutive day on Brent, 102.40, up by 0.5%. Under surveillance this morning, we'll talk about foreign exchange maintaining dollar dominance.
Many of our Gulf allies have requested swap lines, and swap lines are to maintain order in the dollar funding markets and to prevent the sale of the U.S. assets in a disorderly way. So the swap line would both benefit the UAE and the U.S. And as I said, numerous other countries, including some of our Asian allies, have also requested them.
So here's the latest this morning. President Donald Trump confirming the U.S. is considering a currency swap with the UAE as nations hit hard by the war. Look for liquidity. Christina Campmany of Invesco making the bear case for the dollar, writing, our structural thesis for a weaker dollar over the medium term to long term is only amplified by recent developments. Christina joins us now for more. Christina, good morning.
Good morning. Thanks for having me.
What is it about recent developments that will contribute to a weaker dollar?
Look, I think that this has been our structural base case for a while, and you started to see the beginning of this thesis play out in 2025, and they're obviously dollar trends are long trends, but when we take a step back, I think in the last year and a half, we have continued to chip away at the institutional credibility of the U.S. and the Fed and kind of questioning of these things. You've had changes in kind of the norm of world order for the last number of years of economic interdependence, but also security. And I think all of those things kind of continue to build a backdrop for a weaker dollar.
The counter point, as you know, will be that this is a relative trade. It's got to be against something.
Sure.
And the something right now is not great either.
Yeah.
I saw German GDP forecast of just 0.5%. Do growth differentials matter when you start to think about these things?
So I think that they do. But again, you take a step back and you say broadly, the dollar still looks overvalued. I think if you look at 2025, euros moved a lot. EM currencies performed, but again, on a long structural basis, have underperformed. Asia is the clearest kind of region that didn't participate, and I think coming into the year, that was the cleanest case. That is obviously challenged by the Iran conflict because these are all oil-dependent or importing countries. So the mix still matters, but I think there are still opportunities in Asia. I think there has been a pullback of attention and money into EM and carry there for sure. And Europe, I mean, I would just take the step back that the data is not great. You obviously, how long this conflict goes on will matter for sure. And what you said about the U.S., we are energy independent. We're talking about, like, are we changing flights in the summer? Are we changing vacation plans versus are things actually being canceled? There is no oil to have things operate in Europe. That is 100% true. But I think we structurally have a bias in the market that people are much more negative on Europe than is warranted.
Well, at the same time, some people are saying, if you're so negative on Europe, why don't you invest in long-term bonds there? Because ultimately, the ECB is going to have to cut rates based on the GDP prints that some of these countries are putting out. Is that something that you would endorse?
So look, I think we talked about this a bit last time. I think across rate markets, the front end of markets is still what is most interesting. And I think part of the step back from that is in the last 2 months, the reaction to all of this and the inflation shock has just really been a repricing of the front end in a dramatic way. The ECB obviously has a different mandate than many of the other global central banks and seems most willing to react and to hike into it. We think that's a mistake and that ultimately the growth issues there don't really warrant hikes. But I think you need a steepening of the curve and a bit more premium. We're starting to see that a bit. So I think we will get to a point that out the curve, there's some value. I think in the UK, that's like the one market that there is some steepness in the curve and there's value out the curve.
At the same time, you just have to wonder at what point dollar weakness, the trends that underpin it, will cause a reduction in demand for U.S. assets, in particular U.S. debt. And we're talking about potentially the Middle East, which just months ago was talking about investing billions of dollars in the U.S., getting a potential swap line from the United States to help with liquidity matters. I mean, isn't there a fear that there will be a pullback? Are there any signs of that actually happening?
So I think there's definitely a fear, and I think that these comments and the information that we got from Besson and Trump confirming that speaks to that of look, we know that there's been a stop of business and the normal business of as usual, certainly in the Middle East, but more broadly. And all of these nations are tied to the dollar. Their currencies are tied to the dollar. So rather than, I think the effort is in a liquidity effort to make sure that kind of there's normal operations rather than having to go sell U.S. assets. But I think when we come back to the early 2025 themes of, do you have this broad dump of U.S. assets? I don't think it's that. But when you say investors globally are very overweight U.S. assets, so on the margin, is there still a willingness to put the next marginal dollar of investments into home country or home region or diversified more globally? I think that's absolutely still a theme that's with us.
Lots of selling and less buying are two different things. I think we're in the less buying part of the story, and that's kind of been where we're at since the start of the year, Bramo.
Yeah, what I find fascinating is that ultimately a swap line might be an effort to not have more selling. It might just be, okay, if you want to buy less, that's fine, but not have it be a massive move in the immediate near term. And that, I think, is a notable thing.
Are those conditions supportive enough for corporate credit?
I think corporate credit is like where we are kind of the least comfortable in the market. And
why's that?
It just, spreads are still so tight. Like, we are at extremely tight valuations, and we obviously have a K-shaped economy in the U.S., and the wealthy are underpinning growth, and that kind of continues to be what we see with earnings so far. But that can only go so far, and we are 8 weeks in or 7 weeks into this conflict. The repercussions and growth impacts in the U.S. and globally are still playing through and will hit the consumer, right? Or will hit the corporation. And if you start to see layoffs, the labor market is in this very tentative place. So there's like a lot of things that are very finely balanced, and kind of any shocks to that, you can see trickle down.
Is it energy within the high yield sector that is keeping those spreads tight? Is something else happening? Is there a sector you're worried about?
Again, I think the market, as a rates person, we always struggle with this concept that credit people talk about like all-in yields. Like, all-in yields when spreads are so tight, like, go buy T-bills. But like, that is certainly, I think, a concept that does reign in the market. And I think after so many years post-GFC of such low absolute kind of coupon yields that you were getting in credit, there's been a period that just the level of yield attracted people. I think that we're a little bit more cautious of just how does that play out.
Christina, good to see you. Appreciate the caution. Thank you. Christina Campmany of Invesco. We've had lots of constructive views on this program, just to balance things out. A note of caution. I have to tell you, though, as we're having this conversation, a cautious one, the equity market is raising losses this morning. We're down by not even 0.2% on the S&P.
It's the push-pull that we kicked off the show with. On one hand, you've got what's going on in the Middle East, and on the other hand, you've got earnings in corporate America saying things are amazing, and they might look a little bit worse, but they would have been absolutely blockbuster, and that is really the read-through getting to the
That's the story, isn't it? You've said this a few times, would have been absolutely blockbuster. There's almost an underlying boom, and you saw that in the airlines. Before this war started, the demand numbers they were talking about, United and Delta, stellar.
Yeah, the One Big Beautiful Bill actually did deliver those refunds that allowed people to go out and spend. It is the upper-end consumer, though. American Express, premium. American Airlines, premium customer. United Airlines, premium customer. It keeps going back to that trend.
Up next, the premium guest, Eric Cantor of Moelis, Keris Casso of Wolf Research, Nina Richardson of ADP, Nisha Patel of Parametric. The third hour of Bloomberg Surveillance just around the corner.
A cidade estava sitiada.
Isso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Markets remain relatively buoyant and hopeful. That bounce back that you have is warranted.
We're clearly pricing out a lot of the tail risk. The stock market has been the most accurate indicator of where the economy is going.
If you're looking 6 months out, I still think we're higher than where we are here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Coming into Thursday at all-time highs, a small pullback of just 0.16% on the S&P 500. On the NASDAQ, down by 0.17, supported by a major tech boom across several companies and the premium consumer in the United States of America.
That, to me, is the key point. It's not just AI. It's the fact that consumer spending among well-heeled Americans seems to be holding up, and then some. American Express, profit rising, premium customers piling in. They can spend, and what are they spending on? They're spending on flights. That's one of the things they're spending on, because you're seeing that also from American Airlines and United and Delta, all talking about the premium customer. The path forward is the question. How much does the war in Iran really crimp that versus just simply put a damper on what otherwise would have been a blockbuster year?
Equities are raising losses as crude erases gains. We're pulling back from session highs on Brent crude, Brent at 102, WTI at 93, and those numbers still bringing a major bill to the likes of American Airlines, a major fuel bill.
Yeah, $4 billion, which is part of the reason why they ratcheted back their full-year earnings forecast, which you've seen the same kind of move from United. Delta is simply unwilling to restate their earnings forecast because there just is no visibility. At what point does that really create a serious problem? And are we actually gaming out costs that are relevant to what the forecasts are from some of the geopolitical strategists? I mean, I'm trying to wrap my head around this. If it takes 6 months to detonate the mines that potentially were buried in the Strait of Hormuz, we're talking about maybe a ceasefire, but with whom and how? And we're talking about the fact that we're still not seeing commerce through the Strait of Hormuz. How does this get resolved in a way that ameliorate some of these price pressures in the near term? And I think that is one of the reasons why oil strategists come on and they say, we don't really get this move. And we keep saying, well, the stocks keep ripping. So, you know, it is what it is.
Choices and trade-offs, and you're starting to see them being made, not just in Asia. That was up front, now in Europe. And I keep going back to Lufthansa, cancelling 20,000 flights. There are some unprofitable trips that I'm sure they wanted to cancel up front, and they'll try and maintain some of the more profitable trips. I just wonder how close we are to the transatlantic players making similar decisions about how much emphasis they want to put on certain routes versus others.
Yeah, are we going to start to see maybe a flight to, say, you know, Toronto versus a flight to New York, which they would want to go if you're going from London? Look, right now they want to preserve the transatlantic corridor because that is the most profitable, and right now they're willing to cut the shorter end of the flights in order to say, okay, just take a train.
We've got some data a little bit later. It's about 27 minutes away. Jobless claims in America. The data so far this week, so good. Looking at retail sales, stronger than expected. ADP numbers, better than expected. There is more than just resilience in this economy. This economy, based on the numbers we've seen so far, is more than just resilient.
There's been heat, and I keep going back to the idea that Scott Kirby of United was surprised by how much there was not demand destruction as a result of prices going up. It gives you a sense of just how much heat there is in this underlying economy.
Coming up this hour, we'll catch up with Eric Cantor of Moelis & Company. With stocks pulling back from all-time highs, Chris Casso of Wolf Research on the record-breaking run for chips, and Nita Richardson of ADP breaking down the latest jobs data. We begin this hour with stocks lower and crude rising as peace talks in the Middle East remain idle. Eric Cantor of Moelis & Company writing energy independence and domestic production are key to insulating the U.S. from global shocks. Eric joins us now for more. Eric, good morning. It's good to see you.
John, it's great to be here.
In the present, it's tough. In the future, things are looking better according to financial markets. What's going to shake this market have such a powerful, forward-looking mindset?
You know, look, if you think about where we are, and I know the discussion around the table this morning has been the incredible resilience of the American economy, and I think that if you look at it, a lot of it has to do with some shock absorbers that, frankly, the Trump administration in Washington has been put into place. You've just experienced big tax refunds that came out of the One Big Beautiful Bill. You now have a shock absorber, if you will, that is going to be afforded to the corporate community in the terms of a $160 billion tariff refund. You've got actions on the part of this president that said, hey, we're going to go and ease this oil crunch by releasing more of the strategic petroleum reserves, the waivers on the Russian oil. And ultimately, you've got a very pro-business administration in Washington, so you've got a regulatory construct that is much more constructive than we've had in the past. So I think all that helps when you see these earnings, helps explain where we are.
Do you think we're underestimating the momentum going into this war?
I do think so, and I think that there's not been a lot of credit given to this construct, the policy construct we've operated in. Certainly the liquidity that's out there with a high-end consumer has not abated yet. But look, I don't think we've necessarily gotten to peak shortage yet. And just as your guests have been discussing on the show this morning, I do think that we've got real uncertainty as to where and how you're going to see these oil flows resume so that you can get back to normal.
Blackstone just came out with earnings. They said this is going to be the year of the IPO. They still think it's going to be an unprecedented year for IPOs. We've heard that from a number of companies, that mergers and acquisitions going incredibly strong. When you talk to companies, given the uncertainty out there that you just reflected, how much are people willing to carry through with some of these plans, given that things could change a lot in the next couple of months?
I think, you know, the market's clearly looking through the short-term uncertainty in the Gulf. I mean, there's no question about that, and it's undergirded by the earnings. But, you know, if you look at the forces that have been at work, and I talked about some of the policy forces, but if you see in the commercial world and where companies are with this technological revolution that we're experiencing, with the AI boom, you know, companies are thinking, how am I going to position myself? Boards and management are saying, hey, what do we have to do to take advantage of this? And you've got that tailwind that continues to push forward in terms of people saying, hey, maybe we should transact. Maybe we should accomplish more scale in order to take advantage of this situation. And then obviously in the world of private equity, you constantly have this need of recycling capital. You constantly have a need for return of liquidity to the LPs. That hasn't gone away either. So in many ways, the structural pillars that have supported the environment to transact have not gone away either.
So you don't think that what we're seeing right now in the Middle East is going to deter the pace and frankly, the pipeline that people were talking about, which was unprecedented heading into this year?
Well, I mean, look, there's no question that there are going to be specific areas. I mean, individuals, entities in the Middle East are certainly not in the same, state of mind as they were 8 weeks ago. So there are going to be geographies and there are going to be certain areas. I mean, with the AI situation and private credit and software, certainly that's going to have an impact right now. But that, I think, is a short-term sort of thought that longer term, you've got these structural tailwinds that are continuing to propel people's willingness to say, hey, we want to do something. Things are moving too rapidly.
So many people in this industry are incentivized to keep on dancing. We could see 3 of the biggest IPOs we've ever seen in the history of this country. OpenAI, Anthropic, SpaceX, all in the next 9 months.
And it potentially could change the dynamic that we've seen in terms of assets in the U.S., where people were talking about a scarcity of stocks and the buybacks that have been going on for so long. And suddenly we're going to see the biggest expansion of U.S. equities, public equities, that we've seen in many, many years. So there are a lot of structural questions that are facing this market later this year.
Eric, we've struggled with reality versus hype. I'd like your view on that. When I say everyone's incentivized to keep on dancing, it's a little bit of snark in that as well. I think everyone's incentivized to say things are maybe better than they are at the same time, because everyone's got to make some money later this year, particularly off those 3 big IPOs potentially. What is real and what is hype right now?
What is real is we have sort of an era of revolution right now. You think about sort of the geopolitical revolution, the trade revolution that's come into play with this president. You think about the technological revolution that we are experiencing. All these forces are coming to bear that really is the reality. People are trying to understand how to best position themselves, their capital, their companies, to take on these new times. And I think that is reality. And there is incentive for sure to try and benefit from a lot of the changes.
You call them forces. Other people might call it friction. And with that increased friction comes increased costs. What's your reaction to that?
Well, I mean, I do think it's increased costs if you do it the old way. If you're going to go in and try and embrace the new way, that's where everyone's trying to get to. And that's exactly the point. That's the dynamic, whether you call it friction or whether you call it, a tailwind or a force. That is the mechanism that is saying to people, hey, we need to stand up, look at where the opportunities are, otherwise we're going to be left behind.
Which is why there is such an aggressive forward-looking mindset in this market right now. We spoke to Jim Zelter of Apollo in the last month, several weeks ago. He sat in your chair and he said, we all need to take a walk, because in 6 months' time, we won't even be talking about the crisis in the Middle East. We'll be talking about how wide open financial markets are, how much deal making will be getting done. I can't remember the full list from Jim, but it went something like that. Do you agree with that?
I 100% agree with that. And again, I do think you've got a regulatory construct, you've got the SEC, you've got the FTC, the DOJ, you've got all these, regulators in Washington that are primed to want to help the growth in this economy.
Do you think that in this environment it's appropriate for the government to take a stake in, say, a struggling airline maker, like airline operator like Spirit, given the fact that most people are saying this is a short-term issue that you can look through?
Well, look, there's a difference between what this administration has implemented as policy on critical sectors. Critical sectors, whether they be those that are central to the discussions with China. How do we go make our supply chain secure? How do we make sure we have a biopharma supply chain here so the next time we've got a shortage or a pandemic, we're not relying on China for inputs for our drugs? I mean, I do think that there is almost a bipartisan recognition that, hey, we got to do that. I'm not so sure that there is a bipartisan recognition that, hey, we've got to step in and help whatever domestic industry there is. And, we'll have to see whether these discussions come to fruition and what the reasoning is behind.
Eric, what happened to the Republican Party? Come on.
Well, listen, right now, Jonathan, it's not a good topic with me because I just experienced in my state of Virginia a very, very narrow loss in a very extreme partisan gerrymandering that the other side put into place. And I do think people are going to have a reaction, and there will be a backlash to some of the extremity that's going on.
You think that'll show up in the midterms?
Well, I hope so, because there was no question where the intensity was on the part of the two sides in Virginia on Tuesday. They were on my side because of the extremity and the just insane, there's no other word for it.
Aren't both parties guilty of that? Why was this different in Virginia?
Well, this one in Virginia, you have to get granular and specific, but it was 36 changes to the law. There was a waiver of the Constitution just 4 or 5 years so that they could go against Trump and respond to his alleged moves. I mean, these things, most people are not living that partisan lens, and I do think ultimately people are going to be worried about how they get ahead in their life. And I think this discussion about prices and gas pump prices, that's what is going to ultimately determine all of this, as well as the outcome of the midterms, is are we going to get these prices at the pump down?
Eric, it's good to see you. It's good to catch up. Thank you, sir, as always. Eric Cantor there of Moelis & Company with an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn is back with more. Hey, Vonnie.
Hey, John, thank you. The U.S. military intercepting 2 Iranian oil supertankers that were attempting to evade its blockade. U.S. Central Command saying the tankers are now anchored at an Iranian port in the Gulf of Oman. CENTCOM saying the U.S. has directed 29 vessels to turn around or return to port since the blockade began. Italy could make an appearance in the upcoming World Cup. The Financial Times reporting a top envoy to President Donald Trump asking FIFA to replace Iran with Italy, arguing Italy's 4 World Cup titles justify awarding it the slot. The Senate taking the first step, reopening the Department of Homeland Security. Republicans approving a $70 billion budget plan to fund ICE and Border Patrol through a process that requires no Democratic votes. The bill now heads to the House. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes. Up next, the Morning Calls Plus. Chris Casso of Wolf Research on the record-breaking run for chip stocks from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
In the short term, you have flow of funds, maybe people raising capital from selling Tesla to buy SpaceX. The two companies combined together can help get that scale needed to run in this CapEx AI race that Elon is certainly part of right now. For patient investors, it is a way to invest in ultimately what we think is going to be a combined company.
That was Ben Keller of Baird. Great conversation exchange on Tesla there. This equity market, a raise in this morning's losses. The equity market so far insulated by the tech boom and insulated by decent numbers from corporate America so far. Equity futures negative by just 0.1%. See a similar story in the bond market as well. Yields now just about unchanged on a session. They were higher, the 10-year at 430. See the same thing in crude. Crude really setting the tone for the market this morning. Crude was higher, now lower on a session by 0.4%, 92 on WTI. Brent crude at 101. That's the cross-asset story. Let's get you some morning calls. First up, Morgan Stanley reiterating its equal weight rating on Tesla, noting limited near-term upside. Your second call from Guggenheim, raising its price target on GE Vernova. What a story. Citing strong order activity. That name is up at a pre-market by 1%. And finally, Barclays upgrading Texas Instruments to equal weight, calling industrial exposure the, quote, place to be in analog. Let's talk about the semis. The Philadelphia Semiconductor Index hitting fresh all-time highs with a record-setting 16-day rally. Chris Casso of Wolfe Research joins us now for more. Chris, welcome back to the program. Since the end of March, that index has not looked back. What's driving it?
Well, what's really driving it is some of the news that preceded the rally, and the things sounded very good after January earnings season, particularly in AI. You had good news from Broadcom in terms of their visibility all the way into next year. AMD picked up some new business in their AI business. NVIDIA had their investor conference, their developer conference in March, which was very bullish. And the interesting thing is, you talk to investors at the time, the stocks weren't moving, and the question was why? Is the AI trade over? And then all of a sudden, 16 days ago, everything started to move. But there wasn't particular information 16 days ago. It was just reacting to what was already out in the marketplace.
Chris, we did get some headlines from the likes of Anthropic. Mythos is so powerful, it's dangerous, those kind of things. Does that help things?
Well, listen, we're in the experimentations phase of AI right now. What's really interesting and important is agentic AI. Where's that going to go? How is that going to drive the need for tokens? But what seems very clear right now is that there has to be a lot of spending. And, I would say the pushback for everything AI now, and that's certainly what's driving semis, is that are these companies, or the customers, the Googles and Anthropics and OpenAI, is going to be able to spend enough, to kind of keep numbers moving higher? And our view is I don't see how they can't, because this is so transformative that if you are not spending right now, you're going to be left behind, and no one wants to be left behind.
Chris, one of the constraints perhaps maybe is just simply the sheer supply that these companies can produce of semiconductors to fuel demand. How concerned are you in earnings reports that we get some insight into what the Iran war might be doing in terms of key resources needed in production of some of these components?
Yeah, so the war itself and the issues in the Middle East are not an area of concern. There were earlier some concerns about, for example, helium supply, but we've done a lot of work on that, and I think the consensus is that's not an issue. But there are real constraints. For example, right now, memory is one of the main areas of constraint right now, because there's not enough physical clean room space to put the tools in place to build all the memory we need for AI. It's similar with TSMC. TSMC last Thursday, their CEO said it takes 2 to 3 years to build a new fab, 1 to 2 years to ramp it up, and in his words, there are no shortcuts. But ultimately, I think that's a good thing, and it will cap the eventual where numbers can go in 26, 27, because we're tight at capacity. Power availability for AI is also another constraint, but this is a long-term dynamic. And, months ago, the big concern was that we wouldn't have enough demand. Now, if we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. And, of course, one of the other concerns is, are we in a bubble? We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
There's also an issue about how much some of these companies can charge. TSMC said that the latest ASML chip-making gear is too expensive for them to use. I mean, are you hearing this in other capacities also pushback, saying ultimately there are certain levels at which we will just not buy, that is constraining the ability to just simply keep jacking up the cost?
Well, that particular comment is pretty specific to ASML and its next generation equipment. And ASML is the only company that you could buy lithography equipment from right now. So they have a very strong market position. They're flexing that position. TSMC is also really the only place you can go right now for advanced logic. So they're also flexing their market position. So I think what you're hearing in that is a bit of a negotiation between parties that's happening publicly. But the fact of the matter is it's very expensive to build semiconductors right now. But that's the good news in AI is that, the past couple of years, we're depending on handsets and PCs. They weren't generating enough profitability, enough reason to go to the next node. That's the good thing about AI. It needs a lot of performance. And what it seems like is their customers, the end customers, the OpenAIs and Anthropics, are getting paid for that performance right now. And we think that's just bullish for the group in general.
Chris, next week we heard from the big spenders, the big tech players on Wednesday, the big customers of the companies that you cover. It's important to track the tolerance of investors in the stocks of their biggest customers. The tolerance that we're starting to gauge is maybe changing, turning just a touch, just a little bit. Chris, Lisa mentioned this with regards to Tesla earlier. They lifted their capex, the market pushed back. Are we reaching the limits of how far some of the biggest customers of these chip players can push things?
Yeah, and I don't cover those companies, so I won't comment on what it is for those particular companies. But it is a question of investors, is if those hyperscalers, if the investors won't tolerate diminished free cash flow in the near term in order to support these investments, will the investments happen? And our view is that whatever happens to the hyperscaler stocks, whatever the investors' tolerance is, I don't think they have a choice right now. It's a little bit of a prisoner's dilemma right now. If Google spends and Microsoft doesn't spend, Microsoft's just going to get left behind. And I also think those investors are not going to tolerate anyone waving the white flag right now and saying, you know what, we just don't have confidence in this AI investment. We're not going to do it. If you do that, then you're missing, the biggest technological revolution in a long time. So I think you have no choice but to spend, regardless of what your investors feel right now.
That's a pretty powerful bull case for the names you do actually cover. Chris, I appreciate your time, sir. Chris Casser there of Wolf Research. Stuck between a rock and a hard place if you're the big spenders right now.
Which is a reason why they're continuing to spend, and it seems like it's an existential risk. You just wonder, if you're in an existential moment, you're bound to overpay. You're bound to waste money.
Yeah.
Because you don't have a full understanding of exactly how it's going to get deployed, how it's going to get monetized, how it's going to be expressed going forward. There are going to be losses ahead. And this is what the market is sussing out right now. How do we avoid being and bearing the brunt of those losses? Is it going to come from the equity investors? Is it going to come from the bond investors that are fueling this? Or is it going to come somewhere else in the hands of all of us paying higher bills? I don't know the answer, but that is, I think, part of what's generating some of the anxiety.
When you believe, with high conviction, the biggest risk right now is underinvesting and not overinvesting, then the odds are rising for a major misallocation of resources. That concerns a lot of people. With the semi-rally we've seen, Chris brought up a really interesting point. I think he's absolutely right. It was really odd that after the last earnings season, we went through all those numbers, that $600 billion plus of capex from a handful of tech firms, and yet we didn't see the semis rally off the back of it. It was really odd. They didn't do much at all. Then the last 16 days, the reset we've seen through this war, and this powerful rally in chips, has been more than just tremendously phenomenal.
For people who don't want to just keep watching the headlines, they go back to their old notes and they pulled out the one with the semiconductors and the spending plans, and they said, aha, eureka. And
Tech
that's
leadership is back.
Exactly.
Back in a big way. Up next on the program, the latest jobs data set to cross initial jobless claims just around the corner. Reaction from Neil Richardson of ADP.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Live from New York City, welcome to the program. Seconds away from economic data, jobless claims just around the corner. 60 minutes away from the opening bell. Equity futures look like this. A raise in this morning's losses, unchanged on the Russell now. On the S&P 500, negative by not even 0.2%. In the bond market, yields were higher, tracking crude. Now they're lower. At the front end, at least unchanged. 380, 379, 78, and just about unchanged on 10s as well. 430, 55. With that economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, we've got a slight rise in jobless claims, up to 214,000 from a revised 208,000. Not a big change, doesn't signal anything major happening in the economy. On a continuing basis, claims are at 1,821,000. That's up from 1,809 the 2 weeks before. So at this point, it's still kind of the same story that we have been seeing. The companies out there are on hold. They're not laying off people in great numbers, but they're not hiring either. It'll be interesting to see what the war effect is when we get the April jobs numbers coming up in May.
At 8:30 on Thursday mornings, Mike, I'm just going to clip this and then keep playing it out next week and the week after.
So I could take Thursday off.
You can, Mike. Your analysis will still work as well. Thursday morning at 8:30 Eastern time, it's almost exactly the same. It's low hire, low fire. If you're out of work right now, it's difficult to get another job. You see that in continuing claims. Low fire, you see that in jobless claims. 4-week average around 210 this morning. 4-week average around 210. Phenomenally low initial jobless claims, and we talk about the same thing every single Thursday morning and have done now for months on months on months.
People used to say this was the best real-time indicator of the labor market that you could potentially have, and right now it's essentially flatlining as any kind of indicator whatsoever because it's not doing anything. It's essentially staying in the exact same place. So is it losing relevance, or does it just highlight that this is a labor market that just isn't doing anything, that it's almost flatlined in terms of its progression in one way or another?
Mike, how relevant was that to Kevin Walsh's testimony earlier this week, where he seemed to spend way more time on one side of the mandate versus the other?
Almost all of his time was spent on inflation and very little about jobs. And what was discussed on jobs was the Fed's previous idea of inclusion in the labor market and how that didn't work out because it created more inflation. So it's going to be interesting to see what Kevin Walsh starts to say about the labor market when he gets into office at whatever point that is. But for right now, it doesn't seem to be a major concern, and it hasn't been for the Fed for the last couple of weeks. Interesting point. The economists over at Citi point out that in the last 2 years, we have seen rising claims as we get into May, which they're attributing to seasonal effects. So we might get some change coming up in the next few weeks, and something to keep an eye on, but whether it's meaningful or not, they don't reach a conclusion.
Hours worked in the next jobs report might be lower. Mike McKee on a 4-day week from now. Mike McKee, thank you, sir. Appreciate it. Thank you very much. We see it every week, every Thursday morning, 8:30 Eastern time.
I mean, it's just shocking. We were talking about predictions ahead of this, and it was not necessarily like 190 to 250, but is it going to be 209? Is it going to be 210?
Right.
211?
I mean, I'll take it. It's good news.
It's
good news.
wonderful news, but is it news? It is a lack of news, good news, in the sense that if we're not seeing any kind of evolution of a jobs market that is pretty stagnant, is that a good thing or a bad thing?
With us around the table, Neela Richardson of ADP. Neela, good to see you. Unchanged at the surface, at the headline level, how dynamic is this labour market beneath the surface?
So on Tuesday, ADP Research put out their weekly national employment report showing an average over the last 4 weeks of 54,750 jobs. Maybe it was 250, around 54,000 jobs. And that was the fifth, now this is the number I know, the fifth straight week of strengthening. What that means is that I think you're going to pull over into a different dynamic in the labor market this spring, where it's a low fire, some higher, maybe strong higher month in April. That is what the data is looking like right now, and that is our earliest indication of how this labor market is actually strengthening over the last 2 months. I know it's a surprise.
Amazing.
But the small firms are leading the way. We are seeing consistent strength in firms with employees that are less than 20 in count. So we are seeing the small firm engine starting to drive through the geopolitical uncertainty.
54,750, just to confirm.
Thank you.
You basically said it anyway.
I didn't have enough coffee this morning. It was too much traffic. But.
Clearly not. Still early. Let's get into this then. Where are the gains coming from? This is important because when we get the payrolls report, usually we're talking about a lack of breadth. It's just healthcare, healthcare, healthcare. You see more than that now with things changing.
We're seeing healthcare, 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 but we're also seeing small firms driving that as well, and we're seeing it in construction as well. That's important in terms of the infrastructure and the build that's required for a lot of the AI infrastructure with data centers. So we are seeing some pickup in some places that are important to the economy, but it's not as widespread as we would like. It's concentrated now. Given the strength of what we're seeing in early April, that could change for the month. We need Mike McKee back on that Friday because you might start seeing these industries that have been slow, have been stagnant, start to pick up their hiring this spring. That's what I'll be looking for.
How much do you think that the uncertainty around the Middle East and oil prices could crimp that? Or does this feel independent because it is in sectors that are tied to the AI CapEx in the construction areas in particular?
Yeah, it does feel somewhat independent. These firms, for one, are not price makers in the market. They're price takers. And they've been taking this price for a long time in terms of higher energy costs and the effects of inflation in a lot of their input prices, mainly due to tariffs. And whether we look through, whether it's geopolitical uncertainty or tariff uncertainty, small firms can't look through their here and now. They are on the main street. They are doing the groundwork. And when they see the customer demand and know that they need to hire after not hiring late last year, they have to actually meet the customer. And that's why I think we're seeing hiring now, because they've delayed for so long, they can't not and grow their businesses and sustain their businesses.
We've seen job switchers not see as big of a pay raise as job stayers in some capacities, or at least not see as big of a gap as they have in the past. Do you expect that to change just because this demand is increasing to such a degree?
We've already seen it change, actually. With our March report, we saw a pickup in job changer salaries from 6.3 to 6.6% in March. Again, with this strong number, I think it picks up even more. So yeah, the difference between a job stayer pay gain and a job changer pay gain has shrunk tremendously over the last few years, but it's not at its low, and it's starting to widen. Now, what does that mean in the short term? We're seeing strength. We're actually seeing a healthy labor market, though fragmented, though concentrated. What that means for the summer, I can't tell you, because it's going to depend on whether or not this is sustainable or just a blip. Is this kind of small firms being opportunistic, hiring while they can, or is it this longer sustained trend built on customer demand? That is an open question.
That is some good news. The money's coming back, the wages are coming back, the leverage coming back, just a little bit, the pendulum swinging back to the employee.
Yeah, especially because the employee is looking at the higher costs as well and saying, well, if I'm going to go back into the workforce, I'm going to have to pay that. If you start to see wages pick up in job switchers, great news for the employee. A question about the pass-through with inflation, given the fact that some of the unmitigatable costs are going up in a sustained way. So this kind of goes back to the question of what do you do with policy? What does this tell you about where inflation really is?
Neither. This is the ultimate counterpoint to 2022. Labour market's not as tight. Consumer price tolerance not as high. You're not going to see inflation pick up in the same way off the back of this energy shock. Do you agree with that?
No, I think inflation is a really careful watch point. I wouldn't dismiss it. I think it's important for us to keep it front and center. I also think that we are all talking about AI and the impact of AI as part of that inflation reducing mechanism. I'd be careful and cautious there too, because AI is a very resource intensive tool. It takes water, electricity, new data centers, and all of that costs a lot of money to run these tokens on a periodic basis. So we have to be careful how this new technology actually seeps in to inflation, into the larger economy.
Is that a sequencing problem? Is that an upfront cost, and then over time you get the decline in prices over time? How do you see things?
Let's hope, but you know, the important part of tech is that it's always growing, and it's always growing at a faster rate. And so our resources do not grow at an accelerated rate. They grow slowly. And so tech demands and resource constraints will one day meet an economic reality that pushes inflation higher. What we're not seeing, though, is this erosion of the knowledge worker, and I wrote about this week. In fact, when it comes to knowledge work, especially those tied to what are traditional occupations, lawyers, doctors, computer scientists, we're actually not seeing them go away. They're actually increasing as a share of employment. What has gone away is office work tied to the actual location. Think your office manager, your janitorial staff, your clerical staff, those positions are declining, but those don't make headline news. So knowledge work, I think, is here to stay, but we have to be careful of inflation.
And this is the argument that Fed Chair nominee Kevin Walsh was making. Didn't hear much of it in the hearing, but ultimately the argument he's making is that AI is going to lead to a broad-based decline in prices and leave the door open for interest rate reductions.
And it's a highly controversial point, as you're just hearing here, because ultimately it is resource intensive and people are pointing to the CapEx and how much it's increasing costs in the short term. You asked the key question, John. Is this a sequencing issue, or is this going to be permanently higher costs on the input side that offset some of the efficiencies that you get on the worker side?
Nita, good to see you. Thanks for breaking it down. Smart stuff as always. Nita Richardson there of ADP with a cautious note on inflation and a confident note, constructive note on the labour market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. So recapping the data we just got, jobless claims for last week coming in at 214,000, a slight tick up from the previous week and a nudge above estimates. Continuing claims also rising by about 3,000 from the week prior, indicating the economy is holding on to its low-hire, low-fire environment. White House National Economic Council Director Kevin Hassett showing support for Fed Chair Jay Powell. Hassett saying Powell should remain at the helm of the central bank on a temporary basis if a successor is not confirmed when Powell's term expires next month. The Trump administration is nearing a $500 million bailout for Spirit Airlines. Sources telling us here at Bloomberg the deal would give the U.S. government the option to take ownership of up to 90% of the carrier once it emerges from bankruptcy. United Airlines CEO Scott Kirby discussed the deal with our Lisa Abramowitz.
This was a fundamentally flawed business model that I've been on going back into the last administration saying it's going to fail because the business model doesn't work. And so I think the spike in fuel prices just moves it forward by a couple of months.
Kirby sidestepped questions about a potential merger with American, but acknowledged that the current climate might offer opportunities for deals. And that is your Bloomberg brief. John.
Vonnie, thank you. Appreciate the update. There's been some obvious pushback to that story. Let the market do its thing. Let the market work.
Yeah, and you have questions about why Spirit was not allowed to merge with JetBlue a couple of years ago, and then if it was looking to merge a couple of years ago, and now it might not survive. Is this a good use of U.S. funding? This will be an ongoing question.
Rightly, there was criticism under the Biden administration about not letting that deal go ahead, and rightly now there is criticism of intervening in the market when the business model is clearly failing.
We've had consecutive administrations that have taken a role in exactly the way they're taking stakes or putting their thumb on the scale when it comes to certain corporate actions. And there will be a real kind of reckoning about that in markets, and I think people are struggling with that, as I'm struggling to express.
The new normal
Yes,
down in
exactly.
Washington, D.C. Yeah.
That's correct.
Up next on the program, Nisha Vitale of Parametric, looking ahead to next week's Fed meeting, plus Jahara is going to be back. She's got your morning movers going into the opening bell. Another check on IBM shares sinking on AI software concerns. That name down in the pre-market by close to 8%.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
With this technological revolution that we're experiencing, with the AI boom, companies are thinking, how am I going to position myself? Boards and management are saying, hey, what do we have to do to take advantage of this? And you've got that tailwind that continues to push forward in terms of people saying, hey, maybe we should transact. Maybe we should accomplish more scale in order to take advantage of this situation.
So that was Eric Cantor of Moelis and Company on the program a little bit earlier. An aggressive forward-looking mindset dominating this market, keeping equities close to record highs, just pulling back from those levels this morning by 0.3% on the S&P 500. Similar move on the NASDAQ. In the commodity market, interesting morning so far. Let's check it out. Brent and WTI. Positive now by, let's call it 0.6%, in at around 102.50 on Brent crude. The Washington Post reported this coming into today's session, that it could take 6 months to fully clear the Strait of Hormuz of mines deployed by the Iranian military. The president out on social media just moments ago saying the following: I've ordered the United States Navy to shoot and kill any boats, small boats, though they may be that is putting mines in the waters of the Strait of Hormuz. There is to be no hesitation. Additionally, our minesweepers are clearing the strait right now. I'm hereby ordering the activity to continue, but at a tripled up level. Thank you for your attention to that matter. Statement from the president just moments ago.
Yeah, and this is adding a little bit of a premium to the oil trade, especially given the fact that there is an accusation of potentially or in order to shoot on any ship that is suspected of laying any mines. This goes, though, to the Washington Post report, and it kind of edifies it, frankly, that a number of different intelligence sources said it would take 6 months to clear any of those mines that had been laid by the Iranian forces. Again, going back to a question, how soon can we open the Strait of Hormuz in a real way that is anything like what we've seen before this conference
started?
It's
so complex, so difficult. That's why so many people in this equity market have moved on and are clinging to other forces, like the numbers we've seen from tech and from the premium consumer. You've talked about this a few times already this morning. The pillars of support for the US equity market at the moment. One, a tech boom. We've seen that in several companies so far this week. And two, the premium consumer, that even with these higher costs for the airlines is driving demand. And you saw that again in American Express earlier on this morning, better than expected.
They can continue to spend, which is a reason why you've seen even prices maintain at their levels. The fact that we heard from United Airlines that they were surprised at how little demand destruction there actually was, given the fact that they had raised prices, shows the strength under the hood. And then Neil Richardson coming on just moments ago saying, actually, the labor market is turning up and people are getting jobs and a lot of employers are now paying up to get them. It kind of speaks to that resilience and that strength.
That's the support. That's the tailwind for the market. The headwind, just to go over that headline again, the president ordering the Navy to shoot boats, placing mines in the Strait of Hormuz. We've got a ceasefire, but it's a fragile one. And I think that headline, that statement, speaks to that. As we count you down to the opening bell, 41 minutes away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing a big sudden drop in super microcomputer shares, down nearly 11% in the pre-market. After a Bluefin research report unveiled it lost a massive contract with Oracle worth up to $1.4 billion. And they're saying that may be tied to the co-founder's indictment, who, if you remember, back in March was accused of illegally diverting billions of dollars of NVIDIA servers to China. Moving on to IBM, those shares also falling in the pre-market, down 7.7%. Earnings were solid, but not enough to ease Wall Street's biggest concern, which is, of course, AI disruption. Software revenue up 11%, but that was only in line with estimates. And ending on a good note with Texas Instruments surging nearly 10% now in the pre-market after crushing estimates. They make the power and analog chips that keep data centers humming, and that demand is driving all the upside. John?
Stock is flying by 9.8% this morning. Yahara, thank you. Thanks for this morning. As we count you down to the opening bell, sneak peek of the next 24 hours and the next week for that matter. Later this morning, we'll get you some PMI data as well as Intel earnings after the close. Friday, UMich consumer sentiment. On to next week. Next week is basically about one day. Or at least on the schedule, it's basically about one day. On Wednesday, you get a Fed rate decision and earnings from Alphabet, Microsoft, Meta, and more. It is the biggest week of earnings on the calendar.
Yeah, and it's going to be the key pillar for support, potentially or not, for this equity market, given that that has been the support that people are looking at. Is the AI hopes and dreams? How far can they go?
Looking ahead to next week's FOMC meeting, Nisha Patel of Parametric writing the following: the Fed is patient, not panicked. My base case is still another hold. Nisha joins us now for more. Nisha, good morning.
Good morning.
Does that hold go to the next month, the month after that, and potentially through the rest of this year?
I think there's a good chance that now we're looking at a 2026 with where we could see no rate cuts, right? Unless we see a very different story transpire. And the biggest kind of caveat being that, does demand destruction, right, lead to lower consumption spending? Does that start then bleeding into slower growth, right? And an alternate story in the jobs market, labor market, which is the opposite of what we're seeing this morning, kind of that continued strength. So outside of that change, very strong earnings as we're speaking about, a resilient economy, almost a little bit of hiring back into the labor market. It is going to be, I think, very tough for the Fed to change their stance and really justify a rate cut given where we are. Now, I would say it's not maybe about if there's any cuts. This could just be possibly pushed back to maybe 2027, right? Time will tell a lot of how long kind of this war I don't want to say drags on, and higher oil prices will really be an indicator of that.
It's one thing to look at the reaction function of a Federal Reserve. It's another to look at a reaction function of a market. If the Fed were to lower rates, saying,
without that being actually solidified, there could be a short-term reaction there of, hey, is there a reason or really justified cuts without actually seeing this? Now, that may actually transpire, but I think this is more of a medium-term story rather than assuming that productivity gains, right, are going to come about without actually seeing that in the data.
everything that we've been talking about this morning, whether it's the commodity story or if it's the earnings story, and you put those two things together, is inflationary.
Yeah.
Do you think that this market has reflected a true concern about inflation, or are we just measuring it wrong? And actually, if you look at it, it's actually quite low.
So I think we're seeing that, look, if you look at fixed income, if you look at overall rates, right, we're seeing this built into especially the long end of the curve. But I still think that the market is telling you, look, this is still maybe a transitory story, right? This is not going to necessarily be sticky inflation. Market in some sense is willing to look through this. Now, I still go back to at what point, right, all this inflation shock recently has come from higher oil prices. At what point do you start hitting a tipping point where that could actually be disinflationary? Because you start seeing a pullback in demand. So I think we have some of this priced in. I think we haven't really seen maybe kind of all of it fully priced in just yet, which is why, look, in fixed income, I think there's tactical ways to take exposure, right? I think the biggest stories of fixed income managers today, we've had a few guests here on the show, absolute yields are still attractive, right? We're not saying you have to necessarily reach for a duration, but the story here is like you have income. You're no longer banking on rate cuts for total return in a fixed income portfolio. That's the biggest change that we have seen over the past few years. So I think kind of that fixed income story is back, taking some of that exposure, adding a little bit of duration in the short to intermediate part of the curve is a good way to do that.
Nisha, very quickly, 30 seconds. If the U.S. Navy starts hitting and striking boats, laying mines in the Strait of Hormuz, would you consider that a resumption of hostilities and the end of the ceasefire?
I would, and I think that is going to create a significant reaction in the market, right? And I don't even say renewed, increased geopolitical concerns. I mean, you could see a significant flight to quality in that scenario. So I think we're still teetering on, obviously, economic data being a very key component. We had a big number today, having that coming up, Fed meeting, but we cannot separate out the geopolitical risk, right, and that flight to quality that we could see as a result of that.
Nisha, appreciate your time. Thank you. Nisha Patel there of Parametric. It's a fragile truce. A fragile truce.
Yeah, we're seeing the sort of armies line up on both sides, ready to call an end to that truce.
Up next, we'll catch up with a man who's got a good read on what's happening militarily and in the markets. We'll speak to Peter Cheer tomorrow of Academy Securities, Kay Herr of JP Morgan, Sarah Hunt of Alpine Saxon Woods, Bob McNally of Rapid Energy. Looking forward to being with you tomorrow morning from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk. You could look at it the other way. Obviously, this stuff is risk-weighted. I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Every trading day, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
All right, futures selling off a bit. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Crude continues to climb as the U.S. and Iran battle for control of the Strait of Hormuz.
John Gray remains bullish, predicting Blackstone's best year ever for IPOs as deal-making picks back up.
And beyond Blackstone, we're digging through a wave of earnings today, from Tesla's AI push to Americans' rising fuel costs.
And that's all that matters today, not the fact that oil is yet again above $100 a barrel.
Yes, earnings, earnings, earnings. And that's what's driven this market to new highs. I mean, we want to continue to see that happening, and it doesn't look like Tesla.
I was going to say, not all earnings are coming in great, even though a lot of them are. Let me show you what Tesla is doing pre-market. It's down 3%. So profits blew past estimates, margins jumped. So initially you got a rally in share prices post-market, but then it raised AI and robotics CapEx spending to $25 billion. That's triple last year's CapEx. And there you get the shares fall.
Yeah, you got to pay to play, though. American Airlines says full-year earnings will be at the midpoint of its previous guidance as the war creates an additional $4 billion in expenses due to higher jet fuel prices. But they're going to be able to raise prices on consumers and keep a lot of that price increase, even if fuel reverts back to its pre-war costs.
I guess buy your tickets now. It's already too late. I'm not quite sure on that. Let's get back to Tesla, though. Joining us is Bloomberg Tech co-host Ed Ludlow. Ed, is this just about CapEx? Is that what the investor nerves are around?
Yeah, I mean, this is a monster number by Tesla's historical standards. And it was so interesting because Elon Musk opened the call by framing it in kind of like, well, you're all familiar with CapEx. Everyone's doing it, so we'll do it too. But I guess that the nervousness is that it's not just a commitment to $25 billion of CapEx, it's the admission that it will immediately put them into negative free cash flow for the rest of this year. That kind of worries the market, even though their kind of cash pile is pretty good. And, you know, the market can be a fickle thing, but it was evidence that they're going to get going and spending on the future business lines, which is humanoid robotics. They explained how that will manifest, robo-taxi, and the other AI infrastructure costs that they'll have.
Well, and as we know, that's Tesla's main valuation driver, right? It's not the car business. However, I do want to ask you about the car business, Ed, because we've all had, you know, friends that drive EVs who've been bragging over the last 6 weeks about how much money they're saving on fuel costs. You're one of those people. And so I would have expected a massive jump in EV sales. Yesterday, as you know, I was down with Sebastian Mackinson at BMW looking at their new 7 Series. He showed me a cross-industry snapshot of Q1 EV sales, and none of these car makers are doing as well as they did in the first quarter of last year. I mean, they're all facing massive drops for the most part. How is Tesla doing?
That would be logical with Tesla, and that's what happened. They were very explicit. High gas prices drove demand in the quarter. They're seeing a rebound of demand, not just in Asia Pacific and South America, where they're still kind of growing, but even in North America, they saw a rebound in demand. So that was like when the
But is it to the same level that they had in sales at Q1 last year when they had the tax credit, the $7,500 tax credit?
It can't be, because remember that the sales data that comes before earnings tells us no. You know, they still are seeing overall weaker sales data than historically. It's a double-edged sword for them, because also right now they are facing the lasting and longer-term impacts of tariffs that raises their costs. They also talked about higher interest rates raising their costs. But it was a kind of, you know, I think 24 hours ago, we said we're just going to ignore the car numbers, right? And everyone that said that will now eat their hat, because actually, you know, in the quarter gone, Danny noted on the top and bottom line, they outperformed because they had some short-term positive impact from what the war in Iran and energy prices, but also something that we're not quite understanding yet. They got a one-time short-term relief from tariffs and positive FX impact as well. So that's just old school earnings stuff, right?
Ed Ludlow, co-hosting the close. Bloomberg Tech as usual. You'll probably be on the close.
I mean, you basically co-hosted.
Will you be on the close today?
If I'm invited, I'd be honored to be on the close.
Today's your last day in New York, am I right?
It's my last day in New York, and we have Intel after the bell, so that's another big one. By the way, Elon said that he would use Intel's 14A process, and the stock went bananas in after hours. That's all you need to know.
Is he going to buy? Is he going to buy Intel eventually? Is Elon Musk going to buy it eventually?
The thesis of the street this morning is that we're actually moving now even closer to a world where SpaceX combines with Tesla in the future. Doesn't answer your question, but there you go.
He gets his nice pay package, right? Yeah. He reaches the capex he wants, or the market value he wants.
Yeah, I mean, a lot of the hedgies I talk to think Elon eventually is going to buy Intel, or at least that's part of the speculation.
Well, okay, what he did not say is whether they would license the tech or use Intel's foundry as a customer of Intel. They did not say either, so there you go.
All right, you get more of Ed Ludlow. We want to keep him, but he has to go prepare for a show. It starts at 11 a.m. You get more of Ed Ludlow then. Speaking of the war driving earnings, American Airlines says it's going to create $4 billion in extra expenses related to higher jet fuel prices, but they're going to be able to raise prices for consumers and keep at least some of those price increases, even if fuel reverts back to its pre-war level. And I think that's a key observation. Bloomberg Chief Global Aviation Correspondent Sid Phillip joins us now. And Sid, we heard this from the CEO. Clearly, shareholders are happy about that, as the shares are up 2% in the pre-market.
So every airline has telegraphed that fuel costs are going to feature into their full-year earnings expectations. American Airlines, the fact that they've reduced their debt below $35 billion, which is obviously a big overhang for the stock. That's been something that's positive. And the second is the fact that demand continues to be, airlines are talking about demand continuing to be robust even as they increase fares. And they're also talking about how they're going to cut capacity where it isn't profitable. So there is some element of the fuel prices reflecting in the earnings, but at the same time, there is sort of measures that the airlines are taking in order to try and sort of deflect from that. I mean, United Airlines yesterday talked about how they will be able to pass on 100% of the fuel costs by the end of the year. So airlines are looking to sort of take those measures to actually recover those costs.
Right. And I believe it was United Airlines CEO that said the thing about higher prices that stick around.
Oh, that was Scott Kirby?
Yeah, Scott Kirby said that. I do wonder, I mean, we're looking at American Air talking right now, I believe it's on their earnings call, saying that they will be on the forefront of M&A if opportunities arise, something you and I had talked about yesterday on the Deal Show every Wednesday at noon. Is the stress enough that this is what causes more M&A? Or was this inevitable at this point, Sid, that we would see more consolidation?
So it's a sort of question of what would have come first. And I mean, this is something that is a sort of immediate pressing event for some of the weaker carriers, that they need to look at M&A because that's the only way to survive, especially as costs start skyrocketing. I mean, fuel is the most expensive, biggest chunk of expense for an airline. And so when they start sort of the bills keep rising, I mean, airlines have to be able to sort of fend off that. And a lot of airlines that have weaker balance sheets will not be able to sort of get through that. And we're seeing some signs of that. I mean, yesterday we've been reporting on Spirit Airlines, and Spirit Airlines looking at a government bailout. It looks like the government is going to give them a bailout. And the government may take as much as 90% of Spirit Airlines. And so Spirit was one of the airlines that's in its second bankruptcy at the moment. They were looking to get out of second bankruptcy, but given the higher fuel prices, the math doesn't matter anymore. And so they had to get a bailout.
By the way, why do you think the government, given what we saw happen during the Obama administration with General Motors and the bailouts of Detroit, why would the Trump administration want to do that again?
So Spirit Airlines is a large employer in Florida, and they sort of are a massive sort of influence on the East Coast of America. And so for Trump, the optics of losing 14,000 jobs was something that they said was not worth paying for. And so Spirit Airlines is, a low-cost carrier that sort of gets a lot of people across the country. And like a low-cost carrier failing would somehow, maybe it works for their image to sort of support them.
Yeah, we talked about more stimulus heading into the midterms. Maybe this is part of the form it takes. Sid, thank you so much for joining us. Bloomberg's Sid Phillip. Now, back to the war in the Middle East. President Trump saying on Truth Social moments ago that he's ordering the U.S. Navy to shoot and kill any vessels laying mines in the Strait of Hormuz. The U.S. also intercepting Iranian oil tankers as it awaits Tehran's response on restarting talks. Joining us now is Bloomberg Washington correspondent Tyler Kendall. Tyler, I gotta say, it kind of has a feeling of escalation. It's something the markets were worried about, clearly not this morning, but it doesn't seem like the rhetoric is cooling down at all.
Right, Danny. I mean, at this point, it appears that the standoff over the Strait of Hormuz is definitely worsening, threatening the potential prospects for a deal. We got this post moments ago from President Trump when it comes to mines in the Strait of Hormuz. He went on to add that the U.S. is going to double its efforts in trying to clear the strait, which comes on the heels of the Washington Post reporting yesterday that a military assessment shared with Congress is estimating that any such efforts could take nearly 6 months to complete, just underscoring really how dangerous conditions remain. Now, we should say that a Pentagon spokesperson did tell the Post that that information was inaccurate, but it's definitely raising the stakes and the potential timeline here for when we could see a safe strait, because Iran has repeatedly said that they do not want to resume negotiations until the U.S. lifts its naval blockade. But the thing is, President Trump has maintained that it's not going anywhere. And as you just mentioned, new this morning, the U.S. military confirming that it intercepted 2 Iranian oil supertankers. It says they were trying to evade the blockade. It really just marks the latest in this week's efforts by Iran to appear to test the U.S.'s limits when it comes to the waterway. Of course, we heard the IRGC say yesterday that it had seized 2 vessels that it says were trying to make its way through. But Matt and Danny, when asked about this, the White House maintains that none of this is a violation of the ceasefire, particularly in the case of those 2 seized vessels. They say because neither were American or Israeli flagged.
All right, Tyler, thanks very much for joining us. Tyler Kendall in Washington. We'll come back to her in the next hour. Check right now on what's going on with markets. S&P futures down about 0.25%. NASDAQ futures off as well, although only 0.2%. And of course, we were up yesterday 1 full percentage point on the major benchmark yesterday. In terms of Brent crude, we see it continue to climb a bit. Right now, 102.49, and that $100 level has been one that seems to make the administration uncomfortable. So we'll see what we get as a reaction, if anything, to the repricing of oil.
But at the same time, the White House putting out on Truth Social, thank you, Mr. President, stocks, NASDAQ, S&P are at all-time highs. So
yeah, and that's not wrong. I mean, this market is absolutely on fire. And although oil has repriced, we haven't seen too much of that in stocks. We saw, the valuations come down to like 20 times forward earnings, but now we're back to 21, now we're back to 22, and we continue to climb again.
By the way, I spoke with John Gray this morning. We're going to play out more of that earnings conversation, but he talked about this. Let's actually look at what Blackstone is doing this morning, because they did report earnings. The earnings topped estimates as the company expects 2026 to be the best year for IPOs ever. Originally, shares were higher, but then they announced a dividend cut, so perhaps that's why shares are off this morning. As I said, I spoke with the company's president, John Gray, about his outlook for the economy and his portfolio companies following the results.
In aggregate, the picture is pretty good. And the big driver goes back to what we talked about at the beginning, this huge AI infrastructure boom. 5 companies spending $700 billion in capital. Even as we have a shock like we're seeing with the war, we can continue to power through. Our expectation is we'll see a pretty healthy economy despite these headwinds.
And you're going to hear more from our interview with John Gray throughout the show. Elsewhere, IBM software sales, they were in line with estimates, failing to shake investor concerns about AI disruption to its business. Matt, those shares down nearly 7.5%.
ServiceNow reported results that disappointed investors and said some sales deals have been delayed by the war in the Middle East. The CEO of ServiceNow, Bill McDermott, joins us at 10:45 a.m. with Caroline Hyde.
Coming up, we're going to talk more about Tesla's robotics progress and how the Iran war is impacting the auto industry. We're going to speak with TD Cowen's Itay McKelly. This is Bloomberg Open Interest.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Getting out of high interest, look what's making headlines around the world. Navy Secretary John Phelan has been fired after clashes with Pentagon leaders over President Trump's push to revive U.S. shipbuilding. The move comes as military tensions tied to the Iran war are rising. The Navy's undersecretary will step in as operations continue in the Strait of Hormuz. Cannabis stocks are higher after the DOJ moved medical marijuana to Schedule 3, signaling looser federal controls. Major names like Tilray, Aurora, and Canopy Growth are all surging in the pre-market. A broader federal review of the rescheduling is set to begin in June. And Netflix is betting on itself, launching a $25 billion stock buyback program after shares slid more than 13% in weak forecasts and leadership turmoil. The company is also stepping back from a major media deal fight, collecting a $2.8 billion breakup fee while signaling long-term confidence. Danny?
Elsewhere in earnings, Tesla is tripling its spending plans for AI this year to $25 billion as investors look for signs of progress in its robotics push. TD Cowen senior analyst Itay McKelly has a buy rating on Tesla and joins us now. I know in your take of their earnings, you said more positives than negatives, but Itay, I got to say, at the moment, it feels like this is a market concentrated on those CapEx numbers. Shares are down 3.5%. What did you make of it?
Yeah, thank you for having me. So you're right. I mean, the CapEx number has been in focus. The stock has been kind of recovering ground, so a little bit of a pullback on the CapEx numbers, I suppose, makes a little bit of sense here. But the CapEx really isn't new information. They did already guide to a significant amount last quarter. Yes, it did go up again this quarter, but we don't think that the CapEx is likely to linger here for too long, just given some of the momentum we're seeing not only on the AI side, the FSD side, of course, robotaxi, but also on the EV side as well, where the company we thought made some pretty positive comments around recent demand trends.
I mean, isn't it good that they're going to spend $25 billion? They're a $1.4 trillion company, and I mean, that's a bigger market cap than every single automaker on this planet combined.
Yeah, it's a great point. They are at the center of several global megatrends in AI, electronics, manufacturing, of course, EVs, and they're rolling out significant products and services, and those do require investments. And look, we will get proof points later in the year from the Cybercab ramp, for the robotaxi expansions, the potential for FSD on consumer vehicles to go eyes off at the end of the year or early next year. Of course, the launch of AI5 next year. So yes, you have a big CapEx number to your point. We also have a number of fundamental catalysts that can serve as proof points that this company is heading in the right direction and unlocking these very significant opportunities. And that's why we don't think the CapEx number is likely to linger as an overhang going forward. And underneath it all, the EV business we think is starting to come back. We actually published a very large report about a month and a half ago calling for the bottoming of U.S. EV sentiment. We were pleased to hear last night the company talk about recent order uptick, including a record Q1 backlog.
When it comes to the timelines for things like, robo-taxis, Optimus, the Cybercab, the Semi, they always tend to be a little bit squishy. When do you have these included in your earnings models?
Sure. A lot of it's still upside to our model. I think the one area that we think could be maybe the biggest catalyst could be eyes off on consumer vehicles, because that doesn't just accrue to more FSD subs and more revenue on the existing install base. That actually could be a significant driver, in our view, of vehicle demand going forward, given the significant amount of new services that you can launch, even in easier markets, easier conditions. You don't need to deploy in major urban areas to unlock significant new services and revenue streams and ultimately vehicle demand. So we think FSD eyes off could be a significant catalyst into next year, both for revenue as well as vehicle demand, to kind of get that virtuous cycle going.
Itay, I think it's fair to say you're one of the most respected autos analysts on the street. You have spent at least 2 decades, right, covering car makers around the world. I was pretty stunned yesterday when I got a look at EV sales in Q1 compared to EV sales in Q1 last year across automakers. Almost all of them have declined really significantly. And I would have thought that in March, we would have a huge rebound in EV sales. But I guess higher fuel prices, at least $4 a gallon on average, is not enough to make up for the $7,500 tax credit that we lost last September.
Sure. So I'll throw out 2 data points on that may paint a bit of a different picture as what we saw in March. So if you look at the reporting EVs, the actual vehicles and companies who actually report monthly sales, the mix of those relative to overall vehicle sales was the highest in March since IRA credits expired. So we have seen sort of an improvement sequentially. The year-over-year comparison, of course, is still difficult, as you point out. But even on a year-over-year basis, when you look at it on a sales relative to inventory basis, because, of course, EV inventories also come down a lot year over year. Sales relative to inventory in March of this year was flat year over year, meaning consumers pulled down roughly the same percentage of inventory as it did last year in terms of demand. So those are 2 encouraging signs. Of course, it does take some time for the impact of higher gas prices to flow through. Our core thesis on EV2 argues that significant new product is actually coming in the next 12 to 18 months that could catalyze significant demand in the U.S., just given the certain structural advantages we have in the U.S. to drive EV adoption.
All right, Ite, great to get some time with you. Really appreciate it. Hope we get you back soon. TD Cowen Senior Analyst Ite McKelly. Tomorrow, we're going to talk more about the auto industry with the ChargePoint CEO, Rick Wilmer. And you should always, if you care about cars, check out my podcast. It's called Hot Pursuit with Hannah Elliott. I'm currently driving the i7, the BMW, the new BMW electric vehicle. Last week, I drove the Lucid. A few weeks before that, I drove another Kia EV9. So I'm immersing myself in these EVs.
I know you liked the Lucid a lot.
I did, but you know what? The i7, it's so comfortable.
Really?
It's so big. It's so fast. Obviously, it's also very expensive. But they did a fantastic job. And I'll give you more on Hot Pursuit. This is Open Interest.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Minutes ago into the start of trading, some of the movers we're watching. American Express, those shares falling 1 1/3%. They said that spending on its premium credit cards climbed in the first quarter as it prepares to revamp its business credit lineup, but clearly something went wrong.
I mean, the price went way up.
True.
So,
it's
of
like
course.
nearly $1,000. It's crazy.
Yeah, well, you can reap a lot of benefits if you're studious and rigorous about it. Keurig Dr. Pepper beat earnings estimates after completing its takeover of JDE Peet's, and international sales steadily increased. I will say Hasbro also out with earnings. Preliminary results showed revenue growth in double digits as its Magic the Gathering sales continue to climb. Cool. So many nerds out there. Less than 4 minutes until the opening bell. We begin the trading day with BlackRock's Gary Chowdhury. Stay with us.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. Futures are lower. This is after a 1% gain yesterday. So I don't know why I should have said we hit an all-time high at yesterday's close.
And NASDAQ too.
We continue to make new highs on the S&P and the NASDAQ. Dow 50,000 is not. Hey, we still show the small caps here. I thought since Katie and Shanali left, we would show the Dow over here.
It's not at 50K, I can tell you that. I know it's not. It's like still at,
there you go.
Just below
So Pam Bondi can't come back yet. In terms of the bell, L3 Harris here ringing the bell. They're very happy people. Their stock is up. Like if you reinvested dividends, about 75% over the last 5 years. They make defense tech, so obviously they're doing well. If we're in a war, radio comms, their strong point there. Roku ringing the bell at the NASDAQ, and they're in a good mood because they just passed 100 million subscribers, and because maybe they haven't been looking at the stock chart. I always look at a 5-year, I default to 5 years because the Bloomberg terminal does, and that's a horrible default for Roku because it goes back to like the heart of the pandemic when everybody had nothing else to do but watch Roku. So the stock is down 66% in 5 years.
Got it. That's pretty tough for them.
Yeah.
I have a Roku. I don't watch anything on it though. I have the physical thing, but it's not plugged into my TV.
Yeah, I have a couple of them that I mean, Apple TV is.
Sure, I got an Amazon
really
Fire.
good.
You know, there's a lot of choice out there. I'm looking at Tesla here. The open shares are down about 3.5%. So just on the top and bottom line, things did look good. The estimates, the earnings blew past estimates. Margins jumped. The issue for them, though, is that they raised their AI and robotics CapEx. It's going to be $25 billion for the year, and that is triple last year's capital expenditures, Matt.
Yes, but still only $25 billion. And those numbers seem small since I've heard all of the hyperscalers' CapEx numbers. We're not talking about $100 billion, and they're a $1.4 trillion company, so it's a tiny percentage of their market cap. American Airlines says full-year earnings will be at the midpoint of its previous guidance as the Iran war creates an additional $4 billion in expenses due to higher jet fuel prices. But as we've been talking about, airlines are able to raise prices. You know, consumers will pay it, and it's a great excuse. Plus, as you corrected me earlier, it was Scott Kirby, right, from United, who said, like, look, even if we go back to the pre-war price of jet fuel, we're still going to keep a sizable chunk of these price increases. And they have to, like, claw money away from consumers because over the long term, airline ticket prices have actually gone down, inflation adjusted. So
it still has that like post-COVID feel to it, where companies who rose prices basically said, oh, people will keep paying it and we're going to keep prices there. So doesn't that kind of pretend that any inflation hit we might get from this war maybe sticks around for longer than we thought?
Yeah. It tends to be fairly sticky. Joining us now is BlackRock Chief Investment and Portfolio Strategist for the Americas, Gargi Chowdhury. And Gargi, we get stuck on inflation and the war because these are, you know, I guess, interesting or important issues. But if you take those things away and just look at the market, it's doing incredibly well. Corporate earnings are really strong. I guess like $100 Brent is something that we can easily deal with.
Good morning, guys. It's great
good
to
morning.
be here. Thank you for having me. So, you know, we were in the process of writing our spring investment directions, which we just released yesterday, through this headline-driven volatility. And one of the questions that the team and I asked ourselves was, what are we still going to be talking about, not in March and April, but perhaps June, in May? And to you guys' point from before, I think slightly higher inflation, the impact of this $100 or over $100 oil prices, and what that means for your portfolio is going to stay with us. So does that mean a little bit more inflation protection in the form of tips or commodities? Does that mean some allocation to durable growers like energy security, and then keeping the core of your portfolio in diversified assets we think makes sense?
But still like $300 plus earnings on the S&P for 2026, right?
Absolutely. So in the middle of earnings season right now, and I think one of the things that we've seen in the few that have reported so far is not yet a tremendous amount of concern around much higher oil prices. That hasn't come through yet, and strong beats. So coming into this earnings season, one of the things that was different from others was we didn't revise lower, we revised higher, especially across tech and a little bit across energy. And focusing on AI as a result of that, another one of our durable grower themes is what I think investors have been doing, especially over the time that we saw that volatility. We definitely saw investors pouring back into names like semiconductors, into tickers like our BlackRock AI fund.
By the way, in terms of earnings revisions going higher, the MLive team did this really good study basically saying it was basically due to your point to one sector, tech, but one company also within that, that Micron, that basically it had a 5 times bigger uptick in earnings contribution than it did NVIDIA, which is about 10 times Micron's size. And then you get into later in the year, we're also expecting more big tech AI-related companies to come into the market between OpenAI, Anthropic, SpaceX, if you can kind of lump it in there. Is this a market that's due to just get that old concentration problem again, that the tech leadership weighs and acts as like the pillar for a bull market?
It almost does feel like this is a market where investors want to go towards where there is earnings growth. And as we see now, that 35.7% earnings growth is in tech and friends, tech plus sectors. And yes, perhaps that means that we have a little bit more concentration at the top. But what I would also point out, especially in this earnings seasons, as opposed to 12 months ago, you are seeing more sectors in the S&P with positive earnings growth than we saw this time 12 months ago. So there is that broadening out theme that is also happening. But while that's happening, you're certainly seeing tech and AI specifically retain its stock power.
Does it surprise you that we continue to see the rates holding in this range? I mean, I know a lot of people at the beginning of the war were worried and watching closely the 10-year and thinking, like, if that gets to 450 or above, it's a problem. If we stay below that, we can look through this war and we're cool.
You know, no, it doesn't surprise me because I think the theme over the last sort of 12 to 24 months has not at all been about interest rate sensitivity or duration. It has been about income. So if you think about the 55% or so higher in oil prices that we got, 10-year treasuries have been remarkably resilient. It's basically moved between 10 and 15 basis points up or down through this inflationary backdrop. So what I think that means for investors is earn some income in your portfolio with allocations to asset classes like securitized, emerging market. You know, we do that via a ticker called a BlackRock Income Bank. and then add some inflation protection in your portfolio with TIPS, with STIP, which is an area of the market we think will continue to gather inflows.
Why outside the U.S. is your call emerging market over developed market?
Yeah, so the reason there is more and more emerging markets are becoming also another way to diversify outside of the U.S., but stay in that AI theme. So if you look at IEMG and how it's composed, about 45% of that is today comprised of AI-related themes, as opposed to a decade ago, tech was only about 20% of IEMG. So more and more clients are telling us, we love this AI theme, we like the earnings growth. EM has earnings growth revised up to about 36%, as opposed to many parts of the developed markets outside of the U.S.
Gargi, thank you so much for joining this morning. Great to have you. That's BlackRock Chief Investment and Portfolio Strategist for Americas, Gargi Chaudhry. Let's get a check on your equity market right now, about 8 minutes into your trading day. And we are falling, but we hit a record high yesterday for both the NASDAQ and for the S&P 500. I just want to point out, as to what's leading us, it's semis. Semis have been on this insane run. They've been higher, the Philadelphia Semiconductor Index, for 17 consecutive days. That's the longest winning streak in history since that index was created in 1994. We're also trading at a record high price. Texas Instruments is the best performer, also a semi, had really strong earnings. Intel, they're going to report after the bell, but we learned of a Tesla investment into Intel, or at least a cooperation between some of their production. Analog devices doing really well. Again, it's semis are ruling all. Apple of about 0.5%. On the downside, IBM, some earnings that failed to capture the imagination of the investors. Microsoft, that's down 2.6%. Meta, Nvidia, those not having a great day. ServiceNow also reporting earnings down a whopping 14%. In about an hour's time, a little bit over that, we're going to hear from Bill McDermott. But because of those big cap tech names that are down, information technology as a sector is down this morning, despite the fact that semis are on this huge monster run. At the top of the pile, you have utilities, industrials, and real estate. Matt.
All right, so semis are crushing it over the longer term. IT, though, down today. Coming up, Intel gets a boost from Tesla ahead of the earnings that are coming after the bell. So Intel earnings are coming after the bell. We'll talk to Mandeep Singh because he runs Bloomberg Intelligence's tech coverage globally. This is Bloomberg Open Interest.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The GM report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
About 15 minutes into your trading day, let's get you the top calls, what the sell side is saying. First up, JP Morgan. They've cut Avis budget to a sell, saying the stock's recent surge is driven by a short squeeze, no duh, and has pushed valuations way past what the business actually supports, also no duh. The stock has increased nearly 200% since the beginning of this year. JP Morgan expects that the rally will soon fade. We did see at the open, Avis was halted. I mean, look at this, hockey stick all the way down, and now it's trading again. I believe it's declining. We're looking at that declining precipitously. So those shorts are probably sighing a breath of relief. Duh. Next up, Rothschild and Redburn. They're upgrading McDonald's, saying that the chain is pulling off its biggest value reset since the dollar menu days. They also note that weight loss drugs are still a risk, but remain too expensive to impact McDonald's core low-income consumers. Those shares up 1%. Finally, Tesla earnings highlight a spending surge in its AI and autonomy push. Morgan Stanley says that the long-term vision is aggressive, but near-term upside looks limited. Barclays also says that Tesla is entering a key investment phase, but notes that the update offered little new information. Matt.
I love, the Avis story.
Oh, it's so
yesterday, the stock traded at $847.70 a share. Today, it's trading at $343.88.
It's amazing.
What an incredible story. All right, let's talk tech, though. We are joined now by Bloomberg Intelligence Global Head of Tech Coverage, Mandeep Singh. And Mandeep, there's so many places we could go today. I think just to get it out of the way quickly, because we've been talking about Intel's increased CapEx, and $25 billion for a $1.5 trillion company doesn't sound like a ton to me, especially since all of their valuation, or a huge part of their valuation, is based on them doing well in AI, in robotics, in autonomy. So they have to be investing in this stuff.
Yeah, and you're right. I think Tesla's $25 billion contrasts with Google spending probably $180 billion in CapEx this year. All of the other Mag 7 players who are building these AI data centers have north of $100 billion in CapEx. So from that standpoint, Tesla is incorporating LLM in their FSD software. In fact, the latest version that they have released uses LLM. So I'm not surprised that they are raising their CapEx. And look, when it comes to physical AI, the opportunity is huge. Probably it's not a 1 or 2 year thing in terms of, mass adoption, but everyone is investing in physical AI. And I think Tesla is definitely ahead in that race, and it's the right time to keep investing.
By the way, Intel, I just want to quickly bring up, because Intel this year is up 83%. It still has a relatively small market cap, right? 337 billion, compared to other chip makers like NVIDIA is teensy-weensy. Does Elon Musk eventually somehow buy Intel? Because he's so into putting up this, what does he call it, a mega fab or a
terafab.
Gigafab? Terafab,
yes.
There you go.
Well, look, I mean, Elon Musk is the first one to call out that we have a real problem in terms of dependency on TSMC for everything. If you're making GPU, NVIDIA has got all of their allocation with TSMC. Same thing with Apple to make their chips. So companies like AMD and even Google TPU cannot ramp up faster because there's no capacity. So what Musk is saying is, we'll set up a terafab here wherein I'll work with Intel, and make sure that we have enough leading edge capacity here. And so conceptually, it sounds like a good idea. Whether he's going to put a lot of money and a possible acquisition, I don't know. But I think, to my mind, he's highlighting that real constraint, given the geopolitical situation we have, in terms of TSMC dependency. It makes a ton of sense that, you want Intel to succeed, especially on the fab side.
It's something people talk about on the street, right? Which is why I'm bringing it up, because I keep hearing it lately. Do you hear that?
I don't, to be honest, but it wouldn't surprise me.
Please tell Danny, guys.
Yeah, send me messages too. Hey, Mandeep, thank you so much for joining us. That's Mandeep Singh of the Bloomberg Intelligence team. Let's get a look at some of the other movers on our radars. As I mentioned, semis on a tear, and Texas Instruments adds to that. They give a strong forecast. Companies spending big on data centers and industrial equipment. Semis now up for 17 consecutive days, the most ever.
Honeywell said war in the Middle East is hurting revenue in the process automation unit that serves customers in the energy industry, and as a result, those shares are down 2%.
Lululemon has typed Nike veteran Heidi O'Neill as its next CEO as Lulu struggles to dominate the athleisure category that itself created.
I mean, still, 20 years later, I can't get over the athleisure, the term athleisure.
It's staying. I think you gotta get used to it.
I'm not going to embrace it, but I'll accept it.
Sure.
Coming up, Blackstone's president says this is still the year of the IPO. More from our conversation with Danny's conversation with John Gray. Next, this is Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
Blackstone reporting a larger than expected jump in distributable earnings boosted by a robust start to the year for deal making. I spoke with the firm's president and COO, John Gray, following those results.
When you look at the quarter, we're really proud of it because it showed we're an all-weather firm. We had this 25% increase in distributable earnings. We had nearly $70 billion of inflows. But the real key driver is what you're hitting on, which is the strength in performance, which was driven by the focus on AI infrastructure, this massive build-out that's underway. 8 of the top 10 investments for us in terms of performance in the quarter were around data centers, LNG, battery storage. And it's really rippling through our firm, to your point. So it impacts our real estate business, our infrastructure business, our private equity energy business, our asset-based finance area. There's just so much need for capital to deliver this compute. It is really essential now to our firm in driving returns. And we see this shortage of compute and need for capital is really something that's structural now. So it's a big opportunity, and it is clearly the biggest driver for us today.
And you clearly, with $69 billion, pulled in the capital to be able to achieve something like that. I wonder, though, on the more AI side of things, John, because we've heard a lot of different partnerships with private capital firms, inking with Google, with Anthropic. Just this morning, we learned about CVC and Google. Are you partnering with any LLMs?
Well, we're not in a position to announce anything, but obviously getting this diffusion to happen is very important, getting this into our portfolio companies. So we're working on one of these opportunities. We want our portfolio companies to move quickly because we think it's a key competitive advantage. And what's nice about private equity firms, particularly us with more than 270 companies, we can really move the needle. And I would say what's exciting is today we're seeing a 15-fold increase in large language model spending for our companies off of a small base, but I think it's still early days. There are so many opportunities to improve efficiencies, to make content creation better. So big opportunity. The challenge is to change workflows. It's not easy to do, but it can have a big impact on our companies.
Well, we will stay tuned for any announcements. I feel like that was a nice little teaser in there, John. On the other side of this, though, there's a fear of AI disruption in software. I know your exposure is something like 7%, but you have seen some write-downs. Do you think we've hit the peak of write-downs, or might there be more to come?
Well, I think there are a couple things to note. One of the things we've seen is these companies have continued to perform well. And rightfully, folks would say that's in the rearview mirror, but I think it's an interesting data point. I do think there's going to be some disruption here. It's not all going to be the same. I think the outcomes will be heterogeneous. If you compare it to maybe retail 25 years ago, there were plenty of Sears and Kmart's, Toys R Us, but also companies like Walmart and Costco who are really more infrastructure-like. And I think that analogy will hold in software. Many of these companies who are really systems of record, they're deeply embedded. I think they have a good position, but the management teams are going to have to adjust. So I do think we're going to see here this spreading out. I also think overall in the sector, we have seen a re-rating lower in multiples because there's more uncertainty. And it goes beyond software to information services, professional services, really the white-collar world. So I do think we've seen a reset. And of course, managers have to adjust valuations. We've done that in the software area. Multiples have come down quite a bit for these companies. So I think it's an evolving, sort of playing field. And companies cannot sit still. They're going to have to move into an agentic world.
And I know you were pretty early, Medallia, for example, in writing down the value of that loans. There have been reports that Thoma Bravo is handing back the keys to you and other lenders. Is that the case, John?
Well, I can't talk about the specifics of the situation. Medallia has been well reported to be having challenges well before AI. I mean, issues around this credit go back more than a year ago. I do think what's interesting there is it's a situation where we and the other lenders lent less than, I think, a third of the total cost. The equity sponsors had to lose more than $5 billion before you had a transfer here to the potential transfer to the lenders. But here again, the lenders also have taken write-downs. So the valuation multiples are down very dramatically. The overall value's down dramatically. I do think the business under a new management team can do much better here, but obviously they're going to have to pivot as well to this new world.
Blackstone's John Gray, and we're going to have more from my interview with John in the next hour. And it was that final question there. There's been this drama over Medallia. Does it become the poster child for software? But to be fair, as John mentioned, it was having issues even before all of the AI stuff.
Yeah, it has been well reported, but we're, I guess, waiting to see if Thoma Bravo indeed hands over the keys and if the creditors can make money on that business. Coming up in the next hour, Morgan Stanley's Andrew Sliman joins us at the desk. We will also talk with Caroline Hyde and CEO Bill McDermott, CEO of ServiceNow, Bill McDermott, and I will focus in on what's going on in the Iran war. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
President Trump says he has ordered the U.S. military to shoot and kill small boats that deploy mines in the Strait of Hormuz. The post on social media comes as the U.S. military seizes other tankers believed to have been smuggled Iranian oil. So far, no talks have been planned, but the White House says the ceasefire will remain open-ended. ABC's Ian Pannell with more from the region.
I think what we're seeing from the regime, it feels emboldened by this indefinite extension. It feels it can just wait out President Trump while the damage ramps up to the world economy. And if you look historically, it's managed to sustain the economic impacts of severe sanctions for many years, and is likely to do so once again.
The Secretary of the Navy, John Phelan, fired without explanation by Defense Secretary Pete Hegseth. Here's ABC's Martha Raddatz.
Phelan is a civilian political appointee, but there had been clashes with Hegseth in recent months. Hegseth's latest unexplained firing of a top Pentagon official comes as thousands of Navy personnel are blocking the Strait of Hormuz in a standoff with Iran now firing on 3 commercial ships and seizing 2 trying to transit the waterway.
Acting Attorney General Todd Blanche has reclassified weed as a less dangerous drug.
The acting Attorney General says his move would immediately reschedule state-licensed and FDA-approved medical marijuana from Schedule 1, in the same class as heroin, to Schedule 3. Todd Blanche's order would pave the way for significant tax breaks for the distributors of medical marijuana and ease restrictions on federal research of cannabis. The drug remains illegal under federal statutes, but the administration says it vows to expand patients' access to it as a treatment.
ABC National Correspondent Stephen Portnoy. 2 trains with 38 people aboard, both colliding in Denmark today. 5 people were critically injured in the accident north of Copenhagen. You're listening to ABC News. Spirit Airlines is reportedly on the brink of collapse. However, the Trump administration may be about to bail it out to the tune of $500 million.
A rescue would mean that Spirit's thousands of employees do stay on the job for now. Spirit's not commenting on this deal. It does say that flights are operating as usual. Guests can book travel, use credits and points. And if you already have a ticket booked, at least for right now, it's still on track.
That's ABC's Elizabeth Scholze. An announcement about a possible bailout could come as soon as today. Wildfires are still burning in southeast Georgia. At least 50 homes have burned to the ground and thousands of people have been evacuated, among them Denise Stevens.
How I was going to get my animals and all my belongings that I couldn't live without. My kids' things when they were what they made me when they were growing up. How I'm going to get all that out. And then I have my dogs. I have my donkeys.
Another story out about big tech companies and artificial intelligence, this one focusing on how much we humans interact with our computers.
Meta is reportedly tracking its employees' behavior in order to train AI models. Reuters, which was the first to report the news, finds Meta is using a program called the Model Capability Initiative to collect keystrokes, mouse movements, even screenshots from workers' computers. It's all part of an effort to teach its AI to better interact with humans. The company says it won't be used to evaluate employee performance.
ABC's Mike Dubusky. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, streaming live at Bloomberg.com as well. Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence program. Coming up, we're going to check in with Becca Wasser, defense lead for Bloomberg Economics, to get the latest reporting out of Iran and the Strait of Hormuz. Paisley Nardini, Managing Director and Head of Multi-Asset Solutions at Simplify Asset Management, will join to discuss her outlook for the markets. Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst and Senior Weed Analyst, will give us the latest on this marijuana rescheduling. How big of a deal is it for the cannabis industry? Kevin Tynan, Director of Research at the Presidio Group, will recap Tesla's earnings and talk about just autos in general, where we are with this EV transition across the globe for the auto industry. So a lot coming up, a lot of earnings analysis coming up in the next couple hours as well here. Let's kick it all off with Alexis Christophers. Bloomberg, this is Flash. Alexis.
All right, thanks very much, Paul. And we have got some red arrows on Wall Street right now for the equity markets. The S&P 500 is down about 12 points at 7125 after notching a record high yesterday. Dow Jones Industrial Average slipping 157 points, or about 0.3%. NASDAQ Composite now down more than 113 points, again after lodging a record high yesterday. In the oil pits, we have some green arrows. Brent crude at 103.19 the barrel, up 1.25%. West Texas Intermediate also up 1.25% to 94.10 the barrel. And the Bloomberg Dollar Spot Index up fractionally at 1198.12. Bitcoin is taking a breather. It is down 1% at 77,600. Taking a look at some stocks on the move, Tesla is down 3.5%. The company expects to spend an additional $25 billion this year to support CEO Elon Musk's ambitions to transform the EV car maker into an artificial intelligence and robotics company. Comcast up nearly 7% after first quarter profit beat street estimates. Comcast lost fewer broadband customers than expected, and that helped offset lackluster growth at its Peacock streaming service. And Texas Instruments stock up about 16%. It is one of the biggest winners in the S&P 500 after the chip maker gave a strong forecast helped by spending on data centers and industrial equipment. And Intel up about 2.5% ahead of its earnings report after the closing bell. And this Bloomberg Business Flash is brought to you by IBKR. For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. As Alexis was just reporting, we got red on the screen here, but let's take a look at some of the stocks on the move today. We can do that
with Isabel Lee, cross-asset reporter for Bloomberg News. Isabel, what are you looking at?
We have to start with Keurig Dr. Pepper. Ticker is KDP. The stock
I like
is
Dr.
up.
Pepper,
Exactly.
but I don't drink it that much, though.
You know what? Me too. That's why I picked it, because I don't drink it that much.
How do you describe the flavor of Dr. Pepper?
Fruit beer?
Ish, yes.
Fruit beer?
Fruit beer. Yeah.
Combined with medicine.
Oh my God.
Sorry. Sorry.
Waco, Texas. Anyway, go ahead.
The stock is up more than 7%. This comes after the company beat revenue and earnings beat expectations due to strong sales of cold beverages in international markets. And interestingly, those were able to offset a decline in coffee. So KDP is a beverage company, and it makes Dr. Pepper and Keurig coffee, which
Just
is
pods,
the coffee machine. Yes, the pods. First quarter revenue was $3.98 billion, topping estimates. EPS also exceeded projections. So Barclays said that cold drink sales were particularly a standout, and the revenue was high enough to suggest strong sales from the company's legacy beverages, as well as ghost energy drinks, to those who drink energy drinks here, were enough.
All right, sounds good. Next on your list is an airline.
Southwest Air, this is down 2%. The company's adjusted quarterly profit and revenue missed expectations. So this comes after United Airlines slashed their full-year profit forecast, and both showed just the impact on global carriers when it comes to the war in the Middle East, because, of course, they're pushing fuel prices higher and higher. Southwest declined to update their full-year profit guidance of at least $4 a share. It said achieving those results would require lower prices mixed with strong revenue performance. So we know that rival carrier Delta declined to update their full-year forecast. We also know that United Airlines and Alaska Air have revised or withdrawn guidance. So I think it's going to be a challenging time for airlines, and this comes as I am trying to plot my vacation days. So
But your
good luck with
vacations
me.
are either India or the Philippines. I mean, you don't go to, like, Florida.
I am going to the Bitcoin conference next week in Las
That's for
Vegas.
work. That's different.
That's for work. That's for work, yes.
First time to Vegas for you, I'm guessing.
First time in this decade.
Oh, okay.
For some reason, I go every decade once. The
All
first
right.
time I was there was when I was 11 or something.
All right, very good. All right, Texas Instruments.
Ticker TXN, this is a big gainer, up by 17%, the biggest intraday gain since April. This is a chip maker, the biggest chip maker of analog chips and embedded processors, and the oldest chip producer in the industry. So they reported revenue to be $5 billion to $5.4 billion in the second quarter. Analysts had estimated $4.85 billion. So to be sure, the company's revenue is still short of prior peaks, but still, it's spurring enough optimism for this run-up to continue. It's really a surprisingly strong forecast, and as we know, it's because of the booming spend on data centers and industrial equipment.
All right, good stuff. Thank you so much. Isabel Lee is our cross-asset reporter, and for more conversations like this, be sure to subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. You can find it, of course, on Apple Podcasts, Spotify, or anywhere you listen. And Paul, we just got a red headline here that Warner Brothers shareholders have approved the $110 billion sale to Paramount. So that is...
Moving along.
Final, I feel like the chapter has closed.
Yes.
Finally.
Yep, and they're wrapping up the refinancing some of the debt and bridge financing, so it's all moving forward.
So the Hollywood actors and writers and everyone else who oppose this, I guess they continue to agitate, but now it's kind of in the back rearview mirror for
I think so, yeah.
all the regulators here.
Yep.
All right, let's move on to what's happening in Iran. I'm not sure that there's any peace talks on the calendar right now.
No, I hear just a reporting of various ships attacking other ships and that kind of stuff and boarding ships, and that's kind of where we are.
Right, but no military strikes either.
Right.
So we're kind of in this waiting period. Becca Wasser is our defense lead here at Bloomberg Economics, and she joins us now from Washington. Becca, how would you describe what we're seeing right now between the U.S. and Iran? There's tension, but there's not active fighting at the moment, but there isn't any road to peace talks either.
Well, it's purgatory. Right now, the U.S. and Iran are in extreme limbo. There's no war, but there's no peace either. And what that just means is that tensions are quite high, and everyone is waiting on tenterhooks for what might happen next. And this is why I think we're in a new phase of this conflict that is centered on the Strait of Hormuz, but it really speaks to the fact that this is going to be a protracted conflict, a lengthy conflict that's going to go on for some time, where you're going to have periods of high-intensity tensions and fighting, and then periods where there's not much happening. And I think right now we're at a low in that conflict.
President Trump is out with a tweet this morning and saying, basically calling out the Iranian leadership as infighting. They're not really sure who's in charge there. What do we know about what's happening within the Iranian government as it relates to who's in charge and who may be negotiating on behalf?
Well, I don't necessarily have more information than anyone else at this point in time, but I think really what the president is doing is he's relying on the fact that there is some, changes within their government, largely wrought by U.S. and Israeli strikes, including strikes on key leadership nodes within the Iranian system, and saying that that level of confusion means really is his excuse for why negotiations aren't moving forward at the way in which he would like. So right now, it's a really convenient talking point for him, but in terms of who's in charge, I don't have more information on that, and I think it's one of those things that's unfolding in real time.
So we have this ceasefire between U.S. and Iran. We also have a ceasefire between Lebanon and Israel, although both sides have claimed that each has broken the ceasefire at various points. Are the U.S.'s goals and Israel's goals still aligned?
I think the goals have always been quite different at the end of the day. The strategic objectives are different, but there is alignment on how they can achieve those. So this is why you did see such cooperation on the airstrikes on Iran. But really what it comes down to is right now, the U.S. and Israel are on two different pathways. And I think the longer this goes on, the more we're going to see divergence in those paths and, a lack of alignment between Israel and the United States.
So, Becky, I like your term, we're in purgatory here, just kind of waiting here. Is there any sense of maybe who is more incented to maybe break the log jam? Would it be the U.S.? Would it be Iran? Maybe Israel? I don't know.
I mean, I think right now the U.S. is really focused on diplomacy and trying to find an off-ramp to this conflict, and one that allows the U.S. to at least claim victory. Iran also needs to claim victory, so it's finding that sweet spot in the middle. But in terms of, sort of who's up or who's down, let's look at who the ceasefire benefits the most, at least from the military angle, which is the thing that I cover. If you're looking at the industrial efforts, Iran probably can benefit the most because they can, dig out some of the buried missile launchers, some of its missile stockpiles. It could maybe try to obtain some more drones and upgraded drones from Russia in the interim. The United States and Israel definitely can't, produce, more munitions off the factory line at the same rate that Iran could maybe at least bolster its stockpiles. So that puts it into a really interesting scenario if things were to go hot again in this conflict.
You talk about how there's hot and cool periods, and right now nothing seems to be happening. Do we go back to a period of high-intensity fighting? Does the U.S. have the equipment, the military equipment, to do so?
The U.S. has the ability to prosecute a high-intensity conflict against Iran. That part is not in question, even with some of the enormous expenditures of key missiles and munitions. Even if those are running low, they're running low for the Middle East. That doesn't mean that the United States is entirely out, versus for Iran, their arsenal is a bit more finite. So the U.S. can do that. But the question is, are things going to go hot? Is it going to be this high-intensity fighting again in the future? And really, I think we'll probably know more in the next few days, if not a week, as to whether that's more in the offing. But I think what we're going to see are just, various times where Israel in particular is going to strike back at Iran, Iran is going to strike back at Israel, and then there's going to be these lulls. Whether the U.S. is involved is more of an open question, and that's one that ultimately comes down to President Trump.
All right, Becca, thank you so much. We really appreciate your reporting. Becca Wasser, defense lead, Bloomberg Economics, down there in Washington, D.C. And given that kind of level of purgatory, if you will, we've kind of got energy higher for longer. WTI crude oil, $94, up about 70 cents today, well off of its high at the beginning of the war. But again, still roughly 50% above where it was prior to the war. And that's kind of what we're seeing corporate America, particularly most recently the airlines, dealing with
Absolutely.
Calling out those incremental costs.
We're also seeing perhaps more interest among U.S. consumers in looking at EVs, and that's something that Tesla has indicated is kind of reviving interest in its vehicles.
Yep, we had Paul Sankey on, who is probably one of the preeminent oil analysts out there on Global Wall Street, and he said even if this thing were to come to a peace settlement tomorrow, it's going to take a couple of months for the whole ecosystem to kind of free itself up. A little more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:21 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers studio. Stocks are taking a breather after the S&P and NASDAQ closed at record highs yesterday. Oil is higher as U.S. forces boarded a sanctioned supertanker carrying oil from Iran in the Indian Ocean. This is the latest enforcement action in a blockade of the Islamic Republic's shipping. S&P 500 down 10 points. Dow Jones Industrial Average now down just about 25 after being down more than 200 points earlier. The NASDAQ Composite, though, is down about 130 points. Brent crude is now nearing $103 a barrel, with WTI crude at $93.64 the barrel, and the Bloomberg Dollar Spot Index little changed at 1197.26. IBM posted quarterly sales in its software unit that were in line with estimates, but that is not enough to shake investor concerns about AI disruption. Shares of IBM down 9.5%. Honeywell is planning to spin off its aerospace unit in June, and it's entered an agreement to sell its warehouse business to American Industrial Partners. The company did log a lower profit in the first quarter, and second quarter outlook disappointed. So therefore, we've got shares of Honeywell down about 1.5%. And new leadership at Lululemon, the struggling athleisure wear company, has named longtime Nike executive Heidi O'Neill as its new CEO, but shares of Lululemon are down nearly 12%. Her appointment was a surprise to a lot of investors, including her lack of prior CEO experience. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christophorous, and that's your Bloomberg Business Flash. Paul and Scarlett.
All right, Alexis, thank you so much. We appreciate that. Scarlett Phil and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Just coming across the tape recently, Warner Brothers investors approve $110 billion sale to Paramount. I also note, since I know David Zaslav, that investors reject CEO compensation package. That's interesting.
I know. Is that binding?
I don't know. I don't know how it works, but our next guest, I think he probably has some good reporting there. Chris Palmieri, he covers all the entertainment companies out there in Los Angeles for Bloomberg News. Chris, what do you make of the news here today? I guess it's fairly well expected that the shareholders would approve this sale to Paramount, Skydance Paramount.
Yeah, they showed them the money and they said yes. $31 a share, $110 billion total. The pay package vote is not binding. It's one of those say on pays things that companies are required to do. If this company were continuing as a public company, then the board would take that into consideration and next year's pay. But this go round doesn't matter. They'll be gone, and David Zaslav will have his money.
Right. We're looking at accelerating equity awards valued at more than $500 million and $335 million in potential tax reimbursements.
Oh, nice.
So he makes out pretty well.
He always does.
He always does. Chris, what does this mean for the thousands of Hollywood actors, screenwriters, directors, and other workers in the industry who have come together to oppose this merger? They were appealing to regulators, to policymakers. I mean, do they still continue to try to press state attorneys general to do something about this?
They can and they will. It's not a done deal overall. Certainly it is from the shareholder standpoint. It's a milestone in that regard, but there's still regulatory approvals that have to be done, and everyone's sort of anticipating lawsuits similar to what we've seen in Live Nation and other cases, sort of opposing this deal. So yeah, quite still.
But not from the federal government level, right?
It doesn't appear that that's the case. I mean, there's been no official sign-off. The Paramount will say that they've gotten clearance essentially from the DOJ, but there's really been no official sign-off in Washington.
The deal price is $31 a share. The stock's trading at $27.30 here. That feels like a big discount to me from an arbitrage perspective, given this deal is going to presumably close in a couple of months. So I guess, what do you think the uncertainty might be out there in the marketplace, Chris? Is it regulatory? Do we need to get a sign-off from President Trump, and that can always be a risk? Is it some legal, maybe lawsuits or something? What do you think? Is there uncertainty?
Yeah, I think all of the above. I mean, really, and we've really just seen a steady drumbeat. I mean, the Hollywood community has sort of been against it, but, they had to shift. They had to go, they were opposed to Netflix, and then they sort of had to regather, and now they're opposed to Paramount. And so, but we've seen, the list of celebrities signing a petition against is growing. The number of events, people like Cory Booker, the senator from New Jersey have held to sort of examine this deal and criticize this deal. So whether it all amounts to something that will stop the deal, still a big question mark there, but there's certainly sort of growing opposition.
So when does the companies, Paramount, Warner Brothers Discovery, when do they start doing some of the hard work of integrating? Or is that something they cannot do until the regulators have made clear that they're not opposing?
Yeah, they really have to wait to close. We saw in that Nexstar-Techner deal where they jumped as soon as they got a clearance in Washington, and then the lawsuit happens, and now they're actually barred from integrating. So very awkward situation. I imagine the Warner Brothers Paramount folks are looking at that and saying, all right, well, we should probably make sure we're in the clear before we actually close this.
Chris, you're based in LA. I'm sure you know a lot of these folks that work at these entertainment companies. How concerned are they just about LA as a creative community, as a Hollywood community? Because here in New Jersey, Netflix is building a huge production complex down in Fort Monmouth, the old Army base, tore down everything at this huge Army base and are building this gajillion-dollar production facility. I mean, there's Vancouver, there's South Carolina, there's lots of places that are taking business away. What's the mood in LA creatively?
Particularly gloomy, yeah. And, it's been that way. We've written about this for a couple years now. You've had, the flight to other locations to shoot. There's a big part of it, this overall cutbacks in spending among big companies. And the globalization of the business has really changed things. And then, we've got AI as a threat. So jobs are definitely weak, particularly here in the capital of entertainment. And so the idea of this big merger, while David Ellison, the CEO of Paramount, promises there'll be growth, everyone anticipates that it's going to be very difficult in the labor market.
All right, good stuff. Chris, thank you so much for bringing us your perspective. Chris Palmieri, of course, joining us from Los Angeles on this latest news that Warner Brothers Discovery's shareholders have approved the sale to Paramount Skydance, which I guess we weren't surprised about, but now the hard work begins of having the regulators okay it.
Yeah, and again, I'm just calling out this almost a 12% discount from the current stock price to the deal price. And again, that just seems wide to me. But maybe there's still some uncertainty out there. So that's kind of what the market's reflecting.
Yeah, it had traded about $29.15 on February 24th. And then since then, it's come down and really stayed in a narrow band. All right, let's move on and talk about the broader markets right now and bring in Paisley Nardini. She is Managing Director and Head of Multi-Asset Solutions over at Simplify Asset Management. Paisley, good to speak with you. I wanted to get from you a sense of what is driving the markets, because so much of it has been geopolitically focused. And of course, with the start of earnings season, the big bank earnings came out very solid and gave folks a lot of reason to be optimistic about investing in equities. How do you see things right now?
Yeah, thanks for having me back. Good morning. I'm always surprised to see how resilient markets are. I think and it's still front and center, of course, but I think markets are really showing their resiliency in looking forward, which is what investment markets do. That's what the stock market always does for us. But really, since the end of March, we've seen this pretty robust and historical rebound in equity prices and just risk assets broadly. And the amount of times I've heard someone say a historic move, a multi-standard deviation type shift in just the last quarter here is pretty outstanding. But as a broader backdrop, I think markets are looking through some of this geopolitical risk and what's happening in the Middle East right now and its impact on oil, which I think is directly related to consumer confidence numbers. We can come back to that. But corporate earnings have been really the focal point over the last few weeks, which really has lifted markets. And I think, again, looking forward and looking at the resiliency of some of these corporations, profit margins are increasing, earnings are beating on the top and the bottom line. And so really what drives the stock market over time, it is that corporate earnings and that resiliency that we've seen thus far in the last few weeks.
How do you feel about that earnings power in this market, Paisley? Because it looks like, at least as of today, we may have continued uncertainty in the Mideast, which may lead to continued higher energy costs, which could lead to higher inflation, lower economic growth. Given that backdrop, how do you feel about the earnings outlook?
Yeah, as mentioned, we've started to see about maybe 10 to 20% of companies already report. About 90% of them are beating. Next week, we're going to see a really large swath of corporate earnings come to play here. I think it's going to be a lot of dispersion. I mean, the general theme and trend is going to be beating and exceeding expectations. But exactly to your point, you have on one hand this AI impact, and we saw the implications of that earlier this year as it relates to the software sector in particular. We'll still likely see some of that drag. And even what you were mentioning around IBM and some of the earnings we're starting to see, what is AI doing for these companies that aren't at the forefront of that? And then also on the other hand, we've already started to see several of the airline companies come out and say they're going to be reducing some of their guidance and expectations just given the volatility in oil prices. So what we're even seeing today in markets is a bit of a rally in some of the more defensive parts of the market, like consumer staples, for instance. And so I think we'll see a lot of this kind of bifurcation over the next week or so as more earnings come to play.
So clearly the stock market is the center of focus here, especially with the major indexes resuming record highs. We've seen a lot of volatility in the rate markets, FX, and commodities, although that's kind of narrowed a bit here. But you look at credit spreads and they've barely moved in comparison to the other asset classes. Why does it seem like credit is out of the spotlight? That is a little bit of a sideshow right now.
Yeah, we've been, as a broader industry, I think we've been looking at credit spreads for 6 to 12 months here, waiting for them to crack. And that's another part of the market. Typically, we see credit spreads start to widen out before the broader kind of economic crisis comes to play. And despite some small blips and kind of widening of spreads, they've remained extremely tight relative to historical standards. So I think this gives us a little bit of sigh of relief in that the underlying system is perhaps not over-levered. I also think, too, with the rise of private credit over the last 5 or so years, a lot of the public debt outstanding in the corporate sector is higher quality debt. And so from a kind of a broad macro signal right now, I would say credit spreads are definitely signaling that there's no underlying concerns within the market. I think as a prudent investor, though, of course, we can maybe look through that. But exactly to your point, with high yield spreads, 300 basis points or even lower over treasuries, there's not a whole lot to be concerned about there, which is why we see a lot of investors still willing to take credit risk, even though some of them have maybe moved up in quality away from high yield and more into investment grade credit.
Paisley, thank you so much. Really appreciate it. Paisley Nardini, Managing Director and Head of Multi-Asset Solutions at Simplify Asset Management. Some smart folks there. Just looking at gold here, holding steady at $4,700 an ounce. Bitcoin pulling back just a little bit as well. So some of the alts out there for some folks. But right now, it looks like this market feels very steady, right as we after having this big run up.
It really does. We've gotten so accustomed to big swings that now that we're back in the little changed range, especially for equities, if it's not going up, it's just kind of meandering most of the time. And even oil prices have really brought in the volatility. Oil is higher today, but by less than 1%.
Yep, absolutely. All right, coming up, Kevin Tynan, Director of Research at the Presidio Group. We'll get his thoughts on Tesla. Coming up after the close tonight, Tesla will have some earnings. And we'll talk about the auto sector in general, the continued transition to electric vehicles that's coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers studio. The S&P 500 and NASDAQ are pulling back from their all-time highs, and oil is climbing as peace talks with Iran appear to be in limbo. The S&P 500 now down just about 6.5 points. Dow Jones Industrial Average down 53. NASDAQ Composite down 97. So well off their lows of the morning, but still lower. Brent crude 103.05 the barrel. WTI crude now at 93.66 the barrel. American Airlines is the latest carrier to cut its 2026 earnings forecast as a surge in fuel costs have added billions to airlines' expenses this year. But its quarterly earnings beat the street, and shares of American Airlines up nearly 4% now. American is also pursuing potential revenue-sharing agreements and other strategic partnerships with Alaska Air, and we've got shares of Alaska Air up 4.5%. Southwest Airlines, though, declining to update its full-year profit guidance when it reported profit and revenue that fell just shy of estimates. We've got shares of Southwest down 3.25%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christophorous, and that's a Bloomberg Business Flash. Paul and Scarlett.
All right, thank you so much, Alexis. We are looking at, as you mentioned, little change here in the major indexes. The NASDAQ falling the most, down by 0.4%. This is even after Tesla reported a first quarter beat on adjusted earnings per share for a second straight quarter of better than expected results. We did hear from the company that it will spend more than $25 billion this year. That's up from a previous forecast of about $20 billion and 3 times the spending that we saw last year. I want to welcome back Kevin Tynan, Director of Research at Presidio Group. He covers automobiles. And of course, I want to start with autos with you from Tesla, Kevin, because what we know about Tesla is that first quarter auto deliveries were not very good, but Tesla did seem to sound a more optimistic note about its core auto business going forward. What's the message here?
Yeah, and look, it's hard to reconcile what they reported in terms of global deliveries versus the idea that demand is improving. It's not new product, and the focus isn't on the automotive business for that company, and competitors are actually lapping them in terms of that technology. So, you understand why the narrative is that this is not an automotive company, or in a very short while, it will not be an automotive company anymore. And you see where they're moving to, and the results on the automotive side really kind of illustrate that that move is necessary.
Kevin, what are the other big auto manufacturers, the GMs, the Ford, the Stellantis? What's their strategy these days about navigating whatever the transition is going to be to electric vehicles or hybrids? What is the strategy today?
Yeah, look, and I think the risk is often, or at least the financial risk is often having to move quickly to battery electric, full electrification, right? So the walk through hybrids, plug-in hybrids maybe, and eventually to electric vehicles, that work has been done. And you see from the past several years, Ford is a very good example with their Model E business unit, was averaging $5 billion per year in losses. So to me, that's the story, is not whether automakers are capable of doing it. It's not even about whether consumers want them. The fact of the matter is, if an automaker can't make money doing it, and even Tesla is showing it's very difficult to do that, when you back out the one-time items and the regulatory credits and all that, that this is why adoption in the U.S. is very slow, is because you don't want to be selling too many unprofitable things on purpose.
Right. And for now, the big automakers are sticking with what sells and what makes money, which is those big gas-guzzling vehicles. However, what's really interesting, Kevin, is that increasingly on social media, you're seeing a lot of influencers show off these Chinese EVs that are not even available for sale in the U.S. due to tariffs, national security rules, and of course, regulations overall. Is there strategy behind this, behind Chinese EV companies allowing influencers to peddle their wares to consumers who can't buy this stuff?
Well, look, I think in general, right, the narrative from China, because they've set up their supply chains, their transportation, their future is based on electric and electric vehicles, right? So it behooves them to advance that narrative that the entire world needs electrification for whatever the reason is. You know, and I always think that you can't really talk about the Chinese product without talking about the subsidies behind those vehicles. So they may be good and they may be competitive. They're subsidized significantly, maybe up to about $18,000, $20,000 per vehicle. And if you were to put that production here or force those manufacturers to build here or employ the labor, like a lot of that cost advantage, if not all of it, basically goes away, right? So on a technology basis, there's probably some catching up to do, but it's on a cost basis. You're not comparing automaker to automaker anymore. You're comparing automaker to automaker plus Chinese government balance sheet.
Kevin, I know you do a lot of work with the auto dealers around the country. It looks like you're in a generic hotel room somewhere in the middle of America right now.
South Dakota.
There you go. What are the dealers, what are they telling you? How are they doing out there?
Yeah, the dealers are in an interesting spot. You know, obviously, you can imagine on the ground, Tesla's not even is a non-entity to them, not concerned about where that's going. I think what you're seeing on the retail space is new and used vehicle front-end gross margin is getting more and more difficult and will continue to. But the beauty of the franchise network is that it's really for businesses. And the earnings drivers are the fixed operations, you know, the parts and service business, and the F&I, the finance and insurance business. And that's what the industry is cycling back to. We had this great spike in gross margin in new vehicles during the pandemic because of the supply disruption. That's kind of wearing off, and the industry is actually cycling back to where its earnings drivers come from, which is fixed op and F&I.
Consumers want more affordable vehicles. The average price of a new car, Paul, is around 50?
50, I think, yeah.
Yeah, maybe around $50,000, which, you know, basically is out of reach for a lot of people. What is the latest on an affordable internal combustion engine vehicle? Something in the neighborhood of 20,000?
Yeah, and look, I've done this math, and actually it's what I'm going to be presenting in a few minutes to the South Dakota dealers, is that there are affordable vehicles. You know, it's maybe 200 basis points difference in the percentage of affordable vehicles compared to, and I used 2016, which was the highest volume year in U.S. history. So the other part of it is affordability, if it isn't there, is not coming back, right? Because you have inflationary production costs, labor costs, regulatory costs. The answer to that is not lower price because you can't guarantee that you're going to get the volume. So I would expect the OEMs to continue on the path they've been on for more than a decade, which is easier to sell fewer vehicles at a higher transaction price, and then let the used vehicle market, you know, do its thing in terms of affordability, if that's the case. But it's not coming back. It's not automakers. It would be a 180-degree turn from what they're trying to do, which is to expand margin on higher average transaction price vehicles.
All the bells and whistles on the biggest cars possible.
Yep.
Right. Right.
All right, Kevin, thank you so much. Kevin Tynan, Director of Research at the Presidio Group, joining us from South Dakota. Of course, he's a friend of Bloomberg, having worked here before.
Yeah, and he goes literally all around the country talking to dealers like nonstop and just talking to them about the economics of the global auto industry, and, you know, and little give and take, and they both learn.
So he sees the demand on the ground, and I think it's interesting when he says that, you know, Tesla doesn't even appear on dealers' radars. Of course,
From
because
a competitive perspective,
because you can't get a Tesla at one of those regular dealers. You have to go to a Tesla dealership. All right, let's talk about earnings for a moment here, because obviously they're the driver behind the stock market's rally of late. And if you look at the performance of industry groups, energy companies of all stripes, whether it's upstream, downstream, or midstream, are the stock market's best performing group this year. And that's, of course, on the back of higher oil prices and steady demand. You look at Kinder Morgan, the #3 U.S. pipeline company, yesterday delivering higher than expected first quarter results. I recently got a chance to sit down with Kinder Morgan's chairman and co-founder, Rich Kinder, in Houston for Bloomberg's Wall Street Week. And we talked a lot about what's happening in the Middle East. Here's what he told me about the role of pipelines in the region now that the Strait of Hormuz is largely inaccessible to Saudi Arabia and the region's oil producers.
Now, you mentioned pipelines, and of course, the Saudis have one pipeline that runs across to the Red Sea. but it can only move about half of the production of Saudi Arabia. The rest has to go through the Strait of Hormuz. Now, there's already been a lot of talk about, well, let's put another pipeline in. Even in a country like the Saudis, where they don't have as many hurdles to building as you have in the United States or other developed countries, it'll still take an inordinate amount of time and money to do that. And then the two things you have to say, if you don't have a permanent settlement in the Middle East, you can bomb pipelines. You have difficulty getting to the pipe itself that may be 30, 40 feet underground, but you can bomb the compressor stations that actually provide the power to move that crude oil through the line. You can bomb the ports where it's going to leave the Red Sea. And of course, the problem is that's adjacent to Yemen. And as the forces in Yemen have shown, they can rocket attack ships there in the Red Sea. And I've been through the Red Sea, and that's a pretty narrow area also. Not as narrow as the Strait of Hormuz, but as you come up toward the Suez Canal, it's pretty narrow. So I think this whole thing will tilt emphasis on supply toward North America and away from the Middle East.
Do we have the infrastructure to support that supply? I mean, what needs to be built up in the U.S. to service that?
A lot needs to be built up. The INGA Foundation, the Interstate Natural Gas Association, which is a group of pipelines. I have a foundation that just studies these issues, and they just came out with a report in March. Actually, the first week after the war starts, it didn't take into account what's happening right now. But even then, they estimated that you need to build pipelines over the next 20 years or so that would accommodate a capacity for an additional 70 BCF a day of throughput. Now, the whole throughput in America today, the whole natural gas demand in America is about 107 BCF a day. So they are projecting that over the next, by 2050, that you need 70 BCF a day of additional capacity. So we've got to build a lot of infrastructure. That's probably a couple $1 trillion of natural gas infrastructure that needs to be built. And we're certainly seeing that, Kinder Morgan, in the approach of our customers who want gas, not just for LNG, but another big growth is in electric generation to supply particularly these data centers that are going up like wildfire to support AI. Now, not all those will be built. I approach it with a healthy grain of skepticism, but it will still be a major development. So I think you have a lot of demand for natural gas, and you've got to build more infrastructure to supply that demand.
And at least for Kinder Morgan, part of that building more infrastructure means acquiring it as well. The company announcing it's buying Monument Pipeline for about $500 million in cash to add to its Texas natural gas pipeline network, Paul.
Yeah, and it's the first time I'd seen Richard Kinder be interviewed. So I was like, who is this guy? I'm doing some quick stuff on the Bloomberg terminal. Turns out he's the largest shareholder of the company.
Yes, he is.
And
he never sold a share, he said.
At today's stock price, he has a net worth, around it, $8 billion just in this stock.
He's a huge benefactor in Houston, where he gives a lot of money, and he's decided to really localize his giving where it can make the most impact.
Interesting. But I mean, my energy, just how I'm thinking about it these days is we talk to, fossil fuel folks like, Richard Kinder, as well as the renewables, as well as the alternative, it just feels like we're going to need all of it.
Right.
To power.
It's an everything kind of approach.
It's an everything kind of thing. Maybe not the dirtiest coal. We don't have to fire that stuff up, but everything else should be on the table.
Right. You can't say no to one thing and yes only to one part of it because we need everything we can get.
It sounds like it. Just listening to Richard Kinder there about kind of the natural gas incremental demand that's going to be coming. Wow.
Absolutely. All right. Well, of course, you talk about nat gas, you talk about oil. You can't help but think about jet fuel. And jet fuel prices have been rising. And it's been really bad for these airlines, which, as far as I know, don't hedge their oil costs at all. They used to.
Right.
But they don't anymore.
Unless you have a refinery.
Right. Delta has that, right?
That's pretty cool.
All right. Let's bring in George Ferguson. He is our senior aerospace, defense, and airlines analyst. And George, American Airlines just reported, but I mean, for all these airlines, the story is the fuel bill is surging for them, and it is having an impact on their bottom line.
Yep, definitely right. The name of the game right now in airline land is I need to increase fares I think it's, they're roughly going to have to get up into the high teens to 20% rise in order to cover my increased fuel prices. One of the big challenges too is as they need fares to rise, so they have to start to cut some capacity so they can get supply and demand back in balance. As they cut capacity, their costs go up, right? Because there's economies to scale, and so they start to get mid-single digit and higher increases in cost per available seat mile as they trim their capacity growth. So it's a real push-pull kind of challenge here. And American came out and they hit it squarely with, hey, we're not really going to adjust capacity very much in 2Q, and we think we can get fare increases to compensate for a lot of it, but not all of it.
What are the airlines saying about demand here? I mean, and because I would think airlines have some pretty good visibility, people booking trips into the summer, maybe even more longer term than that. How are they seeing demand?
Yeah, so I mean, I would say that across the board, they've all sort of said demand was very strong going into, sort of the end of 1Q into the summer travel season this year. So it sounds like the setup had been pretty good. And again, now it's a function of the demand looks like it's still largely there, although they clearly wouldn't be cutting capacity if it was there and just would take a big price increase in fares. So a lot of them are, and I shouldn't say cutting capacity, they're trimming growth plans, especially the big full-service carriers, because, I mean, to me, that tells me they can't push through the full price increase they need. And a lot of them are talking about the cadence of getting that full recovery in fares to compensate for higher fuel prices. And they're kind of telling us that, we heard from United that by the end of the year, by 4Q, they thought they'd be fully compensated. American told us they thought they would almost be fully compensated by the end of 4Q. So you can see a cadence here where it's going to take them a bunch of the year to really drive through those higher ticket prices and get back the increased fuel prices if they stay here, if fuel prices stay here.
Well, we know demand also looks very good because consumers are booking their flights for this summer and maybe for the holidays that they know they're going to be going away, knowing full well that fares are going up, up, up. I mean, that's been kind of a steady drumbeat of the news flow. For companies sending employees to go do business in other parts of the world and country, that kind of ends up being something you book maybe a month out. What does corporate travel look like? What do we learn from the airlines about that?
Again, the commentary we're hearing right now is that corporate travel is continuing to recover. It was doing well, is doing well. And so from a demand perspective, we're hearing good things. But agree with you on that, Scarlett, that I think that, you're going to have to some degree the people that absolutely want to go or have to go rushing to book here, right? We know the airlines haven't booked out their entire schedule for the summer and into the fall. Again, summer, we're coming into vacation season. It's traditionally a very leisure-focused season, and again, one of their strongest. So this fuel spike comes at a good time for them to pass through some of those increases. It's going to be more interesting to see what happens as we get into 4Q and 1Q of next year if these fuel prices remain high. And yeah, I don't think we have the full story on corporate, but they're telling us in earnings corporate looks good. But like you said, it's a shorter booking window on corporate.
Right. You know how much air travel I'm doing this summer? Zero.
Lots. And you like
I live at the beach. I live at the beach, and people can come to me during the summer.
That's smart. You just avoid the crowds completely.
Avoid the crowds.
eVTOL, Paul.
George can sail
Get yourself down to the beach easy.
Exactly. George can sail his schooner down to see me anytime. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. He's down there in Princeton here. But, I think the K-shaped economy is going to, it has been and likely will continue to prop up the demand side, at least for a lot of these airlines, unless the ticket pricing gets too crazy with some of the fuel.
And that's why something like a Southwest, which used to cater to lower discount-seeking consumers, has moved into another category. And in fact, Southwest says another fare increase is coming today.
All right. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access our world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crescent Metals. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market
right now, and of course, there is some back and forth with the two sides trying to look at what's going on with vessels going through the Strait of Hormuz, or stuck in the Strait of Hormuz, more accurately. We're going to check in, of course, and talk about all of that. But first, we're going to talk to Paul Goldberg, because Blackstone did report earnings, and it was a banner earnings report here from Blackstone. So we're going to check in with Paul Goldberg, our senior equity analyst on that firm. Geetha Ranganathan, she is our analyst on U.S. media. Will recap the latest from Comcast, and of course, news that Warner Brothers Discovery shareholders have approved that sale to Paramount Skydance. We're also going to give you a preview of Intel's results. Intel, which is now largely owned by the U.S. government.
10-year, 4.28%. Gold up, down 0.1%. West Texas Intermediate crude flat, $93 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. As Charlie just said, you got red and green on the screen here today. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Avalon Purnell. Avalon, what are you looking at today?
Lululemon, that's ticker Lulu, falling now about 11% for its biggest one-day drop, at least intraday, since September. That's after the Athleisure brand said that Heidi O'Neill, a former Nike executive, will be coming on to start as their CEO beginning in September. Piper Sandler writing that her appointment will be a surprise to a lot of investors who will likely remember her playing a key role under Nike's former CEO, which, for those who don't remember, that was a period where Nike kind of pushed toward direct-to-consumer and struggled to innovate. So Lulu has definitely had a tough year, already down more than 30% this year.
Yeah. And with today's decline, that is the lowest stock price since March of 2020. And we know what happened in March of 2020. All right, next up.
Yeah, next up we have ServiceNow. That's ticker NOW, very easy to remember, tumbling about 16% for its most intraday since 2020. That's after the software company cut its full year forecast for subscription adjusted gross margin and said that some deals may actually be delayed because of the war in the Middle East. That is on top of a very tough year and tough landscape for software companies as investors continue to question the potential for AI disruption.
All right, very good. Avalon Purnell, we appreciate that. Avalon Purnell, equities reporter for Bloomberg News. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, Blackstone, the world's largest alternative asset manager, reported a larger than expected jump in distributable earnings in the first quarter, boosted by a robust start to the year for deal making. Jonathan Gray, president and COO, spoke to Bloomberg's Danny Berger following the results and discussed AI investments, software holdings, and IPOs. Let's hear a part of that conversation.
When you have this much noise in the system and concern, it will result in investors potentially looking for liquidity. So it's not unreasonable to expect this will take some time to work through. The key will be, do the products continue to show resiliency? And what's nice is, because the yields are high, in the case of our BDC BCRED, more than a 9% yield, you can absorb losses, and you have a very lowly leveraged structure. So if you think about a bank that's typically, call it 12 times levered, these vehicles for us less than 1 times less levered, these vehicles for us less than 1 times levered. So if these vehicles can deliver a premium in performance as they have to liquid leverage loans, investors will say, wow, these things are more resilient than I expected. They continue to deliver positive results. And then this will ebb over time, but it may take a bit to work through.
What's a bit? Is that like quarters, years? What does it look like?
It's hard to say. I would think it would be more quarters than years, but you'll have to see how the environment evolves. And obviously, as base rates come down, that, of course, is a headwind as well from an absolute return standpoint, but not from a relative return standpoint.
Even with the fears in private credit, it has been capital markets and M&A and activity that has been extremely robust. And John, I think that would surprise a lot of people coming into this year, considering we've had the fears over AI, disruption still on trade, and now a war on our hands. What are you seeing in your portfolio companies? Are there any stresses around energy costs and inflation?
What we've seen is remarkably strong. I mean, in Q1, our private equity portfolio had 10% revenue growth, which was an acceleration from Q4. And so, yes, there are isolated companies, particularly in Europe, who are facing higher energy costs. There, natural gas has gone up quite a bit, which is very different than the United States. Some companies are still dealing with some tariff issues. There's slowness or more challenges, I would say, in mid and lower end consumer businesses. But in aggregate, the picture is pretty good. And the big driver goes back to what we talked about at the beginning, this huge AI infrastructure boom. 5 companies spending $700 billion in capital. Just us alone, we think this year our data center business that we could lease across all our platforms 6 gigawatts. 6 gigawatts, to put in context, is almost $100 billion of data centers. There'll be another couple $100 billion of chips put in by the hyperscalers. That's $300 billion of aggregate spend. That's like the economy of Portugal or Finland. And so I think that tailwind to the overall economy globally, but particularly in the United States, is powerful, which is one of the reasons why even as we have a shock like we're seeing with the war, we can continue to power through. Our expectation is we'll see a pretty healthy economy despite these headwinds.
All right, that was Jonathan Gray, Blackstone President and COO, speaking with Bloomberg's Danny Berger following Blackstone's results here. Let's break down further. We're joined by Paul Goldberg, Senior Equity Analyst for Bloomberg Intelligence. Paul, talk to us about Blackstone. What did you learn from their earnings and their call about their business?
Hi, Paul. Thanks for having me. I think the biggest thing for Blackstone is their size and diversification, as they did see some outflows from the retail fund, the BCRED in particular. They did get a lot of inflows across the company, so almost $70 billion worth of inflows. So a lot of the fundraising and a lot of the activity is still holding up despite some of the pressure in the softer pocket and the retail and the credit side.
John Gray talked about how AI infrastructure is driving Blackstone's performance. What does that mean?
So they're investing in data centers. They invested in the infrastructure that supports the AI expansion. They talked about $150 billion of assets across that kind of a size types of businesses. That's over 10% of their overall assets under management. And they also talked about even slightly larger amount of the similar kind of deals in the pipeline to expand in that space. So they're really supporting that growth.
Paul, what's the story for Blackstone in raising capital? Do they have all the capital they need, or is this one of those? Are they always in the market raising capital?
I think they're always in the market. It really depends on what kind of vehicle. Sometimes those are flagship funds, sometimes those are new products. But given their size, they're really usually in the market with both types of products. So, for example, if you look at the BCRED, it did get some inflows, but obviously because of the redemption, they got some outflows. But credit and insurance was still the biggest segment of their growth in terms of the inflows. They raised a $10 billion opportunistic credit fund during the quarter. They closed that. So there's a lot of activity going on outside of the risk-packed pockets that we're hearing about.
Is there a weak link here in these results? I know you mentioned the credit and insurance arm and how that still drew inflows, but earnings in that business dropped 26%.
They did, but I don't think necessarily it's a weak link. So there's still some of that is driven by performance fees. They did have to, and they were very explicit about it because people are always concerned about valuations. They did mention that they lowered the valuations. In some liquid credit, they had a negative return during the quarter. So that's more normal in terms of what we're seeing in the public markets, and they're responding to it. Probably not at that scale that we're seeing in the public markets, but it's there. So there is some pressure, but overall, there's still a reasonable growth.
Stock down 4% today, down about 20% year to date. Is Blackstone getting caught up in just the overall market concern as it relates to private credit?
I think so. I think it's a matter of convincing the investors about the breadth and all the other businesses that are working, and the fact that the credit quality in generally is holding up reasonably well. The companies that they're invested in, and including the software part of businesses, they're doing okay. So it will take a few quarters to convince the market to come around. So if we'll look at the BREIT, there are the retail fund that they manage, a large fund. Going back several years, it took them a few quarters to work through those concerns. So we might see some more pressure coming into Q, even later on possibly, but the investors will come to realize the bigger picture.
All right, Paul, thanks so much. Appreciate it. Paul Goldberg, Senior Equity Analyst for Bloomberg Intelligence, reviewing the results from Blackstone Group. Also had some results and some news in the media space today. We had Warner Brothers Discovery, their shareholders. They approved the deal to be sold to Paramount Skydance. No surprise there. Now it's up to the regulators. We also had some earnings out of Comcast. So let's break it all down with Geetha Ranganathan. She covers all the media stuff for Bloomberg Intelligence. Geetha, let's just start real quick with Comcast. Stocks trading up here today. Talk to us about their earnings. What did we learn?
So pretty good earnings, Paul, across the board. And of course, as you know, the key metric for Comcast and all of the other cable operators is their broadband subscriber number. So the street was looking at something like about 170,000 customer losses. They actually reported much, much better numbers, only about 65,000 broadband subscriber losses. So just kind of really assuaging investors that maybe we are finally seeing some green shoots here, and maybe there's an inflection around the corner, which is why we're seeing the stock trade up the way it is today.
At the same time, because of that strong performance there, stronger than expected performance there, that is offsetting lackluster growth at the Peacock streaming service. Can Peacock survive on its own, or does Comcast need to do something with that streaming business?
So Peacock is, by all means, Scarlett, as you just pointed out, a very, very subscale player. I mean, they have about 40 to 50 million subscribers. You compare that to some of the bigger streaming services, most notably Netflix, that has, more than 325 million global subscribers. So there is absolutely no doubt that at some point they have to think of what the bigger strategy is going to be for Peacock and even for NBC Universal. They probably will have to combine it with another streaming service. And yes, they have kind of been struggling continuously with profitability. But one of the good things that they did mention is thanks to a great deal of promotional activity that Comcast actually had early this year, and that was because of the Winter Olympics. They had the Milan Cortina Olympics. They actually saw pretty good subscriber growth in Peacock. So that should actually help them report profitability for the very first time in Peacock's history in the second quarter. So we are seeing some green shoots on the Peacock side as well.
So they can count me as a subscriber because we signed up during the Olympics, and I've been too lazy to do anything about it, even though I'm a Walmart Plus member, so I can switch over to Paramount and watch Landman, but I just haven't done it yet because it involves, doing something.
There's a lot of moving pieces there. Hey, Geetha, just as it relates to Comcast, Brian Roberts and his family, the founding family here, they're not known to sit on their hands and do nothing with all the industry consolidation and the changes in what's going on in the world here. What do you think he does with his companies? He's got so many assets, but one could argue not a lot of growth stories there.
Yeah, this has really kind of been the burning question for Comcast. So we do know last year they were involved in the whole Warner Brothers Discovery bidding process along with Netflix and Paramount. They were in fact the third bidder. Of course, they did not offer cash. Their offer was an all-stock offer, but they were prepared to actually spin out the NBC business and combine it with Warner Brothers Discovery. Of course, that did not go through, but I think really the big question now for investors is, will they spin out NBC? It is a pretty good asset. So what they did, Paul and Scarlett, last year was they also kind of separated out the cable network business into a separate company called Versant. So all that you have right now with NBC, the NBC Media unit, is all growth assets. I mean, you look at the theme park units doing very well. Studio is doing well. Again, Peacock, they're kind of trying to get it back on track. So you have a collection of pretty good assets, which really begs the question, what do they do? The street, I think, definitely wants them to to separate out NBC so that it could be trading at much better multiples. And then the question becomes, okay, you're going to have a pure play cable operator in Comcast. Do they ultimately combine with, their peer, maybe Charter or maybe somebody else? But all those questions kind of left unanswered today. Brian Roberts and the team really talked down M&A in today's earnings call.
Interesting that they would talk it down when, as Paul mentioned, that's kind of in the company's DNA to be looking for deals. And I think about Cabletown. Do you remember?
Yes, right.
Yes, Cabletown with a K.
Yep.
They ended up being the owners of NBC in the fictional version of
and
what
one of
happens here.
the good businesses they have is the theme park business. Geetha, real quick, why do you think Warner Brothers Discovery, whose shareholders approved the deal, is trading at a 12% discount to the deal price? Is there real regulatory risk there?
I don't think so, Paul. It looks like everything is going to go on track. Obviously, the shareholders approved it. They seem to have a pretty straightforward regulatory path, at least here in the United States. I think maybe the one wild card is, the EU, where we really don't know and where there could be some concentration risk.
All right, Geetha, thanks for that. Geetha Ranganathan, she covers all the media stuff for Bloomberg Intelligence and a lot of moving pieces in that space. And again, one of the big ones is, again, $110 billion deal, enterprise value deal for Warner Brothers Discovery to be acquired by Paramount Skydance. Think the Ellison family of Oracle fame, and that's kind of where a lot of the equity's coming from. And then they're going to the markets in a big way, the debt capital markets for bridge financing, long-term bank financing, and going into the bond market. So this is going to be a pro forma company that's kind of a debt to EBITDA leverage of about 7 times. And just to put that in comparison, the street would like these companies to have leverage of 3 to 4 times.
Warner Brothers Discovery itself had a lot of debt as well.
Yeah, and they did a great job paying it down, and that put them in a position to be sold. So again, David Zaslav, you can complain about how much money he's making in it. It's ridiculous, but the dude delivered. He delivered the company, and he sold it for a pretty darn good valuation. So
and gets a good payday himself.
He does, and so that's how it works in that part of the world. S&P up 7 points. A little more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a decidedly mixed market. S&P 500 index holding on to a gain right now, higher by 6 points. Got to keep in mind the worst level of the morning. The S&P had been down 22, lower by 0.3%. We are seeing a reversal, up now by 0.1%. Any advance will be a record on the S&P today. 7144, by the way, where that index stands. The Dow lower, down 0.1%. NASDAQ, we'll call that flat on the day right now, with a VIX trading below 19. The 10-year 4.28%, with the 2-year 3.79%. Gold is flat on the day as well, 47.39 the ounce. West Texas Intermediate crude above 93 at 93.49 a barrel, up 0.6%. We're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. The U.S. Justice Department has reclassified state-regulated marijuana as a less dangerous drug. It is a major shift that could dramatically increase legal cannabis sales in coming years. Yesterday, we saw those stocks all rally, as well as the weed ETFs. Today, though, they are pulling back on this news. Case in point, Canopy Growth down 6.9%. We got Tilray down 12%. Curaleaf tumbling now by 13.8%. Among some of the ETFs, the Amplify Alternative Harvest ETF, ticker MJ, down 6.3%. Also trading lower, the Advisor Shares Pure U.S. Cannabis ETF, down now by just about 8.2%. So again, recapping here, NASDAQ just turning higher, up by 2 points. S&P little changed, up 0.1%. I'm Charlie Pellet, Scarlett and Paul. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well, so check us out there. The Philadelphia Stock Exchange Semiconductor Index is a day like 18 of a gain or something, like 17 or 18, something crazy.
What a streak.
Yeah, it's like the biggest like forever. And it's up, it's just crazy what's happening there. One of the names in that index is Intel. And it's going to report earnings after the close today. Intel, stock's up 83% this year. It's up 230% on a trailing 12-month basis. So it's certainly reaping or getting the benefits of the AI story. Kunjan Sobhani, he's a senior analyst who covers all the semiconductors for Bloomberg Intelligence. He's a very popular guy because his semis are just ripping. He's out there in the San Francisco office right there in Silicon Valley. Kunjan, talk to us about Intel. What's the story? What are you guys going to be looking for after the close tonight?
Yeah, so, after a long time, there's few good things going their way right now. First is we're seeing a resurgence of demand when it comes to server CPUs in the data center. This is about 35% of their business, but investors care a lot about this because this is where the biggest TAM and the growth in the future will be coming from. And the resurgence is coming from adoption of agentic AI, adoption of inference, which is where customers have realized that adding server CPUs in the AI head nodes along with the GPUs gives you a really offloading advantage and an ROI. So in short, a lot of unit growth demand is coming from here. Why it's beneficial to Intel more specifically is they have been supply capped because remember, they make most of their own chips. So their factories are not at that capacity since the new CEO came in and reduced the CapEx spending, which they were supposed to do. So it's really helping them. Second, our channel checks have suggested that they have been increasing prices. So we expect ASP increase in this quarter of about 10 to 15%, which is, again, not something they have observed in the past. So really good things there in that segment. On the opposite side, there will be some headwinds from the memory constraints in their PC segments. Again, remember, this is their biggest segment. So there's going to be offsetting headwinds and tailwinds here. But more importantly, the North Star, which is their foundry business. Last night we saw an announcement from Elon Musk that they will be considering 14A as one of their top external customers. So that should be good for sentiment moving. We don't think this will really impact estimates, though, in the near term. But overall, still good things starting to happen for them.
Yet you look at the price performance so far this year, Intel up 83% total return. That is double what the double the Philadelphia Semiconductor Index. So Intel stock is also pretty expensive at this point, certainly compared to its peers, isn't it?
Definitely, when we look at from at least P perspective, does scream out that they are trading at a significant valuation.
So where do we go from here, Kujan? What are the smart, sharp guys like you going to be listening for on the call today? What's the next tell for the sector?
I mean, look, finally, structural end demand is on their way now. The tailwinds are on their back. So we just want to see good, clean execution. This is not going to be a quick turnaround. We know that the foundry business that everyone is waiting for, this will take time, at least 2 years, right? But every quarter, if they come out and deliver, look, from going forward here, we want to see a good growth outlook. We hope there's not a downgrade because of the PC market impact from memory headwinds, but we want to see increasing gross margin as we are expecting that. That will really help their utilization in their fabs. So we just want to see clean execution quarter by quarter, keep building on that external fab strategy, keep lining up more customers like we saw last night, and just keep executing until we start seeing estimates show finally the foundry revenues.
Let me ask a dumb question, and very quickly here, Kunjan. The U.S. government took a stake in Intel last year. Does that show up in its results anywhere? How did that help the company?
Well, it really didn't help the fundamentals right now, but it very well helped the sentiment, right? Since the U.S. government took the stake, if you look at what the stock has done, and despite estimates not really changing at that time, the stock had a significant run up just because of that news. That really helps with the stability. You know, the customers that want to sign up and want to believe in Intel's roadmap now has a savior behind them, that it's not going to fail, and we can bet that Intel will be able to supply us wafers in the future.
Very good. Appreciate that. Kunjan, thanks so much. We appreciate getting your time. Kunjan Sabani, Senior Analyst on the Semiconductor Space. Again, Intel reporting numbers after the close, and the stocks, another day of huge gains here. So how about that? The people cannot get enough of these chip stocks. Let's go back, switch gears a little bit, focus on emerging markets, another area of the market that really, I think, just is more in vogue now than it has been for some time. Derek Irwin joins us, Senior Portfolio Manager and Co-Head of the Intrinsic Emerging Markets Equity Team, joining us here in studio. Derek, what is the EM call these days? How are you guys approaching that part of the world?
So look, EM really has two ways to approach emerging markets right now. Obviously, we are very geared to the global tech trade, the same thing that Intel is, right? A huge piece of the performance of the markets have been down to Samsung, SK Hynix, TSMC. And so we're watching that as carefully as anyone. The good news is that in general, those AI and chip makers are cheaper, perhaps, than some of their developed market players. And of course, the fundamentals are excellent. But similar to what we were just talking about with Intel, there is some crowded trade there. So the other areas we're looking at that I think have been more under the radar screen has been, prior to the Iranian crisis, a really positive trend of strong economic growth coupled with declining inflation and the beginnings, interrupted, of a rate cut cycle. And that's very, very important for emerging markets. Obviously, that's on hold. And the question is going to have to be, how long is it on hold for?
And for some countries, probably on hold for longer than others, especially depending on how dependent on oil you are on those oil imports. You keep hearing about how places like Vietnam are fundamentally having to change the way they operate. They can no longer send every kid to school Monday through Friday because they need to conserve energy. How are you thinking through the longer term implications of this, even in a best case scenario where the Strait of Hormuz is open relatively soon?
This is the $1,000 question, right? I think that first, I would say that particularly in Asia, the Asian countries have been more resilient to this shock than we would have thought. If you looked at just sort of very simple calculations about days of LNG available or fertilizer or almost any petroleum-based product, in March, it was dire. And actions like that in Vietnam, we've seen similar things elsewhere, have really stretched that out. I think governments have been very creative about how they're accessing petroleum products. So it has been better than we thought, but I think that we do need to see progress on opening those straits, and we need to see it reasonably soon. My concern is, as I mentioned, that some of this growth and some of these positive inflation trends are on hold. But if this continues, those become more structural in nature, and then we start to see some real challenges.
Simple question on China. Is it investable today?
I think China is very investable today. And it's the first time we've been able to say that for a very long time. Clearly the Chinese economy has been soft for several years by their standards. Consumption has been weak. And I think we're beginning to see the early signs of that turning around. So we're very selective in China right now. And again, we kind of look at it as a bit of a barbell. Some of the great artificial intelligence players that I think most of us would know, Alibaba, Tencent, et cetera, on one end, and then some of those very bombed out consumer names on the other side that we think are very strong, have only gained market share over the last few years, and will come out of this slump in really good shape. So we think there's multiple ways to find opportunities to invest in China, but you do need to be selective.
Talk a little bit about the big internet companies and how they're positioned for the AI revolution there. We've read about, we've learned how Tencent and Alibaba are in talks to join DeepSeek's first funding round. And part of it is because their own AI businesses are under threat from DeepSeek as well. So they need to find a way to, I guess, hedge against the growth of DeepSeek and other open source models.
Well, remember that companies like Tencent and Alibaba have for many years been the kind of de facto venture capital industry in China. So this is nothing new for them, but I think you're right. They're thinking very carefully about how to integrate AI into their business models. What I find really exciting is the AI sort of ecosystem in China has grown up, one, entirely separate from that of the West. In general, it's been done with less capital expenditure than we're seeing in the West, and with, in a typical Chinese fashion, a real focus on how do we use this to increase returns now. So if you look at Tencent, they just reported results, and it's pretty clear that they're integrating their AI models into, say, their advertising and monetizing that advertising. I think it was up 17% last quarter, which was a very good number. So I think the AI architecture and the AI opportunity in China is a really interesting one. Of course, it's competitive. That's the nature of China.
Real quick, 30 seconds. One of the names on your list is a name I know. I saw them in the roadshow way back in the day, Mercado Libre.
Oh, sure.
What is Mercado Libre, and why do you guys like it?
Sure. In many ways, it's kind of the Amazon and PayPal of Latin America, right? It is by far the dominant e-commerce retailer, and most importantly, a dominant payments player. I was just in Argentina last week, and I don't think you could buy anything without using their payment system. It really is entrenched into the sort of fiber of Latin America, which is really important as Chinese players and as AI becomes more ubiquitous. We think that they have a great moat, and most importantly, their execution over the years has been excellent. There's been some concern recently on softer margins as they've invested in expanding that moat with regard to free shipping, with regard to services around their payment platform. But we look past that, and we think this is just an incredible opportunity to own a really well-run, dominant player in Latin America.
I saw that rubber chicken lunch in the city, August 2007, right before the world.
Oh, boy.
Wow.
What we did not know sitting in that room was just extraordinary. Derek Irwin, Senior Portfolio Manager, Co-Head of Emerging Markets at a little shop called All Springs. We know those folks there well. S&P up 8, the Dow minus 30. The NASDAQ minus 5. WTI crude oil up about $1 here, just under $94.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Just getting word from Microsoft. It is now offering voluntary retirement to thousands of its employees in the U.S. Microsoft says about 7% of the U.S. workforce will be eligible for the buyouts. According to a source, Microsoft has never previously done buyouts of this scale. Microsoft shares today down 2.7%. Right now, we got the S&P 500 index a little changed on the day. It is higher after morning losses, up now by about 3 points, up under 0.1%. The Dow does remain lower by 42 points. Dow Industrials down 0.1%, while NASDAQ lower by 29. For NASDAQ, a drop now of 0.1%. The VIX right at 19 with a 10-year, 4.28%. The SOX, by the way, up again, up 2.9%. We've got spot gold at $47.32 the ounce, down 0.2%. And West Texas Intermediate crude up 1.2%, $94.04 a barrel on WTI. Tesla anticipates billions of dollars in additional spending this year to support Elon Musk's ambitions to transform the EV pioneer into an AI and robotics company. Kevin Tynan is Director of Research of Presidio Group. He says Tesla is a company in transition.
The focus isn't on the automotive business for that company, and competitors are actually lapping them in terms of that technology. So, you understand why the narrative is that this is not an automotive company, or in a very short while it will not be an automotive company anymore. And you see where they're moving to, and the results on the automotive side really kind of illustrate that move is necessary.
Kevin Tynan of Presidio Group. So after earnings, Tesla down now by 2.5%. Recapping stocks pushing higher. S&P right now up 5, up under 0.1%. Scarlett and Paul, that is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. I was just looking. Microsoft has 228,000 employees as of June 30th, 2025.
That's a lot of bodies in 7%.
That's a lot of bodies,
Okay.
potentially, yeah. I mean, you compare that to a company like Walmart, which has 2.1 million employees.
Yes, yeah,
but
good point. Yep.
Different price point, different pay levels as well. All right, let's talk about markets, because you look at the S&P 500, not doing a lot. Of course, it is hovering near record highs. Let's not forget that. The Russell 2000 doing a little bit better, up 0.2%. Yields are pretty much stuck in the range, and WTI and Brent marginally higher, and by that I mean they're up by 1%. Carol Schleif is the Chief Market Strategist at BMO Wealth Management. She joins us now from Minneapolis. And Carol, it very much feels like investors have moved on from the Middle East conflict and aren't looking to really price in anything because they don't know what's going to happen.
Well, I think there's that piece of it, but markets have a tendency, they're always trying to skate to where the puck is going, not where it is or where it's been. And so they're always looking for what comes next. And it's really similar. They're looking for some sort of stabilization, not a solution. And then they're ready to move on and deal with the next set of issues. And I mean, the parallels you have are even, you go back to the COVID pandemic, and when it first started, markets reset 30% in a matter of weeks and then V-bottomed and didn't look back for years. Or you go back a year ago and look at things, they wanted some sort of stabilization on tariffs. We still haven't solved tariffs. There's still all kinds of other things going on, but markets have moved way beyond worrying about that issue. And so I think the beauty of both last year and this year is that these events happened right in time for us to hear what managements are doing about it in first quarter earnings. And actually, when you look at the earnings, there's a lot of companies that are coming through above expectations, and they're producing.
Carol, I know you're bullish on industrials. What's the call there for you guys?
I think a big piece of that is that you've got a lot of secular themes going on that you're not going to turn back quickly, because we've underinvested, not just in the US, but as we're all learning, we've underinvested in infrastructure, we've underinvested in supply chains, we've underinvested in a lot of things, in durability, if you will, of the system for many decades. And so the need to turn some of that around, and there's fewer providers. And actually, if you look sheerly at a way to invest in it, industrials used to be a lot bigger percentage of the S&P, and they're a very small percentage anymore. And so if we all want to play that theme, it it's Econ 101.
Yeah, I'm just looking at the weighting of industrials, and you're right. It's only 8.9% of the S&P, smaller than tech, financials, communication services, and consumer discretionary. You also see the industry as ripe for M&A and investment. How big a role is the U.S.? I'm sorry?
No, I was just going to say, I think a piece of it to look at too is if you go back and you look at a lot of the shift, the geopolitical pivot and the political pivot, or the geoeconomic pivot instigated by the Trump administration a year or so ago was aimed at trying to solidify and reindustrialize, if you will, key parts of the United States. And if you were another country, the concept of tariffs or tariffs on specific, because the sectoral tariffs have not gone away, so it's expensive to import steel and aluminum. If you're one of those big global producers of that, you put more production capacity in the United States. So you've got not only domestic producers, but international producers looking to partner up with what's going on here.
So you mentioned that you like industrials in part because it's ripe for M&A and investment. How big a role is the U.S. government going to play in that? Because the Trump administration has been very mindful about wanting to direct a national industrial policy.
Yeah, I think it's unknown at this point, but they're clearly very interested, particularly in certain industries. And actually, if you look at it, if we roll back, the unfortunate thing about the recent space mission is it coincided with a lot of activities going on in the war, but it's fun. I have 6 grandkids, and hearing them get excited again about science and space and lots of things like that. So clearly the administration is behind that. They're also behind and want to play a role, if you will, in dabbling in all kinds of different industrial policy aspects. And the interesting thing is too, once you start deal making in one particular segment, everybody, it's like the fish swarming, everyone looks to see who else in that industry might be a candidate or where else they might find. And who knows, maybe we've got some buried in private equity portfolios that may or may not look to come public.
Technology, what's the AI call for you right now, Carol? Because it seems to evolve out there in the marketplace. Now people are trying to, I guess, differentiate between, I guess, net winners, net losers. How do you think about it?
Yeah, I think there's that piece of net winners, net losers. I was just thinking this morning when I saw people parse through the Tesla numbers and other things that we've really come full circle on a lot of different industries in terms of it used to be spending on a topic was a good thing, then spending wasn't a good thing, and now we're trying to differentiate on that. So we're really trying to figure out which management teams are leaning into the use of new technologies. And it's not just AI, it's robotics, it's autonomous vehicles, it's these new plants that we're putting up. You know, the unique thing is we're not going to have thousands of workers in those plants. We're going to have some highly educated technical workers running the machines that are making the parts or doing the distribution, or even in an Amazon warehouse, picking and packing and getting things out the door. And so, you know, to the extent your previous story was mentioning Microsoft and the first-time buyout of senior people, that's always been something interesting because people have been reluctant to let that technology or that institutional knowledge go. Maybe now there's a suspicion that there's enough embedded in AI knowledge that can replace some of that senior expertise, if you will, and it's okay to let them go retire.
All right, Carol, thank you so much. We'll leave it there. Carol Schleif is Chief Investment Officer with BMO Family Office, and she joins us right now from Minneapolis. Thank you so much. We're not seeing a whole lot of movement in markets, but that's not to say there isn't stuff happening. Plenty of headlines when it comes to the situation in the Middle East. It's just that there's no indication that there's movement on any kind of ceasefire talks.
Yeah, I'm just looking at some of the top stories on the Bloomberg terminal. U.S. boards supertanker carrying oil from Iran in the Indian Ocean. So the Navy continues to be active. That continues to be, I guess, an active, fluid part of the world. But
the bottom line is that the Strait of Hormuz is still not open.
Yep.
And oil is not flowing through that region. And, you know, we're seeing it reflected in the pricing, right? Brent is at $103 a barrel. WTI is at $95 a barrel.
And it's, you know, as we were saying, this might kind of be the new normal, as Carol Schleif was kind of, at least for the near to intermediate term, and the market can move forward with that as a background. So we saw it with the tariffs, and maybe now we're seeing it with the geopolitics. We'll have more coming up. This is good.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So check us out there. Let's talk about the railroad stocks, one of my favorite sectors. I used to cover this group back in the 80s. I have all my earnings models for the railroad and trucking companies, but they're on floppy disk, so I don't think I can really access them anymore. But I'm sure they're still killer. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. He's got some pretty good earnings models, too, here. So Union Pacific, the stock's up about 7% here today, up 15% year to date. How are their earnings, Lee?
Yeah, their earnings were pretty good. They beat this morning on the first quarter, and it really was driven on productivity gains and pricing. The company was able to show that it's able to operate a better network, a more efficient network, despite the fact that volumes were slightly softer than most expected. They were down about 1%. The company really does appear focused that it can continue to get that productivity. Productivity could be more difficult if volumes do increase. Their outlook on the volumes, I would say, was cautiously optimistic. There were some pluses and minuses. They were positive on their bulk commodities like coal and grain, and also some domestic intermodal, while a little negative on their outlook as it relates to housing, like forest products that go into housing, automotives, or international intermodal. So I think the outlook was a mixed bag, but the company is definitely executing on its plan, and it used the earnings call as an opportunity to kind of plug the merits of its proposed merger with Norfolk Southern.
And folks, just for rail geeks like Lee and I, this is a seismic transaction in the railroad business. It would create the first truly coast-to-coast, east-west rail system in the U.S. Lee, but of course the big issue is, will the regulators allow it? What's the feeling here?
You know, the feeling is really mixed amongst participants. Obviously, if you're Union Pacific or Northern Southern, you really think the deal's going to get done. If you're the other railroads or maybe some trucking companies, you might be, hoping that it doesn't. It is a high regulatory hurdle that it has to meet. It has to meet that it enhances competition and it's in the public interest. A long time ago, I think it was 2001, they changed the rules for mergers at the STB, and they wanted to kind of stop the consolidation that was happening in the marketplace, and it was kind of designed to stop a deal like this. The reality is that if it does happen, it will create a truly transcontinental network. That will mean that rail cars will be touchless, and if they're touchless, you would assume that hopefully they can get better service, and that could benefit from the customers that are on it. They are, full press lobbying to try to get the deal done. They recently announced a new locomotive, that commemorates, the 250 year anniversary of the U.S. and it also has Donald Trump's name on the side. So it looks like they're looking everywhere they can to get some help from the administration.
That's a good move. How about if I'm CSX here? I noticed CSX stock is at an all-time high. If I'm CSX, do I feel the need to maybe reach out to, Union Pacific or maybe the other Western Railroad there and figure out that we need to do a deal as well?
Yeah, so if the deal does happen, you would assume that, more mergers will come, whether that's a Burlington Northern merger with CSX. Burlington Northern is owned by Berkshire Hathaway, and so obviously Berkshire Hathaway has some deep pockets to pay for CSX if it wanted to. Also, it could make sense if CSX with one of the Canadian competitors, like a Canadian Pacific Kansas City, that could be an option as well. So if it does happen, and again, it's a high regulatory hurdle, and we probably won't find out until late next year, early 2028, whether the deal gets done. Yeah, it's going to take some time. They have to refile with the STB because their initial filing did not cut the mustard with the regulators, so they wanted them to refile, and that should happen probably in the next 30 to 60 days. And so it just takes time because this is a huge transaction that the STB has to mull over. But yeah, just to answer your question, yes, it could. The announcement of the deal, because the two companies, Union Pacific, Norfolk Southern, really can't do anything together until they get approval. So it's been an opportunity for other rails to work together and create new services. And you've seen some share shift away from Norfolk Southern to CSX on the intermodal side, which has been pretty interesting to watch.
Lee, what are your transport? You cover everything from the trucks, the rails, the air freight, all that kind of stuff, the big ocean shipping companies. What's been the collective, I don't know, response to this war in Iran? Is it localized just to that part of the world, or is it having wider ripple effects?
Yeah, obviously it's impacting, the shipping industry. It's keeping container rates artificially high just because it's tying up capacity, and also assuming that there's a lasting peace, the Suez Canal can open up, and that would make shipping rates come down considerably. The biggest thing is it's pushing energy prices higher, diesel prices higher. That's a huge input for trucking, rails. They do have mechanics to offset that through fuel surcharges. Just to pivot a little bit on the truckload side, Knight Swift reported earnings last night.
Yep.
Their reportings, they pre-announced, and we knew it wasn't going to be a great quarter, which it wasn't, but their outlook really improved. So they expect rates to increase by high single digits to low double digits, and that's up from low to mid-single digits. So they're really seeing the rate recovery happening, and that's really being driven on the supply side, supply coming out of the market.
All right, good stuff as always. Lee Klaskow, one of the best on the street, senior transport, logistics, and shipping analyst, Bloomberg Intelligence. Lee also hosts a weekly podcast entitled Bloomberg Intelligence Talking Transports. And if you're, again, a geek like me that likes trains, planes, and automobiles, it is a great podcast, so give that a listen there. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up right now.
From ABC News, I'm Michelle Franzen. Tensions in the Middle East escalating again. President Trump issuing a new threat over Iran's blockade in the Strait of Hormuz.
President Trump, in a social media post Thursday morning, says he ordered the U.S. Navy to shoot and kill any boat that's laying mines in the Strait of Hormuz. It's not clear if Iran is currently engaged in mine-laying operations in the strait during the ceasefire. There are no U.S. Navy ships in the Strait of Hormuz, though there are 17 U.S. Navy ships east of the strait in the Gulf of Oman and the Arabian Sea. So far, all of the previous attacks on Iranian mine-laying ships have been from the air. Karen Travers, ABC News, the White House.
Warner Brothers Discovery shareholders approving the Paramount Skydance takeover bid today. It's a major hurdle in a move to finalize the multi-billion-dollar mega deal that will impact streaming shows and productions, including HBO Max, CNN, CBS, and Paramount Pictures. The Senate passed a budget blueprint to restore most of Homeland Security without Democrats, who have pushed for ICE reforms. That measure now heads to the House. Lawmakers are also looking to expand SNAP benefits to include purchases of hot rotisserie chicken.
Under current law, SNAP recipients can't use their government assistance to buy hot prepared meals. The thinking is ready-to-eat hot foods at the supermarket bake in added labor costs and generally tend to be more expensive than what can be prepared at home. But a measure has been introduced in the Senate to create a carve-out for hot rotisserie chicken. The bill has bipartisan support, and it's backed by the chicken industry lobby. Similar language was recently floated in the House, but it was plucked out in committee.
ABC's Stephen Portnoy. The number of Americans filing for first-time jobless benefits climbed last week by 6,000 filings compared to the prior week, higher than what analysts expected. In southeast Georgia, fire crews battling a wildfire that triggered evacuations and destroyed dozens of homes. Fire alerts stretch across nearly a dozen states due to dry conditions. You're listening to ABC News. Well, the massacre of 8 children in Louisiana Sunday ended with the suspect and father of the 7 victims dead. Criminal charges have still been filed in connection with the case.
One of the first questions for investigators looking into the mass shooting at a home in Shreveport was, where did Shamar Elkins get his gun?
Elkins had a 2019 conviction of illegal use of a weapon,
which prohibited him from owning one. Shreveport Police Captain Chris Bordelon says the gun belonged to a friend named Charles Ford.
Mr. Ford was a convicted felon
who's now charged with providing the .22 caliber assault-style handgun that Elkins used to murder 8 children. Jim Ryan, ABC News.
Hundreds of Afghans helped U.S. troops during the war in Afghanistan and expected to be welcomed in the U.S. A controversial relocation plan, though, could keep them from ever setting foot on U.S. soil.
The advocacy group Afghanivac says they've been briefed on a Trump administration plan to send more than 1,000 Afghan allies to the Democratic Republic of the Congo. The group includes interpreters and family members who helped U.S. forces during the war in Afghanistan. Advocates say they are now being asked to choose between resettling in Congo, a country in the midst of civil war and a major humanitarian crisis, or returning to Afghanistan, where they would likely be targeted by Taliban forces. Dave Packer, ABC News.
Spotify is 20 years old today. To mark the milestone, the company released its first ever list of the most streamed artists of all time. Taylor Swift topping that list. Michelle Franzen, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The Pentagon steps up enforcement in the Strait. Welcome to the Thursday edition of Balance of Power as the U.S. Navy now intercepts 2 Iranian super tankers trying to evade the blockade. With no new information on peace talks and the president issuing a shoot-to-kill order on Iranian boats laying mines. We're going to talk this out with Bloomberg's Adam Farrer, check the impact on the energy markets with Charlie Pellet. Ed Ludlow will join us later on Tesla earnings. We'll talk to Nathan Dean from Bloomberg Intelligence about why some investors feel burned by cannabis rescheduling. Do you see the way the White House went about this? We'll have details. And as the Senate takes the next step on reconciliation, we've got a great panel for you. Sarah Chamberlain from the Republican Main Street Partnership, joined by Jim Messina, the Democratic strategist, is all ahead this hour on Balance of Power. Let's start, as always, with the markets and our friend Charlie Pellet. He's at the helm at World Headquarters in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. Those cannabis stocks you referenced, all trading lower right now. You set me up for crude. Let's begin there with West Texas Intermediate, 94.61 a barrel. WTI up by 1.8%. We're seeing a surge in Brent, the global benchmark. Brent crude 103.76 now, up by 1.8%. Choppy trading session today. Equities completely back in the red right now. Little change. Perhaps the key takeaway on the S&P, 7,128 on the S&P 500 index, down 9, drop there of 0.1%. We do have the Dow lower by 95, down now by about 0.2%. NASDAQ down 101 for the NASDAQ Composite Index, a drop right now of 0.4%. All of this with the VIX just above 19. The 10-year, 4.29%. The 2-year, 3.80%. Gold is down $20 the ounce to 47.18, drop there of 0.4%. And again, crude bears repeating. WTI 94.67 a barrel, up by 1.8%. As for the mood of the market and the overall backdrop, Eric Cantor is vice chairman at Moelis. He was a House Majority Leader from 2011 to 2014. And on surveillance this morning, he told us, yes, Washington is giving a major lift to the U.S. economy.
Ultimately, you've got a very pro-business administration in Washington, so you've got a regulatory construct that is much more constructive than we've had in the past. So I think all that helps when you see these earnings, helps explain where we are.
Eric Cantor of Moelis interviewed on surveillance. I referenced the cannabis stocks trading lower across the board today after yesterday's surge. Canopy Growth Corp down now by 9.4%. We've got Tilray lower by 4.9%. Curaleaf is down almost 17%. And among the ETFs, MJ, that is the Amplify Alternative Harvest ETF. MJ right now trading lower by 8.9%. And MSOS, that is the Advisor Shares Pure U.S. Cannabis ETF, down now by just about 10.1%. So again, recapping here, the Dow, the S&P, NASDAQ, we're all trading lower. S&P down 0.1%. This is West Texas Intermediate Crude rallies 1.8%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. He starts us off every day, and he'll be back in just about 15 minutes with another reading on the markets. The great Charlie Pellet, the voice of Wall Street and the New York subway. Burned again, they feel. Pot investors coming down hard today. And Nathan Dean will join us a little bit later to talk about this clever avenue that the White House is taking to reschedule cannabis, and it's likely setting up a big lawsuit, and everybody feels like they had the rug pulled out from under them once again. Did you bring your child to work today? It's Take Your Children to Work Day. Someone just went by the studio with a child. They were waving. My 19-year-old is likely still asleep in my basement and probably doesn't know how to hear this program. But there are kids around everywhere. Cece, do we have kids up in the control room in New York? Any kids walking around? You do indeed. I'll watch what I say. They're teeming around here. You know, the U.S. Department of the Interior says that the theme of this, I didn't know this was an Interior Department issue. Doug Burgum declares the theme of 2026, Take Our Children to Work Day, the future is at work. Ooh. Sorry, kids. You'll need to pay the mortgage someday as well. Just watch out for the AI thing. So thanks for joining us on the Thursday edition of Balance of Power. You made it to Little Friday, and boy, the news in Iran is getting ever more complicated with the double blockade, as they call it, in place. And on the United States side, enforcement that is really changing the contours of this whole conversation. The U.S. military says it now has intercepted 2 Iranian oil super tankers. There are different size tankers to try to evade the blockade as they try to keep the shipping to a limit here. The very large crude carriers, Hedi and Hero 2, are now anchored at Chabahar, an Iranian port, Gulf of Oman, after being intercepted earlier this week. Central Command saying in a post on X, in addition to Hedi and Hero 2, another tanker, the Dorena, has been under the escort of a U.S. Navy destroyer in the Indian Ocean after previously attempting to violate its cordon. Look no further than Truth Social today. Actually, that video on YouTube is pretty cool too, Cece. Look at that. They drop them right down on the deck of that boat, and they go straight up to the bridge and take it over. Donald Trump, a little while ago, this is at 8:46 this morning, East Coast time, I have ordered the United States Navy to shoot and kill any boat, small boats though they may be, in parens, their naval ships are all 159 of them at the bottom of the sea, that is putting mines in the waters of the Strait of Hormuz. There is to be no hesitation, he says. Additionally, our mine sweepers are clearing the strait right now. I am hereby ordering that activity to continue, but at a tripled up level. Thank you for your attention to this matter. So he clearly wrote this one, right? We want to get into this. The impact, you heard Charlie already mention on oil prices is, well, it's somewhat real today. We're up about 1.5% to 2%, depending on New York or Brent, 95 and 104 respectively. And it's something that we've talked about a lot, of course, with Adam Ferrer, with Bloomberg Economics, the senior geoeconomics analyst. We drag him back into the studio again for the latest on this. I literally walked over to your desk and pulled you away from the analysis you were doing, and I thank you for it. You did have a child at work today?
I did.
Boy or girl?
Girl. She had a great time.
She came in the studio?
Enjoyed sitting right there in your seat.
Good job. Not the whole day, though, huh? You just swing by, say hi to Dad?
No, at the end of the day, the Bloomberg terminal is not as interesting to a 3-year-old as I would have expected.
A 3-year, oh, that's so cute. Well, that's very nice. I'm glad to see good things happen in this studio from time to time. This tripled up enforcement, it reminds me of his references to tippy-top shape, means what? We've already got a blockade. Were we letting too many boats through? What does that imply to you?
So I think what we're seeing is a responsiveness from President Trump right now to broader concerns about the safety of passage through the Strait of Hormuz for vessels that are not affiliated with Iran, and back to this question of mines and a broader discussion on how the United States will be able to actually demine the strait. And while we're sure that they're working on that, I'm not sure his order to triple that effort is really going to change the speed that they're moving, given the complexity of such a sensitive operation where you're literally trying to remove explosives, often now using remotely piloted craft. And so I think the president here is trying to show the United States is responsive to Iran's recent actions. Right in the last 48 hours, we've seen Iran use these fast boats potentially to put in mines, according to the president, but also to seize tankers and other vessels that are attempting to transit out of the strait, and supposedly taking control of several of those tankers. And there are videos that Iran has released of their own soldiers boarding the vessels, taking them over, just as you described, the U.S. doing as well. So, you said a double blockade. I see it very much as a dueling blockade, right, going back and forth against each other. And I think the big takeaway, though, in the last 24 hours does seem to be that the United States is serious about this, that while the direct cordon is in the Gulf of Oman and the Arabian Sea, they're willing to go after vessels much further afield, right, thousands of miles away, including the Bay of Bengal earlier this week. And so if breaking the blockade really is delivering goods, and that is something the U.S. is stopping right now.
Reporting by the Washington Post was startling yesterday. A 6-month timeline the Pentagon is giving Congress on reopening or clearing the strait once fighting stops. I know the president says we're minesweeping now, but the Post refers to not only the 20-plus mines that have been in and around the strait, some were floated remotely using GPS technology, which makes it difficult or impossible for U.S. forces to detect them when they are being deployed, as opposed to dropping them off the back of a boat and we can watch that happen. How complex is this going to be? Do we have the hardware to do it? I know we've talked about unmanned drones going underwater. Is that how we solve this?
So it is immensely complex and one of the more difficult operations that any Navy in the world can do. And there are specialized crews that train for this. The reality, though, is the United States has actually divested a little bit from this effort over the years. And many of our partners and allies, particularly in Europe and in Asia, have specialized in this. So the Japanese, for instance, and some of our European partners have even more mine-clearing vessels than we do. And so it speaks to the necessity of actually bringing in partners if we really want to speed this up eventually. And to some extent, I think we're seeing that there is some appetite for that, but only after there is some resolution to the negotiations with Iran, in a sense that there's not active conflict in the strait.
Interesting headline in the middle of all of this. We've got a U.S. naval blockade actively being enforced in the Strait of Hormuz. And the Secretary of the Navy was just fired. John Phelan shown the door after, I guess there was some disagreement with Pete Hegseth about the Golden Fleet, as they call it, about shipbuilding. When the civilian leadership is removed in the middle of something like this, as opposed to, for instance, the Southcom commander was removed during Venezuela, does that have an operational impact, or is that removed from what's happening in the Middle East?
So in general, it doesn't have an operational impact. They're not part of the chain of command, right? They're the civilian leadership really looking out at the future construct of the Navy. So he was playing a huge role in building out the future Navy and looking at shipbuilding in particular. And as you described, a lot of back and forth and growing consternation about some of the plans he had put forward potentially for the future frigates for the United States Navy. And so it does seem, at least from the reporting we're seeing, that he got crosswise with Secretary Hegseth and didn't have the cover from the White House to do that, and that Secretary Hegseth removed him. But I do see that as separate from the Iran situation, but it does speak to an overall sense of kind of flex and movement at the Pentagon that's probably unwelcome.
Interesting, yeah. So what do we make of the lack of timeline suddenly? The White House kind of backing away from 3 to 5 days. At one point, it was 2 to 3 days. Then it was 4 to 6 weeks. Now that the 2-week ceasefire has been extended, it's now indefinite. Does that tell us about a changing posture or a realization inside the administration of what we're facing?
I think it aligns with what we've been talking about here now since the start of the conflict, that resolving it will take a lot more time than people were giving it credit for up front, that there are structural differences in how Iran and the United States view an end state here. And that obviously includes the future state of uranium enrichment and Iran's ability to maintain its current enriched stockpile, but also this big and overarching question about the future of the strait. Iran has not backed off from its belief now and assertion that it will control or at least dictate terms in the strait moving forward, regardless of how the war ends. And obviously, from a U.S. perspective and a global perspective, that has real costs and is something that they're not interested in doing. And what we saw last Friday is there also seems to be some disagreement about who to speak with in Iran potentially and who to trust in these discussions and how reliable any interlocutor is as they're moving forward. And the president certainly seemed to think he had a deal in hand, but Iran disagreed with that assessment.
You can tell why he was a steady voice in a prior administration. Adam Ferrer, you're one of the smartest we have, and appreciate your insights as always. With us from Bloomberg Economics, our geoeconomics analyst here in Washington. I'm Joe Matthew. Thank you for joining us here on the Thursday edition. We're just getting started.
as we plant a flag there on Iran. Coming up, a cocktail of Tesla, Anthropic, and cannabis. Yes, indeed. Ed Ludlow and Nathan Dean are the only two who can help us get through this. And you want to stay here, dial us up on YouTube and stay right where you are on Bloomberg Radio.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. A flare-up in tensions over the Strait of Hormuz, sending oil higher and stocks lower. Right now, we do have West Texas Intermediate crude oil advancing by $1.55 a barrel, 94.51 right now. WTI up 1.6%. Brent crude 103.50. It is up by 1.6%. S&P 500 index down 8 to 71.29, drop there of 0.1%. Have been higher for much of the morning. Dow Industrials down 101 now, down 0.2. Nasdaq Composite down 0.4%. All of this with the VIX at 19 and the SOX, the Philadelphia Stock Exchange Semiconductor Stock Index, up now by 2.5%. Spot gold down $18 the ounce to 47.21, down by 0.4%. Crude again 94.40 a barrel, up now by just about 1.6%. Earnings news: Comcast reported first quarter financial results that did exceed analyst estimates with fewer losses among broadband customers. The Philadelphia-based company's brands include the Xfinity Internet and cable services, as well as the NBC broadcast network. And Warner Brothers Discovery shareholders have voted to approve a merger with Paramount Skydance. Netflix, meanwhile, plans to buy back another $25 billion in stock after a disappointing financial outlook sent shares of the streaming pioneer plunging. The buyback does not have an expiration date. Netflix right now down 0.6%. Again, recapping, S&P down by 0.1%. Joe Matthew, that is a Bloomberg Business Flash.
Okay, Charlie, we thank you so much. I'm looking at the front of the Trump Gold Card web, trumpcard.gov. We've talked about, the Trump Gold Card. You make $1 million donation to the United States and you get like this, well, it's a gold card. It acts as a visa. You can, well, it says here, unlock life in America. You can click to apply now. Remember, this came from an executive order last year. Executive Order 14351 in 2025, an expedited investment-based immigration program offering legal permanent residency, but you got to pay for it. Howard Lutnick held an event in the Oval Office September. The Trump Gold Card is here. This headline today is a riot. The Commerce Secretary is testifying on Capitol Hill today. The Trump Gold Card visa, this is the headline, on the terminal, granted to only one person so far? He did not reveal the identity of the applicant who had been approved, saying in committee applications for the visa from hundreds more foreigners are under review. One card has been approved. Applicants must go through an extraordinary vet, they say, and pay a $15,000 processing fee. We're watching shares of Tesla, as you might have heard Charlie mention a couple of times, pointing lower following the earnings report last evening. That was a big bang around here when it comes to coverage. Of course, a lot of traders are deeply concerned about not only what's happening at Tesla, but all of Elon Musk's companies. So when this earnings report comes around, it's a big deal. And the big headline last night had less to do with car sales, although that's where we started when Ed Ludlow was kind to join us on the late edition of Balance of Power. It quickly resolved into a story of CapEx, and the stock turned lower in after-hours trading, and it's still lower today as a result. $25 billion is the magic number, and our friend Ed Ludlow, with us from World Headquarters in New York, is with us now, the co-host of Bloomberg Tech. Ed, what happened to the old gotta spend money to make money? Doesn't Tesla have the cash?
Guy, it's so funny how quickly the story changed. It was within minutes of me being on set with you, right? And, you called it the magic number. I think for the audience, what they need to know is that even for the juggernaut that is Tesla, $25 billion is the monster number. They've never in one financial year spent anywhere near that. I think 2024 was 11.3 billion. And so, they're kind of getting the double-edged sword of Wall Street. Wall Street wants to see them actually achieve some of these big picture dreams around robotaxi, Optimus humanoid robot. And they actually outline that in the earnings report. They explain the steps they're taking logistically, operationally to bring those to life. But on the other hand, they don't want to see them, go into a precarious financial situation. And it's not just that $25 billion is big, right? It's that it means they'll go into negative free cash flow. In other words, they are going to burn through cash for the foreseeable future. So you got to decide how comfortable you are with that.
You look at the numbers, though, from Amazon. What were they, 200 billion for 26? The Alphabet, 170. I mean, it seems like when you look around at the neighborhood, Tesla's being conservative, no?
So I love that you've brought this up. Elon Musk, I'm paraphrasing, but the audience can go and look up the transcript of the earnings call should they wish. He basically made the point, like, look, everyone's doing it, right? You've seen CapEx from all sorts of people. Why can't we do it too? And that was his opening statement on the call. And I kind of sat there, was like, interesting to acknowledge the environment that we're in. But it went beyond that. He's basically saying, like, look, this is going to be a multi-year investment cycle where we've got to spend this money to put the pieces in place for a future where this company isn't sort of core business delivering EVs to consumers. It is operating a proprietary robotaxi fleet in the context of a ride-hailing service, and it's building lots of humanoid robots.
I have to ask you about Anthropic, which has become a super big story here in Washington. As you know, the Treasury Secretary and Fed Chief were sitting down with banks to talk about
how they might best use this kind of technology or give them an opportunity to test it out. And now we've learned this week that the Mythos model has been accessed by unauthorized users. It was some time ago, it was weeks ago, we talked to you about the problems at the Pentagon with Anthropic and the fact that it had been deemed a supply chain risk. Then we know that Pentagon, or the Anthropic CEO, was at the White House to meet with Susie Wiles. The president indicated in an interview they might be close to a deal, and now this. Does this make it more difficult to secure a deal with the U.S. government?
Joe, you summed up what is a flood of 7-day headlines really succinctly. I got to get you on my show, get with some of my writers, because that was really good. You know, you should think about all of that stuff as kind of mutually exclusive. So the Pentagon designated Anthropic a supply chain risk. They will go to tribunal to challenge that, right? That official status. And in the meantime, what we are waiting on is some kind of broader agreement between the federal government and a number of U.S. government agencies to have access to Mythos. Mythos is a general purpose AI model that is in limited release. Only a small number of financial institutions, banks, and other technology companies are using it. It is like every other AI model capable of doing very many things. But what the leaders that you've just outlined, the Fed and the Treasury, are encouraging those companies to do is cybersecurity de-risking. In other words, let the model go through your code, let it find vulnerabilities, and let it help you patch them. And that is what the broader U.S. government wants to do with it. And that is what we're waiting on. We don't have this kind of universal deal between the U.S. government and Anthropic. So we wait for that, and we wait for the outcome of litigation, Anthropic challenging the supply risk designation.
You distilled that beautifully, and I wonder, in our remaining 30 seconds here, if we're going to remember either of these stories, and of course you will, but the general public, when it comes to Anthropic, or today Tesla, by the time Anthropic goes public and SpaceX goes public, this will seem like 100 years ago, right?
Right. You know, it's a story about technology. Both of those companies are good at what they do. To recap, SpaceX will go public in June, probably, and we believe that Anthropic has the pieces in place to file to go public by the end of this year. That's where we're at.
Man, what a time to be on your beat. It's just absolutely incredible every day what we're talking about. Ed, thank you. Ed Ludlow, of course, you find him, as always, on Bloomberg Tech every day here on Bloomberg. I'm Joe Matthew in Washington as we turn to the cannabis story. There's a lot in the air today, right? I told you our cocktail this hour involved cannabis because the President of the United States had a promise that was made on the campaign trail, reiterated in the White House, to reschedule marijuana. And he mentioned it last week, Friday, or Saturday actually, when he held an event in the Oval Office, signed an executive order to start research on psychedelic substances. And he mentioned the cannabis. He said, they're slow walking me on rescheduling. I don't know who he was pointing at off camera, but somebody decided to act, and it turned out to be the acting attorney general. Forget the DEA, forget the FDA. The attorney general has single-handedly rescheduled marijuana, but kind of, at least only to a point. Nathan Dean joins us. He's the expert on this, our senior government analyst at Bloomberg Intelligence. Pot stocks are lower. They've been burned again. This is a pretty clever approach here. How are we skinning the cat without going to the appropriate agencies?
Yeah, so what happened here is the acting attorney general signed a final order. It's not a final rule, it's a final order. Now, under a 1961 United Nations treaty, and then subsequently under the Controlled Substances Act, the acting attorney general is saying, due to our treaty obligations, we are moving marijuana for FDA-approved and state-licensed marijuana, not recreational, but we're moving it from Schedule 1 to Schedule 3. Now, what it means for these tax companies is they get to drop what's known as 280E tax relief, so their tax rate comes down much lower. And we think over the long term, it's going to spur M&A activity and probably boost some additional usage. But the thing is that this order would most likely be challenged in court because they're referring to a United Nations 1961 treaty. So what they also did in the press release is they said, we're going to have an administrative hearing on June 29th to continue this process and to make it more legally substantial. I'm trying to remember the exact words, but it was essentially to codify what they did because there has to be a notice and comment period. And there was no way that they were going to be able to get that done before the midterms. So this final order, don't get me wrong, it is going to be reclassified. So for anybody out there, just remember, they have plenty of time before the end of the Trump administration. So it will be reclassified, and it is as of today. But this additional notice and comment period that's going to be coming up after June is a way to codify it and actually mitigate some of the legal risk that could come from this.
So under the order signed by Todd Blanche, marijuana products regulated by a state medical cannabis license move to Schedule 3, as will any marijuana products approved by the FDA. I don't know if there are any. But that leaves a whole lot of cannabis to not be rescheduled, doesn't it?
Yeah, well, it's recreational for adult use. And so this is where, you're getting a little bit, if you're looking at this from the industry perspective, you're getting a good, don't get me wrong, this is going to be substantial tax relief for these companies. But, we are no longer in a situation, we're not going to be in a situation where it's going to be legally on the federal level from recreational use. Most of, I think, what the status quo for the next 3 to 5 years is going to be is this idea of where certain states will decriminalize it, or like for us in the District of Columbia, it's decriminalized on district land, but if you walk into the National Mall, then all of a sudden you're entering federal land, it's a different story. And so, that murkiness is going to remain, and I still think that you're going to see from the investment point of view, these stocks are still going to be susceptible to the hot sauce, as we put it.
The hot sauce, indeed. I'm just scrolling to look at how we're doing here, because there are a couple of these that we want to watch and a couple that we don't, as you've taught us. MSOS is the ETF that is geared toward U.S. cannabis companies. It's down 11% right now. The MJ, which has a lot of different things, tobacco and Canadian companies, is down by about 9%. Clearly, it's bad news, I guess, for the rest. Curaleaf is down about 16% right now. So it's again, 2 steps forward, 1 step back.
Yeah,
for the industry and for investors.
Yeah, so let's think about what do they get. I mean, they've been chasing the car for a long time now, and so now that they've caught the car, what do they get? If you're a small mom and pop investor, you get this 280 tax relief. Your tax rate drops from about 40% down to around somewhere 8 to 12%. It depends on the state. If you're in a state like Washington, your tax rate is much higher. But there's been significant disruption in this industry. It's a difficult business, and eventually, you didn't really get all that much.
Are they popping people for smoking weed on the mall? Is that how that works?
I've
heard from the street to the. I didn't even know that.
I've heard anecdotal stories.
How about that? Be careful if you're going to Washington on vacation. I'm Joe Matthew in Washington. Nathan Dean, thank you, sir. We'll assemble our panel next, only here on.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. It's been a choppy trading session this Thursday. Right now we do have the NASDAQ 100 index back in the green, trading higher by under 0.1%. But the Dow, the S&P, NASDAQ, they're all lower. Little changed on the S&P right now. Down 5, down under 0.1%. Dow Industrials down 110, a decline there of 0.2%. While NASDAQ is down 70, a drop there of 0.3%. A flare-up in tensions over the Strait of Hormuz, sending oil higher. Stocks fluctuating on concern that a prolonged closure of the waterway could worsen energy disruptions. 10-year right now at 4.29% against the backdrop of a VIX at 19. Spot gold is down $11 the ounce to $47.28, down by about 0.2%. Crude, $94.23 a barrel. WTI up now by 1.4%. American Express plans to boost spending on marketing and technology and says its customers' spending on air travel has been slowing. American Express today down 3.9%. American, meanwhile, lowering its full-year earnings target, saying it may end 2026 with a loss as the carrier absorbs $4 billion in additional fuel costs from the war in Iran. Paul Sankey is a founder of Sankey Research.
What we're really looking at is how jet is doing. We hit a high of $300 a barrel for jet in Asia. We come back probably down towards 200 right now. And then, in Europe, you've seen probably a peak of 200 barrels a day, and you're back down and holding about, let's say, 170.
Paul Sankey, founder of Sankey Research. All of this as American Airlines is said to have been exploring a revenue-sharing deal with Alaska Air. Today, we are looking at American shares. They are up by 5.3%. Briefly, elsewhere in the aviation industry, Spirit Aviation Holdings confirms, yes, it is in very advanced discussions with the U.S. government on terms of a material financing package. Recapping, stocks lower, S&P down 5, drop there of 0.1%. And that, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, we thank you very much. Live from New York, he'll be back in about 20 minutes' time, top of the hour, 1 p.m. Eastern, with another check on the markets here as we welcome our global television audience to the conversation. As we're talking affordability and ahead of our panel here, we've got a great one for you today. Sarah Chamberlain is with us in Washington, and Jim Messina is joining us as well from the left and the right. The issue of affordability, we talk so much about $4 a gallon gas. Look no further than the Hot Rotisserie Chicken Act. Did you hear this in the newscast earlier in the broadcast? It turns out with SNAP benefits, you can't buy prepared foods, and maybe you knew this at the lunch hour. And this is bipartisan. This is the stuff that we're talking about here. Senators Jim Justice, John Fetterman, Shelley Moore Capito, Michael Bennet, typically not agreeing on a lot of things, up with legislation that would allow people with SNAP benefits to purchase rotisserie chicken. Currently, you can only buy a cooled-off chicken. This is real. John Fetterman talking about this. America's best and delicious affordability play, he says, is Costco's $4.99 rotisserie chicken. It's one of my family's favorites, and I'm proud to join this bill with Senator Justice for all to try. Companion legislation in the House being led by Congressman Rick Crawford, Republican from Arkansas. My friend Sarah Chamberlain talks frequently about what we can actually get done here in Washington. Tell me this is going to pass.
It's going to pass.
You knew about this, right?
I did,
The
and it's the most
Chicken
ridiculous thing. I know. But yes, it will pass.
There is only one Sarah Chamberlain, Republican Main Street Partnership President and CEO. Great to see you. Welcome back. Jim Messina is with us, too, campaign manager, of course, for President Obama's 2012 re-election campaign. Previously, White House Deputy Chief of Staff. He runs his own consulting shop now, Democratic strategist. Great to see you, Jim. Little rotisserie chicken might bring these two sides together, huh?
You gotta love some chicken, Joe. Let's eat some chicken together, Sarah. I love it.
I guess so.
We will.
Well, look, they might be hungry after a late night. So 3:30 a.m., while you were sleeping, the Senate actually got to a vote, 50 to 48, to greenlight the budget blueprint that's going to become the reconciliation plan that we've talked about so much. 17 amendments over the course of 6 hours. Were you awake for this whole thing?
I
or
was
you
not.
just let them go and let me know what happened in the
Brief
morning?
me in the morning.
Great. So at 4 a.m., this is the part where I started thinking about you. Senate Majority Leader John Thune clearly got to be feeling good about passing something here. tells reporters Speaker Johnson has not guaranteed that the House can adopt this bill. What happens next
Correct.
door?
So now I still always say Speaker Johnson has the hardest job in Washington.
Yep.
His Republicans, very skinny margins, have very different thoughts on this. Some want the skinny one, which is pretty much what is coming out of the Senate.
And ICE.
Exactly. And then others want to add a Christmas tree of their priorities into it. So he has a tough job. The Main Street members want to do the skinny one. They want to get it funded and move on from this. I mean, obviously the secretary came out of Republican Main Street Partnership, so they're very loyal to him. Like, let's get this done.
Okay.
So we'll see. It's going to be a fight on the floor, unfortunately.
So it's unlikely that you just bring this to the floor and see what happens. He's got a lot of negotiating to do.
He's going to have to negotiate.
Beginning with the Freedom Caucus?
It's always the Freedom Caucus, yeah.
What do they want to attach to this, or is it about simply not fully funding DHS all in one swoop?
It's a combination of both.
Yeah.
Some don't want to fully fund it. 3 years, which would be past President Trump's time in the White House. And then others want things added to it. I mean, the Freedom Caucus, it's very difficult to negotiate with them. I mean, as I said, the Speaker's got a very tough job.
We've seen this movie before.
We have.
Jim
Never
Messina,
ends well.
How do you feel, Jim, about the stakes surrounding this whole debate? Democrats refused to go along with Republicans in a series of funding bills because they wanted reforms inside DHS, and specifically when it comes to ICE. We've not seen demasking. We've not seen a change when it comes to warrants. We do have body cameras and identification on uniforms. Is that enough for what Democrats were looking for?
I think it can be. I mean, to Sarah's point, this is going to be a very close negotiation. I think Democrats are looking at this saying, okay, in one beautiful bill, we gave ICE another $100 and some billion. Now this bill wants to give them even more money. We're not going to go along with that unless we get some reform. This is a place where voters agree with the Democrats and are like, hey, let's get some reform for all this money we're spending. So they feel kind of buffeted by the polls. They feel pretty secure in watching Donald Trump's numbers fall apart. So, there's real pressure inside their own caucus to actually get something done at this moment of leverage. The Republicans run all three chambers or all three branches here, but it is very clear that they may need some Democratic votes, especially in the Senate, to get a final bill done. And the Democrats are going to ask for a price here, Joe.
Yeah. Well, when you see Republican senators, and I realize we're talking about Susan Collins, Dan Sullivan, Josh Hawley's on here, though, as well. Ashley Moody, Lisa Murkowski, not a big shocker, voting with Democrats on amendments. Chuck Schumer saw this as a major opening. He says they're running for their lives. They're scared of what's happening in the midterm election cycle. Jim, is that a signal to you?
Not so fast, Chuck. What is a signal to me is the members who are up for election voted with the Democrats because they kind of had to. This vote-a-rama that you were talking about is really a show political vote. The Democrats making them vote on every kind of, want ad thing that consultants like me put up there and say, let's make them vote on all these things. The Republicans who are up, especially Sullivan and Collins, kind of had to vote with the Democrats on this. Hawley's kind of always been with the Democrats on a couple of these things, especially going after insurance companies and pharmaceutical companies. And so those are pretty predictable places for them to go. I didn't see big numbers of Republicans join the Democrats as we all hold hands and run into the river. But maybe Sarah can tell me that it's going to be okay here.
Wow, amazing. We are, I guess, getting closer to something. How long will it take Speaker Johnson, or how much time does Speaker Johnson need to ask for when he talks to the president about getting this done in a reconciliation bill on his desk by June 1?
So the Speaker has said he'd like to do it next week.
Next week.
I don't see that happening. I think early May will be better.
Okay.
Which isn't that far away. It's
Plenty
really
of
just
time,
a couple
June
weeks.
June 1's the deadline, then that happens. So maybe there's another extension while this is being worked out?
Could be. I mean, they're really in negotiations to figure out how many votes and do they have any Democratic votes on this. So that could be an interesting. You could lose some R's if you're picking up some of the D's, who also, some of them are in tough elections as well.
Yes, that's right.
It's not just Republicans that have problems.
I know you're making your own spending plans for the midterms, and the Congressional Leadership Fund has a lot of money to spend. This is a remarkable story today. Speaker Johnson's aligned Political Action Committee booking more than $153 million in fall ad buys this early the CLF's largest ever initial reservation. And I'm sure you're well aware of where we're looking here. 14 million South Texas, 20 million Michigan, 18 million New York City, 12 million in Central California. What does this tell us if we're spending this much this early?
Well, first of all, it's very smart to start to lay this out, because not only does it signal to the members where they're going, it also gets them less expensive rates.
Yes, right.
So that's very smart that they're doing this.
You're talking about some expensive markets here.
We are. So the earlier you go in, the less expensive they are, especially in California when you're going to have a governor's race and everything else. But we have some problems, and I'm glad they've got that much money.
Interesting.
We have a fraction of that much money as we go into it, but most of these are the members of the Republican Main Street Partnership.
So how do Democrats manage this, or is it about doing nothing right now, Jim Messina? This is 38 media markets: broadcast, cable, streaming, and digital. Is it up to Democrats to match Republicans dollar for dollar, knowing that there's been a fundraising disparity?
Oh, absolutely. In fact, the House Majority PAC, which is Hakeem Jeffries' kind of super PAC, put in about $250 million buy this week in a bunch of these same districts. I think the interesting thing for Sarah and I to look at is just where they're buying, Joe. And the Republicans are clearly on the defense. 80% of their money is spent on protecting their own seats. Democrats are about 75% in offense, going after Republican seats. You want to be on the offense. That said, I agree with Sarah. I think it's smart that Johnson's doing this early. When I ran Obama's reelection campaign, my job was to knock Mitt Romney out of this thing before Labor Day. You don't want to get into the fall spending where everything's expensive, not having your vulnerable members taken care of. So I think Johnson is doing everything he can do on his side of the aisle. The problem is cost of living, affordability, and Donald Trump's poll numbers all make it so much more difficult for him.
I know these buys are not static, Sarah, which is always fascinating to me. You've got $153 million you reserve ad time, but it's probably going to change as the contours of each race or each district will change. How are those decisions made when you start to pull money back or reallocate somewhere else?
It's made by a small group of individuals, not elected officials. It is based on polling. But I want to emphasize the speaker helps raise the money. He cannot control any of the money legally. So there's a small group of people in the room that make these decisions. And they'll look at polling. They'll also look at how the member is doing. Are they funding themselves? Are they picking up momentum? And is a Democrat ended up being stronger or weaker than they had originally thought they were going to be?
How difficult are those decisions to make when you're in the flow of a campaign, Jim?
They're incredibly difficult. And Sarah's right. Members don't want to make this because part of what they're going to have to do this fall is decide which of the members they can't save. And they're going to pull the ad buys from their districts, and those members know that they're screwed and they're going to lose, right? And those are really difficult conversations. The other thing is, in this America craziness, there's so much money swimming around. You get polling every day. You have members screaming at you every day. It's helpful to just have a few very smart staff sitting in a windowless room in Washington, D.C., trying to make some very tough decisions about where you're going to spend money. I did this for the Senate Dems, and at one point I had to call a United States senator and basically say, look, you're going to lose and we're taking the money. That senator is still no longer speaking to me over a decade later, Joe.
Oh, man. You guys have one heck of a way to make
It's a tough job. I've had some of those too, Jim.
Guess what? We're not invested in you any longer. To what extent will Ken Martin be judged by the fundraising picture here, Jim, as the head of the DNC?
Zero. The DNC is a presidential vehicle now after Citizens United Supreme Court case. All the spending, all this huge spending Sarah and I were talking about is not through the DNC or RNC. They're all through these committees. For the purposes of the midterm elections, there is no DNC. That'll be more important once we get to the presidential and they get to decide the calendar and the rules and the debates and lots of fun things that you and Sarah and I will be talking about in January. But right now, Hakeem Jeffries and Chuck Schumer aren't calling Ken Martin and asking him what he thinks.
Fascinating, as always. Cece says, I respect a long-term grudge. I have to admit, this is what makes politics work around here, right? We have a great panel today. I love this. Jim Messina is with us, Sarah Chamberlain. They're going to be back in our second hour as we welcome our global television audience to the conversation. Kaylee's going to come in, and we'll have a lot more to talk about on another busy day here in Washington, from Iran to rescheduling to, yes, the Department of Homeland Security, which at some point soon will have to be funded, and we'll talk about the way to get there with our great panel. I'm Joe Matthew in Washington. It's Little Friday, the Thursday edition of Balance of Power. Dial us up on YouTube, search Bloomberg Business News Live, or stay with us right here on Bloomberg Radio. As I mentioned, we'll be adding our television audience to the conversation coming up as well, so you can turn us on in the studio with myself and Kaylee Lyons. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lyons.
President Trump issues a shoot-to-kill order in the Strait. Welcome to the Thursday edition of Balance of Power, as the U.S. Navy now intercepts 2 Iranian super tankers trying to evade the U.S. blockade. And the president calling on the Navy now to destroy Iranian boats laying mines. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, we have no word, however, on another round of peace talks today.
Well, yes, and Iran maintains that in order to pursue further peace negotiations, the U.S. naval blockade needs to stop.
Right.
So this is where we are stuck, Joe, because President Trump says the naval blockade is going to stay in place as he is trying to use economic leverage against Iran.
That's
Iran
right.
obviously has been trying to exercise its own leverage over all the other economies that rely on the Strait of Hormuz, but their oil having difficulty getting not just out of the strait, but to its end destination. The super tanker, the most recent one we boarded, in the Indian Ocean.
That's correct.
So clearly the U.S. Navy is widening these operations here.
Moving beyond the region here, and the president on Truth Social calling on the Navy to triple up enforcement. I'm not sure exactly what that means, but clearly we've been calling this a double blockade in some cases. Adam Ferrer at Bloomberg Economics calling it a dueling blockade, to your point, Kaylee.
And while it's ongoing, we have a shakeup at the top echelons of the Navy as the Navy secretary was fired yesterday, ousted after reported disputes with Pete Hegseth and with President Trump. There is a question as to what that means operationally to have that kind of leadership change in the midst of all this.
The civilian leadership is gone for the United States Navy, and it's not the first change we've seen. The head of Southcom was dispatched right in the middle of the Venezuela operation. So we'll have a lot to talk about coming up here with Jenny Welch from the aforementioned Bloomberg Economics, going to be with us a little bit later on this hour. And Kaylee, looking forward to our conversation with Vice Admiral Robert Harward, a man who has been there and knows what those chain of command changes can mean.
Yeah, it'll be great to get his insight into this. We'll also speak with Democratic Senator Tammy Duckworth this hour. But we begin, as always, with a check on financial markets, which are watching all of this very closely. And Charlie Pellet is watching those markets closely up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lines. Indeed, all eyes on the Strait of Hormuz. We do have oil trading higher right now. West Texas Intermediate, 94.54 a barrel, up now by just about 2%. Barrel of Brent, 104, just got a print there, up by 2.1%. Oil higher, stocks lower. S&P right now down 11, 71.25, drop there of 0.2%. Stocks have been fluctuating on concern that a prolonged closure of the Strait of Hormuz could worsen energy disruptions. The Dow off by 157, down now by 0.4%. The Nasdaq Composite Index down by 0.5%. Nasdaq 100 Index has been swinging between gains and losses. Right now, that index is down by about 0.2%. We've got the 10-year at 4.30% with the 2-year 3.80%. Spot gold is lower now by $13 the ounce to $47.25, a drop there of 0.3%. Again, crude bears repeating above $95 a barrel. WTI up now by 2.6%. All of this with the VIX just above 19. The U.S. Justice Department made it official this morning, officially reclassifying state-regulated marijuana as a less dangerous drug by moving it from Schedule 1 to Schedule 3. Now, this directive does allow for research on the safety and efficacy of marijuana, but could increase legal cannabis sales. It does, however, stop short of being fully legal. So today we're seeing a lot of the weed stocks selling off. Case in point, Canopy Growth down by 12.5%, Tilray down by 9.2%, Curaleaf down 19.3%, and among some of the weed ETFs, the Amplify Alternative Market Harvest ETF, ticker MJ, it is down by 10%, and also the Advisor Shares Pure U.S. Cannabis ETF trading lower now by 11.7%. So again, recapping, the Dow, the S&P, NASDAQ, all in the red. S&P down now by 0.2%. That, Joe Matthew and Kaylee Lines, is a Bloomberg Business Flash.
All right, Charlie Pellet checking on the markets for us. Thank you so much. As always, as we, oil markets in particular, are closely monitoring the situation in the Strait of Hormuz, which, despite a ceasefire that was extended by President Trump earlier this week, seems like tension is still remaining, if not escalating further, as not only you have Iranian activity with vessels trying to transit the strait, now the U.S., as we mentioned, boarding a second supertanker in the Indian Ocean, and President Trump taking to Truth Social this morning to say, I have ordered the United States Navy to shoot and kill any boat, small boats though they may be, as he once again references the notion that the Navy has been destroyed by the U.S. military that is putting mines in the waters of the Strait of Hormuz. But this gets to another issue, Joe. It's not just about essentially having the strait declared open or closed or what have you, but what could already be in the water that could take some time to fully clear out?
6 months, according to the Washington Post, to actually clear the strait. And we saw in that same Washington Post report that it wasn't just these small boats laying mines in the water, that they in fact were using remote-controlled, GPS-controlled mines that are floated from other areas and close to impossible for the U.S. to detect when they go in the water. So this is not becoming any easier. You know, we talked to Senator Roger Marshall, the Republican from Kansas, on the late edition last evening about the cost of this blockade. He's pretty strident in his defense of this whole operation. Let's listen to what he said.
Look, this is hurting Iran much more than it's hurting us. I mean, we're basically embargoing their entire country. They can't even feed themselves right now. So if they have no income, no food, hopefully this war will come to a much of an end. Remember this, though, if Iran had nukes, if they had nuclear weapons, then gasoline would be $10 a gallon. And that strait would be blocked off for years as well. And not to mention just the safety of Americans going forward for generations to come.
This is where we start our conversation with Tyler Kendall. Bloomberg's Washington correspondent is on the north lawn of the White House right now with this Truth Social post to hang on to. And Tyler, I don't know if we're going to see the president or get any further news today. Maybe you can tell us.
Well, Joe, actually, we're expected to see the president. He has an open press event at 3 p.m. Eastern. It's related to health care, but the White House press pool is going to head in there, so I would expect there would be a lot of questions about this ongoing ceasefire extension and what it's going to take for the U.S.'s side to try to prompt Iran to come to the negotiating table, because at this point we have a lot of questions about exactly what is happening in terms of diplomatic efforts behind the scenes, because while we've heard from regional mediators, for example, like Pakistan, saying that they are pushing for some momentum. We saw the country's prime minister meet with Iran's diplomat just yesterday. At the moment, Iran is saying, at least publicly, they're not going to negotiate until we see the U.S. lift its blockade. And this White House says that's not going to happen. Instead, you have the president posting on Truth Social, as you were just discussing, saying that the U.S. is going to ramp up efforts in the strait, including to ensure that they can clear mines, which may, according to one military analysis shared with Congress and reported on by the Washington Post, could take 6 months to clear. And that's really underscoring just how dangerous the conditions really do remain in the waterway, because this has been a week of headlines that are pointing to escalation when it comes to the Strait of Hormuz. You've already ticked through a few of them, including the U.S. saying that they intercepted Iranian oil super tankers earlier this week. But then you saw Iran really trying to test the limits of the U.S.'s blockade, as data is showing us that they're moving more super tankers into the Arabian Sea. So we'll have to wait if we get an update from this president, because the White House at the moment, we should say, still says that a diplomatic solution is viable, right? We had officials come out yesterday saying, yes, the ceasefire at the moment is indefinite because the U.S. wants to give Iranian leadership time to coalesce and put a proposal on the table.
All right, Bloomberg's Tyler Kendall live at the White House for us. Thank you so much. Of course, no such proposal has yet been seen, at least reported on publicly, as Iran is holding a hard line, just as President Trump is here. It seems like we're in a very stubborn, sticky situation, especially when it comes to the Strait of Hormuz. And for more insight on what's happening in the strait and U.S. naval operations there, I'm pleased to say joining us now is Vice Admiral Robert Harward, who also served in Central Command previously and has a litany of other titles: a Navy SEAL, a member of the National Security Council under President George W. Bush, and again, former Deputy Commander of U.S. Central Command. Vice Admiral, thank you so much for being with us here on Bloomberg TV and radio. When you see the kind of activity we are seeing in the Strait, be it the Iran firing on ships, seizing vessels, the U.S. also boarding a number of vessels at this point, and President Trump threatening to shoot small boats that may be laying mines, how volatile is this to you? Do you really see this period we are in right now as being a ceasefire? Can we really call it that?
Well, it's not kinetic in the sense that we're not bombing anything. We're not putting boots on the ground. We're using pressure as much as possible. And there's some tactical events, but those are significantly less impactful for both the Iranians and us. And we're dealing with those as they come up. So the strategy has been very sound: blockade, choke off their money, And then any of the other activity we can use to diminish their military power. So I think it's a sound strategy. We're going to try to outlast them while the world economy adjusts to additional oil. They're going to adjust to having no money. How do they pay their people? How do they feed their people? So I suspect in very near order, they're going to come back to the table and hopefully meet the concessions that the president has asked for.
Admiral, it's great to have you with us. I wonder what you make of this timeline that's been put out. Reportedly, the Washington Post says the Pentagon briefed Congress that it would take 6 months to clear the strait once fighting ends. I know the president today says we're actively minesweeping, but bring us inside that operation and why it would be so complicated, why it would take so long to remove these mines.
Well, again, I have not seen a report of a mine in the water. I think they're laying out the worst case scenario to give expectations and messaging to everyone. Worst case situation. They find a plethora of mines. They've got to clear them. So that's the worst case situation. But I have yet to see or hear a report of a found mine, a mine being detonated. So again, I think this is the worst case scenario. And they're working very proactively to ensure there are no mines in the water. And don't forget, that was one of the initial targets in the strikes, take out their capability. Right. So all those things contribute. But I suspect they want to make sure how bad this could be should that happen.
Well, even if the mines may not be present, just the threat of them obviously is enough to deter the private actors who have to make calculated decisions as to whether or not they're going to risk crew and cargo to try to get through the strait. Admiral, obviously, due to that hesitation on the part of some in the private sector, we've seen, obviously, the president previously throw out the idea of naval escorts. If we are to see that kind of activity staying halted, the idea that vessels aren't still going through or are going through at a much slower rate as before, and the U.S. were to deem that unsustainable, try to get things flowing more freely, what would that naval operation actually have to entail? How much would we need to ramp up the presence beyond what is there to maintain the blockade?
Well, you put ships and boats in position to block anyone who could approach those. More importantly, systems that could take out drones and missiles, that's kind of dissipated significantly. And then in the mine front, you run other ships through there, ghost ships and hulls that, if hit, have no significant impact. That's the techniques we used in Iraq, clearing the waterways up to Qasr when we did that. And so you could see those same sort of tactics be employed here to give the commercial shippers the security they need to move their product through the straits.
As we see stepped up enforcement now in the blockade, Admiral, the U.S. military says it now has intercepted 2 Iranian oil super tankers that tried to evade the blockade. We've got the very large crude carriers Hedi and Hero 2 now anchored at an Iranian port in the Gulf of Oman. What do these operations include? Once we have U.S. forces on board and we have control of the ship, what happens to the crew and what do we end up doing with the boat?
Well, in most cases, some of these crews on Iranians, they're third nation nationals. So are they cooperating? Can they live on the boat? Do you have the companies come out and replace those people? So there's all sorts of options. I think more important at this case is the options the president still has in his deck. Okay, we know we're shutting down their oil. We can hold these ships. We can take custody of them. We can even take the oil if we need to. Look at what happened in Venezuela. But I think to the regime and the people in Iran, they know how serious they are, evidently, by trying to break the blockade. But they also know the president has more options on hand. How is he going to treat Karg Island? Is he going to seize it? Is he going to destroy it? Those present long-term dilemmas for the regime. Again, another method and tactic to bring them back to the negotiation table to make concessions.
You just mentioned living on the boat, Admiral, and for U.S. service members, I do wonder at what point you grow concerned about deployment fatigue, knowing that many had been rerouted to the Middle East, deployments extended as we built up our presence there, and obviously as these operations got going. We know another aircraft carrier, the Ford, I believe, is set to be in theater in just a number of days. Do you see that as necessary relief rather than building up the force, just replenishing and allowing a refresh of some of our force that has been positioned there for some time?
It can be either or, but you go back to this delayed deployments. That's what makes our military so amazing. We have all volunteer force who believe in their purpose, believe in their mission, and are willing to take on these sacrifices as their family do. And we've seen that through the history of our country. No other country is able to do that. It's because of our service members. So if they have to extend their deployments, they have to do what's necessary to meet the mission, they do it. And they do it professionally. And most of them are proud to do that because they understand the impact they have and the purpose they serve. And that's why all of us who served and have such a close tie or such a family because of that shared purpose and sacrifice. So I wouldn't put too much in that or word too much, but we'll stay and do the mission.
Yeah, these are remarkable men and women. Admiral, a lot of us first learned about you and learned of your name back in 2017 when it was reported by multiple organizations, including the Washington Post, that you were being considered as a front runner to replace Michael Flynn as President Trump's national security advisor in the first term. I realize, at least according to reports, you had your own reasons to not take that position, but I wonder your thoughts now on the people surrounding the President of the United States who are advising him with regard to this operation. Does he have the right people assembled to give him the right advice?
That's a great question. And again, I wasn't considered. The president asked me, and I told him I was proud and honored, but the timing was not right for me then. So I want to make sure the facts on that straight. But back to the point, the team, and I focus on their policies. I am very encouraged by the policies. The president and his team had the courage to step in and take action against Iran. I've been watching this situation and waiting for someone to do that for decades, and particularly the last 2 decades, where Iran, because no one would react, no one would challenge them, they did whatever they wanted to do to reach the point they had now, where they were on the cusp of a nuclear weapon. They had a extensive missile and drone capability. They had mines. They could control the Gulf. If that had not been challenged now, I think in the not too distant future, we would not have been able to challenge that under nuclear umbrella. So I think that's indicative of the team he has now. And I think some of these strategies employed now, like the blockade, putting up the kill box for all the small boats that may want to shoot or put mines in the water, is indicative of the policies that I support and I feel are appropriate. And they got a lot more up their sleeve. I know we've talked to see it, blockade, but are we sure that no aircraft are coming in and resupplying the Iranians? Are we told them, hey, we'll take Garg Island. We're not going to blow it, but get everyone off the island, because if they're not, we're going to take them out and really shut down the island completely. So he's still got a lot on this plate. And so far, this team has been very astute in applying those options for the president to meet his strategy and the end objectives we're all looking for.
Well, we're glad we could spend some time with you before you fly away, Admiral. It's great to see you. Robert Harward, former Deputy Commander, U.S. Central Command, a former Navy SEAL, although I think that's forever, and member of the National Security Council under President George W. Bush. Fascinating conversation. We'll assemble our panel with a lot more on this straight ahead here on the fastest show in politics alongside Kaylee Lyons in Washington. I'm Joe Matthew. This is Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Another leg lower for the U.S. stock market. In fact, we are just about at the lows of the session right now. Oil higher, stocks lower. S&P is now down 47 to 7,089. Drop there of just about 0.6%. For much of the morning, we did see the S&P higher, but again, it is down now by 0.7%. Dow Industrials down 371 on the Dow. Drop there of 0.7%. While NASDAQ is down 264 points for the NASDAQ Composite Index, a drop of 1.1%. The NASDAQ 100 Index down 0.7%. All of this with a VIX just above 20 and a 10-year at 4.34%. Gold at $47.08 the ounce. Gold is down 0.7%. We are seeing a big move in crude. West Texas Intermediate back above $96 a barrel, indeed closing in on 97. Right now we've got WTI surging 4.1%. Barrel of Brent above 105 now. Brent crude up by 3.8%. Earnings news, American Express plans to boost spending on marketing and technology. Also says its customers' spending on air travel has been slowing down. Shares of American Express now trading lower by 5%. Meanwhile, American Airlines lowering its full-year earnings target, saying it may end 2026 with a loss as the carrier absorbs $4 billion in additional fuel costs from the war in Iran. Recapping, West Texas Intermediate crude up now by 4.2%, 96.92 a barrel. Stocks are selling off with the S&P down 0.7%, just about the low of the session. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Very interesting turnaround we're seeing in the markets right now. As Charlie mentioned, stocks taking a big leg lower. You're seeing bond yields moving higher, oil higher as well. You have to wonder if the market is seeing something pertaining to the ongoing conflict with Iran. Obviously, if we get any confirmed news that could be impacting sentiment here, we will bring it to you here on Bloomberg TV and radio. In the meantime, though, we will be focusing on politics as well. Not just the geopolitics abroad in the Middle East, but domestic politics here at home, as we, of course, earlier this week had a redistricting win for Democrats in the state of Virginia, a new map that will give them an advantage going into November of 10 likely Democratic seats to 1 in terms of the House delegation, though that was knocked down by a judge in Virginia almost immediately. This happened last night, Joe. Obviously, we knew that this was a fight that likely could end up in courts, perhaps go all the way up to the Virginia State Supreme Court. We saw this in Texas as well. All know how that went, but it just goes to show you the redistricting wars that begun with Texas are not ending there. This whole thing is far from over.
That's right. We saw legal challenges in other states that have done this. Virginia's Attorney General Jay Jones vowing to fight the order issued by Judge Jack Hurley, a Republican appointee. House Democratic leaders are still celebrating because they think they're up by 1 here. Kaylee, the question is, will Florida follow, and will the courts allow that? And that's where we start with our great panel today. Republican strategist Sarah Chamberlain is with us, the president and CEO of the Republican Main Street Partnership, and Democratic strategist Jim Messina, the campaign manager for President Obama's 2012 re-election campaign, former White House Deputy Chief of Staff. Great to have both of you with us here. Jim, I'll start with you because Democrats seem to think that they're in the lead. I think it's by 1 seat if you're keeping score nationally, but if Florida then follows on, and I'm assuming that the courts don't change the picture here, is this just a wash in the end?
Boy, it feels like that, Joe. It feels like a wash, and it feels like hundreds of millions of dollars have been spent here by both sides, and I think it's kind of sad where we become. I don't think voters really want some of this. It was all started in Texas. Both sides decided they had to then continue the game. But it looks like when it's all said and done, it's basically a wash. And Democrats are actually thinking that some of the Texas seats they now have better shots at because of their growing lead with Latino voters. So they may actually come out of this whole thing, with a gain. I think the question is long term, though. Did we just make a whole bunch of more safe seats for both parties and have less swing seats? And I think if that's what happened here, I think it's going to do some long-term damage to the institution.
Well, so how much buyer's remorse is there right now, Sarah, in your party with this whole effort?
There is some. Obviously, we didn't They didn't game it out that it would end up in this situation. They have great confidence, though, that we will prevail in Virginia. So then it will flip the numbers. And I just, for full disclosure, those Virginia members, 3 of the 4 of them are members of the Republican Main Street Partnership. So we certainly hope that that we do get to keep them. They're great members, and they should be in Congress. And to be honest with you, the new Virginia map is kind of a joke. I mean, it is really crazy.
Pretty much
for those
every
of
district starts outside of the D.C. area.
It does, and it goes hundreds of miles. I mean, it's really kind of ridiculous for those of us who live in Virginia.
Well, so it's on to Florida then. Can Ron DeSantis move the needle?
He's going to certainly try.
Yeah.
We'll have to wait and see how that goes. We're kind of starting to get low on time.
Yeah, well,
So
that's
we'll have
true,
to-
isn't it?
Yeah.
He could be late to the party for this midterm
He could be
cycle.
very late to the party for this cycle, but I do know he's going to make an honest effort to try to get a couple seats in Florida.
Well, with what you were just saying, Jim, about Texas and the Latino vote, how could that actually show itself in Florida as well, depending on how they want to redraw these lines?
Yeah, earlier in the block, we talked about the big media buys that both parties have done, and the Democrats are on the offense. They bought their first Florida congressional media ad since 2020. They think they could pick up 2 or 3 seats right now, depending on the current lines. Who I think Sarah's right. We'll see what DeSantis can do. It feels late to me, but governors get what governors want sometimes. But definitely Democrats are on the offense and are targeting 3 seats in Florida because of the president's numbers with Latino voters. And so, it is really interesting that Florida, which is not a swing state in a presidential election anymore, is now very much a swing state in the middle of these congressional races.
We've spent a lot of time talking about governors with regard to this story, whether Gavin Newsom could get it done, whether Abigail Spanberger could get it done, and how they might be judged in the end. But Nancy Pelosi, Jim, reached out to congratulate Hakeem Jeffries. Was he the real force behind the Democratic movement to redraw the lines?
Yes, and he went to war to get this done. And there's been following Nancy Pelosi as leader is a thankless job, considering she's probably the best leader of our generation. And yet, and he's more quiet on how he does it, but he really put together the implementation of this and dealt with the governors and dealt with kind of the national media, raised the money for it, and is really his moment to shine here. And he has now a caucus who's saying, whoa, the new guy is pretty good at this. And so, people are calling him the silent assassin this morning, and it's a pretty fair assessment after what they just did in Virginia.
I want to go back, Jim, to something you were saying about creating more safe districts for either party and there potentially being fewer swing districts. As we think about the Main Street Caucus members, for example, Sarah, you mentioned 3 of the 4 candidates we're talking about in Virginia are members. It is a group that represents a lot of the moderates. A lot of these people are in swing districts. What will be lost if we lose some of these hotly contested seats that require a candidate to be more in the middle rather than on the extremes? I wonder if it just has the potential to intensify the problems existing on Capitol Hill right now.
It certainly does, from both the far left and the far right. And I really want to emphasize, people need to vote in primaries. I mean, yes, as we get more gerrymandered districts, the primary is the most important vote that you can take. It's the whole election now, and we cannot afford any more extremists on either side at this point, and that's what you could end up with.
Does money end up moving that way, where you overspend up front in the primary cycle, and general election spending simply means less?
Absolutely.
Or are we already there, Sarah?
We have, and in past cycles, this cycle is a little bit different, but in past cycles, the bulk of the Main Street money has been spent in primaries.
How about that?
Yeah, absolutely. That's how you get Main Street type members elected. You have to go in and change the primary turnout model.
It's incredible to consider. Obviously, most of our conversation here with redistricting, Jim, is focused on House seats in particular. But what about the Senate? There is a growing consensus that what would already have been a difficult year for Republicans just because of historical norms, you have a Republican president, we know how things usually swing in the midterms. Now you layer on a war with Iran that has raised gasoline prices at home, and suddenly everybody thinks the Senate may too be at least in contention for flipping, more difficult for Republicans to control. How much confidence do you have as a Democrat looking at the Senate map here that there is potential for not just guarding seats that may have been in jeopardy, but picking up some elsewhere?
Kelly, I'm so glad you raised this because it is like what offensive politics is. When you look at the Senate map, there's no way the Democrats should have a chance to take the Senate this cycle. It's just a brutal map for the Democrats. But when you start to look at the numbers, and the reason why it's a brutal map for Democrats is because Democrats would have to win 2 or 3 Senate seats in states where Donald Trump won by over 10 points, which in Senate races just doesn't happen anymore. In the last 10 years, Senate races usually go to whatever party won the presidential election in that state. So Democrats are now on the offense in states they should have no chance at, like in Texas, where Trump won by double digits, like in Iowa, where he won by double digits, in Alaska, where he won by double digits. And part of why is just the president's own approval rating. His biggest slide of any electoral group is non-college educated white voters, which are a majority of voters in the states we just talked about. And so, it's still difficult for me as just a number geek, because Sarah and I like to sit there at night and crunch numbers. It's still difficult for me to see how the Senate goes Democratic. But when you start to look at his non-college white numbers, you start to say, whoa, you could win Ohio, you could win places like Maine, you could win North Carolina, and you could possibly put it together. I'm not going to go spend all of Joe's salary on Kalshi tonight betting on it, but the fact that we're just talking about it is kind of the offensive game plan we talked about, where the Democrats are now on offense in places we shouldn't be on offense.
I have very little to offer here, Jim. But I have to ask you about the big issue right now and the way it's going to play in the midterm cycle. We've been spending a good chunk of time this hour talking about the war in Iran. We just spent time talking with a retired admiral about the potential for a 6-month clearing of the Strait of Hormuz, and this all brings us back to $4 a gallon gas. But whenever we talk to Republican members, Sarah, they really make the case that this was a moral imperative to protect America by eliminating a nuclear threat. It's going to be one or the other here. Is that the message that wins, or is it how did you get my gas to $4 a gallon?
I think if we message it correctly, which we haven't really done much of yet, we really have to explain to the American people why we went into Iran, what the situation was, and really what the danger is. I mean, them having a nuclear weapon would be a disaster for the entire area and the entire world, frankly. I know past presidents have looked at doing this. Yep. President Trump has actually done it. So if we can explain to the American people, listen, we're actually making you safer. $4 a gallon gas is not good. We understand that. But once this is over, it will come back down. That is the messaging that we have to get a little bit better at doing.
Does it need to happen before November?
Absolutely needs to happen before November. We need to get our messaging there.
In terms of the prices coming down?
We're in hopes that this will be behind us by November and the prices will start coming down. And the American people will understand we're actually safer now with what has happened in Iran. But time will tell. This is taking a little bit longer than we had originally thought it would.
Well, and there were a lot of members who said, look, the president has 60 days of leeway here. We're getting closer to the expiration of that 60 days. And now everybody's saying, okay, well, maybe it's 90 because there's a clause around an extra 30 days to get troops out. Sarah, are we just going to keep moving the goalposts for the president, or are there going to be members who are going to be more vocal as this drags on?
We are going to continue to move the goalpost until probably early August, maybe late July, and then we can't keep moving it. We have to have some type of conclusion.
That's some time to go, though.
It is more than 30 days. Jim, what's your thought on that when we start talking about a debate on the use of authorization for the use of military force? Is that inevitable if timelines are going out the window?
Well, it's a great question. I want to go back to Sarah's point because I think she's right. The problem is the president didn't message this at the very beginning. The problem is the president didn't explain why we were doing this, why 6 months after he said he bombed everything that they could bomb and they don't have any chance to do this, we had to go in again. This is the first war of our lifetime. It started out with a negative approval rating. And we keep talking about Election Day, and it's actually not Election Day. Voters' feelings on the economy, there's been numerous studies, are baked in by the end of June. And why is it the end of June? Because everyone goes on vacation with their kids and gets on a plane flight or drives a car in June. And none of us think the prices are going to be below $4 by June. In fact, it could be, as you guys have reported, up into the fall. That is just a disaster for the president and his party. I've gone through this when I worked for the president. It is just a disaster for the party. So it's not a November thing. It is a people driving around in June thing. And it is very unlikely that they're going to believe that this whole thing was worth it by then.
All right, Jim Messina, great to have you with us alongside Sarah Chamberlain, our wonderful political panel today. We so appreciate you joining us here on Bloomberg TV and radio. Now, we do have a bit of breaking news that is just crossing the terminal pertaining to Meta, telling staff that it will cut about 10% of its workers in order to boost efficiency and offset its heavy spending on artificial intelligence. This 10% cut, Joe, equivalent to roughly 8,000 employees. The company also won't be hiring workers for 6,000 open roles that it had intended to fill. This is something we've been talking about. A lot of these major tech companies investing heavily in artificial intelligence, a lot of capital expenditures. The market hasn't always taken kindly to that notion. And now Meta obviously taking steps to potentially offset where they're spending money on technology, not spending as much money on personnel.
Interesting. You typically see a positive stock reaction when layoffs are announced because we're cutting costs, but Meta shares are decidedly lower, down about 2.5% right now, $657. Remembering this is a stock that was trading near $800 back in August of 2025. Ed Ludlow is standing by to help us once again with a breaking news story. Of course, the co-host of Bloomberg Tech and steeped in all things Meta. Ed, what do you make of this decision? You and I were just talking about the increased levels of CapEx spending that all of these hyperscalers are embroiled in. What does this mean for Meta?
Yeah, you guys summed it perfectly. Prioritizing the spending of infrastructure over the spending of headcount. And, you know, this has been reported, right? So what you see in the stock might be a little bit of a sell the news kind of reaction. The moment the headlines hit, we were down 2.5%. There was an algo spike pairing those declines, and now we're back down 2.5%. Cuts are effective May 20th. You know, there's an element of accounting here because Meta's going to have to pay those that are eliminated or have their roles eliminated 16 weeks of severance pay effective May 20th. But remember, you know, the political story here is Mark Zuckerberg sitting alongside the president of the United States saying, oh, I shall spend $600 billion in the United States of America to reindustrialize AI infrastructure in this country over a 3-year period. And so that's the sort of political side of the story, but their capital expenditure commitment for the year is size large.
Well, and of course, and Joe alluded to this with the other hyperscalers, it's not only Meta. We're getting news in this regard today. As we know, it was reported earlier that Microsoft is offering buyouts to about 7% of its workers. Is that the exact same story here, Ed, or are there some idiosyncrasies to consider with Meta in particular?
Well, idiosyncrasies in the sense that the way that Microsoft is going about this is offering buyouts to 7% of the workforce. So a different number, but also a different mechanism, trying to make voluntary retirement the modus operandi by which they reduce that headcount longer term. But you're still talking about thousands of employees in the United States. And that reporting, according to a Bloomberg source, Microsoft has 125,000 people. So again, similar level, you know, 8,000 to 9,000 employees. You know, the capital expenditure commitment from Microsoft is also great. And when we talk about that, when we say capital expenditure, it's a financial term. You're talking about an upfront cost commitment to buy the latest generations of chips and build out data center infrastructure to develop or run AI. It basically comes down to being as simple as that. And what has been the story of a longer period of time is investors really cheering that commitment. But as you guys know, Wall Street also likes to have it both ways. And they want to see something give in the opposite direction, some financial discipline. And usually headcount is where you find that, what should we call it, compromise.
What's this mean for morale at a company that's involved in building out the next industrial revolution?
Oh, goodness. You know, since the Meta story broke, I haven't had a chance to talk to anyone within the company. I would note that I think Reuters reported the Meta cuts were coming, and based on what's now confirmed pretty accurately. The other way of looking at it is that this is the story of Silicon Valley. When you have a big round of layoffs or voluntary redundancies, retirements, you create a generation of people who have time on their hands and experience. And those people tend to found companies. or they invest in other companies. And so that's how I would tend to look at that story. But morale can also be difficult. And in Meta's memo, which came from the chief people officer, obviously it's acknowledged that this is not what people want to be hearing. But I look at the bright side. Many people often do.
10% cut in jobs in a push for efficiency. Meta shares down a little more than 2.5%, $18 at $656. Ed, thank you so much for jumping in to help us understand this a bit more. And we'll be watching the shares. We'll touch this in the late edition of Balance of Power to see, of course, where things closed. We've got some important conversations ahead. Jenny Welch is going to join us from our Bloomberg Economics team with regard to the latest in Iran. And we're going to spend some time with Senator Tammy Duckworth, a Democrat from Illinois, and of course, combat veteran is going to join us as well. Let's take stock on Wall Street. We mean that literally right now with Charlie Pellet. He's got the latest on market action today, and things have turned lower. Charlie, what's going on?
Indeed. We are at lows of the day right now, Joe and Kaylee, and indeed another leg lower as I speak. Right to the numbers here. We got some fast-moving markets on our hands now with the S&P down 70, 7,067 where we stand. That is a drop of 1% on the S&P. The Dow Industrials down 519 now, lower by 1.1%. NASDAQ down 1.5%. All of this with the VIX just below 21. We've got the 10-year at 4.34%. Spot gold down $55 the ounce, down 1.2%. 46.85 on the precious metal. West Texas Intermediate crude continues to push higher, very close now to $98 a barrel on WTI, up by 5%, so a move higher there. Barrel of Brent, the global benchmark, above $106 now. Brent crude up by just about 4.7%. So bottom line here, we've got oil climbing as a flare-up in tensions over the Strait of Hormuz sends oil higher. Stocks moving lower on concern that a prolonged closure of the waterway could worsen energy disruptions. I just want to recap and reset on a couple of major tech stories breaking today. Meta Platforms, as we heard from our Ed Ludlow, cutting 10% of its workers. Meta shares, they are trading lower now on that news. We got Meta down by just about 2.5%. All of this as Microsoft offers voluntary retirement to thousands of its employees in the U.S., and Microsoft shares trading lower now by 4.7%. So again, recapping here, stocks lower, lows of the day right now, oil pushing higher, WTI, it is advancing to $98.11 a barrel, up by 5.5%. Joe and Kaylee, lots going on, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Keeping us abreast of the turn we are seeing in markets across asset classes, stocks lower, bond yields up, oil up, the dollar moving as well. We don't have a clear justification for it, but of course we know the markets have been glued to each and every headline pertaining to the conflict and or ceasefire in the Middle East. We did just have a headline crossing the terminal from Iranian media reporting blasts over Tehran that has triggered air defense systems. Those have been activated. Again, we do not know exactly what is happening in Iran, what may have triggered those defenses, but it is also worth pointing out the commentary we got from Israel earlier today, Joe. Israeli Defense Minister Katz saying that they're waiting for a green light from the U.S. to complete the elimination of the Khamenei dynasty, talking about the notion that they are ready to resume the war. All of it just speaks to how fragile this situation is and how little forward progress toward an ultimate resolution we really seem to be seeing.
This is really something. AFP picked up that headline from Iranian state news, and it is potentially what we're seeing move markets here. It's just very difficult to tell in real time when the algorithms start working, but it's a great time to compare notes with Jenny Welch, who runs our geoeconomics team at Bloomberg Economics and is with us now ahead of our conversation with Senator Tammy Duckworth. When you hear headlines like this, Jenny, it's a clear reminder that not only do not we have a ceasefire, but it's almost difficult to call this anything other than a war still at this point. What do you make of the news that we've seen in the last 24 hours with the president saying that the Navy is tripling up enforcement in the Strait?
We're in this murky limbo where the ceasefire has been unilaterally extended by the United States for an undetermined amount of time. But the blockade is still in place, which is technically an act of war. We have very real action happening on both sides, the Iranians firing on ships, the U.S. intercepting ships, a debate about whether Iranian ships are still able to make it through the blockade. And I think, as Kaylee mentioned, this highlights not just how fragile the situation is, but how volatile. We could have talks at any moment. We could have a major escalation in tensions at any moment. And I think both of those put the global economy and oil markets on a very different path, and yet both of them at this moment seem entirely plausible.
Well, and clearly you're seeing a bit more upward pressure on oil prices today. We're back at 107 on Brent crude as we consider the situation in the Strait. Do we need to start having a kind of separation here, Jenny, between the strategic diplomatic aims that talks could be focused at, including the elimination of the nuclear program, versus still the economic reality in the Strait of Hormuz? I wonder if markets should be reading any diplomatic effort as really something positive, knowing that we still have effectively a chokehold of this waterway that is being implemented by both Iran and the United States.
At this point in time, our models for what oil prices should be are entirely divorced from where oil prices actually are. We had previously modeled what it would look like if the Strait of Hormuz was shut for 2 months, and our models suggested oil prices should be up at around $140 a barrel. We are now nearing 3 months of the Strait of Hormuz being closed. Oil prices are high, but nowhere near that. They don't seem to be climbing much higher at the rate we would expect them to, given how little time we have left till that 3-month mark. And yet, it's not that there has been a major change in the physical constraints on Hormuz. Yes, there might be some Iranian tankers still getting through, but we are still nowhere near the pre-war levels of traffic in that strait.
When you consider the idea of peace talks progressing from here, look no further than the president's tweet of this morning at 9:14 a.m. Iran is having a very hard time figuring out who their leader is, he writes. They just don't know. The infighting is between the hardliners who have been losing badly on the battlefield and the moderates who are not very moderate at all. The fractures, I should say, that we're seeing inside Iran, when the IRGC is saying one thing, the Speaker of the Parliament is saying another, and whoever else is at the table is pointing to a different solution, seem to be as confusing as the mixed messages coming from the administration. Do we know who we're talking to?
So I think that is an excellent question, and I think it might suggest why there was a breakdown in communications a few days ago, right? When the president thought that he had a deal, might have been talking to somebody, but maybe not someone with the authority to make a deal. I think the fractures within the system, to a certain extent, are a feature of it. They existed before the war. The war has probably compounded it, especially because the IRGC, Iran's Revolutionary Guard Corps, a real hardline force, has been empowered by this and is probably making more decisions or weighing more decisions than they were beforehand. And that has led to some of these divergences between them and like the foreign ministry, which tends to be a little bit more open. But I think we should be under no illusions that they aren't able to make decisions, that they aren't able to put together a negotiating position and come and talk. That's probably not why talks broke down earlier this week. I suspect it was the continuation of the U.S. blockade and Iran not wanting to negotiate under those conditions.
Well, that's what I wanted to ask you about. We were just speaking with a retired admiral who said the blockade is an excellent mechanism for increasing economic pressure on Iran. How real are those economic pressures, Jenny, when we consider the economic reliance on oil and energy, and who within the various leadership strata, if you will, is likely to want to cave to that pressure? Because I would imagine the military is not going to be as responsive to that as political leadership.
I think that a blockade is extremely effective theoretically, but it depends on who you're dealing with. And for Iran, which has already been facing really stringent U.S. sanctions for years, their economy is already severely handicapped. You have a leadership that sees this fight as existential. They are not worried about headline GDP numbers. They are worried about their own skins and the survival of the regime. And they, by the way, are reporting that they're still able to get some oil out. So there is still a lifeline. And recall, they were also the only ones who were able to get it out for the prior 6 weeks of the war at a much higher price premium. So we don't assess that the blockade is going to break their will, at least in the near term. Maybe that will change if it endures for another few weeks to months, but the global economy is going to suffer in the meantime, too.
The White House has removed all references to timeline. In fact, the same day the president mentioned 3 to 5 days before we maybe have another round of talks to the New York Post, we've pulled back on all of this. The Washington Post says 6 months to clear the strait. What are you considering here in the days or weeks ahead, or does Bloomberg Economics have a timeline on this?
Our assessment is, and it's not a very optimistic one, that we are phasing into a new normal, where this limbo might be with us for a while, where it's not clear whether we're at peace, not clear whether we're still at war, and it's sort of this low-intensity, protracted conflict and hostilities, and a lot of uncertainty about whether it is safe to move through the Strait of Hormuz, we might be here for a while.
Boy, it's a market that clearly is getting used to $100 a barrel of oil, Kaylee.
Yeah, well, and Jenny thinks that should be a little bit higher than that. I guess the question is whether the market is going to catch up to what experts are saying, because there has been this disconnect for some time. Just on this timeline notion, especially as we consider what we've heard consistently from a Republican-controlled Congress, give the president 60 days. The War Powers Act allows that. Now they're saying, okay, but there's also an extra 30 days he could have to get troops out safely. Even if, in the best case scenario, with the number of assets we have deployed there and the kind of an indefinite blockade maintenance, do you realistically think that even if we reach the 90-day point that we're going to have all of our forces out of theater by then?
Well, I don't think we would ever, or it would be very unlikely that we would pull all of our forces out of the theater. There are always going to be forces that remain in theater at our bases there, but probably, additional forces, given that the threat is not going away. Iran isn't collapsed. Its partners in the region, like the Houthis, haven't collapsed. So I would imagine there is going to be a sustained presence there above what there was before the war for some period of time. And then it gets to a question of how does that affect readiness in other theaters? You've had to draw those assets from elsewhere. You've had to delay their maintenance in order to keep them out at sea. And I think those are going to be questions that the administration will have to start to wrestle with very soon.
The president has spent quite a bit of time on Truth Social, and I guess he will be speaking publicly later, which is a little bit more meaningful than trying to dissect the words from a social media post. What's the most important question that you have for him right now? It looks like reporters will be in the room with him a bit later on.
I think the question that comes to mind is he's extended the ceasefire, but for how long? Yeah. He's previously threatened if Iran didn't come to the table or didn't produce a deal that he was going to reinvigorate his prior threat to hit power plants and bridges in the country or otherwise escalate. And I guess my question to him is, how long is your patience going to last on that front?
Well, I think everyone's patience is a question here. We all obviously know that there has been a certain lack of patience inside the Pentagon with even inter-Pentagon leadership. There's been a lot of contention between the defense secretary and others. We now have the ousting of the secretary of the Navy. Jenny, does that have a real impact operationally as we maintain a naval blockade?
So it would seem to pose that risk. But I think when you think about the structure of the United States Navy, and in particular the role of regional commands in executing things like a blockade, I don't foresee an immediate threat to this operation. I think it probably will, though, create questions within the service and maybe concern about where things are headed, especially on the heels of prior dismissals that were already raising questions about how much the administration was listening to seasoned, experienced military officers.
All right, Jenny Welch, we appreciate it as always, and you can find her analysis on the Bloomberg Terminal. She leads our geoeconomics team here at Bloomberg Economics. And as we continue our conversation on the ongoing war and ceasefire with Iran, we turn now to Democratic Senator Tammy Duckworth of Illinois, who is joining us live here on Bloomberg TV and radio. She, of course, is a veteran herself, having served as a helicopter pilot in Operation Iraqi Freedom. Senator, great to have you with us on Balance of Power. Would you describe the current state of play when it comes to Iran? A ceasefire, at least in name, but an ongoing U.S. naval blockade. Is the U.S. still being actively at war?
I think we are still actively at war, and a war that we have no known end state. The president has not explained to the American people or even to the members of Congress, which he's supposed to do, as to exactly what his end state is, because it seems to change from day to day and sometimes from sentence to sentence when he is giving interviews. First, he wanted regime change. Well, he got regime change, but it was for the worse, right? We've got a worse Ayatollah than was there before. Then he says he wants to open the Straits of Hormuz, but the Straits of Hormuz were open before he attacked, and now it's mined, and now Iran is charging $1 million per ship that's traveling through it. So I would say we are still at war, and this is Trump's war of choice, and it's at the expense of the American people.
Well, we're knocking around 60 days, maybe 90 days, Senator, when it comes to a war powers inflection point. I know there have been a series of votes, and you've been front and center in the congressional effort to pass a war powers resolution. When you talk to your Republican colleagues, if we do in fact get through that next 30 days, and we're talking about this 90 days into a wartime operation in the Middle East, do you think there will be growing appetite for an authorization for the use of military force, and how important is that to you?
Well, it's critically important. And by the way the law works is the president has up to a maximum of 60 days to come to Congress after launching armed conflict to explain and justify why that happened. So 60 days is the longest amount of time he has to come and explain to us. The War Powers Resolution that Democrats have been filing every week, and we're going to do it every single week. Mine went through last week, and then, of course, Tammy Baldwin. We're going to bring that up every week to give my Republican colleagues a chance to vote to have Trump stop hostilities, come to Congress, explain and justify this war of choice of his, and then we will debate and vote whether or not we will give authorization for the use of military force. That said, I do think the 60-day mark is really important because I've heard from some of my Republican colleagues that, where I'm not going to be able to I can't vote to authorize more funding for this war beyond the 60-day mark without Trump coming to us. So there's growing anxiousness among some of my Republican colleagues, and I think we may actually be able to pass this war power resolution where we actually force the president to come before Congress.
Well, as we consider what may come before Congress and the Senate specifically, Senator, now that we have seen the ousting of Navy Secretary Phelan and we've seen an acting secretary appointed in Hung Kao, do you have concerns about him as a candidate? Is that someone that you are comfortable with serving in this role, or does there need to be a thorough vetting of someone else? And how is it complicated by the ongoing operations and naval blockade we are engaged in the Middle East?
Well, what I'm most concerned about is incompetent leadership both at the White House with the Commander-in-Chief and incompetent leadership with Secretary Hegseth. When you see such a rapid turnover of the top military officials constantly getting fired, and now, Mr. Phelan was Trump's Mar-a-Lago buddy. This is a guy that raised millions of dollars for him, and I didn't think he was competent to serve as Secretary of the Navy to begin with. He has no naval experience. But obviously, at some point, he actually stood up and opposed with this war of choice, and now he's out. And from everything that I'm hearing, this was a surprise firing for him. He did not expect it to happen. What I'm most concerned about is the disorganization within the DOD, the incompetence of the Secretary of Defense. And yes, anybody that is brought in to serve in that role needs to come before Congress. That's my job. It's my job to represent the American people and the voice of the people of Illinois and the people of the United States to interview and determine whether or not someone is qualified to be Secretary of the Navy. And it's all absolutely complicated by the fact that we are still engaged in active hostilities with Iran.
Senator, it's great to have you. We'd love to stay in touch with you throughout this whole process. Tammy Duckworth, Democrat from Illinois, we appreciate your insights as always. Alongside Kaylee Lyons, I'm Joe Matthew in Washington. We'll see you on the late edition of Balance of Power right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, welcome to Bloomberg Business Week Daily. We are across radio, TV, YouTube, Bloomberg Originals. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. We have seen equities over the last hour or so take a leg down to its lows of the session in terms of those major equity averages. We're bouncing off of it, but I was just pulling up a story out from the AP just about 1:58 p.m. President Trump ordering the U.S. military to, quote, shoot and kill Iranian small boats choking the Strait of Hormuz. Safe to say it felt like we were treading water a little bit earlier in the trading session, but the standoff in the Strait of Hormuz creating investor concerns, and I think safe to say global concerns about where we are in this war between the United States and Iran. and Israel.
Yeah, we really saw stocks take a leg lower after the Iran newswire reported that active air defense systems were engaging in hostile targets over Tehran. That jolted a market that had leaned heavily into this idea of fragile optimism. Like the status quo, there was a ceasefire that the president's staff clarified yesterday was not 3 to 5 days, but instead was until they got a deal done.
Yeah, exactly. So, all right, the back and forth continues. We're going to keep an eye on it. We did see, I think, oil also spike. Let me just pull up WTI crude futures on my Bloomberg, 3.4% to the upside. We've been as high as 5.8%. So definitely trending higher, though, overall in the session. We're going to get an update on the trade in a moment. We're also going to talk big time tech, a deep dive with our own Ed Ludlow. We've got Meta headlines that crossed just a little while ago, in fact, about cutting 10% of jobs. So we'll talk about that. We've got Tesla, which rallied after hours yesterday, and then it didn't, especially when the company mentioned its CapEx spending.
Yeah, that wasn't in the earnings statement. Instead, that came on the call.
Not in the deck?
That moved the company's stock. We got Ed on that in just a minute. Also, another group that soared yesterday, only to drop back today, cannabis companies. It was a classic buy on the rumor, sell on the news situation. The CEO of Curaleaf is stopping by in just a few moments.
Yeah, we've also got the head of macro over at Lombard Odier Investment, Florian Ielpo. He's going to be back with us, kind of tying it all together. And then we get another read on the economy with the real estate services firm, CBRE. We've got the CEO actually talking to our Norma Linda. We're talking about Bob Salentic. So a lot coming your way in the next 60 minutes.
First up, though, let's get a check on the trading day and the weakness that we're seeing across stocks, the strength that we're seeing when it comes to energy. Charlie Pellet is standing by in the Bloomberg newsroom. Hey, Charlie.
Thank you very much, Tim and Carol. And in a sentence here, we have got oil pushing higher, S&P, Dow, NASDAQ, all declining. We are, however, off our session lows. Let's get right to the numbers here. We got fast-moving markets on this Thursday here with the S&P 500 index now at 7,095. We are down 43 again, off session lows, down now by about 0.6%. Dow Industrials down 309, drop there of 0.6%. NASDAQ is down 1%. The NASDAQ 100 index down 0.6%. All of this with the VIX just below 20. The 10-year 4.31%, with a 2-year currently yielding 3.81%. Now gold down 0.5%, 47.15 the ounce, while West Texas Intermediate crude oil WTI is up 3%, 95.73 a barrel. Brent holding above $104 a barrel, up by 2.5%. Lots of tech news today, specifically job cuts. Meta Platforms plans to cut 10% of its workers in an effort to boost efficiency and offset its heavy spending on AI. Meta right now down by 2.4%, and Microsoft offering voluntary retirement to thousands of its employees in the United States. Microsoft now down by 4.1%. So again, recapping here, the Dow, the S&P, NASDAQ very much in the red. Key takeaway at this hour, we're off session lows, but still down by 0.6%. Keeping an eye on crude. WTI just below $96 a barrel, up by 3.1%. Tim and Carol, that is a Bloomberg Business Flash.
All right, folks, and we're going to keep an eye on those headlines. I mentioned the President Trump about shooting and killing Iranian small boats. That actually came out in a tweet earlier this morning, but it's the back and forth in the Strait that is ultimately certainly putting pressure on global financial markets, because it doesn't seem like a step closer to peace talks. In fact, it feels like a step closer to escalation, but who knows what's going on behind closed doors. All right, we'll keep a watch on it for you. Charlie, thank you so much. Meantime, we're also watching big time the tech sector. Meta Platforms planning to cut 10% of workers, or roughly 8,000 employees, in an effort to boost efficiency and offset its heavy spending on artificial intelligence. Now, the company disclosed the move in a memo sent to employees today, saying the layoffs will come on May 20th. Meta also will not hire workers for 6,000 open roles that it had intended to fill. Ed Ludlow is with us, covering everything that's going on in the tech sector, including Meta. He's co-host of Bloomberg Tech on Bloomberg TV, 11 to 12 noon every Monday through Friday. He joins us here in our studio.
For him, it's earlier when he does this.
I know, but
that's okay.
I'm living on East Coast time.
I'm here with you. I'm here for it.
And it's been full time for you. You have been doing double, triple duty. Let's talk about Meta.
Yeah.
Good news, bad news. What's the read?
Well, just in the moment when the headlines hit, the stock was already down 2.5%, and there was a big, basically algo spike, and it paired declines, and it's back where it was. Right? It probably is a sell the news kind of moment. There had been reports that about 8,000 was what they were looking at, and there's always another side of the story. And so for Meta, the other side of the story is capital expenditures and its commitment to spend into AI. And it was really interesting. I was just on Balance of Power when the story broke. Think about it not just as like a capital expenditure figure for 1 year, but Mark Zuckerberg sitting next to President Trump at that dinner last year saying, oh, well, Mr. President, I'm going to spend $600 billion in this country over the next 3 years.
And then later, what did he say in the president's ear that was picked up on the mic?
Yeah.
I wasn't actually expecting to say that.
Yeah, and you know, he's not alone. They kind of went around the table, right?
Yeah.
But that's the story. And so, you know, if you're going to commit to spend on physical things, infrastructure, something's got to give, and it's on headcount where they focus that.
Wait, is that what is more physical infrastructure than those incredibly expensive poaches that they made when it comes to AI, those 10, 20, $30 million salaries we're talking about?
One thing I would say, I'm not an accountant, nor am I a forensic accounting journalist, but remember that stock comp comes into play big time. So what Tim's talking about is Meta hired really competitively to build the superintelligence team. And part of that, you know, we're talking about pay packages that are in the hundreds of millions of dollars, which sounds crazy when you say it out loud. A lot of that is related to stock-based compensation. Yes, we're talking about physical things. You know, Meta is not a cloud computing company, but it is at hyperscale in that it operates its own data centers, and it is heavily committed to buying the latest chips and building more of them to train AI models and then run AI workloads.
I mean, at this point, you are judged, it feels like, as certainly a hyperscaler, one of these big tech companies, that you are all in doing the right things with AI. That seems to be the play that everybody wants to see you doing. We'll see what the payoff is ultimately, right? But at some point, too, as a publicly held entity, Meta, Mark Zuckerberg, they've got to manage costs.
Well, you're also damned if you do, damned if you don't.
Yes.
So Meta is down right now. It has just, Bloomberg's reported, sent a memo to all its staff saying it's cutting 10% of jobs. And Bloomberg's headline is, in push for efficiency. I remember 2023 when Mark Zuckerberg declared the year of efficiency.
Yeah.
And the story then was Wall Street punishing Meta or Facebook for all the cash it was burning through in its Reality Labs division. They were saying, stop losing money and do things more profitably and efficiently across the business in aggregate. It's kind of a similar story now where the market's like, we want you to spend a lot on AI, but we don't want you to do it irresponsibly, you know?
Yeah, but they've given up completely on the metaverse, I think it's fair to say.
So the metaverse, I mean, we don't have enough time to get into the history of the metaverse, but basically through virtual and augmented reality headsets, the metaverse was a digital world we were all going to hang out in, and that's not a priority anymore.
No, but hey, I do want to touch on it's related to Meta's identity as a company, and this is a company known for WhatsApp, Facebook, the Blue app, and of course Instagram and more.
Yeah.
But it's an advertising company.
Yes.
And that's where it makes money. And that's where it still makes money.
Yes.
Is that what the AI investments are about? Is it getting the ads that show up in my Instagram feed that much more targeted to me? And
Super
that much
smart
better?
question. I mean, what most people probably underappreciate is that a lot of the work Meta is doing in AI is for its own internal use.
Yeah.
So, for example, we did a big story a few weeks ago on its in-house chips. They are called the MTIA program, Meta Training Inference Accelerators. One of the uses of those is to train the algorithm that decides where an ad places specific to you in your timeline. Now, that impacts how much money they make from you as a user. So, like, that's an example. Also important to note that, like, internally, there are loads of different teams, right? They all fight each other for compute, because they will say, look at the project I'm doing. I need access to the servers to run my AI. And another team would argue the same. That's a big part of this story. They're not selling that AI to the general population.
Big difference from some of the other companies that are out there.
Well, quite. You know, if you accept that Meta is a developer of leading AI models, OpenAI is another leading developer of AI models. It sells that model either through a subscription or through an enterprise agreement. We call it ChatGPT, but there are other, more enterprise-specific variants and access points than that. Meta doesn't do that. It still makes bread and butter from ads. Yeah.
But you hate to be that employee who has to go because you're not part of the efficiency. I'm just saying.
Yeah.
Like, you know, there's people
and
involved.
that's 1 out of 10.
Yeah.
We only have a little bit of time, like 30 seconds for Tesla. That's where we were planning to start with you before the Meta
no
news.
worries.
Shares down 3.5%, 20 billion to 25 billion. That's why.
Tesla's going to spend
$5 billion?
No, $25 billion in capex is a monster number for Tesla.
But it was 20. What's $5 billion more?
Because they got to spend even more,
Okay.
spend money to prove they're actually doing the AI projects, Robotaxi and Optimus. That's as simple as
But
that.
you called it. You said when we talked,
Yeah.
as the earnings came out, you're like, I want to know what's it going to do the robots, to do all of this stuff. It's expensive, the build out.
Yeah, it wasn't in the deck. It was only
wasn't
on the
in the
call.
deck,
And
right.
so Elon's warning very quick is expect this to last for many years in a multi-year investment cycle, spend money, burn cash.
Is he right?
AI.
You got to spend, right, to make money.
Yes.
It just depends if it's going to be too much and whether or not the money comes back. All right, Ed Ludlow, thank you so much. We really don't want you to go back to the West Coast, but
No, he's going to come back here before he goes back to the West Coast. 4 o'clock.
We've got more with you.
Yes,
It's on your
I
calendar.
believe so. Yeah.
Okay, it's on your
We're
calendar.
actually going to do,
All right.
we're going to talk Intel, we're going to talk a deep dive
Don't
into
say
the
goodbye
business of
yet.
space, so I'm not going to say goodbye, not yet.
No, see you later.
All right. Let's get a read on the markets that we earlier seemed to be treading water, but now we know we've got a lot more pressure. Right now you've got 34 points lower on the S&P, down about 0.5%, down 0.5%, 150 points to the downside on the NASDAQ 100. We have come off well off our lows here, but we know what's going on here.
Yeah, we want to bring in the head of macro at the active investment manager operating across Europe, Asia, and North America, Lombard Odier Investment. Florian Elpo back with us, joining us today from Geneva, where it's late into the evening after 8 o'clock, so we appreciate you taking the time. Florian, the headline that we got that moved markets here in the U.S. and moved oil too was about Tehran activating its defense systems and explosions being heard. This is coming from Tehran, we should note, and from Newswire in Tehran. But I'm curious from you about the macroeconomic backdrop of a war that doesn't seem to, where the ceasefire is holding, at least right now.
Sure. Hi, Tim. I'm Carol. Thanks for having me again. I think it's important to start from the big disagreement, which we can see from markets at the moment. The oil market is saying risk when the equity market is saying risk on and go with the flow. So there's this disagreement going on. The crisis we're confronted in the Strait of Hormuz has this particularity that the longer it lasts, the higher the leverage, basically, Iran have on the U.S., and that leverage is called inflation, meaning it's not war itself, it's just a negative impact of this overall situation. So our own estimates are very simple. What they're saying is that if you stay where we are at the moment for a period of 3 months, you're supposed to be eating about, let's say, 5 to 15% of your earnings growth, which is not huge, but still significant enough to let investors rethink their exposure to the market at this point in time in the here and now.
Say that again. You said eating 5% of what? I'm sorry, just if you could reiterate that.
No worries. 5 to 10% of earnings growth, which is pretty much what's animating market at the moment, right? It was all about the earnings season until now. And this earnings season was coming with the good news of expanding earnings, a strong earnings growth. And that was the best moments for the stock market to rally on the back of that. Now, well, basically, we're still confronted with the temptation of taking profit because this inflation shock creates potentially a negative earnings shock.
You know, Florian, something we talked about yesterday.
Yeah, so glad you're going there.
Right, this new normal that our team wrote about, Bloomberg Economics, but basically no peace, no war. The new normal in the relationship between the United States and Iran. Is that what we're moving towards in your view? And is that going to be stable enough for investors, for CEOs, for heads of institutions and organizations to make decisions and move forward, and for global economic growth?
It's a very broad question. I'm going to answer from the investment perspective, basically. I think this new normal makes a very strong difference between stocks which have a business model which is cyclical and stocks which have a business model which will monetize in a few years with, a longer term investment horizon. Of course, when I'm saying that, I'm opposing value to growth. I'm opposing Europe to US. essentially, and with the emerging world in the midst, in the middle of the situation. So this new status quo basically is a call for investors to rethink the way they access equity market, and maybe growth is exactly the place where you want to be at this point in time, because growth is a kind of style that looks through short to medium term issues, which is pretty much what we're confronted with.
But growth everywhere, or just growth in the U.S.? Because one thing that we have spent a lot of time talking about is the different way this energy shock is being dealt with by U.S. companies versus by companies in Asia, for example, by companies in Europe, for example. So what's your view there?
Intuitive call, of course, is diversify. The one thing I would look at is what's called PEG, so the price earning to earnings growth ratio, so that to assess whether the valuation of your stocks is still outpaced by the growth rate of your earnings. And that's pretty much what's happening in the US at the moment. That's why the S&P these days is on a roll, because basically the earnings growth we're getting from this Q1 season is showing such a growth rate, a surprisingly high growth rate, that it outpaces the expensiveness of the overall index. That expensiveness is weaker in the emerging world, but still attractive. So let's say a combination between the two is potentially one way to say through those waters.
So, Florian, the AI revolution is a revolution, in your view, that needs to be treated as such. And I'm curious those are your words, what that means. What do you mean treated? And I do also wonder, does that revolution continue even if this war continues, or some kind of stalemate, uneasy stalemate continues between the U.S. and Iran?
Of course, we're confronted with a technical revolution. And we've been there before. Simply the one technological revolutions we've seen in the past have come with a slow adoption rate until the internet revolution. So basically, if you go back into the 19th century and you look at the performance of US equities during the railway building, the electrification of the United States, the decades of that change was actually coming with negative stock returns, which is not good news, right? Actually, like a century ago, investors were fearing technological change. Now we're embracing it. And the difference between these two situations is adoption. The adoption rate of the current revolution is actually quite fast. It's quite fast for a reason, because let's say our demography calls for that change. We have a slowing growth, of our population globally, and that slowing growth is actually one of the remedies is the tech change we're currently experiencing.
All I hope is that artificial intelligence does shopping, because my understanding is the consumer is pretty important to certainly the U.S. economy. All right, we got to leave it there. Florian, thank you so much. Florian Ielpo, he's the head of macro at Lombard ODA Investment. I think about that.
Yeah.
Does AI shop?
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all very much in the red. We are, however, off session lows. Now, you got to keep in mind that moments ago we did have the S&P down as much as 91 points, down now by 33. Have been down as much as 1.3%. Right now, that is down to a 0.5% loss on the S&P. Dow Industrials down 0.4%, lower by 220. NASDAQ Composite Index down 232 for NASDAQ, a drop right now of just about 0.9%. All of this with the VIX at 19, the 10-year 4.31%, 2-year yield 3.81%. Spot gold is down 0.6%, 47.12 the ounce, while West Texas Intermediate crude oil up 3.2%, 95.84 a barrel. A flare-up in tensions over the Strait of Hormuz has sent stocks lower. Oil is rising on concern that a prolonged closure of the waterway could worsen energy disruptions. Briefly, sources tell Bloomberg Microsoft is offering voluntary retirement to thousands of its employees in the U.S. Meta Platforms, meanwhile, telling staff it will be cutting 10% of jobs in a push for efficiency. Recapping, Dow, S&P, NASDAQ, all very much in the red. Right now, we got the S&P down by 0.5%. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
Appreciate that. Charlie Pellet there. Well, we're watching two different sectors today. We're going to get to real estate in just a moment, but we're also keeping a close watch on cannabis stocks. Advisor Shares Plus U.S. Cannabis ETF, Amplify Alternative Harvest ETF, Tilray, Aurora Cannabis, Kronos, Canopy Growth, Cureleaf Holdings. I mean, these are on our radar. Shares of these cannabis companies and ETFs, some getting a bit of a reset, dropping back today after soaring in yesterday's session, and that was on expectations that the Justice Department and DEA would move certain marijuana products to the less strictly controlled Schedule 3, which is reserved for drugs with accepted medical uses and lower abuse potential. Well, that happened, Tim, earlier today.
We're here to talk about the move and what, if anything, it changes for these companies. We've got the CEO, chairman, and co-founder of one of them. Boris Johnson is joining us. He is chairman, CEO, and co-founder of Cureleaf Holdings. He joins us from Europe. Boris, good to have you on the program. So what does it mean that the Justice Department and DEA removes certain marijuana products or moves them to the less strictly controlled Schedule 3? What does that do for your company?
Well, Tim, first I want to correct, I'm not Boris Johnson, Boris Jordan.
Boris Jordan, excuse me.
A much more important person.
I apologize. Thank you for that. Boris Jordan, good to see you.
But no problem, Tim. Listen, this is a monumental move. It's been 55 years since President Nixon, on a political decision, scheduled cannabis as a Schedule 1 drug. It's a product that was used for hundreds and hundreds of years as a wellness product by many, both in Europe and the United States. It wasn't too long that Eli Lilly and other pharmaceutical companies were selling cannabis extracts for medical reasons. So this reclassifies it from a Schedule 1 to a Schedule 3 drug. It has several major impacts. The first impact, of course, is that we will be allowed to do research, working with medical institutions and get federal grants to do that research on the product nationwide. Cureleaf, as the largest operator globally and working in Europe, just finished phase 1 trials on neuropathic medication with cannabis in Europe, in London, in the UK, and moving on to phase 2. We can now bring that to the United States. We couldn't do any of that work in the United States. We have a partnership with the University of Pennsylvania Medical Center, and so we will start doing that work here in the United States. The second aspect of it is that we had a capricious tax on basically a revenue tax on gross margin, which was about 72%. That, it was almost impossible to be a profitable company on that basis. Now that will go away as well. So we'll be taxed and treated as any other corporation in the United States, which will immediately make most of the larger players like Cureleaf very profitable going forward.
All right. So is the job done? Is this all you guys need to kind of move forward?
No, I think that the current rescheduling is being done in 2 steps. The first step was under something called the United Nations Single Convention on Narcotics. That was the first step for medical, because under the UN treaty, you can only reschedule for medical reasons. The second will be a ALJ hearing. Was a process started under President Biden, which was halted at the beginning of the Trump presidency, and that will now be restarted on June 29th. That will address the issue of adult use cannabis, rescheduling those products as well. Once that happens, what we expect to happen in the third quarter, then for the most part, I would say this was the first step. Now we need to start working with the federal government on banking, on uplisting to major exchanges in the United States.
Okay.
And so there will be a lot more work to be done.
So that's what I want to talk to you about is the banking side of this and what it changes for banks that are, if anything, does it change anything for banks? Or is the next step that there is something from the federal government that allows banks to do business in this industry?
So using the proverbial, broke the glass ceiling, this breaks the glass ceiling. Right?
Okay.
This is the first piece of federal legislation that we've seen since 20 years ago when Rohrabacher-Farr was passed, protecting medical cannabis companies in the states. Now you have the rescheduling of cannabis. I believe that you're going to see action from the Treasury. We know that both Janet Yellen and I believe Scott Bessent have both said they want major banking institutions to bank the cannabis sector. They also want to see these companies on U.S. exchanges. And that will be a part of the process. That may need some legislation from Congress, but also because of the fact that we will be applying for DEA licenses, that will make us federally legal as medical companies now. That will most likely give us the ability to at least apply for uplisting on the U.S. exchanges. Credit cards, I think, are going to be a big deal, which will increase business dramatically. So all of these things, I think, are on the horizon going forward.
Hey, Boris, but at the end of the day, if the Democrats take the House in November, do you think a future Congress can get along with President Trump to bring recreational changes?
I think that we're not going to see a lot of recreational changes. I think the next step is going to be the whole financial services aspect of the business. So we've now rescheduled, and now we'll see recreational. I believe that to legalize this recreationally nationally at a federal level, we need to do the work, right? That's why they're rescheduling from Schedule 1 to Schedule 3. We need to do the work with the medical institutions in the countries to work on all of the aspects of the plant, to make sure the plant is safe. We know it's safe, but we need to have evidence now because in Europe it's been proven, in Israel and other places, that this is a plant that has a lot of wellness aspects to it. We now need to do that in the United States. I think that will take 2 to 3 years. So I more than likely suspect that full legalization will probably happen in the next administration. Not that Trump doesn't want to do it, but I believe just the steps that need to be taken are going to take 2 to 3 more years.
Who's ever in the White House, who's ever in Congress in the next administration, you think it'll still go through?
Yes, I think we're past the point where cannabis was, stigmatized the way it was. The Democrats, as we know, this polls at almost 80% in the country for legalization. Amongst Republicans, it's 59, 60%. Amongst the whole country, it's almost 80%. So I pretty much feel that this is going to happen, but it'll probably happen in 2 to 3 years on full legalization. But this is a major step forward.
Boris, you mentioned the idea of moving from stock exchanges outside of the United States to the United States. Would you do that at Curaleaf?
Yeah, Curaleaf today is the only major cannabis company, global cannabis company that trades on the TSX in Canada, which is a major exchange in Canada, but still we don't trade on the NASDAQ. I do believe that this will, over the next couple of years, will more than likely allow us to uplist to U.S. exchanges.
Hey, what do you think happens in terms of the industry? So many times you start to see some consolidation of, very smaller companies tying up together. Do you think that ultimately this is going to spur M&A activity? The idea being that if more companies are getting the 280E tax relief, does it make it more attractive, Boris, for the larger players to come in and buy up some of those smaller companies?
Absolutely. I think you're going to see a tremendous amount of consolidation going in the second half of 26 and 27. This decision brings down the cost of capital. It will increase capitalizations, even though we're seeing a correction today. I think it's a misunderstanding of the whole process. People are trying to digest it. But I do think it's going to widen the investor pool that can invest in the sector. I think you're going to see more and more money coming into it, a reevaluation of these companies. And on the back of that, you are going to see consolidation. This is a scale business. We need to consolidate these companies and create scale.
What does it mean for Curaleaf? So are you already taking calls, thinking about strategizing, like who you might want to tie up with?
I mean, Curaleaf's already the largest global player. We are definitely going to be acting on that consolidation. We are in talks with numerous, both regional as well as larger companies. We are talks in Europe. We're talks in the United States. We've been having them for a while because we knew this was coming. It was just a matter of when it was going to come. It has now happened. I think it creates certainty in the market from a balance sheet and cash flow perspective for these companies. So now I think it'll be a lot easier to make these transactions happen.
All right. Stock was up 26% yesterday. It's down about 22% today. Is it just a case that this is going to still take time?
I think, yes. You have to understand that the cannabis sector today does not have virtually no institutional money. This is largely algorithms and retail investors trading in and out of these stocks. as we start to see large institutional investors come back into the sector, those that were there, for instance, when Curaleaf went public in 2018, we had BlackRock, we had Fidelity, we had all of these players in the IPO. Then they all had to exit because Jeff Sessions removed the Cole memo, which made it uncertain to invest in the sector. As those investors reacquaint on the back of this decision with the sector and they get permission to invest, I think you're going to see a dramatic reevaluation in these stocks. I think this is a massive buying opportunity. And if we weren't in the middle of a blackout period, I can tell you we have a buyback program, we would be doing it.
Okay, well, you got to come back when you're not in the middle of the blackout. Speaking of buying, Boris Jordan, I want to go back to what you said about M&A and the discussions that you're having with companies all over the world and here in the United States too. Push deeper for us with that, and like what kind of companies? I know you probably can't say the names of the companies, but like what specific types of company is attractive to you right now?
I think, given the current regulation, I think we're looking at both retail, which is very unusual right now. We're looking at retail. 65% of our business is sold online. However, we still have to deliver the product from our delivery point. So think about Amazon and Whole Foods. Very similar model where they both come into the store, but mainly come in just to pick up what they bought online. And about 30% will actually buy in the store. So we're looking for retail distribution points to continue to distribute these products throughout the country. So we're looking at tuck-in acquisitions in the various states around the country now. And also we're looking at large-scale companies because a lot of these companies, because of historic state regulations, couldn't combine because they had limitations. Most of those limitations are gone now. And the scale, we want to build scale and get cost savings from that scale. And we can do that today because the transactions couldn't happen until this day because there was too much uncertainty around the balance sheets because of the tax accruals. Now that that uncertainty has gone away, now that these companies will be largely significantly cash flow positive and profitable, it makes it much easier to do the transactions.
All right, good stuff. As always, really great to check in with you once again. Boris Jordan, not Boris Johnson. Boris Jordan.
Oh, thanks for reminding me. Thanks for that.
I can laugh.
Although he was a prime minister of England, so I don't.
And mayor of London, yes.
It's a good comparison.
And mayor of London and the head of the Spectator, editor-in-chief. So.
Yes, people forget about his journalist past. But Boris Jordan, we'll never forget about you.
That voice you're hearing is Boris Jordan. He's Chairman, CEO, and co-founder of the $2.4 billion market cap company Curaleaf Holdings. All right, let's get to another sector on our radar.
And that is commercial real estate. The more than $42 billion real estate services provider, CBRE Group, reported its quarterly results this morning. The company's revenue for their first quarter beat the average analyst estimate, boosted its core earnings forecast for the full year. Bloomberg TV Markets correspondent Norma Melinda caught up today with the chairman and CEO of CBRE, Bob Salentic.
We have about $155 billion of assets under management. We access considerable capital from the Middle East. We've downgraded our capital raising goals for the year by only less than 10% as a result of what's going on, because what we're already seeing is the capital sources in the Middle East regrouping and putting new plans in place to invest in the United States and other parts of the world. So that's going to have a little impact on our business, not much.
What do you expect that to be? What?
Less than 10%.
Okay.
Yeah, less. And by the way, we haven't really downgraded our expectations for earnings in that business, just some of the capital raising in that part of the business. If you look at the rest of our business, there's no part of the rest of our business where we earn as much as 5% of our profits, so it's not a real concern. Of course, what is a concern to all of us, real estate, critical infrastructure, data centers aside, is if what goes on there results in prices for energy going up to the point where we might have a recession, then of course we all got to pay attention to that.
Well, coming back to the U.S., I also want to talk about the tax environment. We know big cities like New York City have really been in focus. Are you at all seeing any particular business shift toward lower tax, faster growing markets like the Sun Belt in particular with your business?
You know, our business, as you probably would expect in Texas and Florida, is quite strong in both those markets. We've seen a lot. Texas, we've seen tremendous growth. We've seen also considerable growth in Florida, and I think some of that is tax driven. But our biggest profit market in the world is the one we're sitting in here today, New York City, and we had a spectacular first quarter in New York City.
So you're not expecting any particular pullback or potential bearishness when people think about the New York City tax environment?
We aren't. I'll tell you one thing we talk about all the time is we have also a very big business in London and a very big business in Tokyo. And over the last couple decades, there's been the coming and going about, oh, is London dead? Is New York dead? Is it dying? Is Tokyo dying? All three of those markets are so big and so diverse and such a magnet for people and companies and so forth. They're all doing extremely well now, and we're bullish about the long-term prospects for New York and the others as well.
Well, speaking about the long-term outlook as we wrap, I want to understand, what are you optimistic about over the next 12, maybe 18 months, and what potentially keeps you up at night?
Yeah. I'm generally optimistic about our business in a broad-based sense.
And that is Bloomberg TV markets correspondent Nora Melinda, who is here around the table with us in the studio. She, of course, caught up, as you saw and heard, with the chairman and CEO of CBRE, Bob Sulentic. Hey, Nora, good to have you here. Real estate, as you know, so sensitive to rate, interest rate, and economic cycles. In general, they are a real estate servicing company. When you sat down to talk to them, what was it that you wanted to kind of really get to?
Well, as you mentioned, they are real estate services companies. They made it pretty clear that they don't like to necessarily be classified with the REITs, which we know tend to pay dividends. This is not necessarily a dividend-paying business when you think about CBRE. Also, CBRE tends to be known as a brokerage company, but they've really been, I'll say, maybe de-emphasizing that aspect of the business in terms of its exposure, and they really are leaning a lot more into critical infrastructure, leaning into data centers. If you flash back to 2021, they only had about 3% of their profit was focused on critical infrastructure and data centers. Now it's up at 14% as of 2025. So you're really seeing them trying to lean into that specifically. And we did get to catch up, of course, as to what's been going on in the headlines, Middle East, also what's going on here in New York.
Yeah, let's talk about the Middle East a little bit, and then we'll get to New York. In terms of the Middle East, what is the company's exposure to that part of the world when it comes to I don't know, when it comes to it, not just its assets, but where the revenue comes from.
Right, and that's what I really wanted to get to, because they do have exposure in the Middle East, Abu Dhabi, other areas in the region, and we do know, given the fact that we're in the situation with the conflict in the Middle East, that's something I'd like to know in terms of whether or not investors are potentially wanting to stay more domestic, as opposed to doing some of that cross-border different agreements and partnerships. He essentially said that they downgraded their capital raising goals by less than 10%. He doesn't really see it to be a large impact on their business in the Middle East. Seems as though it's overwhelmingly stable. That's what I took away from that conversation with him.
Okay. Yeah, what about deal making and capital flows? It's always interesting to see in different rate environments and market cycles what they're seeing along those lines.
Absolutely. I mean, we talked a lot about New York City. He talked about this being actually...
Not running away?
Right, not running away, actually leaning in. He talked about the fact that this, when you look at their metrics, New York City, the infrastructure here actually accounted for a lot of their gains in the last quarter. So we've heard this story over and over again about the flight from New York City, the flight from San Francisco, all these big cities. You know, London is dead, Tokyo is dead, New York City's dead, is what he was saying. And he's saying that actually, if you look at the fundamentals, if you look at their stats, it's actually a lot better here in New York City than what's actually being painted broad-based across the industry.
I mean, I like the sound of that, but
yeah.
but is there, you know, does he have the evidence to back that up right now? Because what we've heard from a lot of our guests is not all of these buildings are created equal. And
absolutely.
Class A is doing really well.
Yep.
But then you have a lot of laggards, and vacancies are in those places.
Right.
And then there's also the AI question, of course.
Absolutely, the
exactly.
AI scare. And we spoke about that because, of course, CBRE is one of the real estate services companies that was caught up in that February sell-off, the broad-based sell-off where everyone felt as though maybe artificial intelligence could make some of these industries obsolete. So, you know, as I mentioned before, they don't really like to focus as much on the brokerage side of the business, but that is also an investor concern as to whether or not artificial intelligence could potentially, you know, present a threat to their business model.
All right, really interesting stuff. Great interview, really important company. And if you missed any of it, the full interview you can probably find on the Bloomberg and at Bloomberg.com. So be sure to check it out. Bloomberg TV markets correspondent Norma Linda, who caught up with the chairman and CEO of CBRE, Bob Sulentic.
Hey, when we come back in just a moment, about half of women and 20% of men over 50, they break a bone because of osteoporosis, yet many people with the condition do not get treated.
Yeah, we're going to dig into that story, a reality as we all get older. We'll get to that when we come back. First up, though, a check on the markets once again. We're definitely off our worst levels of the session, Charlie Pellet.
Indeed, and let me put that all in context, put some numbers on it, Carol Master. At the worst level of the day, we did have the S&P 500 index down 1.3%, down 91. Right right now. Going to the numbers, S&P stands at 7112, lower now by just about 25 points. That is a drop of 0.4%. Dow Industrials down 178, a decline right now of 0.4%. NASDAQ down 195 for NASDAQ, a drop there of 1.8%. A flare-up in tensions over the Strait of Hormuz, sending stocks lower. Oil is rising on concern that a prolonged closure of the waterway could worsen energy disruptions. The VIX just above 19 right now, with a 10-year that's currently yielding 4.31%. Spot gold down $27 the ounce, down 0.6%. Crude 96.01 a barrel, talking WTI up 3.3%. Brent 105.22 up by 3.2%. Briefly after earnings, Tesla down 3.3%. After earnings, Texas Instruments up 18%. Intel reports after the bell up now by 3.5%. And that, my friends, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. That, of course, is Charlie Pellet with an update on the trade. We'll head back to Charlie in just a moment. Tim mentioned this. I'm going to go back there. About half of women and 20% of men over 50 break a bone because of osteoporosis. Yet many people with the condition don't get treated. But late last year, we did see the Food and Drug Administration making an important policy change that is expected to spark new interest in treating the common bone disease.
So instead of waiting years to see whether clinical trial participants experience fewer fractures, drug makers can now measure whether their medicine increases bone mineral density. It'll make clinical trials much shorter and cheaper, but it's expected to entice more biotech companies to pursue new drugs and investors to back them.
And it'll be interesting about the differences men versus women, because we know we've talked about that a lot in this segment. Let's get to it. It's time for the Business Week Women's Health segment. We focus on key issues in developing technologies impacting the present and future of women's health around the world. Delighted to have with us Dr. Doug Lucas. He's an orthopedic surgeon, osteoporosis specialist at the telehealth platform LifeMD, joining us here in studio. Welcome, welcome.
Thank you. Happy to be here.
It's good to have you here. I don't think we talk about it a lot, but I think we should. Tell us about this condition and why you chose to focus on it, especially when it comes to health, bone health in women.
First of all, thank you for letting me talk about it, because you're right, we don't talk about it enough. Osteoporosis, as you mentioned, has a very high morbidity rate, meaning the problems that come along with fracture is very high, meaning you could potentially die after a fracture. A third of women and men after a fracture will actually pass away within 12 months. The loss of...
Why is that?
So,
because you sound like people get fractures and they deal with it. Why?
So a lot of it has to do with who is actually having fractures. Some of these patients are older, they're very frail to begin with, but we're actually seeing fractures younger and younger too. And so while the mortality, the death rate is very high and alarming, it's actually the loss of independence that I think is more important. And not that death isn't important, but we see so many women especially lose independence much earlier in life than we would anticipate, and it catches them off guard because we're not talking about it and we're not screening.
Well, I feel like orthopedic surgeons, you often see an orthopedic surgeon for the first time when you've already had an injury. Right. You know, you're going in because you need something fixed, and that doesn't sound like we're prepping in the right way or avoiding this in the right way. So what should we be understanding? What should we be talking about? What should we be doing to actually prevent having to go see you?
So there's two huge things here. No, it's fine. I actually don't operate anymore because I actually am now in the game of prevention. I want to educate, I want to prevent. And so there's two main things to think about here. One is screening. So screening earlier. Right now, the recommendations from some of the governing bodies like the USPSTF, United States Preventive Services Task Force, recommend screening for women at 65 and men for 70 if they have risk factors.
That seems old.
It is way too late. And I understand they do it because of the statistics, and I get it. But we should be screening, especially women through midlife, perimenopause, and menopause, because that is the opportune time to intervene, especially when we talk about hormone therapy.
Well, let's go there, because I feel like in the last year or so, we've had a whole kind of enlightenment about some of the research that's been done when it comes to women and hormonal therapy. So what have we learned, and what do we need to know now going forward?
Well, this is a really fun space for me to talk about, because this is where we get to talk about hormones in a different light. For the last 20 plus years, we've been living in this sort of fear, use as little hormone as possible, only treating symptoms. Those are what the guidelines actually still say, for the most part, is treat symptoms of menopause. But when you look at hormones through the lens of bone health, we have the opportunity to start saying, wait a minute, the lowest dose that treats your symptoms might not actually be enough to treat your bones, to prevent bone loss. And yet, estrogen, is FDA approved for the prevention of osteoporosis. But if we're not measuring it, then we don't actually know that it's doing what we want it to do. And this is where we have to get into a new space of hormone optimization rather than just hormone replacement or menopausal hormone therapy.
What happens to people who missed that window? I think about, this is where, okay, every day we're learning how to treat various ailments across the spectrum, if you will. So what happens for those who've missed out? And obviously we're getting enlightened about for the next generation, if you will.
Sure. There's a lot of opportunity to talk to different groups of women here. For the women that went through menopause over the last 20 plus years, many of them are traditionally, quote unquote, beyond the window of opportunity, which is within 10 years from menopause, right? I talk to a lot of these women in their 60s and 70s every day, and they are angry that they didn't have that conversation, that opportunity was robbed from them. But at the same time, the research actually supports there is opportunity for some of these women, especially the women 10 to 20 years from menopause. So this is most women in their 60s. It's not necessarily too late. We just need to take individual risk factors into consideration. A lot of doctors, unfortunately, are still treating as if any time after 10 years out from menopause is too late.
That's what I feel like. As a woman, as the mother of a daughter, it is fascinating to see I have a 23-year-old daughter, going into various medical offices and how they're treated, how we're treated. It's not always so ideal in terms of being open to what you say about yourself or the questioning of, well, maybe that's, not kind of really thinking about the diagnosis and maybe pursuing what's wrong.
I think you're saying it nicely.
I'm trying to be careful here, but you know what I'm saying.
Absolutely. No, absolutely. It's really,
why is that still?
Well, I think there's a lot of reasons. I think for most of modern medical history, we have not treated women as individual, women are different than men.
Yeah.
The sexes are different. Women have different needs than men's. And the research shows that. Research has mostly been done on men until very recently. There's very little funding for women in medical research, even currently.
Amazing.
And so doctors, I think for the most part, mean well. They want to treat their patients, but a lot of times they don't actually have the tools they need or the knowledge they need to treat a woman as a woman, which is really unfortunate. On top of that, there is this underlying just paternalistic nature of physicians that when it comes to women, we tend to tell them what to do versus when it comes to men, we tend to educate them on the risks and let them decide.
Is this being taught in med school these days at all?
Which part?
Like what you just mentioned, like what we've tended to do and what physicians have tended to do. and ways to avoid that bias when it comes to treatment.
Not in my medical school training. No, we do learn from our mentors, though, right?
Yeah.
So these are how things get passed along from generation to generation in medicine. This is how these biases get passed down.
Real quickly, got about 40 seconds. I'm going to go 3 things. Calcium and vitamin D, important?
Yes, but it's just one part of the bigger picture.
Doing weights.
Absolutely important.
What's the other part of the picture that people should be thinking about here?
Get screened early, optimize hormones, resistance training, and impact if you can do it. That's the recipe. And food. Gotta
Peptides?
eat a whole food diet.
Peptides?
That's a longer conversation. The answer is maybe. There's a lot of research coming, though.
Okay. Will you come back?
Absolutely.
All right, that would be great. So appreciate it. That, of course, is Dr. Doug Lucas, orthopedic surgeon, osteoporosis specialist. Say that 5 times fast. At the telehealth platform, it is, of course, Life MD.
When we come back, we are talking stocks on a move on a day when we are seeing stocks lower today. The S&P 500 off of session lows, but still down 0.5%.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.